to make additional disclosures to the 50,000 crore in equity AUM in India versus the earlier 25,000 crore. SEBI will no longer prescribe a cooling off period for the public interest directors transitioning from one market infrastructure institution to the another, but existing process for the appointment of PIDs will remain unchanged. Other than that, the other important change is that the registered investment advisors can collect up to 1 year's fee in advance and reversing the previous 3 months limit that they had. The market regulator has also decided now to form a high-level committee to look at the rules governing to conflict of interest and related matters that are pertaining to the SEBI board members as well. And lastly, the SEBI chief is signaling review of NSE's IPO proposal, and here is what he had to say on that front.
But surely I think we'll look into it. I've just, we'll apply our mind on how is it and how we can take it forward and what's the issues.
Now let's move on, and the Indian government has proposed to end the 6% equalization levy on online advertising in the finance bill. Now the bill was moved in the parliament, and the move is to remove this equalization levy and will benefit global tech giants like Google, Meta, and Timsy is joining in with us to give us more updates on this front. What are the details of this as well, and the proposed amendments? Timsy, take us through those amendments.
Well, as you rightly said, Centre has moved amendments to the Finance Bill 2025, and as per the amendments, the proposal is to remove the 6% equalization levy under the direct taxes, which were being charged on online services, primarily online advertising. Remember, this is popularly known as Google tax, which was introduced in 2016, and now as per the proposals, it implies that the 6% levy which was being charged to the consumers of online advertising will now be removed completely if the proposal gets the Parliament approval. Reduction in this tax burden is actually going to benefit sales of advertising space, especially by online giants such as Google and Meta. And just to remind our viewers again, this is equalization levy which was introduced in 2016, and since then US has been opposing this decision of India, seeking a complete reversal of the levy. Experts claim that this move is part of India's piecemeal duty reduction commitment to the US post the recent bilateral talks. Now, what is to be seen is how do these global giants, especially Google and Meta, react to this move, and also what is the impact on India and US trade relationships. Back to you.
Thank you so much for that, Timsy. On that note, we'll slip into a very short break. Up next, we'll get you the cues in the world of commodities after the break.
Drivers are demanding higher base fares to cover rising costs, lower platform commissions and government regulations to ensure fair pay. The union is also pushing for a Telangana gig workers' rights bill, and if their concerns aren't addressed, they plan to escalate the protests nationwide. While Hyderabad's campaign is making headlines, this isn't new. It has been happening in Hyderabad and even Bengaluru. Drivers in Bengaluru have unofficially stopped using ACs for more than a year. In 2024, drivers even demanded 5 rupees per kilometer extra for AC rides, but this wasn't officially implemented by ride-hailing apps. Most drivers just simply refuse to switch on the AC unless riders insist, and even then, some decline. Now, as the mercury rises, so have passenger complaints. This begs the bigger debate, which is who pays for the AC. Passengers expect an AC cab, especially in the scorching summer heat. Drivers say they can't afford it unless fares increase. Ola, Uber, Rapido haven't provided a clear solution. No pricing model for AC usage, no opt-in feature either. So should drivers absorb the cost or should riders pay extra? Let us know what you think in the comments below. There doesn't seem to be an easy resolution to this tug of war. Perhaps us riders should consider investing in one of those handheld fans for now.
Welcome back to Power Breakfast on CNBC-TV18. Now, getting you the latest on Trump-related developments. We have Dia joining in with us in a special segment, Trump Watch.
In an unexpected turn of events, reports reveal that members of the Trump administration coordinated highly sensitive Yemen war plans through an unsecured group chat, inadvertently including Jeffrey Goldberg, the editor-in-chief of The Atlantic. Goldberg reported on the incident in an article. White House National Security Council spokesman Brian Hughes confirmed the existence of the Signal group chat, validating the account provided by The Atlantic, while the president himself denied knowing that the editor was also part of the group.
I don't know anything about it. I'm not a big fan of The Atlantic. To me, it's a magazine that's going out of business. I think it's not much of a magazine, but I know nothing about it. You're saying that they had what?
They were using Signal to coordinate on sensitive materials and
Having to do with what? Having to do with what? What were they talking about?
with the Houthis.
The Houthis? You mean the attack on the Houthis? Well, it couldn't have been very effective because the attack was very effective. I can tell you that. I don't know anything about it. You're telling me about it for the first time.
Donald Trump reiterated his call for the Federal Reserve to cut interest rates. During a cabinet meeting, Trump once again urged the central bank to lower rates in order to stimulate economic growth, continuing his push for a more accommodative monetary policy. President Trump also expressed confidence that the U.S. and Ukraine will soon sign a revenue-sharing agreement concerning critical minerals. The deal would deepen economic ties, and Trump added that ongoing discussions are also exploring the possibility of American firms owning power plants in Ukraine, further strengthening the U.S.-Ukraine relationship. In another major international development, President Trump has threatened a 25% secondary tariff on any nation purchasing oil and gas from Venezuela. This move escalates the U.S. dispute with Venezuela over immigration issues and could significantly impact the global energy market. Trump confirmed that the tariff will take effect on April 2nd, coinciding with the release of additional tariffs targeting multiple countries. Moving on, Donald Trump willed out plans by Hyundai Motor to invest $20 billion in the U.S. The South Korean automaker moves to boost production in America and avoid its tariff threats. Staying with tariff-related news, reports suggest that the Indian government will seek an exemption from reciprocal tariffs when U.S. officials arrive for trade talks later today. Assistant Trade Representatives Brendan Lynch and a team of officials will be in India from March 25th to 29th for discussions focused on a bilateral trade agreement with India looking for relief from tariffs. That's all for today's updates surrounding President Trump's actions both domestically and globally. Back to you, Vinny.
Thank you so much for that, Dia. But let's move on and get you the latest update in the world of commodities this morning. Manisha is here to give us all those updates. Good morning, Manisha. What are we looking at today? Is it crude, metals, gold? What should we keep an eye out on?
Well, crude for sure, Vinny, because we're looking at a 3-week highs onto this one, and the Brent prices are now trading above $73 a barrel. Well, the U.S. president has announced 25% tariff on any country buying Venezuelan oil. Now, China is a major buyer of oil from Venezuela, and that perhaps is what is impacting the prices. The second point really is about OPEC and allies, which, remember, pump 40% of the world crude oil, and they have been cutting output by 5.8 million barrels per day since 2022. Now, OPEC and allies are meeting on 5th of April, and they could be looking to increase some part of that production from the month of May onwards. So that meeting is going to be important to watch out for. The other thing that is going to be important to watch out is the U.S. PCE data that comes in on Friday. And ahead of that, we have seen the dollar index gain up to a 2-week highs. Now, that is putting pressure on many of the precious metal prices, is the reason you've seen gold and silver prices come off its highs. But what hasn't come off its highs has been the metal prices. So zinc is still trading at around 3-month highs, and copper very close to its all-time highs.
Okay, Manisha, thank you so much for that. Keeping an eye out on crude specifically as well as those metals over there. But on that note, we are absolutely out of time on this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, your Bazaar Morning Call to take you through the market action.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Tuesday morning, you're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. The markets are flying and they're raging and they're doing all kinds of things in a very, very fast-paced manner. Will the gains continue at this pace is the question now, which I think is logical to ask. So now, I think 6 days in a row the market's been up. It's got to be, the longest streak of win, at least in 7 months, if not longer now. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, hi, good morning.
Hi, good morning. Morning, Nigel. Morning, Prashant. I guess no one's going to be questioning it or complaining because we got slammed so hard that this momentum on the way up just has been feeling, I think, very good across the street. But let's not forget, there is a gentleman called Donald Trump out there. Always makes life very interesting.
Well, give and take everything. In January and February, everyone was pointing out that India was underperforming. Guess what? In March, we're outperforming. And that's a point to be noted as well, because after the stark underperformance, there are signs that we have been outperforming. Let's see how long it lasts. But good times for the markets, particularly the broader markets.
The broader markets. And I think last night, US also has rallied hard.
Yes.
So that is another point to note. Let's just sort of start there, right? So 1.7 higher on the S&P, then Nasdaq was up about 2.27%. The story which really moved markets in a big way, which was the underlying driver, was of course the weekend story, which we put out here the morning yesterday, which is the fact that the WSJ and the Bloomberg stories, which said that tariffs could be more targeted and less drastic. And that is, I think, ultimately what really was the tailwind for the market. President Trump reiterated last night that I may give lots of countries breaks on tariffs. And then, of course, he threatened 25% secondary tariffs on nations buying Venezuelan oil and gas. It's just chaos, absolute chaos, a huge amount of uncertainty, lots of questions without even going into, the second order questions. Even at the first glance, we don't know whether what will eventually happen. So, enormous amount of uncertainty. But the fact is that markets will stop reacting in a very sort of dramatic way if you have this news flow day after day after day. The only good thing is that we don't have to wait very long. 2nd of April is here, is just around the corner. I think, next Wednesday is when we will find out what actually comes through. While there is a lot of uncertainty, I think the markets are getting a little tired maybe at the margin with all of the confusion, reprieve, go all in, etc., etc. So we'll find out. In any case, the S&P 500, by the way, in terms of that Venezuelan story, I'll just put that the graphic will come up again. Reuters says that according to Venezuela data from Venezuelan government, India has now become the 3rd largest buyer of Venezuelan oil and gas, oil basically. We'll be reaching out to the ministry. We're talking to oil marketing companies here, and we'll try and understand what this really means. Now, the S&P 500, just to go back to prices, has closed above its 200-day moving average yesterday. So that's sort of a Lakshman Rekha in that sense. The CBOE VIX cooled off almost 10%, back to 17 point something. The 10-year jumped, though, 9 basis points. And, we were back at about 4.34. Dollar index was up. It's been creeping higher. I think about 4 days in a row now. We're about 104.31. Slowly and steadily, it's coming back up. As we are getting closer and closer to the 2nd of April. Tariffs are dollar positive. They are supposed to be dollar positive. They've not been dollar positive. Dollar's gone the other way. But so will some of that start to reverse? Technically as well, maybe there are some indications that perhaps there is a bit of a bounce coming. Oil prices were higher. 73 plus is where Brent oil prices left off at. So which gets us to levels and prices here where we've left off. So 23,600 is a number that we put out last week, Thursday, that the market should head to. Yesterday, we got to 23,600. In 2 days, I didn't think we'll get to it so fast. And we've closed above it. What is the 23,600 level? Is a 38% retracement of the entire fall from the all-time high of 26,277 to the low of 21,964. even after this massive move, there is no signs of tiring or any reversal signals. And by the way, readings, especially on the technical side, at the margin are screaming overbought now with the kind of move that we've had. The next level is the February high on the Nifty, which is 23,807. That is the next number where perhaps there will be a little bit of supply which comes in. Support comes in at the hourly averages, which keep getting pulled higher as the market keeps running up. So 23,387 is the 20 hourly, and then 23,157 is the 40 hourly exponential moving average. But I mean, watch the 20, which is closer to 23,400, about 250, still 250 points away from where we left off. The Nifty Bank, I mean, I think, you know, it's close to rallying 5,000 odd points from the lows. And again, it's done phenomenally well. I mean, here, the 61.8% retracement of the entire fall comes into view, which is 51,883. We left off at 51,704. And once the 51,883 number goes, then we're looking at potentially, I mean, the market opening up to the idea of a new all-time high. Support, like for the Nifty, comes in at the 20 hourly and the 40 hourly. 5715 is the first support, and then 50,172 is the next support, which comes in for the Bank Nifty. Gift Nifty will come up on your screen, gives you a quick sense of how we are likely to start. 70-point gap up once again. I mean, and of course, as the market has shown last few days, it's kind of been, you know, now you get into a bit of a tricky kind of a zone. Because you know, it's been a clean run so far, and now you got some. We don't know if the 2nd of April is going to be a clearing event or it's going to be a risk event, right? So in that sense, I mean, as you get closer and closer into it, and with these gains in the bag, I think it perhaps gets a bit more choppy and not one way like we've had from the rally that we've had from the lows. Surabhi.
Yeah, absolutely, and which is why, I mean, Asian markets are not exactly you know, as bright a shade of green as Wall Street, because many of these markets, including us, we're on the receiving side of a lot of this chatter, plus, of course, the reality that's coming through. For instance, I mean, the Japanese market is holding up quite okay, but look at the Hong Kong market, look at China. Hong Kong's selling off big time right now. It's down 1.6%. I'll get to more of it in just a bit. Before we talk about tariffs and the implications of whatever Trump has said now on Venezuelan oil, Bank of Japan, one of the reasons why the Japanese market is not faltering is that the BOJ minutes are indicating that, yes, there are more rate hikes coming. The members have been fairly concerned about two things primarily. One, that the real rates in Japan are still negative. So that's the point of concern, which is why some of the members are arguing for the need to hike rates again. And second, the concern is on inflation. So this is indicating that this was just a pause that the BOJ was on. They will continue hiking rates. So that's something that's kind of playing out over there. Talking about the whole Venezuela issue, while Prashant, of course, mentioned India, and we are obviously the third largest sort of importer of Venezuelan oil, let's look at some of the other markets as well. China actually is the largest importer of Venezuelan crude, followed by the US. We come in at number 3, and then there is Spain. So these are 4 large economies that are importing a lot of this Venezuelan oil. And if there's, you know, straight 25% blanket tariff, then obviously it becomes a little tricky. So continues muddling the water. So that's what we've got going. So international picture not as clean as yesterday. Let's see how we navigate it as we go forward. Couple of important local developments as well worth taking note of. One, very good news on the FPI front. We've got these flows coming in on a daily basis. Yesterday, what the market regulator has done, this is at the end of the SEBI board meeting, is that it has removed uncertainty, the overhang that started way back in August 2023. That is when the market regulator had issued its infamous August 23 circular, saying that all FPIs which have more than 25,000 crores in terms of total AUM in India, they must make granular disclosure right up to the last beneficial owner, complete see-through in the whole structures. This had unnerved a lot of people. There was a lot of back and forth, and then there was some talk about certain FPIs being exempt. Now the limit itself has been hiked to 50,000, and SEBI reiterated or explained why they've done it, because the market valuation has gone up several times. So they felt that it's the right thing to enhance that limit to 50,000 crores. So it's a blanket sort of, end of uncertainty on a whole range of FPIs. However, the concentration criteria has not been changed, which basically means that if your total AUM is more than 50% is in only one group entity, one Indian listed conglomerate, then you have to make additional disclosures. So overall, it's very good news on the FPI regulatory front. And the numbers kept coming in. Let's move to the fund flow picture. Yesterday, we got another 3,000 crores. Nigel, I completely take your point. The previous day, that 7,000 crores had the index rebalancing. Yesterday, again, we had 3,000 crores coming through. You can argue some of it is coming through a lot of the secondary market action that's picked up, blocks, QIPs, etc. But anyway, it's money that's coming in. Domestic institutions were also on the buy side, about 100 crores. Some news on banks. We'll tell you more details in just a bit. But again, it's good news, largely speaking. RBI has revised the priority sector lending criteria. Essentially, the two big headlines are that it becomes easier for housing sectors to sort of get more loans because the definitions or the limits have been enhanced for housing loans, and also for renewable energy, the definitions have been broadened. So it gets easier for RE entities to perhaps get more loans under the PSL tax. So that's good news coming in. And finally, lots of QIPs, like I was saying, lots of action. And these are the additional companies that are out there in the market to raise capital. We'll tell you more about them individually. But overall, looking good. Good news from RBI, good news from SEBI, and global picture not too bad.
Well, and what was encouraging yesterday is we had a big breakout yesterday, and the rally was led by institutional buying, not by short covering. So that was the big point in yesterday's trading session. After a while, no one-offs, no rebalances, what we saw. We had genuine buying coming in from institutions in the cash market, and that is heartening to see. What about the FIs do, though, on index futures? Well, they added some mild long positions, short positions as well. More longs than shorts in the ratio of close to around 8:1, which is encouraging, though they continue to remain net short with close to around 68% of their positions on the short side. On stock futures, though, there was a bit of a short covering bounce that did play out because the shorts were covered out by close to 9,000 contracts. Longs were added by around 5,000 contracts. A swing factor there of close to around 13,000 contracts. Remember, they have been net long on stock futures itself, but in yesterday's trading session, individual stocks would see a bit of a short covering bounce. The options data comes up for you on the screen, and now those called writers, they are running for cover. You know, the 23,500 call, 23,600 call. Big unwinding is what we saw there. They are packing their bags. They're saying, let's take what we're getting and let's get out of this market, because it seems now the momentum is with the bulls. And at the 23,500 put, we saw aggressive writing in yesterday's trading session, which gives us a couple of those reference points. On the downside, this becomes important support level because at the 23,500 put, there was writing. You also have the 100 DMA that's in this vicinity, so that becomes important on the downside. On the upside, the 200 DMA, that's going to be very, very important. 24,000 mark. This is the line in the sand. The bears will try to protect this level. Very, very important out there. The Nifty Bank, that's the one that's broken out. It's conquered all technical levels, the 20, the 50, the 100, as well as the 200. In terms of a reference point, now the 200 DMA becomes a bit of a support zone. The 100 and the 200 DMA, which it broke out in yesterday's trading session, conquered the 200 DMA as well. So things looking good. Reliance Industries is holding one end up. The Nifty Bank is breaking out. The important point is, will tech join the party? Fundamentally, we had a couple of brokerage notes that came out yesterday that said, maybe it's time for tech to now join the party. And if you look at it, year to date, the tech index actually has been a rank underperformer. It's down close to around 14%, while now the Nifty is giving you positive returns for the year. And if you look at it on the technical aspect, fundamentally, many brokerages believe things are looking good. But on the technical aspect, now the tech index is very, very close to its 20 DMA. So I think, the tech index needs to participate if the markets need to move higher from here on. Stocks that I'm looking at, a couple of stocks because of a technical reason, they come out of the F&O band, Hindustan Copper as well as Polycab. We'll keep an eye out on both these two. Maybe post the recent run, taking some money off the table if you're a trader may not be such a bad idea. Let's see how this goes.
Okay, all right, got that. So maybe a little bit of a pause today, maybe some profit taking, just take your breath to continue. Let's see if that's kind of a day. Well, let's start with the equity call of the morning. Venugopal Gare of Bernstein says that earlier this year, they had turned positive on the headline equity index as against a cautious view in the second half of last year. He says bottoming of domestic macros is central to that thesis. And as it is playing out, it is driving some recovery in equity indices. He says the next step is about navigating the global challenges, among which the risk of a US recession has emerged. He says their analysis suggests that India being a beneficiary of such an event. He adds, with domestic flows still resilient and FII outflows now largely done, they reiterate their positive view on the Nifty index with a year-end target of 26,500.
Mark Matthews is now with us of Bank Julius Baer and Company. Mark, good morning. Good to have you here. Prashant, this side. A rampant confusion about the 2nd April tariffs. Some relief, no relief. Will blanket tariffs, carve-outs, etc., etc. I mean, at some level of obviously, I think it's been a tiring 2 months or so since the inauguration, with at least headline chasing. What's your sense, Mark, as we get closer now to the 2nd of April? Will it be meaningful Will it be everything on day one? Will it be phased in? What's your sense?
Well, Prashant, you're right. It is chasing headlines, which you're right. That's an exhausting thing. I think there's two ways of looking at it. The one way of looking at it is that they're just kicking the can down the road by coming out, every other day, it seems, with little tweaks. So, for example, the most recent one is that there will be flexibility, and a lot of countries will get breaks on the reciprocal tariffs, and some of the sectors will not have tariffs applied to them, like automotive and semiconductors and pharmaceuticals. To me, that's kind of kicking the can down the road, because what we want is certainty, and what we don't like is the uncertainty. So that's the negative way of looking at it. The positive way of looking at it, though, is last month Donald Trump said that, or he heavily hinted is maybe a better way of putting it, that he didn't really mind if the stock market went down, and maybe there could be a recession as a result of all the changes they're doing. It might be that he actually does care, after all, about the impact on the economy and the stock market going down. Because unlike Joe Biden, who was kind of, out of action most of the time in his presidency, Donald Trump is in the media every day, all the time. It's amazing how much he gets around. And so if the market does turn into a bear market, if we do have a recession, absolutely, he will be the one who gets the blame. Like Harry Truman said, the buck stops here. And so it could be one or the other. I don't know which it is. Either, it's sort of kicking the can down the road, or maybe he actually does care more than we think he does about the market and the economy. But on balance, my feeling is that this is a market that is going to churn for a few more months. There has been just far too much uncertainty created, and we're clearly seeing that starting to percolate through into economic data.
Yeah, but given what they've been saying, of course, some of his close aides, including Mr. Besant, caught the market off guard, saying short-term pain is fine and you have to fix the long-term issues like deficit, etc. So the image that they seem to be creating is that they don't care about the market. We'll find out soon enough, Mark. Now, the question is that as, U.S. equities have been faltering, there's a change, obviously, in terms of the flow picture towards India. Do you expect a much bigger, wider move in the Indian market? Right now, we're just recovering from extremely beaten down levels. But do you expect a bigger India rally to build?
It's not just India, by the way. There's about 50 country ETFs listed in the United States, and 35 of them are up so far this year. So most of them are up, and the world, excluding the United States, stock index has returned about 8%. So India is just one of many countries that have actually benefited from this turmoil and people feeling that they don't want to invest in America as much, at least, as they did before. Many people had pretty much 100% of their equity exposure in the U.S. market before. And I think a lot of it is personal. I don't know if you've been reading about all these people who've been taken aside and detained trying to enter the United States, going through immigration, not just people from sort of Central America or South America, but Europeans, Canadians, being swept up into this strange immigration dragnet. And so, if you don't want to visit a country, you probably don't want to invest in it either. And I think that perception is helping the rest of the world. India, I mean, there's pros and cons. The pro is that it is the fastest growing large economy in the world. It will be the third largest economy in the world in a couple of years. So GDP growth in excess of 6%. You don't find many very large economies that have that. That's the pro. And the con is it's expensive. It kind of always has been. But now that it's bounced a little bit, we're back at, around 20 times forward earnings, which is a bit more expensive than the long-term average, actually. The long-term average, if memory serves me right, let's say over the last 20 years, is probably closer to 18 times forward earnings. So on the one hand, you've got great growth. On the other hand, it's not cheap. I don't know. I've always preferred growth over value, and I think that growth deserves a premium. So that's why we're overweight India, and we're sticking with that call. And maybe other people are starting to think that way too.
A valid point, Mark, and good to see you in as always. Mark, what about the dollar index? You know, the perception was that President Trump is going to be very, very good for the U.S. markets and the U.S. economy. Well, in the last couple of months, that's got a little bit derailed. But what's played according to script, like we saw in 2017-18, is that the dollar index, once he took office, we did see weakening out there. And even out here, in this year itself, we've seen the dollar index cool off from around 110 to around 104. How do you see that one moving out? Because from an India market perspective and an emerging market perspective, the dollar index is extremely crucial. Your take?
Absolutely crucial. Well, we've noticed the dollar has broken some very key barriers. It had upward trend channels for the last few years against many of the more cyclical currencies like the Canadian dollar, like the Mexican peso. So it's broken those barriers to the downside. And we generally think that will continue. I mentioned earlier, that a lot of people just don't want to go to the United States right now, and they're not investing as much there. So if the flow of funds is generally in the other direction, of course, that would mean a weaker dollar. And the dollar is very expensive. I mean, if you just measure it fundamentally in terms of trade and forex reserves and GDP growth, that kind of thing, it is pretty much the most overvalued it's been ever because it had been going up for the previous 4 years. So on balance, I would look for softness in the dollar, and that should be good, as you say, Nigel, for the broad emerging market asset class.
All right, Mark, we'll leave it there. Thank you very much for joining us. Appreciate it. And thank you for being here, as always. Well, let's just quickly run you through the interactions which are lined up here over the next 2 hours or so. So you'll hear from Greenply Industries at 8:35, and we talk business with them. How's the industry and the business looking? 9 o'clock, Prabal Sen of ICICI Securities will be with us. We'll talk about City Gas Distribution Company. Stocks were up 4-5% yesterday by close. 9:20, Krishna Sangvi of Mahindra Manulife Investments will join us on markets. NLC India at 9:30, talk about demand trends in the sector. We'll have the management of Titagarh Rail Systems at 9:40 to talk about if there's an improvement in execution and the capex picture from the government. A little later at 9:50, we'll have the management of Electronic Smart India and Retailers Association of India to talk about demand trends and the summer season sales that are picking up. Towards the end of the program, it's the economy. Lata in conversation with the head of Credit Bureau, CRIF, Hi Mark, to check out trends as far as bad loan formation is concerned. Stay tuned.
Well, time to slip into a short break. We've got a lot of stock-specific action lined up for you on the other side in our special Top 10 segment. We're looking at Cholamandalam Investment, Mahindra Finance, Ola Electric, Godrej Properties. There'll be stocks that will be reacting to positive news flow, while we have more stocks reacting to negative news flow. They include ONGC, BPCL, IOC, HPCL, Central Bank of India, and Restaurant Brands Asia. All of them will be lined up for you on the other side. Don't go anywhere.
Welcome back. The setup across Asia is a little more mixed. It's not as wide a green move that we saw on Wall Street. Some of the markets like Hong Kong are down. So it's a mixed picture. Now it's down about 2%. Remember, these are the markets that get hit with a lot of the tariff reality, as we will start to hear it from the 2nd of April. And the Venezuelan issue obviously is bigger for the Chinese market. China is the biggest importer of Venezuelan oil. But anyway, let's talk about individual stocks, and we have plenty to track this morning, and our team is standing by with the CNBC-TV18 list of top stocks to watch. Let's actually go across to Sudarshan. Start with him first, guys. Morning to all of you. Once again, Sudarshan, it's the oil and gas space making headlines.
Good morning, Survi. Yes, so now today it's on the back of US President Trump's announcement that he'll be imposing 25% tariffs on countries that buy Venezuelan oil, and that would be effective April 2. So I'm going with red on ONGC and oil marketing companies. Now, what's the reason? First, for oil marketing companies, one important point that has to be noted down is the most of the imports, Venezuelan oil imports that India did, were in 2023 or in early 2024. So 2024 imports that we did were of 22 million barrels. That formed 1.5% of our total imports. So it's not a big quantum. Now, why is ONGC in focus? It has subsidiary ONGC Videsh. First, it has 2 plants in Venezuela where company was expecting to increase that production. That might be difficult now. And second, ONGC was looking to get $500 million from Venezuela by getting more crude. That also seems to be very unlikely. Now, why oil marketing companies? First, they were not importing that much. But earlier, basically in February, oil minister had commented that India is looking to increase the oil imports from Venezuela, and that might be one of the reasons that we might take negative for OMC. And so, ONGC, oil marketing companies, in the red on the back of this news.
Okay, all right, Sudarshan, thanks a lot for explaining that to us. But let's hop across to Vivek. He's here to tell us about Restaurant Brand Asia and the central bank QIP as well. Morning, Vivek, take it away.
Good morning. That's right. So both of these companies in focus is on the back of QIPs that both of these companies have launched. Restaurant Brand Asia, remember Abhishek Kotari told us yesterday, and this particular news break has been confirmed. The issue size is up to 500 crore, where the base size is 400 crore, and another 100 crore is the upside option that the company may choose in case there is strong enough demand. The indicative issue price for this particular fundraise is at 60 rupees a share, or over a 6.5% discount to yesterday's close. Almost 16.7% equity dilution at that particular rate is what RBA or Burger King will actually see. The other stock on the radar is the bank, Central Bank of India. Again, a QIP that the company or the bank has launched. A company looking to raise close to 1,500 crore with an upsize option of close to 500 crore. The indicative issue price is at 40.49 rupees a share. Again, over a 13.5% discount to yesterday's close. The company will use these particular funds to augment the Taiwan capital base to meet further capital requirements. Expect both of these stocks to open in the red on the back of the significant discount being given.
All right, Vivek, thank you very much for that. Well, Ola Electric is the next one we want to put the spotlight on. Sud is here with more. Sud, morning.
Morning, Prashant. So first, before coming to today's disclosure, I'll give you the background. Ola Electric had one agency with the name of Rosmeta Digital Services. Now, company earlier this month had filed a plea in NCLT Bengaluru alleging default, and as per sources, the dues were in the range of 18 to 20 crore. Now, Ola has come out with a disclosure. It has disclosed to exchanges today. It's saying that it has settled all outstanding dues with Rosmeta Group, and also Rosmeta Group now has filed the plea that it will withdraw the petitions that it had filed before NCLT Bengaluru. Also, company is saying that matter with respect to Rosmeta Group now stands fully resolved, and that would be the reason that I'm going with green for Ola Electric for today's trade.
Got it. All right. Green on Ola Electric being a relative underperformer. This is clearly good news coming for the company. Let's wind this down with Vinny. She is here to tell us about Chola as well as Mahindra & Mahindra Finance. Morning, Vinny.
Good morning. So yes, we have Chola Investments that's in focus on the back of an appointment that has come in. Vilayan Subbai is now the executive chairman of the company. This is going to be with effect from 1st of April. Currently, he was the non-executive chairman of the company. Do not forget that he's been a part of the company, obviously, but he's been the MD of the company since 2010 to 2017 as well. So now, executive chairman role is what will he be taking from 1st of April. M&M Finance, we are seeing that there's an appointment that has come in of Ram Ganesh Iyer, who's as a Chief Operating Officer. This is going to be for the 10th of April that we're watching out for. And overall, he's got a good experience in the field of financial services, consulting services, as well as entrepreneurship. And it'll be an interesting one to watch out for. So we are expecting green on both these stocks as well.
All right. Godrej Properties is the next one. Vinny, you want to sort of wrap that up as well?
Yeah, so Godrej Properties, we're expecting green here. Now, do not forget that in Jan, they'd launched one of these, properties in Hyderabad. This was their first launch in Hyderabad, Godrej Madison Avenue. Now, they've sold around 300 homes in that property, and 1,000 crore sales is what they've done so far. So, an interesting one that we're watching out for from the company, especially strengthening their presence in Hyderabad is interesting, and we're expecting green.
Okay, thanks, Vinny, for that. Well, here's a quick recap of all the top stocks with positive news flow. Chola Investment, Mahindra Finance, Ola Electric, and Godrej Properties. Well, the ones with negative news flow, they include ONGC, BPCL, IOC, HPCL, Central Bank of India, and Restaurant Brands. From the equity space, let's move to the commodity action. Manisha Gupta joins us to help us out with exactly that. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we are trading at a 3-week highs above $73 a barrel. Well, Trump has announced 25% tariff on any country that buys Venezuelan oil. And China is a major buyer of oil from Venezuela, and that is a premium that you are seeing in prices. Apart from that, it is also going to be about the OPEC and allies meeting, which is on 5th of April, where they will decide on whether or not to increase output for the month of May. So that's going to be an important event to watch out for. Another important event is going to be the U.S. PCE data that comes in on Friday. Ahead of that, we have seen the dollar index hit a 2-week highs, and that's weighing on the gold and silver prices both. But what is continuing to trade well is the metal as a sector. Copper very close to its all-time highs, and you have zinc prices also trading at a 3-month highs in Asia right now.
All right, Manisha, thank you very much for that. So that is what's happening with regards to oil and commodities. We'll take a quick commercial break here. We're going to come back. Amnish Agarwal is going to be with us. If Prabhudas later coupled, we talk some stocks. Lots coming up. Stay tuned.
The good news is, the bad news is that yes, it's under a cloud right now. It's under a very serious cloud. That's why I told you the axis was changed. The good news that is my personal belief and my personal call that these are irreversible changes. That you could delay globalization by another 3 years or 4 years. I doubt if it's even that long. You can delay a world where the strong prey on the poor, which is what is happening now with the spheres of influence, as Donald Trump is calling it. That Russia controls Europe, we control North America and South America, and China controls Asia. So all that is being questioned as we speak right now. But I think it will delay globalization, it will delay international system. It cannot deny it because the human arc works towards progress. And it's very hard for me to believe that we will go back to a mercantilist policy, a tariff-based policy, as Trump is advocating. Either he will change or democracy and the people's aspirations will force him to change.
action.
Okay, welcome back. Let's just talk about what's happening with regards to some news flow now. RBI has issued revised priority sector lending guidelines. Lata is now joining in with a quick snapshot view of what these would mean. Lata, good morning.
Good morning. The Reserve Bank, from time to time, amends these guidelines. Priority sector, as you know, 40% of all their deposits banks must lend for specific goals like, farming, weaker sections, affordable housing, etc. Now, they have to be revised primarily because of inflation. So what you call, say, what was a 30 lakh house now is not affordable unless you pay 40 lakhs. So those were the guidelines. And that's why I'm saying that it doesn't makes life easy for other banks, but for HDFC Bank, it becomes much easier because they have a large housing book. So let me come through the reasons, or let me get through the changes. First one is limits on housing loans. The price limits have been increased. So in cities with less than 1 lakh population, less than 10 lakh population, less than 1 crore population, it changes. And for each of them, the limit has been raised by about 10 lakh. And that makes it easier for banks to find people who are building those kinds of houses. So basically, ease of business for banks. They've also broadened purposes under renewable energy. That's because new products have come. And therefore, you want to redefine and allow new products. Also, for urban, this is important, urban cooperative banks, they had to give 75% of their deposits. Now, it has been reduced to 60%, but not any listed entity, so we don't have to bother. Expansion of the weaker section definition so that more people become eligible. Even women who take up to 2 lakh loans get included in this. So that again makes it easier for banks to find people and therefore fulfill their priority sector loan obligations. There is also a very helpful list of districts with very high PSL and very low PSL. So again, this is a moral suasion for banks to lend in those areas so that the priority sector fulfills the social obligations. So basically, I wouldn't think that banks get green because of this, but it certainly makes life a little easier for banks. Many of them, like RBL, even State Bank, often don't fulfill that 40% and they have to buy PSL certificates from others who have fulfilled. Now, this becomes a little easier for them.
All right. Absolutely, Lata. Thank you very much. A very useful and concise explanation with regards to what has happened there. Now, from one sort of regulatory sort of easing to another, SEBI's eased disclosure rules for foreign portfolio investors after Tuhin Kantapande chaired his first board meeting yesterday. Sandeep Parekh is now joining us to talk about this and more. Sandeep, good morning. Good to have you with us here. Prashant this side. Easier disclosure rules for smaller FPIs. How significant is this, according to you?
Hi, Prashant. So I think it's I would say it is definitely a change for the positive in terms of changing the number from 25,000 crore to 50,000 crore. I would have actually wanted another thing, which really is, allowing exemptions based on good evidence. Because, we've seen, multiple clients and other people that I've met, many FPIs are being forced to kind of wind up their positions because they're unable to go to the last natural person without any, de minimis rule, which means even if you have $100 in a fund, you have to go to the last person, which is not always practical or possible for funds which have, hundreds of investors. So I think an additional change would have been very, very useful so that, we don't get rid of clean money, right? We want clean money. We don't want press note fee violation. We don't want minimum public shareholding violation or any other violation. But at the same time, we should not get rid of good money.
Okay, but this will help at the margin, Sandeep, in terms of what is needed, as you said. You've pointed out that clearly, but what has happened, perhaps step in the right direction?
I think it's a step in the right direction. And if you see all the other agenda, the decisions from yesterday's agendas, I think almost every single one is getting into deregulation. I think this is pretty good news directionally, and of course those steps are still small steps. But I think the point of number one, deregulation, number two, transparency at SEBI, I think great signals to the market.
Anything apart from this which really stands out to you, which you thought was
so another thing which one of the things which stood out was the merchant banking regulations, debenture trustee merchant banking, which actually reverses or rather stays a decision by SEBI in its previous board meeting, where they wanted to kind of make merchant bankers divest unlisted work that they do. So if any advice that they give for unlisted securities, debt securities, or any such thing that had to be divested, which actually didn't make too much sense, because then you'll have two merchant banks of the same family doing pretty much identical stuff, one for listed space. So they put that on hold, which is great, I think. And I hope they kind of, I don't think it's precedented anywhere in the world to have an unlisted company merchant bank and one listed company merchant bank. So I'm glad they paused that.
Okay, Sandeep, quick initial top-of-the-mind thoughts there, but good to get those. So most decisions, and that's the broader takeaway, the broader message, most decisions from SEBI yesterday point towards deregulation and sort of ease of doing business, both for foreign investors and, of course, locally here as well. So that's the first board meeting under the new SEBI chairman, Tuhin Pandey. GIFT Nifty will just come up on your screen. There's still 20 minutes to go as far as market open is concerned. At 8 o'clock, when we looked at it, they had we saw almost a 70-75 odd point pop. And I'll give you a sense of where we are now exactly. Almost pasted that 70-point gap up, very much still there. 23,770 is where we're at. Nigel.
All right. Well, let's get in. Let's get a little bit more fundamental analysis going. We have Amnish Agarwal, the Director of Institutional Research at PL Capital, who joins us. Hi, Amnish. Thanks a lot for joining in. Well, the oil and gas space, plenty of news flow, right? Overnight, Trump, wrapping those who are going to take oil from Venezuela on the knuckles. And also we have news that there could be some light at the end of the tunnel on the LPG recoveries as well. How are you viewing the oil and gas space? For starters, maybe the stock start off negative, both the producers, that's Oil India and ONGC, as well as the OMCs as well. Do you think it's a buying opportunity?
You see, the situation remains volatile because, first of all, the crude is actually, for example, fluctuating. But I think this news on Venezuela in particular, I think it is going to be negative for many OMCs which have been actually importing crude from there. So to that extent, I think your margins can come under pressure incrementally. And what was the second part of your question?
So how do you approach them? These stocks are going to start off in the red. As you're saying, things are very, very volatile. But if you look at the OMCs, they seem to have got their mojo back. If not mistaken, the stocks are up 15 to 20% from the recent lows because of lower crude prices, valuations, and also the margins now are much better than the historical average, as well as what the street is factoring for FY26. Your take?
You see, OMCs, you can't look at, like, for example, a structural fundamental stocks because they're, for example, month on month, quarter on quarter, your refining margins, marketing margins, they will continue to fluctuate. But having said that, the lower crude prices are going to benefit in the near term, and that is why there has been some rally in the OMC stocks. So in the near term, unless until we are clear about what happens on the Venezuela front, to what extent it is going to impact, there might be some more steam left in these stocks. But it is purely, I would say, like you can say, a trading call, and very difficult to watch what is going to happen 1 or 2 quarters down the line.
Okay, all right. Amnish, what about the tech space? The IT index has been a relative underperformer. Now, various brokerages are pointing out that maybe bulk of the bad news is in the price. To give our viewers a data point, the Nifty is up mildly now in 2025 so far, while the tech index is down 15%. What's your view on tech from here on, given that we have earnings in the next 20 days or so? We'll have most of them that will report their numbers. And what's the pick of the pack?
Is a tech, actually the demand continues to be benign for all the tech companies, and the commentary also is not great. Now, there are 2 parts to it. For example, Europe was already witnessing a slowdown. And if the current, you can say the positioning or the current whatever news we are getting from US, I think that there could be some pressure incrementally there also. So I think if you are looking at, say, a tech space, there is not a significant improvement which is likely in the near to medium term over that space. So we expect that in tech space, you might see, say, low to mid single digit kind of accreting earnings as we go along. And I think that is perhaps what the stocks are also reacting to it. And given the global uncertainty, the kind of, you can say, the trade wars which are on the horizon, and the kind of news flow which we are getting, I think I would be very reluctant to stick my neck out and go overweight on tech at this point of time.
Okay. All right, Amnish, got that. Thanks very much. We also have a management waiting by. The spotlight now is on Greenply Industries to talk about how the business trends are shaping up as we're almost winding down the year. Manoj Tulsian, joint MD and CEO at Greenply Industries, is with us now to take a couple of questions. Thanks very much, Manoj, for joining in. So, we're in the final leg of the year. Let's start by just getting a basic sense of how Q4 has shaped up in terms of volumes, in terms of pricing, overall demand. What has that meant for both the segments, MDF as well as plywood?
Thank you for having me on the show. See, Q4 numbers won't be able to speak on details, because of the regulatory things. But I can give you a picture of the overall year. The overall year, if you really see, demand has been slightly tepid. But more so, the challenge which we have faced in the last 3 quarters has been liquidity concerns. So even in pockets, when we get to talk to our channel, they show about demand, they are not able to pay us on time. And that is one discipline which we have been hearing across the segment, not only panel, but even in other building material products. When we are talking, we are finding that liquidity has surely become a concern. I think that is one of the reasons also that somewhere the growth during the year is getting hampered. Quarter 3, quarter 4, if you really look at, on the real estate side, when I look at data points, I find that the numbers looks good in pockets, but somehow we don't, you people are the best people to, answer where is that money gone from the system. We all believe that after a union election, there's a lot of money which flows into the country, on the consumption side. And normally the years behaves very well.
Manoj, just to get that the clarity on that point, what you're saying is that liquidity concerns have hit you. Are you talking about, in terms of overall payment cycles, receivables? And now I guess that should be easing up, right? Because the RBI has taken a very different approach in the last couple of weeks. So overall volume growth for the year, what are you looking at?
No, the volume growth has not been in line with, what we guided. And as I said that, clearly, yes, it is on the receivable cycle, not getting the payment on time, which means that, either we break that discipline and, get into that, the rough side of it. But I don't think that's a very feasible way of looking at things from a long-term perspective. We have corrected many things, which was a concern in the past. So these are, short-term hiccups which we are willing to look at. Because I can clearly see that, in the going forward, in the next 2 to 3 years, things looks to be very, very good. Especially because of the implementation of QCO, things will change dramatically. And I can clearly see a shift which can happen from the unorganized to the organized market. So, that's the tailwind which we are able to see going forward.
All right. Hi, Mr. Tulsian. Good to have you as always on the show. Give us a couple of details. Let's focus on the plywood business itself. Century seems to be growing at a faster clip. So if you could tell us, what is your market share? Have you lost out on market share out there? Point number one. Point number two is margins, you've gradually been improving it just in the plywood segment. Do you see it head to around that 10% odd mark, double digits is something that we should be working with for the coming year since things will look up? Please go ahead.
So Nigel, first I'll come on the margin. If you really see, our margin has been in single digit. Yes. Though in the last quarter, after the results, I've given a commentary that, definitely now we have worked internally on a few things. A few places we have taken price correction also. So the margin looks like it will go back into the double digit. Having said that, one very important point which I want to bring to the notice of everyone is if you really see our A&P spend in the last 3 years have gone up by almost 1.6%. Earlier, we used to spend around 3% of our total sales as A&P. Now it has gone to close to around 4.5 to 4.6%. So that's the additional investment which you made in the business, because if you really see, we were only into plywood business at one point of time. And then we also got into MDF. Now we have gone into hardware also. So the brand overall needs to be strengthened. This is a good investment which we have started doing. Now that we know that we are at that level of investment, maybe for one more year or a couple of years, we might have to remain at around 4.5%. We started working now internally on the efficiency parameters. Okay. And also, I think that the next best trigger will also come in the coming year, because last 4 to 5 years, you will see clearly that the timber prices were only going up. Now we get a sense from our plantation team that, that is possibly looking like the end of the cycle of the prices rising. There would be new supplies which will be coming during the year. For sure, around Q3 is what they are promising.
So, Mr. Tulsian, Mr. Tulsian, just to confirm, though your A&P spends have gone up, you have the benefit of lower timber prices, which will help you. So we see double-digit margins in FY26. Is that the goal?
In plywood business, for sure, yes. MDF, in any case, we are doing very well in terms of margin, but plywood also, yes.
Okay, all right. And market share? Have you lost some market share? Do you want to pull that back?
Well, yes, of course. I think we are prepared as a company now. In 3 to 4 years, there has been a lot of rigor which has gone. There was a lot of focus which has also gone in setting up MDF as a business entity. Successfully, we were able to do that, and we were able to ramp up. Then the next challenge came is again getting into a new line of business, which was hardware, furniture hardware. That also successfully, the plant has been set up in the fastest time. The production has started. So, lot much focus will come back to our bread and butter business, which is plywood. So once that happens, and since, many of the internal things in terms of building up our processes, system, automations has worked quite well, I think we are very well prepared now to look at a good growth, including the margin improvement.
So double-digit volume growth in FY26, right?
Looks possible, very much possible.
Very good speaking to you, Mr. Tulsian. We have not got too many numbers out of you, but we've got a broad sense in terms of how you see business evolving. We look forward to chatting up with you at the end of Q4 numbers and then press you a little bit more for numbers for FY26. Wishing you a good day ahead. Well, time to slip into a short break. On the other side, our technical experts are waiting for us. Welcome back. You're tuned into Bazaar Morning Call. As promised, our technical experts are waiting for us. Mitesh Thakkar and Sudarshan Sukhani. Hi, gentlemen. Good morning. Thanks a lot for joining in. Mitesh, go first. Is the party going to continue? What's the level on the Nifty you're looking at? What would the trade be, given that we're going to start off with a gap up of around 70-80 points?
Morning, I believe so, we'll see further hikes. See, again, the question is whether we'll keep moving up or whether we'll have a pullback. I think we're quite stretched too far away from the short-term averages, so the chance of a pullback is always there. But I had a similar view yesterday, and there was no kind of, there was no decline or intraday pullback which happened. So trade with a long bias, but now for the next few days, trade with tighter stop losses and slightly lighter quantities. Once you get a dip, I think that would be a wonderful entry point, and we'll see much higher levels. On the Bank Nifty, I think I'm now looking at 52,000 as the first target, and then 52,700. While on the Nifty, I think I'm looking at about 23,800 as the near-term target, and in case we start getting past that, in a good case scenario, even 24,000 can be scaled, and we can look at 24,150, 200. So the targets are there. The pattern and the structure suggests that we'll see higher levels. Just tactically, you'll have to position it and be long, but be aggressive once you get an intraday or a one-day kind of a pullback.
Okay, well, will we get that pullback is the question, and interesting times really. Big moves from the lows. What next? Gentlemen, morning. Sudarshan, to you next. By the way, at the margin, are some of the near-term indicators getting a little overbought? The point is these signals, when the market was selling off one way, it didn't work, right? I mean, the market kept getting more and more oversold, but the selling continued. They need not work on the way up as well. If there is some cash buying, which is returning at the margin. What's your sense, Sudarshan?
Yeah, good morning. No, they will not work. It's not just need not. There's no concept of an overbought signal or an oversold signal, except in very narrow range-bound markets. This is not a range-bound market. So we should simply ignore this overbought concept here. The market is in a strong trend. Trending markets can go more than we can imagine, as we've already seen. Nobody thought we would have 1,700, 1,800 points of a rally in 20 days. But my view now is, yesterday I said go and buy, and we had a spectacular day. That was just lucky. I think the markets will now take it easy. Two things have happened. One, yesterday the market was anticipating a big rise in the US markets. Early pre-market signals were there, and we anticipated it. Second, March ending is usually a time when there is this decent window dressing going on. Every March you will see it. That will end on Friday. So I would expect the markets to consolidate now. I don't think we are going to go down. It's not so simple that markets go up, wait patiently. They will come down significantly and we can buy. Markets are never so easy. Expect a series of days when consolidation takes place. So for those who are long, this is a time to take profits and step aside. For those who are not long, use small dips to take trades, but I don't know whether those dips will work out or not. Primarily expect a consolidation which becomes choppy, start planning to take profits.
Okay, all right, gentlemen, stay with us. We want to hear your picks, but for the time being, we'll slip in a short break. We'll be back. We'll get you pre-open rates. We'll also be joined by Prabal Sen of ICICI Securities for a view on the oil and gas space.
I've just requested that the Governor General dissolve Parliament and call an election for April 28th. And she has agreed. We are facing the most significant crisis of our lifetimes because of President Trump's unjustified trade actions and his threats to our sovereignty. Our response must be to build a strong economy and a more secure Canada. President Trump claims that Canada isn't a real country. He wants to break us so America can own us. We will not let that happen. We're over the shock of the betrayal, but we should never forget the lessons. We have to look out for ourselves. we have to look out for each other.
Welcome back. So we're just about approaching 9 o'clock. Let's quickly get some trading ideas in then. Mitesh and Sudarshan, of course, with us. Gentlemen, morning. Once again from my side. Let's talk about stocks. Mitesh, what are you working with?
Good morning, Sobi. I have all buy calls. A buy on Punjab National Bank with a stop at 94 for targets of 100. Bosch India has given a reversal after a long time. That's a buy with a stop at 27,800 for a target of 29,000. Nippon Asset Management is a buy. Keep a stop below 576, look for targets of 620. And Power Finance Corporation is a buy with a stop at 419 for targets of 436.
Okay, got that. Sudarshan, what about you?
Well, it's an all-buy list. I mean, the idea of shorting this market is horrible. So we start with Hinge Unilever, buy with a stop under 22.19. Zydus Life, buy with a stop under 907. Info Edge, that is Naukri, buy with a stop under 69.48, and Inside Industries, buy with a stop under 358. Yesterday also I explained that there is a sense that small caps and mid caps are slowly rising from the ashes. We'll see.
You know, the pre-open is kicking off, and so we've got about 100 points on the Nifty, 23,770 or so. The Sensex is at about is up 630 points. Let's just look at Reliance Industries and the oil marketing companies. I've seen some pointing out that how there is perhaps Reliance and OMCs perhaps will get impacted because of this Venezuelan oil issue. But the fact is that in terms of the Venezuelan exports, which by the way in any case are heavily curtailed of oil, India is now the third largest buyer according to Reuters, but it is a percentage of our own imports. I mean, it's a very small percentage, very, very small percentage, which can be, I reckon, replaced with oil from other sources. So, some commentary around this, but I think you should keep that in mind. To my mind, it's not a big negative or anything of that sort at all for OMCs or Reliance, which of course is got the most efficient refinery to process that heavy crude. So those are names up on your screens. Mitesh and Sudarshan will talk again. Amnish is with us. Amnish, thank you for waiting. Any thoughts on this issue if you've looked at it?
Yeah, which one? This oil one?
The oil imports and Trump saying that 25% tariffs on anybody buying oil from Venezuela. Any implications for Indian companies?
Yeah, you see, the main thing is that India has been increasing the imports from, you can say, Venezuela, if you look at, say, past few years. And whenever you get a cheap crude imports, then actually it reduces the overall basket price to some extent. But having said that, now the kind of, you can say, duties which have been imposed by US that anyone who imports, they will be facing the duties, I think that advantage actually goes away. But the number is not big enough for India to worry that it is not maybe say double digit of our imports or something. I think it is hardly 1 or 2% of imports, which India can easily shift to other sources. But having said that, it actually might push up your overall cost shade. That is one. And secondly, it narrows down your choice to some extent, which might have even implications not only on India, but some of the other oil importing countries. So to that extent, I think there might be minor variation here or there, not a you can say big one, unless and until we realize that there is that the bulk of imports are going to, you can say, one single player, and so that might be one issue with one player. But otherwise, I think not a big needle mover as far as India as a country is concerned.
Okay, all right. Thanks a lot, Amnish, for joining in and filling us in with all that fundamental analysis. But let's stick with this topic. The oil and gas stocks, they're going to be in focus. Remember, yesterday, we had gas stocks that were on fire on the PNGRB proposed amendments to the gas transmission tariff regulations. And today we have news on the curtailment put on Venezuelan oil. Prabal Sen, the senior research analyst at ICICI Securities, joins in. Hi, Prabal. Thanks a lot for joining in. Give us a few details. What's the percentage of imports coming in from Venezuela for India? We understand it's relatively small. Do you see this as a risk?
I think, while exact real-time data is difficult, but my understanding is that India imports close to about 0.2 to 0.25 million barrels a day of oil from Venezuela. When you consider that India's total imports are in the range of around 4.5 million barrels of oil per day, obviously it is a relatively small percentage compared to the percentage from, let's say, Middle East or even Russia, for that matter. But the fact is that if the condition for avoiding this additional 25% tariff is that this oil will have to be replaced, then that's an additional sourcing that you will have to find from somewhere. And, to basically find 250,000 odd barrels of oil per day is obviously going to, take its own time. But from a supply security perspective, I guess because it's less than 5% or less than 4% of our overall crude slate, it's something that I think India can figure out how to basically, manage this hit from what we get there.
So not a big challenge on this aspect. Another aspect, I wanted to focus on is the OMC LPG losses. And now there's a couple of reports, by Money Control as well, that state that those, that under recovery could actually, there could be some lighter day on that. I think for the first 9 months, it was around 30,000 crores or thereabouts. Are you factoring this in your estimates? What realistically should we be working with in terms of some compensation for these LPG recoveries?
No, actually, I think, we were pretty hopeful that it would come through in the budget first. And then there was also this news that in the supplementary provisions that were basically announced, it would have some, good news as far as the OMCs is concerned. But as of now, given the uncertainty in terms of exactly the quantum and the timing of this compensation, we frankly are not really building it into our FY25 estimates. As and when it happens, it's something that will probably be more of a positive trigger as far as we are concerned. But right now we are assuming that the 40,000 crore odd of losses that are due, if you build, another 10,000 crore odd in the fourth quarter, I think that will have to be absorbed by the OMCs, at least for this financial year. That is what our base case is.
We'll talk about city gas in just a bit. Prabal, hi, good morning. The standalone refiners, actually Chennai Petro has seen one of the sharpest rebounds in the broader markets, up some 35% from lows, MRPL as well. How's the picture there for these two names? What's the environment like?
We don't track CPCL and MRPL separately. We don't have an official view or rating on it. But, what has obviously happened is if you see the direction of Singapore benchmark margins, they have definitely improved a bit. And specifically, diesel spreads have once again been hovering at somewhere between $13 to $14 a barrel. And that is always good news for Indian refiners, given that close to 50% of our product slate comprises of diesel. And if you consider gasoline and ATF as well, the total proportion is close to 67-68%. I'm talking about average for Indian refiners. Each individual refiner might have a different percentage. But given that whatever strength is coming through in Singapore is being driven by these three benchmark fuels, whatever strength is coming through is obviously good news from a refining margin perspective, because if Singapore is at $4, but it is being driven primarily by strength in, diesel and ATF and gasoline, I think Indian refiner margins will obviously be at a premium to that. So to that extent, definitely it's slightly better, directionally than what Q3 trends were for GRMs. And remember that, probably, given that crude volatility has been slightly lower, your inventory impact could also be much lower in this quarter. That is also something that can help reported margins.
All right, Prabal, so that is the standalone refiners, and I completely understand you don't have a view in terms of actually coverage on these names. City gas companies, IGL, MGL, Prabal, what's the view there?
I think, given after the restoration of part of the, priority gas and the way that, gas costs have been moving, we would probably continue to remain positive on these names. I certainly think that volume growth has continued to surprise on the upside, specifically for MGL and to a lesser extent for IGL in the last couple of quarters. Gujarat Gas, of course, it's a different story because it's driven a little bit with what ceramic industry is doing, what export trends are as far as ceramics from Morbi are concerned. So there, the constraints could be a little bit more external, but certainly from a CNG conversion and volume momentum point of view, I think despite all the constraints that are there in terms of slightly higher sourcing costs and a more challenging gas supply environment, I think the conversion rates and the volume run rate probably continues to surprise, and I think that momentum should continue with the partial restoration of priority gas. What will be, of course, interesting is to look at spot LNG trends, because what is interesting is for the first time in probably a very long time, term LNG prices are now much cheaper than spot LNG and are likely to probably remain so for at least the next 3 to 6 months. So the key to success or the key to margin strength probably would be whichever player can probably tie up much more of contracted long-term volumes rather than having to rely on spot LNG to fulfill the shortfall from any priority gas deallocation or any incremental volume growth. So I think that is something that will be key monitorable at these prices with the kind of volume growth, and I think margin looking slightly better than they were 3 months ago. We would remain positive on the space.
Prabal, just 30-second response to this. We were supposed to have a gas glut. So even without these long-term contracted volumes, spot prices, at least from what I remember, beginning of the year, late last year, reading, we're entering a period of a lot of gas. Prices generally, spot prices should be lower. You think?
I think we have seen this story before. If you remember a few years ago when Australia was coming up as an LNG export destination, this was exactly what was being speculated, that there would be a huge gas glut and prices would drop to low single digits and stay there. What really happens is that when prices drop below a certain threshold, the market tends to correct itself in terms of probably delays in commissioning of new projects. There are, shutdowns that happen in projects which don't find it economic to sell at sub $10 levels, and so on and so forth. So to that extent, I think there is always a minimum threshold that spot LNG prices need to be at for these projects to keep running at full tilt. That's one. Secondly, what has happened this year is that the European gas inventory has actually fallen a little bit faster than what has been the trend over CY 22 and 23. So that has impacted the near-term balance in terms of supply and demand. I would still believe that with the capacity expansions that are targeted over the next 2 to 3 years, where I think 190 million ton plus of additional LNG liquefaction is slated to come online by CY 28, you would probably see a normalization and moderation in prices. But in the near term, there have been specific factors that have impacted spot prices, and that's probably why you're seeing them remain elevated probably a bit longer than what earlier estimates were. We would remain confident that spot prices would probably normalize to somewhere around $11-12, but we have never advocated that prices go below 10 and stay there, because that always brings about a swift market response from the supply side to correct it upward, and I think that's something that will continue.
Okay, all right, Prabal, thanks very much for the context and the perspective. Appreciate you joining us today. Thank you very much. Have a good day. Let's quickly revisit the pre-open rates. And now we've actually still got a nice 90-point upswing in terms of the gap up. And the mid-cap index is also on the higher side, at least for the time being. So green is still very much the color. Let's quickly take some final trading calls with our experts. Sudarshan, so what would you go with?
I'll go with the Exide Industries. Buy Exide with a stop under 358.
And Mitesh, what about you?
I'll go with the buy on Nippon Asset Management for targets of 620.
Okay, all right, gentlemen, thanks a lot for that. Well, let's focus on the cement space. This after UBS has gone ahead and upgraded the cement sector. They believe that the rough patch is coming to an end. And so they've upgraded Ultratech, Ambuja, as well as Dalmia to buy. Remember, UBS had a negative view on the sector all the way since July 2023. The key reasons they cited back then was that competition was rising, demand slowdown because of the general elections, and also the rising price competition post Adani's entry into the cement space. Now UBS, they've done a U-turn. They are turning positive. They anticipate earnings upcycle to emerge in FY26 with strong EBITDA growth in the next two fiscals. Their positive stance is backed by demand revival, which is driven by housing upcycle and the revival in government capex as well. The other part they are pointing out is the structural cost-saving factors that will play out and the initiatives that have been taken by companies which will drive margins. Bottoming of prices is another thing that they're looking at after the dismal prices we have seen in the first 9 months of this fiscal. The sector consolidation has been led by the top two players, that's Ultratech as well as Ambuja. The reasons for upgrading various stocks is as follows, and the chart should come up for you on the screen. Ultratech, well, they have shown strong execution in tough times, and they've led industry both in growth as well as in margins. Their top pick, though, is Ambuja due to its high growth and lower valuation, while on Dalmia, they have done a complete U-turn. From a sell rating, now they have a buy rating, while on ACC, they had a buy rating. They're maintaining that. The factors they're citing is supportive valuation as well as industry tailwinds. Put all this together, UBS, after being cautious on the cement space in the last couple of years, they've done a U-turn. Now they have buys on a whole host of stocks. So we'll keep an eye on those stocks.
Okay, well, just a minute to go for the market open. What do we have? First rates will start to come up. 90 points higher on the Nifty in the pre-open, 300 on the Nifty Bank, the Sensex, beg your pardon. There you go. I mean, we're at about 23,753. The February highs are slightly above the 23,800 mark. The Nifty Bank is up about 1/3%, 51,875. You've got the mid-cap index, which is up 0.6%, and the small-cap index, which is, I think, up about 0.5% plus as well. And like we've had for a few days now, market breadth right out of the gate, super strong this morning. And the BSE advanced decline is up, and the NSE as well. So 5:1 in favor of advances in the BSE, and much stronger on the NSE as well. But just sort of these are opening rates. We'll have to give it some time. The Nifty heat map will come up on your screen, gives you a quick snapshot view of how things are starting. So it's, I think, a replica of what we saw yesterday. Majority of the names are higher, and about 10-11 names are starting the day lower at this point. I think the Ultratech is, I can see on the gainers board, as Nigel was pointing out, that upgrade coming in on cement from UBS. Surabhi.
Absolutely. So it's looking good, 100 points higher on the Nifty and far more green than red today. Apart from Ultratech is, of course, the biggest Nifty winner at this point in time, 2.5% higher. IT is off to a good start. HCL Tech, Infosys, TCS, all these stocks are up and about. Banks are chugging along quite nicely. HDFC Bank about 0.6%, 0.7% higher. There's some green on Axis Bank as well. Kotak Mahindra Bank also on the positive side. So banks and IT look fairly stable. L&T is notching up a gain of about 1% or so. Some of the auto stocks are seeing a little bit of buying as well. Hero Moto, Tata Motors, Maruti, M&M. So not too much, but just about 0.5% on all of these stocks, so not too bad. On the flip side, Dr. Reddy's is lower by about 1.5%. Britannia, there's some labor issue. There's a strike at one of their plants, I think in Gujarat. Stocks down about 0.5%. Innocent Bank is seeing some more pressure after yesterday's 1.5% fall, another 0.5% today. And some of the steel counters are a little careful this morning. Tata Steel, JSW Steel, Hindalco, all the steel majors are down about 0.5%. Reliance, Lever, these are the fence-sitters, the big boys, not doing too much. But at least many of the banks and IT on the positive side looking good.
Well, that's right. EIL and RVNL, both those two, they have won orders. So that's why both those two stocks have opened up in the green. Suzlon, there's an initiating coverage that's come in from Motilal Oswal. They have a big target price out there, and that explains why that one as well is doing well. It's up close to around 2% or thereabouts. Colgate, I've seen a report coming in from Investec, and they are talking about earnings deceleration likely to continue on Colgate. So that explains why that stock, in fact, is down close to around 3%. Could be weighing on the stock. Colgate, one of the big losers this morning. On the flip side, what's doing well? Ramco Cement's up. Ambuja Cement's up. Both those two participating as well. Ultratech obviously is the big gainer. Polycab, we had highlighted earlier today that one's come out of the F&O ban. That stock is up close to around 2.5% or thereabouts. A good move is what we're seeing on that particular name. Ola Electric, well, they have settled the dues with Rosmota Group. So on the back of that, you have that stock as well that's doing quite well. IRIDA, the stock continues to see its good run. Remember, it saw a sharp correction from the peak. Now, in fact, that's bounced back. And ITC Hotels as well. That one's gradually hovering around the 200 rupee odd mark. The sector of the day, though, to start off with, is the cement space. All the stocks doing quite well. Relative underperformance is what we're seeing. Dalmia, Ultratech, Ambuja, all of them firing all cylinders.
All right, absolutely. It's a solid start for that particular pack, as we've been sort of highlighting and pointing out. The number one volume-led gainer right now is Garden Reach Shipbuilders, GRSE, which is up 3%, 1754 on Garden Reach. And I mean, that defense pack is done phenomenally well in terms of just bounces. Garden Reach is one. I mean, look at names like even smaller names, private companies, Zentech, for example, Cochin Shipyard. HAL has come up very sharply as well. I think HAL is up about 25% from the lows. It's done less as compared to some of the others in that. BDL is another one. So, yeah, I mean, massive moves, very short time span, like Spring Coil, right? I mean, Zentech, I think, is up another 5%. 1600 is back on the rate on Zentech. The high, I think, was close to about 2600. So, yeah, I mean, a fair bit going on. What else? I mean, maybe this IGIL, I think it was up 5 yesterday in the morning as well, I remember. That's the diamond certification company. So it's coming up almost back at 400. Brigade is up 3.5%, 1027. These are, by the way, I'm just sort of reading out based on the largest volume-led gains. Info Edge Naukri is up 3% with gains. E2E Networks, 5% gain, 2414 on E2E coming through. Medanta, the hospital company, 3.5%. Carborundum Universal is up 7%, 1085 there. Chola Holdings is up about 3% or so. And then volumes drop off a cliff. Nothing really. If you go down the list and look at more gainers, I mean, this is the bulk of where we are in terms of volume-led gains coming through. On the downside, JBM Auto had an outsized move yesterday. It's down about 1.5% and large volumes. Colgate is down 3%, is the number one volume-led loser at this stage. Dr. Reddy's is down 2%. Viatech Vabag is down 3.5%. And the two refiners we were talking about with Prabal, Chennai Petro and MRPL, both are starting the day down about 2.5–3% lower. So, again, large volumes and some gains being taken off here. Nigel?
Just one more stock I wanted to point out. SG Finserv, noted investor Mr. Madhu Kela, went ahead yesterday and bought close to around 10 lakh shares. That one should come up for you on the screen. SG Finserv is now up close to around 15%. Big volumes out there for the initial part of trade. And yesterday, I think, to be precise, 9.5 lakh shares or 1.7% stake was picked up by Mr. Madhu Kela. Explains why the stock is flying away. And just one more point. Earlier this morning, we said that if the market needs to hold on to this rally that we have seen, and if we need to see a bit of an up move, we need the tech index to participate. And the tech index in this year itself has been a relative underperformer. This morning, it's a big outperformer. It's up 1.4%, and gradually it's approaching that 20 DMA, which is an important, crucial level. So tech is the one that's outperforming this morning, taking over the mantle from the Nifty Bank.
Yeah, absolutely. I mean, within the sectoral bounces we saw, the data that we put out, IT has done the worst. So yeah, I mean, there is there is room. Definitely, there is room. I think it remains about 20% off the all-time highs on the Nifty IT space. Well, we'll talk more about this. Krishna Sangvi is with us, Chief Investment Officer, Equities at Mahindra Manulife Investment Management. Krishna, good morning. Great to have you with us here. Prashant here. I mean, by the way, the market's coming off a little bit. So just about 40 points left now after the massive move we've had from the lows. The question, though, Krishna, is even after, 4,500 point rally on the Bank Nifty, 2,000 point rally on the Nifty from the lows, I don't think it's wrong to ask whether we're completely out of the woods. How would you answer that question, Krishna?
Yeah, hi, Prashant. Actually, markets have taught us that it's clearly impossible to, categorically say we are out of the woods or not. But let's look at the factors, right? So what we've seen in last 6 months, is a multitude of factors. If you look at pure fundamentals, we had a little bit concern on earnings, on economy not, growing as expected a year earlier. The kind of data points we got for Q2 and Q3 was honestly a bit weaker than what we really want as economy. You look at a little bit on the flow side and sentiment side. Post election in US, the expectations rose about how US economy can do well, US corporate earnings can pick up because of tax savings, etc. So that's the reason, why across the EMs we saw money moving out and possibly heading to US as a preferred option for some time. And third really was, a little bit pure India-specific liquidity angle, which you call it, about how, new rules of, derivatives, etc., were being played out, or margin trading, etc. So if you look at combination of all three, we saw markets, behave the way they did. Come to, let's say, March this month, I think, you know, the worry started in US actually on reverse side, saying that if they really implement Dodge and if they really implement tariffs the way they plan to, some sort of a worry on US corporate earning growth stroke economy. So that reversal of EM money into DM possibly is what could have reversed is one. And from a economy side, the budget was pretty interesting. We got this this consumer surplus kind of thing, and government's action. On top of it, RBI did its own support by way of rate cut, as well as really indicating their willingness to do that extra to really support the growth. I think that factor has changed. The only thing missing in this, really is the pace of change, which is quite fast in a sense. If you just look at last 7 days, we would have rallied nearly 2,000 points. That typically comes more in a rebound or a oversold kind of market. So let's see how it plays out. I think data-wise, quite a bit of oversold or short position would have been reduced by now. Let's wait for Q4 season and then judge based on what the management commentary comes out of economy in 26 for their own companies, as well as little bit support from global markets is required. Last thing, maybe let's not forget, April 2nd is still a relevant date. So that's what we're likely to see some formal announcement from US on the tariff, etc., and how India as a country, stroke a lot of other countries, can get impacted. Can be another things to monitor and then possibly take a call later on.
Krishna, hi, morning. Good to have you on the show. So financials have, become the face of this move that we've seen, right? The recovery from the early March lows. What is the weightage that you're willing to give financials in your portfolios and within the basket, because it's a very wide basket? What is your preference between banks, NBFCs, private sector PSU, obviously insurance, capital market plays? There's a lot going on there. So just give us the details.
Yeah, sure. So I think if you look at broad positioning, financials, clearly it is more domestic economy driven, so would likely to go overweight for now. Basket is huge, whether you call it private banks or public sector banks or lenders. So broad thought really is they'll have relative preferences, partly coming from the kind of mandates we run in each of our funds. As quite a bit of large cap has more of banks and NBFCs, while capital market plays, etc., are more into mid and small cap kind of schemes. So broadly, as a house, some of our schemes will be overweight more in capital marketplace, somebody more into NBFCs or financials. So I think combination is what possibly makes sense to be overweight for now.
Hi, Krishna. The problem is that Q4 earnings are not going to be great. The hope is that after that, we'll see that, that earnings will be good. We'll have a low base as well, which will play out. Do you think the markets are prepared to look through a weakish to a muted earnings in Q4 and just be happy with the positive commentary that we're likely to hear? Your take?
Yeah, again, it's difficult to pre-guess, whether markets are ready for all the bad results or weak results. I think some of the companies which have corrected sharply in last, 2-3 months, possibly, those Q3, so those Q4 outcomes is, perhaps captured is my guess. Somewhere, the intensity of the numbers stroke the commentary for FY26 possibly will be a far bigger play. Come to think of it, yes, clearly in the month of March, where we are now, and by May the results are out, more or less markets will be more in a mood to see what they have to say, and report about FY26 outlook rather than so much about Q4. So it will be a mixed bag, I guess. For some companies, if the intensity is pretty poor in terms of numbers of Q4, it might be worry, but otherwise broadly it looks good. Especially for large cap, it looks far better.
Okay, all right, Krishna, let's talk about the two top sectors of the day in the first few minutes. One is tech, where we have seen that index being an underperformer. That's actually outperforming this morning. It's up closer to 1.5%, while the markets are more or less flattish. As well as cement, which is the inward-facing sector, right? Irrespective of what's going to happen on tariffs, the cement demand is more domestic in nature. How do you approach both these two sectors, and what's your current stance?
No, I think cement is clearly demand is reasonably good. If you're betting on India capex cycle, demand wise, cement is a pure play commodity which is required, can't be imported. So a domestic play, as you suggested. So clearly positive, overweight call on cement is something I'll say. IT, it's been an underperformer for last, let's say, 2-3 months. In a way, if you look at again the IT cycle of last 6 months, the stark outperformer as expectations built up for how US economy can pick up in October to December time. IT was a stark outperformer. Once a little bit worry on US came stroke, the tariffs. So if I have to really, make a view on IT, I'll prefer to say, let's wait till 2nd April does, IT come into some test, some gamut. I know it's not a product, so, tariff is difficult to be use the word there, but is there something else, which might come to possibly, is possibly a worry right now?
I just want to quickly point out that for the first time, I think in at least 4 or 5 days, and 4 or 5 days is how long this market has rallied non-stop, and in a very powerful way, market breadth is turned. This is, again, I mean, we've been trading for half an hour, not even half an hour, and market gains are there. I mean, 65 points in the Nifty, but look at the advanced decline ratio. So 1,400 stocks are lower and about 1,000 stocks are higher. It's nothing dramatic, but, we've had a one-way move, as we've been pointing out, and now you're heading into that, as Krishna has also been pointing out, the 2nd of April. And who knows, if anything, there is only, Trump and his team have been creating chaos and confusion with statement after statement, sometimes meaning this, sometimes meaning that. So very little, there's no firm handle on the extent of it and what may actually happen. Once again, I think this came through clearly in one of the discussions. The impact on India is indirect through weaker global growth, weaker, if tariffs are higher. It's not directly with regards to tariffs imposed on India, even if India has come up in Trump's speeches, etc., multiple times over the last 2 months or so. Look at the market Nifty heat map as well, more evenly matched now, equal number of gainers and equal number of losers as well. Phenolics Cables is another one which is up about 3.5%. It was not there in the mix in the morning and we started, and it's the number one volume-led gainer. And look at two other names which were absent in the morning. HEG is up 13% now, so it's gone up like a rocket. Of course, along with it is graphite, which is up 10%. So HEG and graphite are both surging as we speak. Those are sort of new additions. As I said, still early, just 15 minutes into market open at this point in time. What we'll do is we'll take a quick commercial break here. Krishna, thank you very much for joining us here on the program. Appreciate your thoughts. We'll take a quick break, come back. And okay, I think what we'll do is we'll focus on our next management. Krishna, thank you very much. I think we have the management of NLC ready with us.
Nigel is taking this one.
All right, let's focus on the power play. Power demand is expected to peak this summer. Electricity consumption is already on the rise with strong demand in the last 2 months. So is India ready to beat the peak power demand? To discuss this and more, and also focus on business, we're joined by Mr. Prasanna Kumar Motupalli, the Chairman and Managing Director at NLC India. Hi, sir. Good morning. Always good to have you on the show. Tell us, what are the trends you're observing currently with regard to the demand supply? The problem is we are bracing for a bit of a power deficit. Is that the case? Could you tell us your quick word on it?
In the last financial year, in fact, it is in the current financial year, the 250 gigawatt of power requirement was met successfully. And coal and lignite production for supporting that was also good. So in the current next financial year, the power demand is going to increase by around 6 to 7%. That is the forecast. And with the type of production of coal and lignite the country is having, and the power stations stocks are also good, I don't see any problem in meeting the power requirement. In the last 10 years, we traveled from power scarce scenario to power sufficient scenario. So there is no problem in meeting the peak demand that is going to come.
Is it, the thing is, sir, good morning, Prashant here. Of course, I mean, you're well prepared, capacities, etc. But how well prepared is the industry in your opinion, sir? Because, every summer, and I think this has been true for many years now, is hotter than the last one. So peak deficits keep rising, right? And into every summer, this becomes a big talking point. Through the summer, it becomes a big talking point. Our capacity is coming up fast enough, sir.
If there is a substantial capacity addition both in thermal as well as renewable power generation, and the whatever growth in power requirement we are expecting 6% to 7%, the capacity addition is more than that, and that is the reason why we can comfortably meet the power demand requirement going forward.
Sir, can you give us some targets on lignite mining? I mean, how are you likely to close FY25, and then what are your overall mining and production targets for as you start planning for the next year as well?
Madam, in the current financial year, we targeted 25 million metric tons. We will be achieving around 92% of that. That was mainly because lignite being a fitted thermal power station, and there were power surrenders because of the rains in the rainy season in the last financial year. This year, next financial year, we are targeting 26 million metric ton, and we are hopeful that we will be doing more than that. And in coal production, this time we achieved more than 16 million metric ton, which is the all-time highest ever coal production. And coal plus lignite also, this is the all-time highest ever coal plus lignite production in the history of NLC India Limited.
Okay. Just a quick update on, some of the capex that you've been undertaking. Ghatampur Unit 2 and 3, if you could tell us about that, and also the Talabira power plant. What are the commissioning timelines for all of these?
In the month of December, we declared COD of unit number 1 of Ghatampur, and we are targeting for COD of unit number 2 in the month of May, and unit number 3 by October. So by October end, the entire station commercial operation will be declared. And coming to Talabira, the contract was awarded to BHEL, and works are in fast progress. The land acquisition activities are also in fast progress. So the timeline for Talabira 3 into 800 megawatt is 2030 and 2930 in fact. And Talabira stage 2, that 800 megawatt, that also we are going to tenderize. And the timeline for that is 3031.
All right, let's focus on the renewable part of your business, sir. Could you tell us what is the current capacity? How much of it comes on stream in FY26 and FY27? And since we're talking about renewable, where are you at with regard to the IPO? When do we see that hit the markets?
At present, we are having 1.4 gigawatt solar plus wind capacity. We were the first company to add 1 gigawatt capacity in the country. And subsequently, we are targeting to reach to 10 gigawatt level by 2030. While entire globe is targeting to triple their renewables, we are targeting to increase our renewable capacity 7 times. And efforts are already on for that. Around 2.5 gigawatt of renewable capacity work is in progress in the state of Rajasthan, in the state of Gujarat, and in the state of Tamil Nadu. And we are targeting to achieve more than 50% renewable capacity by 2030. And all works are in fast progress. And recently, we won 2 major tenders in renewables. One wind power tender by SJVN, that is 200 megawatt. And in the tender floated by NTPC Green, we won 450 megawatt, and it is about to be LOA is about to be issued. And we entered an agreement with Assam government for adding a capacity of 1 gigawatt in the state of Assam. And we also entered an agreement with Rajasthan and formed JV for establishing renewable capacity of 2,000 gigawatt. With all these things in position, we are sure that we will be achieving the target of 10 gigawatt by 2030. Coming to the IPO, all the actions required for that are in fast progress, and we are expecting in the Q4 of next financial year or Q1 of the 26-27.
And sir, on this IPO, I mean, do you already have a rough sense of the total value of the assets that you will be having in that housing in that entity? I mean, the timelines you've said Q4 of FY26, and what will be the scale and size of this entity and the total value that perhaps you'll be ascribing to the assets there?
Actually, that's we are still working on that. I think the exact figure we will let you know once we finally calculate that.
Okay.
All right. We'll leave it there, sir. Thank you very much, as always, for taking out the time and joining us here on CNBC-TV18. It's a pleasure. The markets turned right back up. It gave a little bit of a wobble, and we are back up 130 points once again. 23,789, 23,790. And we are almost at the February highs now. So high is 23,807. We're at 23,785. So 15, 20 points away, the February highs for the Nifty. There you go, the brief dip. Market breadth is still 1:1. It is not 3:1 what we started with. But it looks like broadly the dip has been bought in, at least the first one this morning. Time for a quick commercial break here. We'll come back. We'll speak with the management of Titagarh Wagons on the other side. We'll ask them how execution is looking, both from the company's perspective and, of course, also awards, which were tenders, etc., which are being put out by the government. Stay tuned.
Welcome back. So green continues to be the color. Lots of individual stocks in focus. The next company on our radar is actually Titagarh Wagon. The company's got big capex plans, and the outlook for FY26 is just about coming in place. So let's get that conversation going. The company has given long-term EBITDA margin targets of about 13 to 15%. But what about a pickup in execution? Let's discuss this with Pritish Chaudhary, Deputy Managing Director at Titagarh Rail Systems. Mr. Chaudhary, thank you very much for joining in. So, let's actually start there. In Q4, has there been some sort of a pickup in execution? Because while you've had, of course, big plans on the capex side, on the order book side, what about the revenue accretion? I mean, how has it been in the fourth quarter as now you're coming up to end the year?
Sure. So the Q4 has been comparatively compared to a Q3 in terms of the wagon execution better. So as you may be aware, in Q3 there were some issues with the availability of wheel sets, which the entire industry faced, all the wagon manufacturers faced. In Q4, that situation has resolved to some extent, not fully, but it has resolved to some extent, and the production numbers have improved as compared to Q3. But we are still not at that level, that stable run rate level of 1,000 wagons per month, which we intend or which we expect that by Q1, the situation should be normalized.
So Q1, maybe you get back to full normalcy. Right now, it's only partially resolved, which means what? I mean, when you talk about your wagon segment, and let's kind of break this down. Let's talk about, of course, passenger wagons, and also give us an update on the freight segment as well. Will it be sort of a flat end to the year then?
So it would not be flat if you compare it on a year-on-year basis. Compared to the last quarter, the numbers would maybe be even a little higher as far as wagon production is concerned. But as I said, the wheel set issue that prevailed in Q3 did not get entirely resolved in Q4. So a little bit of an impact on account of that is still visible, which will get resolved by Q1. As far as the passenger division is concerned, the availability or the non-availability of wheel sets doesn't really make a difference there because that's not a constraint. On the passenger side, the Ahmedabad Metro and the Surat Metro, as well as the Vande Bharat, are actually in their design phase at the moment. And in the coming financial year, all of those three projects will actually go into execution.
Pritish, hi, good morning. Prashant here. Just to take a point, there was an article 2 days back about this wheel sets issue saying that we are going back to importing wheel sets from China. What's the basic issue? I mean, is it just sort of ramping up capacity here and we're kind of bridging the gap with these imports now? Or what is the gap really?
So the gap was that in the rail wheel factory in Bangalore, they were having some production constraints, the exact details of which are not known to me. But there were some production constraints because of which the levels at which they were aiming to produce at, those levels were not being met. And therefore, there has been a little order placed on China. But as far as the private wagon industry is concerned, the wheel sets were being imported from China and they still are being imported from China. Not just in the case of Titagarh, but in the case of all wagon manufacturers. This import we intend to stop only next year once the wheel factory that we're setting up in a JV with Ramakrishna Forgings, once that's active by Feb or March of 2026, we expect that the import of wheel sets from China, for whether it's for the private wagons or for whatever else, would stop.
All right. Well, hi, Pritesh. Good to have you on the show. Could you give us a couple of numbers, though, in terms of wagons? I think you were aiming for around 12,000, right? So by when do you get to that mark? And for the coming year, what kind of a number should we be looking at?
Sure. So as far as the capacity is concerned and the manpower availability and the entire infrastructure is concerned, we're already ready and geared to produce at 1,000 wagons per month. It's just a few external factors like the ones we've just been talking about, because of which we haven't been able to breach those levels consistently. As far as this year goes, since we're very close to the end of the year, I will refrain from giving any sort of numbers. But as far as the next year is concerned, we expect to be the standard run rate of 11 to 12,000 wagons.
All right. And you had guided that margins will perk up from here as well. 13 to 15% was the range you were talking about. We see that in FY26?
So the 13 to 15% range is actually on account of the PRS that will be achieved in a few years from now. For the FRS business, for the freight wagon business, an EBITDA level of between 12 to 13% is what we've been guiding, and that is what we'll achieve.
All right. Pritish, in terms of... So for now, I'm assuming in terms of fresh tenders, etc., being put together by the railways, I mean, should we see anything? What should we expect this year, this calendar year?
So in fact, just this morning, there were some news articles which said that in the next financial, actually, the railway capex is likely to increase by almost 15 to 20%. Now, again, these are media reports, so the veracity of those is yet to be confirmed. But the plans of the railways are very, very clear, the long-term plans of the railways. And in an industry like ours, in a business like ours, we do not expect that every month they'll be ordering or every quarter they'll be ordering. As of now, as far as Titagarh is concerned, our order backlog does see us through the entire next financial year as far as wagons is concerned. As far as Vande Bharat is concerned, it's for the next few financial years, actually. So we expect that before the current orders actually come to a close or start coming to a close, there will be further tenders floated from the railways. On the metro side, however, the story is a little different. On the metro side, since that does not directly fall under the Ministry of Railways, there are new tenders, new lines being announced, new projects being announced almost on a weekly or a fortnightly basis. So the metro market is really booming.
Absolutely. I was just coming to that, Pritesh, because if I look at the Q3 numbers, then the dispatch of metro coaches, and I understand these are lumpy businesses. I mean, this is not like, steady billing. It's not an IT services business. But I think it was only 3, the dispatch over there. So, an overall passenger rail revenue, if I talk about the passenger rail business, and that had come down quite a bit. It had kind of halved in the third quarter. So, if we talk about projections for the new year now, from the metro business, what is going to be the pickup in the business? Your sense of, and we're talking only execution and therefore revenue growth from the metro business and also from the passenger rail segment.
Sure. So we kind of expected the Q3 and the Q4 to be muted on the passenger front because the Pune Metro, which was the only project under execution, is now almost finished. And the Ahmedabad Metro, the Surat Metro, and the Vande Bharat all are in their design phase, which, as I mentioned at the beginning of my conversation, will start execution in the coming financial year. The Bangalore Metro as well, which we're doing in collaboration with CRRC, that the series execution or the series production starts picking up from Q1 of the coming financial as well. So the long story short is that in FY 25-26, all the passenger projects that we have that have been in their design phase or in various phases leading up to the execution will actually start execution.
First half or second half, Pritesh? This is going to be more back-ended, second half FY26, or will Q1, Q2 also start showing up, more traction?
So some projects, it will be across the year, ma'am. So Vande Bharat, for example, will be in March of 26. So absolute end of the next financial. Ahmedabad will be around the end of Q1 or beginning of Q2. Surat will be shortly thereafter. Bangalore actually starts from the beginning of Q1 itself. So it's all spread out a little bit, actually.
Okay, all right. Thank you very much, Pritesh, and good speaking with you. That's Titagarh Rail with perspective on their business and, of course, a bit about the industry as well. That wheelsets issue, perhaps still a factor for now for them and other players as well, like Texmaco, etc. as well. But otherwise remain very, very positive. Let's talk about now demand as far as the consumer durables space is concerned. Summer demand is sort of course, starting to pick up in certain categories. We've sort of got that feedback from companies like Blue Star, etc., that we have spoken with. We have Premchand Devarakonda, Chief Financial Officer at Electronic Smart India, and Biju Kurian, Chairman of Retailers Association of India, to give us a sense of how things are looking. Gentlemen, good morning. Good to have both of you here. Prashant here. Mr. Premchand, if I can start with you, sir. Could you give us a sense of how, this quarter, Jan to March, is panning out like? I mean, you typically evaluate your business on a Jan to June basis to cut out seasonality. We are, of course, not there yet. We're just at the beginning rather than at the end. But how are things shaping up for you on the consumer durable side?
Good morning. First of all, thank you very much for having me on your show. After witnessing a little bit of disappointing third quarter, so this fourth quarter is quite promising, and we did see decent demand for the consumer durables in the fourth quarter of this year. And I think the trend is going to continue further till
I think we'll okay, I think Mr. Premchand, can you hear me, sir?
Yeah, now I can hear you. Yeah.
Okay, there was a bit of a scratchy line there. So could you put that in numbers, Mr. Premchand? 9-month same-store sales growth was about 3.8%. You said Q4 is looking very promising. Could you give us what Q4 may look like? I mean, you don't have to give a precise number since the quarter is still on. But 5% plus, what exactly are we looking at? And also, if you can provide us with some targets for same-store sales growth for next year, FY26, sir.
See, SSG, because about more than 65% of our top line is contributed from Hyderabad. So since the base is very high, expecting like a double-digit SSG from Hyderabad region is little, it's over-optimistic, but we are expecting mid-single-digit SSG coming from Hyderabad cluster. And in other clusters like Telangana and then Andhra Pradesh and North cluster, there we could see a double-digit SSG coming in from these three clusters.
This is for Q4.
Yeah.
So on a blended basis, on an overall basis, what are we looking at? If you can give us a sense.
See, overall for the Q3, it will be on between 5 and 6%.
You mean Jan to March?
Yes, I'm talking about Jan to March.
Okay, and beyond that, I mean, is too early or you have some visibility? Will you be able to improve?
See, for the next year, at the company level, we are expecting mid-single digit SSG because last year base was very high. That's the reason why it is going to be like mid-single digit for the next year also.
All right, Mr. Premchand, got that. Stay with us. Let's get in Mr. Biju Kurian as well into the conversation. Hi, Biju. Good morning and thanks a lot for joining in. What are the demand trends that you have seen so far in Q4 ahead of the summer season? And also, if you could give us your sense, which are the key categories that are doing well and expected to do well?
Well, I think overall, when I take into account all the categories, what we have seen is a very subdued growth in Q4. Now, whether this is because of absolute consumption, whether this is because of the consumer sentiment, and typically the stock market has a very critical role to play in terms of consumer sentiment, all of these have truly affected the way the business has actually turned out in this quarter so far. Some categories, obviously, like food and grocery, has remained steady, mid-single digits in terms of growth. The apparel industry is close to zero in terms of growth. The electronics industry, again, which is largely led by the introduction of new products, as well as the introduction of new occasions. So typically things like a World Cup football, IPL tends to drive some upgradation in terms of purchases, or new mobile phone launches also tend to do that. There hasn't been too much happening in this quarter so far, and I think that has kind of tempered the growth. So as far as the overall retail industry is concerned, we are seeing a relatively stable market, not much of a growth like we had seen earlier. So I think that's the larger RAI view on this.
Okay, so you spoke about two industries, electronics and apparel. Would you be in a position, Mr. Kurian, to talk about consumer durables? I mean, large appliances, etc.
Yeah, electronics also, includes consumer durables, and what we must see. Yeah, so when we talk about it, and if you were to look at it segment by segment, the large three categories are televisions, mobile phones, and appliances. Now, televisions largely driven, as I mentioned earlier, by sporting occasions. Mobile phones largely driven by the introduction of new models, which are, really killer models. And then in terms of appliances, is mostly through penetration and upgradation in households. The penetration and upgradation in households continues to happen. However, appliances as a part of the consumer durables market is a smaller part, while televisions and mobile phones tend to be much larger in terms of contributors. So while appliances have done relatively better, televisions and mobile phones have been slightly weaker in terms of growth, which is the reason why the category as a whole tends to be at maybe between 5 to 8% in terms of like-for-like growth.
Okay, got it. So some slowdown trends quite evident. And you're looking at mid-single same-store sales growth. This mid-single-digit growth has become quite synonymous with most things consumer. Mr. Kurian, if you could just expand on that point, this gradual slowdown in demand that we're seeing, how much is it a function of maybe tighter financing, lesser availability of just funds with households? And do you have reasons to believe that now with the RBI also easing, and obviously now we've got the income tax bonanza as well, do you have reasons to believe that FY26 could be substantially better?
Certainly, there's a lot of hope about the future. But more importantly, I think when we talked about household finance, the RBI has actually come down quite heavily on personal loans. A lot of personal loans were used to drive appliances purchase as well as some durables purchase. So that to some extent has affected because there is both secured and unsecured. So the EMI model continues to work well, whereas the non-EMI model is where there is a bit of a challenge. In terms of general consumer sentiment has been a bit damp. Two reasons. One is that even though you might not be heavily invested in the stock market, but a decline in the stock market tends to bring down the mood of consumers. That's one part of it. And the second part of it is that we've also been hearing some early signs of layoffs in the IT industry, etc. And that is another reason why there is a little bit of concern about job security. So when the future doesn't augur well, then what tends to happen is that the consumers tend to be a bit more conservative in terms of spending, not so willing to be able to open their wallets. So I think that's one part about it. As we go along, and if you were to look at the kind of savings that have happened, and that savings have happened largely in the lower tax brackets, which is up to 10 to 12 lakhs. But if you really look at, where a lot of India's income is, a lot of India's income is actually in the greater than 10 to 12 lakhs. So you do have a part of the middle class which gets covered by the tax savings, but a lot beyond the middle class who are actually drivers of categories like consumer durables still really don't have any tax savings, but for them, really, these tax incentives were not the big driver of purchase. So, the lower middle class, you might see a little bit of impact in terms of consumer appliances penetration levels and purchases. So that's our view. FY26 is expected to be better. A lot will depend on how the rural markets perform. A lot will depend on what happens in urban. So I think we're all looking forward with a lot of anticipation to FY26.
I mean, we can hope, right? That's certainly the case. 1st of April, by the way, those 1 lakh crores worth of tax breaks start to kick in. I mean, it'll show a few months to start to take shape. And maybe on the 9th of April, RBI will cut rates, and that'll be the beginning of a few rate cuts as well. So there are, at the margin, maybe things which are lined up. Mr. Premchand, if you can hear me, sir, you are, as you said, Hyderabad, Telangana, Andhra. I mean, these are all, that's one spot where, which is still, and Mr. Kurian mentioned about some IT layoffs, etc. The one industry which is doing extremely well is global capability centers, GCCs. And every day you hear about some GCC or the other setting up base or wanting to set up base, signing up with the government in that zone, in the markets that you operate in and on which you're very heavily reliant. Does the underlying sort of consumer remain strong in those markets that you operate in, or is there any weakness there as well? Mr. Premchand. Mr. Premchand, can you hear me, sir? Okay, I think we don't have him. So a bit of a tricky, patchy line. I think we'll wrap up this discussion. Mr. Kurian, thank you very much for the insights. Both of you, by the way, spoke about stock market decline and the market's coming up. So maybe at the margin, that is also a factor which perhaps will work and we'll see. Thank you for that. Thank you for those insights and appreciate your time here on CNBC-TV18. I think we'll just look at the market, which is up 200 points now. So this is now, I think we need to put bigger targets. I think that's the only way. At 190 points now, 23,847. The February high is come and gone. And this is turning out to be another, super day. Mitesh is back with us. Mitesh, it's a surge. Once again, what would you do?
That's right, Prashant. And in fact, I was looking at the weekly charts on the indices because now the weekly indicators have started turning up. It started with the hourly indicators last week, then the daily indicators, and now the weekly indicators are turning up. Very likely that, we will look at extension of the upside targets in the Nifty to about 24,750, 800 zone. So we now have more space to go up further. But let's not forget the kind of rally which we have had. So again, the idea is that use declines to buy into. Today we got an intraday dip. I would have hoped for more. My best entry point on the Nifty would be around 23,600. In case we get it, if not today, maybe in a day or two. But yeah, I think we're heading much higher, and we'll make the sequence of higher highs and higher lows on the hourly to hourly charts. So trade with long bias. Today, I think, some kind of reversal, Prashant, is also seen in the Nifty IT index. So if you look at the IT names, you will find good traction being built up over there. So I have a buy on HCL Tech. It's coming after a long time, but HCL Tech is a buy with a stop below levels of 1630 for targets of 1695. And the other one which I like is Info Edge on Naukri, which I would recommend buying with yesterday's high as the stop loss, which was around 7160, so about a 150 point lower, and a target of 7650 on the upside.
All right. Thank you for those trades, Mitesh, and appreciate it. We'll take a quick commercial break here. On the other side, Manisha will focus on commodities, what's top of her mind, coming up in just a bit.
The shakeout has been good. It has tested you. It has, proven that you have a conviction in what you buy. And there's no something called easy money on the Lal Street, as everyone thinks that I buy today, make tomorrow, which had gone on for a few years. But all the veterans have told you that, wait, when the correction comes, people will panic. But I think if they hold true to the flag and, I think it's great. I think the domestic money prospering or domestic India is great. We welcome foreign money, we welcome foreign capital, but they have a right to sell, and I don't begrudge that.
Okay.
Market is a self-correcting mechanism. If you take stocks to
Welcome back. Markets holding strong, and as we pointed out earlier today, the sector to watch is going to be the tech pack. That's the one that's making the big bazooka move today, up close to around 2% or thereabouts. The tech pack comes up for you on the screen. For the time being, let's turn our attention a little bit away from the equity markets and focus on the commodity space. Manisha Gupta is standing by to tell us exactly that. Manisha, take it away.
Thank you for that, Nigel. I'm looking at metals prices because we're looking at very strong gains continuing into this one, and the outperformance clearly coming in from copper, which is very close to its all-time highs. Actually, when you look at the COMEX prices, we're just about 2 cents away from its all-time high of $5.2 per barrel per pound there. So very strong gains continuing into this one. And interestingly, even as on LME, we've seen prices gain up by 13%, but in the COMEX, you have seen prices gain up by 28%. That's the kind of disparity that we have seen on prices, and is the reason you're looking at US copper premium at LME standing at $1,500 a ton there. Well, various supportive factors there. To begin with, it has been about potential US tariffs of 25% perhaps coming in copper, and that has led to a lot of copper being shifted from various other geographies into US. Apart from that, it also is about new stimulus measures coming in from China and more anticipated. And then the markets also are looking at deficit concerns. Almost everybody, all brokings and banks have talked about big deficit in this year and the next as well. The latest report comes in from JP Morgan, which is talking about a big deficit of around 3 million tons every year by 2030. JP Morgan also talks about all-time high prices in this year, and their forecast for copper for this year is $11,500 a ton. Not too far behind is zinc, which, by the way, is an underperformer in this year in the metal space until now, but it also has seen good gains in this week. It's trading at a 3-month highs, and we also are looking at reports coming in from Nyrstar Australia announcing a 25% output cut for the year, and then Alaska Red Dog Mine, which is 10% of where global zinc comes in from, also is looking to scale back because of ore depletion for 2025. The markets also are looking at unprofitable TCs, and that has led to lower production from China, down by nearly 7% in sense of refined zinc production for the year 2024. When you look at 2024 reports as well, it also will tell you that the global zinc output fell for a third straight year in 2024. If the demand starts to come back, then you are looking at zinc prices going higher. Also, when you look at the LME as inventories, LME zinc, high zinc grade inventories have declined by 74,000 tons in this year and stand at 160,000 tons. So everywhere that you look, you are looking at strength continuing in case of prices. One last table should show you on what we've done as this quarter ends in sense of many of these metal prices. These are LME prices, but let me tell you, copper is up 13% on LME. It is 28% higher in the US markets right now. Aluminum, 2.5% higher on LME. It's up 15% in the COMEX markets right now. So that disparity is quite huge as we look at LME and the US markets. Nickel is gained up by 5%. And remember, 25% of those tariffs have come in on aluminum and cobalt as well. So cobalt, which was an underperformer last year, is up 38% in this year. Zinc continues to be an underperformer, and we've seen tin prices gain up by 18% because of inventory declines and production concerns as well. So overall, metal pack slightly taken down by zinc, but otherwise doing quite well.
All right, thanks a lot for that, Manisha. From metals, let's focus on cement. And UBS has gone ahead and upgraded the cement sector. They believe that the rough patch is coming to an end, and so they've upgraded Ultratech Cement, Ambuja, as well as Dalmia to buy. Remember, UBS had a negative view on the sector since July 2023. Due to rising competition, demand slowdown due to general election last year, and also rising price competition after Adani's entry. But now, UBS has done a bit of a U-turn. They've gone ahead, they've turned positive. They anticipate earnings upcycle to emerge from this fiscal onwards. And for the next couple of years, they are focusing on solid EBITDA growth. Their positive stance is backed by demand revival driven by housing upcycle and revival in government capex. The structural cost savings measures, that's what's going to help margins of all these companies. And they're citing bottoming out of prices after the sharp fall we have seen in the 9 months of FY25. Sector consolidation as well has been led by the top two companies, that's Ultratech as well as Ambuja. This chart should come up for you on the screen, and they've given reasons for upgrading the various stocks. Ultratech has shown execution in tough times, both on the growth as well as on margins. Their top pick, though, is Ambuja because of the higher growth as well as lower valuation. And on Dalmia, they've done a U-turn. They've upgraded the stock from sell to buy, while on ACC, as is they were positive, they believe that the valuations are supportive and there is an industry tailwind as well. Put all this together, cement stocks are doing quite well in today's trade. Well, time to slip into a short break. On the other side, we'll focus on a special segment. It's the economy. Lata speaks to the head of Credit Bureau, CRIF, on whether MFI loans and unsecured loans are showing less or more defaults. Stay tuned for that conversation.
It's the short seller will step in, or the promoters will sell in, or the insiders will sell in and want to encash it. So that will act as a natural check on the market, which it has done. As long as there's not any undue amount of leverage in the system. There was, I think, 70,000 crores of margin funding, which is the size of a small mid-cap company in India today. So there's no leverage. The banking system has no leverage. The government had fiscal restraints. So, in fact, money was tight. So there was no reason to believe that this would be a long-lasting bear market.
Sure.
And market will correct itself. Anytime the valuations of something become excessive, people step in and sell, insiders sell, someone sells, and that creates a buying opportunity. First correction in 4 or 5 years, so it was particularly severe. And market correction is always severe. It always kind of panics you and tests your conviction, tests your patience, which is all the things that it did. But they are short, sharp, and swift. As you saw, the index fell very sharply and very swiftly, almost without respite, 800,000 points a day after that. But my feeling is that that is just a correction in a bull market, not the topping of a bull market. The reason I say that is even when the fall started, individual stocks were making new highs, new all-time highs. Bajaj Finance, United Phosphorus, Shree Cement, so many companies, good high-quality businesses were making new high. That would typically not happen in a bearish phase of the market.
Welcome to It's the Economy. Today we are looking at the asset quality of banks, the amount of defaults. We are looking at NBFCs, MFIs, all categories of lenders. Now, two sets of loans have been showing a worrying trend, a worrying rise in defaults in 2024. The microfinance, MFI loans and unsecured personal loans, credit card loans, uncollateralized loans. Is there any improvement as we enter into 2025? Now almost one quarter is over. To answer this, I have with me perhaps the person best suited to it, the Managing Director of a fast-growing credit bureau, CRIF Highmark, Sachin Seth, Chairman at CRIF Highmark and Regional Managing Director at CRIF India and South Asia joins us. Thank you very much, Sachin, for joining us. Well, first up, let me get straight away to the microfinance. That is the category that is worrying people a lot. So how does, I believe you have January data. Is it looking any better or much worse than, 2024?
Thank you, Lata, for having me. And, really pleasure to be here. I do agree that, microfinance has given a lot of sleepless nights to people this year. I was on the show in January with you. And from then on, there has been, I must say that while a lot of action has been taken by everyone in the ecosystem, but still, I think there is seems to be a certain decline continues. So if I give you the data, if I talk about portfolio at risk from 91 to 180, which is considered to be the very important parameter to look at the portfolio, the health. So March 2024, it was at 0.9%. September 24 data, what we discussed in January, that was about 3.2%. As of today, is 3.6. So I would say the rate of decline of the portfolio definitely has reduced significantly, because between March and September, it declined, very, very drastically. But from September to January, which is the latest data which you have as of today, nobody has in the industry, which we've called out for you, that is about 3.6%. So it is reducing, the decline is reducing, but yes, it has continued from September till the data of end of January at this moment. And the
declining, one minute. What is declining? Total amount of lending is declining. But what about defaults?
Yeah. So basically, the default percentage has gone up. When I say the loan portfolio at risk, when I say 3.6% is basically portfolio, so that's increased. but the book size has declined. So book size obviously was in March was 4.42 lakh crore, and it has come down to 3.86 lakhs crore, which is almost a 13% decline of the book. Yeah, so you are correct. I mean, the book has declined, and the portfolio at risk has gone up from 0.9% to 3.6%. So that's understandable.
Okay. Are people able to show any better collections? I mean, that's the data that MFIs normally release, net collections. So collections are going down, you're saying? And is it going down for all categories? 30-day default, 60-day, 90-day, all of them are collections going down?
So there is I must say, silver lining here. Till December, we were seeing that collections were, improvements were not happening as people had expected. But from January, the trend is showing that there is an improvement between, let's say, up to 30 days. There is a 5% improvement in the forward flow rates basis, net forward flow rate, NFF rates, what we call it, right? Okay. So there's a 5% improvement there. In 31 to 60 days, it's about 11%, and 61 to 90 also is about 11%. So there's a silver lining here. So definitely there is collection rates, which is basically moving from one bucket to another and offsetted by the collection from next bucket to previous one. That's we call NFF rates. There is a 5%, 11% and 11% improvement. So that's what I can tell you, that may be the sign of things to come. But as of today, it's just an indicator. Yeah.
So, most of the MFI, we had Sanjay Agarwal of AU Small Finance. Before that, we have had many MFI people. Their point is that Q4 will look bad and it will start showing improvement in April, May, June. Would that be your view? I mean, it's a forward-looking statement.
I would say, given the indications I just shared with you, first of all, a couple of things on this. First of all, the SROs have put guardrails. I've been meeting a lot of CEOs of MFI organizations for the last couple of months, and I think everybody has been very cautious. They have been very, very cautious about the way they underwrite loans. So all that is showing results, I must say. And I think probably, it's a matter of, I really can't forecast that whether it's a 1 quarter or 2 quarter or whatever. But yes, definitely, I think the results have started showing. Now, how much time it will take to really solve the problem, we'll have to see. Okay. But yes, we are in the right direction.
Okay. All right. Now, let me come to the more important unsecured loans. Can you tell us whether in unsecured loans, so I think unsecured would be what? Credit card loans. Is there any higher default rate?
Yeah, so unsecured is covered in, you have credit card loans, you have personal loans, consumer durable loans, and some of the business loans, etc. So there, I must say that at this moment, credit card definitely remains under stress. And credit card, if you talk about 91 to 180 days DPD, it was January 2024. If you compare with January 2025, it was 6.94%. Was in January 2024. And today it is actually 7.9%. So definitely, and under 50,000 kind of limit cards are really under a bit of a stress, more than anything else. But if you ask me, personal loans, which the growth rate was very high, but because of regulator being vigilant about ensuring that we don't create a sort of a bad book there, and also there were a lot of stringent norms were put which were in the favor of basically making a stable environment. I think personal loans remain stable, so we have delinquencies 1.1%, and they remain 1.1% today. In the last 1 year, they have not increased. Only the growth of PL book has reduced from 40% a year to maybe 11% now, and business loans also about 1%. Was last year and remained 1.6% last year. It remains 1.6% now as well. So it's stable. So other than credit card, if you ask me, unsecured loan book remains more or less stable because of the actions taken by various ecosystem players and regulator. But credit card definitely is about 1% more than what it was here in terms of stress.
Yeah, I get that your table is very clear, but I couldn't put that entire table. But credit card loans clearly defaults going up or still high. What about even secured loans? There was a stray, I can't remember who said it, that even two-wheeler loans there have been rising defaults. Now, technically, these are secured, but what is the experience in these kinds of loans, two-wheeler, commercial vehicle?
Yeah, two-wheeler loans in between. I mean, so if you talk about data from January 2024 to January 2025, I mean, it has been very minor changes. While on a face of it, it did look like there was a sentiment that, it would go up. So it was 1.7% January 2024. It was around June 1.6. September, December, it was 1.8. So there was a bit of a stress, which was people were feeling that it would cause. But January data is showing very good signs, and we are about 1.7. So we are back to the normal, so January 24 and 25 is exactly the same. So I must say that, we are doing good. And I think I don't see any need of concern. But obviously, we need to be vigilant because it is hypothecated loan, but it is as good as the consumer durable in terms of size and or a PL in terms of the loan ticket size, etc.
Okay. Well, time permitting, I'll come back to this personal retail loans. Let me quickly go through MSME loans or what you call business loans. Is there any improvement in terms of amount of loans given as well quality of loans? What are the trends?
Yeah. So I think MSME loans, I mean, obviously there is, in terms of loans, there has been uptake in MSME loans there. But I would say right now, people are, cautious in giving MSME loans as well because of the current trend, which is in the market in terms of now the MSME, definitions are also changing, and people are looking at micro segments also. And micro segments are a little bit more riskier, and people are looking at new economies of which are coming, typically the e-commerce loans, etc. But if you ask me, typically people who are in MSME loans, commercial vehicle loans, etc., more or less it is same. And I mean, it was like at 1%, 91 to 180 days delinquency in January 24. It is 1.5% today. So MSMEs, which are dependent on wheels kind of loans, are basically more or less same.
Okay. Now, yeah, you do have a category of secured business loans where the portfolio at risk seems to have gone down. So maybe that's something positive. Sachin, finally, instead of me throwing categories at you, you tell me as key takeaways, where are the areas of worry in terms of retail loans? Where are the areas you won't worry?
Okay, so Lata, I must say that, right now, offtake of loans around housing, around gold loan, around loan against properties, and basically, and business loans have been pretty good. And I think these loans are doing well. Obviously, I must also say with the caution that, many of the personal loans which were coming to personal loan and now personal loan are being given with much more stringent norms. A lot of people are going and putting gold and taking the personal loan against that for the uses which were again PL. So I would say we have to be a little bit cautious on that. But yeah, if you ask me from lender's perspective, it is highly secured. Risk is very low. So anything which is, housing, loan against property, business loan, and the gold loan. I think these are the loans from lender's perspective considered to be the low risk, and they are on the high end.
Okay. All right. We'll leave it at that. Thank you very much for a great 360-degree perspective on retail loans and MFI loans. Thank you very much, Sachin, for joining us. We really appreciate it. I think the areas of worry, as Sachin points out, is still credit card loans and MFI, a little bit of improvement, but perhaps we have a bit of distance to go. Secured loans, on the other hand, including two-wheeler loans, are not a spot of bother. And of course, secured loans like gold and LAP are doing very well. With that, we wrap up on Bazaar. Chartbusters coming.
If you're booking an Ola, Uber or Rapido in Hyderabad, it could be a sweltering ride. Cab drivers have launched a no AC campaign, refusing to turn on air conditioning to highlight their financial struggles. For many drivers at ride-hailing platforms, driving a cab is no longer financially viable After operational costs and platform commissions, they're often left with earnings that barely cover their daily expenses, forcing them to make tough choices like turning off the AC. And so the Telangana Gig and Platform Workers Union has launched this No AC campaign. What are their concerns? Fuel prices are high and running AC means burning more fuel, making trips less profitable. Second is low earnings. Drivers say Ola and Uber take 30 to 40% of the fare, leaving them with just 10 to 12 rupees per kilometer. But operating costs with the AC turned on rise to 16 to 18 rupees per kilometer. Essentially, the driver is left with very little in hand. And so drivers are demanding higher base fares to cover rising costs, lower platform commissions and government regulations to ensure fair pay. The union is also pushing for a Telangana gig workers' rights bill, and if their concerns aren't addressed, they plan to escalate the protests nationwide. While Hyderabad's campaign is making headlines, this isn't new. It has been happening in Hyderabad and even Bengaluru. Drivers in Bengaluru have unofficially stopped using ACs for more than a year. In 2024, drivers even demanded 5 rupees per kilometer extra for AC rides, but this wasn't officially implemented by ride-hailing apps. Most drivers just simply refuse to switch on the AC unless riders insist, and even then, some decline. Now, as the mercury rises, so have passenger complaints. This begs the bigger debate, which is who pays for the AC. Passengers expect an AC cab, especially in the scorching summer heat. Drivers say they can't afford it unless fares increase. Ola, Uber, Rapido haven't provided a clear solution. No pricing model for AC usage, no opt-in feature either. So should drivers absorb the cost or should riders pay extra? Let us know what you think in the comments below. There doesn't seem to be an easy resolution to this tug of war. Perhaps us riders should consider investing in one of those handheld fans for now.
Cement stocks climbs on the back of a sectoral upgrade coming in from UBS. The brokerage believes that the rough patch for the sector is coming to an end. Upgrades Ultratech, Ambuja and Dalmia to a buy rating.
IT stocks gain, and the IT index is in fact the top sectoral gainer on the back of a good handover from Wall Street as Nasdaq surges close to 2% overnight after CLSA's upgrade yesterday. UBS also turned positive on the sector, expecting near-term rebound in multiples.
IREDA climbs more than 3%, now up around 1.5% after the Reserve Bank has revised priority sector lending norm guidelines. Among the key changes is the eligible loan limit, which has increased in the range of 35 to 50 lakh rupees.
Suzlon trades high after Motilal Oswal initiates coverage on the stock with a buy rating, target price at 70 rupees, expecting an EPS CAGR of around 63% till FY27.
Hindustan Copper trades with cuts of nearly 2.5%, while Polycab is about 3% higher. Both these stocks move as they exit the F&O banned list.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. And as you could see to the top of the screen, the Nifty is holding very, very strong. However, the mid-cap index today, after a few days, is doing a relative underperformance. The Nifty Bank, though, doing well. And the one that's come back into shape, Mangalam, is the tech index. That's been a relative underperformer. We pointed this out earlier this morning as well. It's at a very, very crucial juncture. Fundamentally, a couple of brokerages have upgraded the sector. And also, it's currently at around the 20-day MA. Still a rank underperformer in 2025 so far. But the tech index is the one that's showing some signs of recovery.
Yeah, it has been an underperformer in the past as well. What's interesting is, however, after a 1600, 1650 point rally on the Nifty itself, some pause for breath, or perhaps, the markets consolidating at current levels is usually par for course, more so in the mid-cap end of things where, the rally has been a lot harder. So maybe some bit of profit taking can't be ruled out. And that's exactly what the advanced decline ratio is indicating as well. 1700 stocks which are declining for about 840 stocks which are advancing. The mid-cap index at the lows of trade. buying the dips in the last 10-15 days has worked a lot better than chasing rallies, and that perhaps may be the case today as well. Yesterday we had pointed out that, even as the Nifty and all the other indices were higher, the India VIX was up by about 9%. And today is the case as well. With the market moving higher, one would like the India VIX to be lower, but then again, the fact that it is moving higher tells you that there would be some sort of protection buying on the downside as well. But we're not the experts here, we're just analysts, and we have Shilpa Raut who joins in for a quick chart check on where the indices could go from here. Shilpa, has been a big rally that we've seen. Maybe is it time for pause for breath and buy the dips, or maybe you believe that this momentum will continue all the way up to expiry?
Good morning, Nigel and Mangalam, and thank you for having me on the show. I believe the momentum will keep extending towards 24,200, 24,500. At least during this expiry, we might see levels of 24,000 and above, hitting very likely. So, buying the intraday dips is also very much fine. You keep a stop loss of 20,650 and stay long, and you can see levels of 24,000 to 24,200 coming as well. For Bank Nifty, the sustenance above 52,000 is very crucial. If it does, then levels of 52,500 to 52,750 will also be hitting.
Okay, all right. Let's talk about a couple of stocks. And Shilpa, what's on your radar?
I have two buys. The first one would be a buy in Max Health. Max Health is looking too strong. We have seen the past 15 days as well. The stock has been gradually showing a lot of strength, and it is only continuing to do so. In April series also, I believe 1200 to 1220 targets should be getting hit very soon with a stop loss of 1140. So one can also trade in 1200 call option for April series at 42 rupees. Keep a stop loss of 30 and look for targets of 65 to 70. The other one would be a buy in Godrej CP. Godrej CP is also looking outstandingly, bullish, and the stock trading at around 1130 levels. I believe you keep a stop loss of 1100 and stay long and look for targets of 1180.
All right. Thanks a lot for that, Shilpa. Godrej Consumer is one of the buys that she has. Let's get you some more ideas of profit as well. We have our colleagues from Money Control Pro joining in. Nitin Agarwal is the one who's joining in today with the stock that he's tracking.
The company that I have chosen for today is eMudra Limited, a license certifying authority involved in issuing digital certificates in India. First, let me touch upon its Q3 number. The company recorded a YOY growth of around 42.6% in its top line, driven by 53% growth in its enterprise solution and 9% growth in its digital trust services. However, what continues to spook investors is the significant contraction in its EBITDA margin, primarily due to the regulatory changes. Now moving on to the outlook, there are a couple of factors that make us upbeat about the company. First, the digital trust services, which has been not performing well for last 3 quarters. However, the management has indicated that they have devised a strategy which will give them some pricing power and help company to improve its EBITDA margin, and the impact of which is expected to come in next 2 quarters. Moving on to the enterprise business, it is the place where the company continues to register significant growth. The company continues to have a strong deal wins and has a very strong pipeline in this particular business. The company got new businesses from APEC, Middle East and Africa businesses. The management continues to be bullish on the company, and they have guided around 25 to 26% top line growth in the FY26 and bringing the EBITDA margin back to 23 to 24%. Now, in terms of valuation, after correcting significantly from its 52-week high due to the market volatility and the EBITDA margin contraction, the company currently trades at around 42.4 times, which we believe is reasonable and captures the whatever the negative the company had.
All right, with that, we'll slip into a short break with the news that a couple of stocks are doing fairly well. Piramal Pharma, for instance, is up around 7%. Remember, the stock has been a bit of an underperformer this year so far, down about 12%. Not too different from the way the mid-caps had been falling, but now seeing some pickup, and Piramal Pharma stands out because the other pharmaceutical stocks actually are underperforming in today's trading session, so just keep an eye out on that one. Take a short break, come back, focus on a lot of other stocks which are moving down. Now, a couple of broader markets names. We have Dixon Tech, which is down about 5% right now. It's, turned negative for the week after today's downtick. And not to say that there has been too much of a week behind us. We have Kalyan Jewellers, which is down about 3.5% as well. And HFCL is the other one from the F&O space, which is down about 3.5% as well. But let's focus on the CRDMO sector. Kotak has issued a note on the contract research and manufacturing, operations in pharmaceutical companies. They've initiated coverage on some stocks from that space. What does that mean? What are these stocks and what are they saying? Let's get across to Vinny. Vinny.
Hi, morning. So we're looking at this CRDMO space, which is contract research, development and manufacturing. So it's a sort of third-party manufacturing for pharmaceutical companies, right? So on the basis of that, they have initiated coverage on some of these names. Piramal Pharma, they have initiated the buy rating, target price of 300 rupees per share. Then they do have Syngene, which they're initiating coverage, buy rating on this one as well, target price of 700 rupees. And for Sai Life Sciences, they have initiated coverage, reduced rating, target price of 875 rupees per share. Now, what they believe as factors that we know that will support the CRDMO side is going to be in terms of the rising research and development outsourcing that has been increasing. The shift that we've been seeing coming in from China to other countries is something on the supply side from innovators, is something that will be the key for these companies in terms of orders as well as the inquiries that they've seen. Other than that, they expect this segment to actually, quadruple in the next decade. So that is an important one. And over the last few years, since 2005 to now also, they've seen a sharp jump up in terms of this segment, in terms of outsourcing, the spending that has come in for India. It's at around 42% now versus in 2005 it was just at 18%. So a lot that is playing out for these companies on the India front, CDMO side especially, and skill talent, low cost structure. These are some of the factors that will support the growth of these companies, and that is why they're positive on these stocks.
Okay, Vinny, thanks a lot for running us through that note. But Mangalam, tell us about Macquarie. They have written a note indicating their preference for restaurant companies over food delivery aggregators. Tell us more.
Yes, we had pointed out that there are things which are turning in the QSR space, as data in the recent past would tell you, and the growth rate of a lot of these food delivery aggregators were also lowering in terms of what they had done in the past to now itself. And now Macquarie has written that they prefer restaurants as higher discretionary incomes, which would come in on account of the tax cuts that were announced in the budget, would drive a recovery there more than food aggregators. In fact, in the food delivery aggregation space, gross order value growth driven by user additions and stable economics is what they expect, but they're cautious on Zomato and Swiggy. On the other hand, they prefer playing this theme. If you were to play the, eating out or food delivery sort of food theme itself, you play it via either Devyani International or Westlife Foodworld. Devyani International marginally in the green right now. Westlife Foodworld doing slightly better as well. There's been a leadership transition out there. But on the way down, where they say that they're cautious on Zomato as well as Swiggy, these stocks are a wee bit under pressure. Now, a larger point here would be that, for Zomato and Swiggy, the big driver for margins would have been the food delivery business, whereas the investment areas would be quick commerce. If there is slowdown in the growth of food delivery itself, then how do you get the money to fund your quick commerce foray? Even if you do have cash on your balance sheet, the EBITDA multiples may perhaps come down, largely because the cash generator of your business is slowing down, whereas your investment in quick commerce is not. Whereas for the others, the quick service restaurant players, QSRs, they have been beaten down out of shape. So from current levels, valuations are a lot more supportive. And the other part is that, they've also figured out delivery versus the others. So maybe all those factors doing well for them. So if you have, names like Jubilant Foodworks, that's moving higher. You have, Devyani International and Westlife, all of them in focus too.
All right, Mangalam, thanks a lot for that. Well, let's hop across to Vivek. He's here to tell us about Suzlon. That's moving in high in today's trading session. Brokerage firm Motilal Oswal has initiated coverage. Vivek, tell us more.
Well, that's right. Like you mentioned, it's Motilal Oswal that's written a note on Suzlon today, and they've initiated coverage on the stock. They have a buy rating. They have a target price of close to 70 rupees a share. What is it that they're targeting in terms of valuation? They see target valuations at 34 times December 26 EPS, which is a slight premium to the historical average 2-year forward P of 27 times. Now, what is it that the company has said and what is it that Motilal Oswal is actually taking away? Company has said that they expect wind energy installations to reach approximately 4 gigawatt in FY25, 6 gigawatt in FY26 and 7 to 8 gigawatts annually from FY27 onwards. On the back of that, they expect Suzlon's order book execution to be close to 3.2 gigawatt in FY27, and they're estimating CAGR of 51%, 52% and 63% of revenue, EBITDA and adjusted PAT over the period of FY24 to FY27. They expect consolidated EBITDA margins to be in the range of 14 to 16% in FY25, 6 and 7. So overall, a positive note coming on Suzlon Energy, and this on the back of the fact that they expect wind energy installations to pick up materially from FY27.
Take that point, Vivek. Thanks a lot for that. Suzlon Energy has been a big mover in the past as well. Motilal Oswal believes there could be more for Suzlon Energy itself. Though the stock which is always in the news is Ola Electric, opened higher, thereafter saw a bit of a sell-off, currently at the low point of trade, and that's despite the company saying that they've cleared all their dues with the Rosmerta Group. Sudarshan joins in to get the details. Sudarshan.
Yeah, so it's a case between Rosmerta Group and Ola Electric. If you remember, last week, Rosmerta Group had alleged default and had moved NCLT Bengaluru in the same case. Now, today morning, Ola Electric disclosed to exchanges that the case between the company and Rosmerta Group has been resolved, and now Rosmerta Group has agreed to withdraw its petition from NCLT Bengaluru. And after Ola Electric's disclosure, even Rosmerta Group had disclosed same information, saying that yes, the disputes between both the companies have been resolved and the group has received the amount of nearly rupees 27 crore that it was asking for from Ola Electric. And Rosmerta Group basically is the agency which registers the vehicles being sold by Ola Electric, and that's the reason Ola Electric had opened higher, but now it's in the red. Okay, all right. Thanks a lot for that, Sudarshan. Well, time to slip in a short break. As we do that, here's some good news for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app from the Apple Store or Google Play Store, or simply just scan the QR code that's up for you on the screen. Well, the markets have come off a little bit from the top, and the reason is a few stocks have slipped. Pull up Mahindra and Mahindra, you'll see the intraday chart will tell you the picture. That stock has come in a little bit lower. You have IndusInd Bank, that's the one that was underperforming yesterday as well and continues to underperform even in today's trading session. And pull in a couple of other names. Adani Ports is lower as well as Nestle. So some of these names from the Nifty pack itself, they've seen a sharp slide from the high point of the day, which explains why now the markets are up only around 70 points. When we started off the show, we were up more than 100 points or thereabouts. But let's focus on the oil and gas space. Both ONGC, that's the oil producer, as well as OMC, which is the oil marketing companies. Sudarshan joins us to tell us about the news flow overnight and the impact on these stocks. Sudarshan, take it away.
So all the stocks that you have mentioned are currently in the red, and it's on the back of announcement of US President Donald Trump. He announced that he would be imposing 25% tariffs on all the countries that are planning to buy oil from Venezuela, and that tariff would be effective April 2. And because of that, ONGC is in the focus because ONGC has a subsidiary with the name of ONGC Videsh, which has 2 plants in Venezuela and produces oil. Second, ONGC Videsh was expecting $500 million in the form of more crude from Venezuela. This is the reason that ONGC is impacted. Why will OMCs be impacted? Because last month, if you remember, Oil Minister Hardeep Singh Puri had said that government is planning for OMCs to increase the oil imports from Venezuela, and that will unlikely be happening in the near future. And that's the reason OMCs are in the focus on the back of this news, and because of that, all the stocks are under pressure.
Take your point, Sudarshan, entirely. In fact, earlier today, we spoke with Prawal Sen, who's a senior research analyst at ICICI Securities, to understand the impact of this as well. Let's listen into what he had to say.
My understanding is that India imports close to about 0.2 to 0.25 million barrels a day of oil from Venezuela. When you consider that India's total imports are in the range of around 4.5 million barrels of oil per day, obviously it is a relatively small percentage compared to the percentage from, let's say, Middle East or even Russia, for that matter. But the fact is that if the condition for avoiding this additional 25% tariff is that this oil will have to be replaced, then that's an additional sourcing that you will have to find from somewhere. From a supply security perspective, I guess because it's less than 5% or less than 4% of our overall crude slate, it's something that I think India can figure out how to basically manage this hit, from what we can tell.
All right, it's an interesting day of trade. Even as the frontline indices are higher, we are seeing some sort of supply at higher levels itself. Every time the Nifty is crossing past that 23,800 mark, we are seeing some bit of supply. But at current levels, closer to 23,650, 23,700, we're also seeing some purchase. So it's likely to be that sort of consolidatory kind of day. It's interesting to see a couple of names which are, underperforming today. IndusInd Bank. Now, it has been an underperformer over the last 10-15 days, ever since the news of the forex-related, derivatives-related loss did come by. In fact, even before that, when we had Sumant Katpalia's extension, which was given for just 1 year as against the expected 3 years, the stock has been under pressure, and now it continues to reel under pressure. Yesterday as well was lower. Now this week's losses on IndusInd Bank make it 6%, and from the top itself, the stock has corrected about 60%. Remember, it's the expiry week. The stock is still in F&O band. The other one that stands out in terms of losses is Dr. Reddy's. We've seen a bunch of stocks in the pharmaceutical space underperform. Dr. Reddy's leading that pack, though, as Vinny told us earlier, Piramal Pharma higher on account of the note that has come in from Kotak. And the third stock I'm looking at is Kalyan Jewellers. Again, the stock has been a beaten down name, was seeing some sort of recovery from the lows, but once again, it's come off the highs. Currently below the 500 rupee mark on Kalyan Jewellers. 472 is where the stock is at the low point of trade. But a bunch of stocks moving around, Nigel.
Well, that's right. Well, I think on that note, though, we've completely run out of time on this edition of Chartbusters. You stay with us. Trading Hour comes up next.
The shakeout has been good. It has tested you. It has, proven that you have a conviction in what you buy. And there's no something called easy money on the Lal Street, as everyone thinks that I buy today, make tomorrow, which had gone on for a few years. But all the veterans have told you that, wait, when the correction comes, people will panic. But I think if they hold true to the flag and, I think it's great. I think the domestic money prospering or domestic India is great. We welcome foreign money, we welcome foreign capital, but they have a right to sell, and I don't begrudge that.
Okay.
Market has a self-correcting mechanism. If you take stocks to unbelievable heights, the short seller will step in, or the promoters will sell in, or the insiders will sell in and want to encash it. So that will act as a natural check on the market, which it has done. As long as there's not any undue amount of leverage in the system. There was, I think, 70,000 crores of margin funding, which is the size of a small mid-cap company in India today. So there's no leverage. The banking system has no leverage. The government had fiscal restraint. So, in fact, money was tight. So there was no reason to believe that this would be a long-lasting bear market.
Sure.
And market will correct itself. Anytime the valuations of something become excessive, people step in and sell. Insiders sell, someone sells, and that creates a buying opportunity. First correction in 4 or 5 years, so it was particularly severe. And market correction is always severe. It always kind of panics you and tests your conviction, tests your patience, which is all the things that it did. But they are short, sharp, and swift. As you saw, the index fell very sharply and very swiftly, almost without respite, 800,000 points a day after that. But my feeling is that that is just a correction in a bull market, not the topping of a bull market. The reason I say that is even when the fall started, individual stocks were making new highs, new all-time highs. Bajaj Finance, United Phosphorus, Shree Cement, so many companies, good high-quality businesses were making new high. That would typically not happen in a bearish phase of the market.
Good morning and welcome to Tuesday's edition of Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer, and the morning strength is fading now, and it's fading quite rapidly. We opened up higher. There was a gap up opening, the Nifty gaining for the 7th day in a row. We also surpassed our February high, which was about 23,800. We went on to hit levels of 23,867. But from that level, in the last 1 hour, we've seen the markets come off, and it's now nearly 200 points off from the session highs, hovering somewhere around the 23,700 mark. IT is holding fort for the second day in a row. The Nifty IT index is still strong. And remember, the Nifty IT index is still an underperformer. So year to date, while the Nifty is turned positive, the Nifty IT index is down about 12 to 13%. So it still has some catch up to play. Yesterday, it was CLSA. Today, it's UBS. And they're all saying that perhaps the pessimism, the correction could be overdone. But the problem is the broader markets, right? I think some fatigue, tiredness after the recent run-up.
Good morning, Reema. Like you mentioned, volatile trading session. So the mid-caps and small caps, 6-day winning streak is what they are snapping today. Both of the indices in the negative territory. Advanced decline ratio in the broader end of the markets skewed towards the decline. One stock that stands out amongst the banking pack is HDFC Bank. That stock is seen, or that bank is seen as the key beneficiary of RBI's move to go ahead and enhance the loan limits across various categories under the PSL. The other set of stocks that are in focus, and Vinny just highlighted them a while ago, Syngene as well as Pyramid Pharma, both of these stocks are doing quite well. Kotak Institutional Equities initiated coverage on both of these stocks, and both of these stocks are doing quite well. A couple of stocks that are under, in focus on the back of QIPs is Restaurants Brand Asia, Central Bank of India, as well as Punjab and Sind Bank. All three of them actually seeing divergent trends. But Reema, a couple of stocks that you're tracking as well.
Indeed, some news coming in on RailTel. It seems to be positive because the dispute with respect to the telecom department is now withdrawn, has been resolved. The telecom department has withdrawn its demand of 1,500 crore rupees with respect to non-telecom revenue. The DOT had demanded it from RailTel, but now they've withdrawn that demand. So that dispute has been resolved. So some relief coming through for RailTel, and it's trying to trim some of its losses. But let's talk about IT that's clearly clearly the sector of the day, and it's UBS today which is talking about more upside in the stocks compared to downside. So they're saying that Indian IT stocks have corrected 15 to 20%. The earnings downgrade in the same period was not much, about 0 to 2%. So what happened is the PE got corrected to a much greater extent. In some cases, it was nearly about a 20% correction in the PE. Now, they spoke to IT companies, and their discussions with the management suggest that yes, uncertainty has increased, but it's not that there has been a big impact on client spending. If at all, very marginal. So they do expect that FY26 is going to be a tough year. There will be earnings cuts of about 5 to 7%. But that said, FY26 on the whole will still be a better year compared to FY25. And therefore, there is scope for the earnings, PE multiples which contracted over the last 3 months to get back to the levels that it was prior to that. And what will help offset some of the uncertainty or the US economic slowdown is corporate tax, Fed rate cuts. So these are some counterbalancing forces. So just putting on board what UBS expects IT companies to do, at least large cap IT companies to do in FY26. Except TCS, all the companies will do better or post a higher revenue growth compared to FY25. Now talking about the valuations, because their call is that the valuation derating seen in Indian IT companies was excessive, and we will see some reversal in that, some recovery in the valuations. So they're saying TCS is trading at more than 1 standard deviation below the 5-year average. Infy is trading below its 5-year average by about 0.6 standard deviation. And all the whole, the Nifty IT is also trading below its 5-year average. So therefore, they expect valuations to revert, and they are bullish on TCS, Infosys, Wipro, HCL Tech in the large cap, sell call on Tech Mahindra.
Thank you so much, Rima, for telling us about what exactly is the call as far as Indian IT is concerned. The IT index amongst the top gainers today with a gain of over 1%. But a very interesting note from UBS today on the entire cement pack. Nigel joins in with more details.
Well, that's right. UBS has upgraded the cement sector as they believe that the rough patch is coming to an end. And so they're upgrading Ultratech, Ambuja's Dalmia to buy. Remember, UBS, they had a negative view on the sector itself all the way since July 2023 because of rising competition, demand slowdown because of the general elections, and also rising price competition after Adani's entry into the cement space. But now, UBS, they've turned positive. They anticipate earnings upcycle to emerge from the coming fiscal year, and they're expecting strong EBITDA growth for the next 2 fiscals. Their positive stance is backed by demand revival, which will be driven by the housing upcycle, as well as revival in government capex. The structural cost savings, that's what's going to help margins. And also, they believe that pricing is likely to bottom out after the weak pricing we've seen in the first 9 months of this fiscal. They also highlight that the sector consolidation led by the top 2 players, that is Ultratech as well as Ambuja. Reasons for upgrading the stocks, and the chart should come up for you on the screen. Ultratech, they say that they have shown strong execution in tough times with industry-leading growth as well as on margins. Their top pick, though, is Ambuja due to the high growth and lower valuation. While on Dalmia, they have done a U-turn. They have upgraded it from a sell to around a buy. And also, they continue to remain their positive stance or the buy rating that they had on ACC because of supportive valuations and industry tailwinds. Put all this together, UBS, after being underweight or negative on the sector for the last couple of years, they have turned positive on the cement pack, and that's what's playing out on the stock prices. Back to you.
Thank you. So UBS constructive on IT and now cement too. But let's talk about the other big issue. SEBI has decided on a host of changes in its board meeting held yesterday. Yash is joining in with the key details. Yash.
Well, it was the first board meeting under the new chairman, Tuhin Kanta Pandey. It was a long list of agenda, and what came out again was a long list of changes which have been suggested by SEBI. First, good news for smaller foreign portfolio investors. Market regulator SEBI going ahead and raising the threshold when it comes to FPIs which have to submit additional or granular disclosures with SEBI. Now the threshold for submitting that additional disclosure would be 50,000 crore in equity AUM in the Indian equity markets as compared to 25,000 crore rupees. What doesn't change here, essentially, any FPI having 50% of its total equity AUM in a single corporate entity will have to continue to make those additional disclosures. Apart from that, when it comes to public interest directors moving from one MII or market infrastructure institution to another one, this will continue to require SEBI approval but won't require shareholder approval. Also, now the cooling off period between the PID or the public interest director moving from one MII to the other one, now that cooling off period will be decided by exchanges and not SEBI. Another good news which came in from all the investment advisors and research analysts. Now, these research analysts and investment advisors will be allowed to charge an advance fee to their clients to up to 1 year, which is 4 quarters. Currently, investment advisors can only charge advance fee for just 2 quarters. Research analysts can charge this advance fee just for about 1 quarter. Finally, SEBI's announced formation of a high-level committee. What this committee will do is it will decide what needs to be disclosed by its own board members, what is the conflict of interest which needs to be disclosed in terms of assets, investments, liabilities, all of those things. And this committee will submit its reports in terms of those regulations within 3 months after it has been formed. Interestingly, during the question and answer session with SEBI chairperson, there was also a question which was asked on NSE's potential IPO, and that got some interesting response from the chairperson. Hear out what the SEBI chairperson had to say as far as NSE's potential IPO is concerned.
But surely, I think we'll look into it. I've just, we'll apply our mind on how is it and how we can take it forward and what's the issues.
In fact, to discuss this in greater detail, the key takeaways from SEBI's board meet, we will have Sunil Badla, who is the national head at KPMG, and Tejas Desai, partner and leader of Wealth Asset Management Tax in EY India, joining us today at 12 noon. So stay tuned for that conversation. We'll get into a break on that note. We'll come back and discuss commodities on the other side with Manisha Gupta.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive.
Welcome back to Trading Hour. Well, let's now shift focus to the commodity space. Manisha joins in, and today she's focusing on crude.
Well, the crude oil prices have seen a percentage point of gain in the overnight markets, trading around $73 a barrel for the Brent prices. And with that, it's a 3-week highs coming in for the crude oil prices. Having said that, the first quarter clearly seems to be going into the negative. We are down by nearly 2.5% for both the crude varieties at this point in time. But currently, it is all about Trump announcing a 25% tariff on any country buying oil from Venezuela. Now, China is the largest buyer of the Venezuelan oil, and how will that impact shippers, insurance companies, and China itself in sense of the largest importer is something that the markets are weaving in sense of premium in case of prices. The second thing to watch out for is the OPEC and allies meeting, who have been talking about increasing production from the month of May. April 5 is when the OPEC and allies meet, and any statement coming in from there will have a direct impact on the crude oil prices. The third thing is more importantly about on how OPEC and allies really have been cutting output. Remember, 40% of the global crude production comes in from OPEC. They have been cutting to the tune of 5.8 million barrels per day since 2022 and have been looking to bring back this crude production back into the markets. Most of the analysts believe that the crude prices, the sudden surge that we have seen, is very event related. Going forward, it really is between 65 to 75 that you will see the crude oil prices trading for the rest of 2025.
Manisha, thank you very much for that important update. Some stocks which have moved lower. So Tata Consumer is one of them. Titan continues to struggle. Yesterday, it was down close to about 2.5%. It's followed it up with another 0.5% loss. And Indian IT names, the Nifty IT index itself is up closer to 1.5%. And now it's trimmed some of those gains. So up nearly just about 0.5%. So come off from the day's high. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar joins in with his top trading bets.
Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
If you're booking an Ola, Uber or Rapido in Hyderabad, it could be a sweltering ride. Cab drivers have launched a no AC campaign, refusing to turn on air conditioning to highlight their financial struggles. For many drivers at ride-hailing platforms, driving a cab is no longer financially viable. After operational costs and platform commissions, they're often left with earnings that barely cover their daily expenses, forcing them to make tough choices like turning off the AC. And so the Telangana Gig and Platform Workers Union has launched this no AC campaign. What are their concerns? Fuel prices are high and running AC means burning more fuel, making trips less profitable. Second is low earnings. Drivers say Ola and Uber take 30 to 40% of the fare, leaving them with just 10 to 12 rupees per kilometer. But operating costs with the AC turned on rise to 16 to 18 rupees per kilometer. Essentially, the driver is left with very little in hand. And so drivers are demanding higher base fares to cover rising costs, lower platform commissions and government regulations to ensure fair pay. The union is also pushing for a Telangana gig workers' rights bill, and if their concerns aren't addressed, they plan to escalate the protests nationwide. While Hyderabad's campaign is making headlines, this isn't new. It has been happening in Hyderabad and even Bengaluru. Drivers in Bengaluru have unofficially stopped using ACs for more than a year. In 2024, drivers even demanded 5 rupees per kilometer extra for AC rides, but this wasn't officially implemented by ride-hailing apps. Most drivers just simply refuse to switch on the AC unless riders insist, and even then, some decline. Now, as the mercury rises, so have passenger complaints. This begs the bigger debate, which is who pays for the AC. Passengers expect an AC cab, especially in the scorching summer heat. Drivers say they can't afford it unless fares increase. Ola, Uber, Rapido haven't provided a clear solution. No pricing model for AC usage, no opt-in feature either. So should drivers absorb the cost or should riders pay extra? Let us know what you think in the comments below. There doesn't seem to be an easy resolution to this tug-of-war. Perhaps us riders should consider investing in one of those handheld fans for now.
Welcome back. Let's focus now on the CRDMO sector. Kotak has issued a note. They've initiated coverage on some stocks. Vinny is here to tell us more. Vinny.
Yes, Kotak has issued and initiated coverage on some of the CRDMO space. CRDMO is Contract Research Development Manufacturing Organization. So they are third-party manufacturers somewhat of that sort to make it easy for pharma companies. Now they've initiated coverage on PPL Pharma, buy rating, target price of 300 rupees per share. Syngene is another one, buy rating, target price of 700 rupees per share. And Sai Lives, they've initiated coverage, reduced rating as of now, and target price of 875 rupees per share. What they say and what factors they believe will work out well for these companies. One, the rising focus in terms of the research and development outsourcing that may continue to inch up going forward as well. In 2005, it was somewhere around 18% and now it's become 42% across the globe. So that is an increase coming in. Plus, we have seen that shift coming in where everyone wants to reduce their focus on China and come to other countries. And that is what is something that could work out well for Indian CRDMO companies as well. So that rising shift from China will augur well for these Indian companies. Other than that, they expect the CRDMO market to even quadruple over the next decade. So that is important to watch out for in terms of the growth opportunity that they see coming in for these companies. And that is why they have come out with a note on this. Most of them are a positive rating that they've given here.
Thank you so much, Vinny, for joining us and talking to us about Kotak Institutional Equities report as far as the CRDMO space is concerned. But moving on, brokerage firm Macquarie has written a note indicating its preference for restaurant companies over food delivery aggregators. Panglam joins in to tell us more.
Well, you know, the underlying thesis is that food delivery or food consumption is likely to continue to grow. Where do you allocate your money in this space itself? Do you go via the QSR way or do you go via the food aggregator way? You know, over the last many quarters, investors were betting on the food aggregator way, and as a result of which we saw underperformance of the quick service restaurant space. And at the same time, we also didn't see much business growth coming in for quick service restaurants until the last quarter, where we saw 4 or 5 straight quarters of declining trend when it came to gross order values in these food aggregators. And at the same time, there was an increase in the same store sales growth or like-for-like growth that we saw in a lot of these quick service restaurants as well. So taking note of that, Macquarie has written, they've said that, you know, the increased money that all, consumers will have on account of the reduced taxes that were announced in the budget will go towards restaurants as against food aggregators, because food aggregators are now at a space where gross order values are stable, operating metrics are by and large stable, and will be led only by increasing users as against further expansion that they would see out there. The unit economics are only stable. Add to that the uncertainty around the quick commerce foray for all these guys keeps them cautious on food aggregators like Swiggy as well as Zomato. They do believe that maybe the next leg of consumption in food would be led by quick service restaurants, and as a result of which, on account of valuation preference, they choose Devyani and Westlife. But we are seeing a resurgence in the stock prices of a lot of these food, quick service restaurants, and decline in the prices of food aggregators.
Thank you very much for that. Let's move on now. Ola Electric also opened higher after it settled all dues with the Rosmerta Group. Sudarshan gets us the details and the backstory behind this. Sudarshan.
So there is a positive development in the case related to Ola Electric and Rosmerta Group. If you remember, last week there was a news that Rosmerta Group had moved NCLT Bengaluru, filing the plea alleging default against Ola Electric. Now, early morning today, Ola Electric disclosed to exchanges that it had resolved all the disputes with Rosmerta Group, and now Rosmerta Group has agreed to withdraw its plea against Ola Electric. And following Ola Electric's disclosure, even Rosmerta Group has released a statement saying yes, the disputes between both the companies have been resolved, and also it has received the amount of nearly rupees 27 crore from Ola Electric, and going forward, relationship between both the companies will be based on the agreement signed. So now overall it's positive because Rosmerta Group is the agency who does the registration work for Ola Electric vehicles that are being sold. So overall it's positive, but stock had opened higher, but now it's in the red.
Thank you so much, Sudarshan, for joining us and telling us about the news flow related to Ola Electric. But moving on, technical analyst Mitesh Thakkar now joins in for a quick technical check on the market. Thank you so much for joining us, Mitesh. Some exhaustion seen at high levels. Do you feel markets will head further downwards from here, or do you feel that the bulls are just taking a breather?
My understanding is that this could be a pause. We've had a very good rally, and the markets has continued to move up, and the setup has also turned positive. But just look at the extent of the rally. The Bank Nifty has already gone up by nearly 4,000 points in the last 8-9 days. Similarly, the Nifty, if you talk about it, has done from 22,200, 300 zones to about 23,800, so 1,500 points. And now I think they are very overbought on the hourly chart. So it's a welcome pullback. In fact, I've been talking about this, that if somebody wants to go long now on the indices, be tactical, be slow, trade with tight stop losses, but wait for a dip to come in. I think that will be a good entry point. My preferred entry level on the Nifty is around 23,600, give and take 20-30 points here and there. And on the Bank Nifty would be closer to about 51,500, 450 zone. So, I think a bit more decline, and I would be an aggressive buyer on the indices.
What about stocks, Mitesh? Is there anything that one can buy at these levels?
I like a couple of cement names. Ambuja Cement is a buy for me. Keep a stop at about 524 and look for a target of 560 here. Similarly, ACC is something which I like a lot, but I'm just waiting for the stock to clear a weekly pivot. Once it starts trading above levels of 1960, 1965, and today we had an intraday high of 1967, but I would want a closing above that. So buy above 1960, keep a stop at 1930, and then the stock could possibly head towards 2040.
Thank you so much, Mitesh, for joining us, giving us your views on the market as well as your individual trading calls. We'll take a short break now. Up next, we'll discuss more on the markets and stock-specific action. Welcome back to Trading Hour. Well, the market has slipped further. The Nifty Small Cap Index now down over 1%. But moving on, the RBI has modified priority sector loan rules. How will it impact banks? Lata is here with more details.
Well, first things first, priority sector is that 40% of all the loans banks have to give some favored sectors like, farming, affordable housing, renewables, etc. Now, regularly, the Reserve Bank does modify these rules because they have to at least adjust for inflation, sometimes even for new products like renewable products. So what is the revision now? Houses, the limit has been raised as to what will qualify as priority. For big cities, over 50 lakh population, they used to give only up to 35 lakh loan as priority. Now it can go to 50 lakh. For smaller, for smaller towns, mid towns, the level goes from 35 to 45. And for, very small towns, the limit used to be 25 lakh to qualify as priority. It goes to 35. Then there are other limits that have been raised. You give even for damaged housing repair. Even there, similarly, for various categories, the limits are raised. Education loans, only 20 lakh was considered priority. Now it's become 25 lakh. So loans for, drinking water in schools, sanitation, that has been up from 5 to 8 crore. Healthcare in tier 2 and lower cities, smaller cities, has been up from 10 to 12 crore. And the number of people who qualify as weaker section, it has been increased a little, artisans, cottage industries and women, and also the amount that you can give them to qualify has gone up from 1 lakh to 2 lakh. So basically, they're adjusting to inflation and they're adjusting to a few new products. Then there are smaller, ease of doing business for banks, if you please. There used to be an interest cap if banks sold off the loans in the form of securitization. Those caps are gone. For urban cooperative banks, there is a genuine big relief. They had to give 75% of their loans as priority loans. Now they have to give 60%. And then for renewable energy, more projects under renewable energy are included as priority. These are also technological advancements which bring new products into the market. Now, who benefits? Well, all banks benefit in a way because it's easier to find a priority sector borrower. If it is a very small amount, it becomes more difficult for them. And HDFC Bank benefits because, they had this huge HDFC loan coming in and they had to do priority sector for that entire lot of some 7 lakh crore. Now more of the erstwhile HDFC loans will qualify as priority sector because the limits have been raised. And likewise, other banks, this is an IIFL note, which says banks like RBL, SBI, IIB, Federal, used to now and then fall short. In 2024, they fall short of that 40%. Then there are ways you buy priority sector certificates from other banks, or you have to invest in what you call RIDF, Rural Infrastructure Development Fund, done by the NABARD. That will be less. That gives very little money, these other avenues. Now that the limits are raised, these banks can perhaps lend more profitably in the priority sector category.
Thank you, Lata, for explaining that so well and beautifully to us. Let's move on and talk about the markets, individual sectors. Devang Mehta, Director of Equity Advisory at Spark Private Wealth Management, joining us on the show now. Devang, what are you advising to your clients now? Do you think the worst is behind? It's time to go out there and make all your investments, or stagger it?
Thanks, Rima, for having me on the show. I think, yes, on your channel last time around also, I think the advice was that during such times, right, either you get good prices or you get good valuations or you get sort of good news. So I think the prices and valuations were sort of quite cheap. And I still say that after this huge rally, and I know it is very difficult to probably call it, some people will call it a bounce back, some will call it a relief rally, some will call it a sort of a real rally. So that will only be known in the hindsight, that whether it is a real rally or it's just a relief rally. But I think our control or our controllable is whether positives outweighs negatives. I think probably in the last 15-20 days, the market participants have realized that there are so many, I think, good points that one can note, right from reducing inflation in India, to sort of also industrial production rising. I also had a look at the manufacturing, HSBC manufacturing PMI, which sort of also is again higher than July 2024, the highest number since July 2024, which says that a lot of capex, even private capex, is coming back to the fore, be it Kumbh Mela, be it the wedding season. I think also consumption sort of has picked up rural and on the urban side. My sense is there are large on the anvil than negatives. Plus FII is coming back. Again, I am not making this statement because just seeing the last 4-5 day statement. But ideally, I think it is now the selling pressure has sort of with less intensity. And I think there is some buying also, which is done by domestic investors as well. So my sense from here on, probably if you have a 2-3 year horizon, the next 2-3 months will present you good opportunities. There will be volatility on the way, considering the April 2nd tariff announcements as well. But ideally, there is less downside, more upside, less risk, more reward.
Absolutely take your point, Devang. Devang, you mentioned a couple of important points. You said that probably the worst is behind. You said that valuations now are a lot more palatable. In that, in that context, which sectors, which stocks are the ones that you're liking? Where are you advising clients to go ahead and add positions?
Vivek, ideally, we've generally been, I can say, very, very firm in our call that there are themes and there are sectors. I think there is a very easy statement to say that we are bottom up, but certain themes you need to understand. And those themes are, I think, India probably right now, if you talk, the Nifty is around 70% of Nifty is into banks or IT companies or FMCG or for that matter, oil and gas. I think a lot of money is to be made outside of the index, right? There are sunrise sectors. There are a lot of sectors. I think I was just listening to your conversation about priority sector lending, renewables, power automation. There is air compression. There is water management. I think a lot of such themes, which is into lamination, stamping. I think all such micro themes. Semiconductor is another theme which probably one can play by buying a lot of proxy plays rather than the usual capital goods or usual structure type of themes. So I think there are a lot of micro themes which have corrected. Yes, there's this fall in more of mid caps and small caps. A lot of such themes have corrected. I think if there is cash flows, if there is going to be profitability in this companies growing at say 18 to 25%, I think there is no problem buying such themes if you feel India is going to go up the capex curve as well as the consumption is going to improve. I think manufacturing, engineering, this type of companies will also keep on doing well. Even ER&D type of themes will do well.
Understood that. Which are the sectors, especially in the context of the impending tariffs, will you stay away from? Are you right now a little cautious on pharma or some of the export-oriented sectors?
I think, yes, we generally have been more domestic-centric. We clearly know that in India for the next 3 to 5 years, domestic-centric stories or sort of anything that has to do with either domestic cyclicality or domestic even consumption or that, for that matter, even something related to financials will do well. Having said that, yes, to answer your question, there are a lot of themes in the export-oriented. IT would not get impacted much because I think they rely on Indian IT services more often. Pharma, yes, there is a probability that there can be some tariffs. I think some clarity will emerge post the first week of April. But ideally, as I said, we would be more, I think, inclined towards buying domestic-centric stories. I think globally, every week it was changing, every month now it changes, every week and every hour the narrative changes. So it's very difficult to take a call on global cyclicals and something which is export-dependent.
Understood that. Now, when it comes to the Indian BFSI space, where does your priority or where does your preference lie? Is it the larger private financials? Is it, the NBFCs? Or would you also look at some of the MFIs? A lot of them have corrected more than 50-60% from the recent peaks.
I think the most interesting part about the BFSI is that, and I always make this a point, out of the 400 lakh crore of market in India, there is around 100 lakh crores of BFSI, and there are large banks, there are large NBFCs. But I think the sector which is still extremely small in terms of market cap and also penetration, and there is a rising ultra HNIs, which are sort of coming to the fore, and also there is financialization happening. So I think the proxy to play this is via depositories. The proxy to play this is via wealth management firms, via broking companies, via exchanges. I think this is one theme, even AMCs, which probably will see a lot more penetration happening in India, plus the wealth effect, the rising incomes, I think will also help this type of sort of industry to sort of do very well. So my sense in financials as a BFSI, if I can say, banks would be your usual 12-14% type compounders. But if somebody wants a little bit of more alpha, I think this is the sectors. These are the sectors which I talked about.
Devang, consumption in India was played via the hotels theme. It was played by the premium discretionary spending. Food delivery guys over the QSR. So Swiggy, Zomato had a great run. They've corrected now in the last couple of months in this correction that we've seen. But QSRs had taken a complete backseat. Macquarie is now talking about, they've come out with a report, Mangalam was telling us, and how they prefer QSRs over the food delivery guys at the current juncture. Your thoughts on QSR, and is that a consumption play to your mind?
I think so far we have sort of not taken any sort of view on QSRs as such. We've been considering QSRs as well as the likes of the food aggregators. But our model of looking at cash flows, our model looking at free cash flows or operating cash flows, generating incremental ROEs, the business which generate incremental ROEs, and the businesses which grow at sort of abnormally higher rates. If we look at this type of businesses, I think then there are certain hotel companies which have deleveraged themselves. We also look at organized retail. I've talked about multiple times. I talked about and again, not saying whether not recommending the stock, but I think this type of companies have also corrected. I think there is more money here rather than getting into themes where there is a sort of uncertainty, as well as there is also a sort of whether cash flows will be there or not. So my sense, be in hotels, be in type of aviation, be in the businesses where sort of you're seeing phenomenal growth over the period.
Thank you so much, Devang, for joining us, giving us a view on the markets, your preferred sectors, as well as your views on the entire BFSI pack. Time now for a short break. We'll get back with Prashant Pitti, co-founder of Ease My Trip, to discuss the company's foray in charter aviation market, as well as much more.
Welcome back. In the red now, and it's now more than 200 points off from the session highs on the Nifty. The Nifty is down close to about 13 points. Sensex down 26 points, so snapping a 6-day winning streak. There was some fatigue which has crept into the markets. The morning was fine the first 1 hour, but since then we've seen profit booking emerging at higher levels. The mid-cap index sell-off is quite steep now. The mid-cap index is down close to about 1.5%, while the small-cap index too is down over 1%, with the advanced decline ratio now standing at about 2 stocks advancing for 7 in the red. The key sectors where we are seeing some amount of profit booking and pressure, they include metals. The Nifty Metal Index is down nearly 1.5%. The oil and gas index, pharma index, realty. These are sectors which did well over the last couple of days in the recovery rally, and today they are retreating. But let's talk about Ease My Trip. The company has forayed into the charter aviation market. The company has announced a 49% investment in a company called Big Charter Private Limited. Prashant Pitti, co-founder of Ease My Trip, is now with us on the show. Thank you for joining in. First, if you could tell us, how much are you paying for this 49% stake?
Hi. Firstly, thank you for having me on the show. With respect to the amount and the quantum, that is still to be decided. The board has given us approval to acquire 49% of the stake. We are planning to go ahead with a share swap as a medium to acquire in this company.
Last round, can you give us an indication then? What was the valuation of Big Charter? Some ballpark. I'm sure you don't go into, the board will not give a buy-in, blind. So give us some indication of the amount, the valuation of Big Charter, how much you're willing to invest in it, and what kind of assets, revenues, and margins you would be looking at.
Happy to explain a little bit more about the business. The brand name is basically Fly Big. It has 100 exclusive rights over sectors. 100 sectors, they have exclusive rights where only they can operate. They are pretty much operating in tier 2, tier 3 sectors. These are non-scheduled flights. They have 4 charter airplanes with them. And in the last year, their revenue was 128 crores. Ease My Trip revenue was somewhere about 600 odd crores. So this is a bigger acquisition done by the company. This will enable Ease My Trip to basically cater to high net worth individuals, corporate clients, and also people in tier 2, tier 3 geographies who have capability to pay in this high margin business. And to give you some idea, for example, one of the exclusive sectors which they have is from Hindon to Ludhiana. Hindon is basically closer to Noida and eastern part of Delhi. And from Hindon to Ludhiana, only Fly Big can operate under Udan scheme. They have exclusive rights. They have 100 such exclusive rights. And in terms of valuation, it would be a little bit early for me to say. The board and the team is still working on the valuation. And we hope that this will become a very fruitful acquisition for the company.
Prashant, thank you for explaining that. So we understand that the entity that you're looking to acquire a 49% stake in is close to 1/5 of the current size at which you operate at in terms of the top line. What are the margins that they are working on currently? And secondly, assuming all the approvals come in time, when is this particular acquisition expected to consummate?
Well, again, board approval has come in. Now there is a negotiation happening between both the teams, and which is why it is difficult for me to talk about valuation at the moment. However,
no, just the margins of the acquiring business.
So it's a high margin business. Margin can vary anywhere between 10 to 20% business. These are non-scheduled flights. The way Indigo, SpiceJet, Air India operates, this is not the same way. They have 19-seater, 4 aircrafts. All of them are 19-seater, and they operate under Udan scheme, under which government also gives certain portion of revenues for operating in such sectors, which are not run by traditional airlines. So it's a high margin business, and last year the turnover was 128 odd crores, and we are looking forward to fill more of their demands since Ease My Trip has about 10 lakh people who visit our website on daily basis, and there's a very, very high demand in tier 2, tier 3 cities. We look forward to ensure that they do not see any empty seats and their occupancy rates are high.
So the company that you're looking to acquire, 49% stake, had revenues of 120 crore last year with margins of 10 to 20%, correct? What did it grow at last year? Or if you could give us the 3-year revenue growth rates.
I believe the number which I have is for FY22. At that time, the number was about 60 odd crores. From 60 odd crores, to about 128 odd crores. The numbers have increased in the couple of months.
And is it a way, I mean, what would the capacity utilization be? How much could you scale the revenues up to? And do you have plans to further increase your stake?
So all that is work in progress. It would be very, very difficult for me to, pinpoint and give exact details around it. But yes, we are extremely bullish about this industry. It's an industry which is extremely fast growing and with a very high net margin. It is directly related to e-smart business as well. As we can basically fulfill their demands even better, and looking forward to grow along with them.
Prashant, just coming back to this particular business, while you have explained the rationale and you've explained the business idea, or the idea behind going ahead with this particular acquisition, number one, why are you doing it outside India? Secondly, why not focus on India itself, given that the market here is quite large? So that is the key question. And secondly, the other question that we constantly get is the absence of any domestic mutual funds as far as the shareholding pattern is concerned. What is being worked on that particular front?
So firstly, Flybig is all India. It's not outside India. They have 100 exclusives within India only. It is not outside India. Yes, we have forayed into opening up markets in Brazil, in Saudi Arabia, in US, and other places. And the rationale behind it is very simple. 3 years ago, we started our operations in Middle East and Dubai, specifically UAE. And our business has grown exponentially from the Middle East area. I believe it is almost about 5% of our total business, grown organically over the period of 3 years, and it is still growing very, very rapidly. So we want to capture the success which we have received from the UAE area to the other parts of the world, which is why we have sold the seeds in Brazil, in US, and in Saudi Arabia, and a couple of other regions as well. EaseMyTrip is doing phenomenally well in terms of its international expansion, and we would want to continue growth on that side.
Prashant, is this your first foray into charter aviation, or you had tried it earlier as well?
So we have another company called as Nuthana Airways, which is basically based out of Gift City. But Nuthana Airways' main focus is basically of buying the charter airways and subleasing it to the others. Their main focus is not to operate. While for this company, their main focus is actually operating the aircraft under the government's UDAN scheme. These are all non-scheduled flights. So this is a very different acquisition in its nature.
Prashant, very quickly, Q4, what has been the trend over there? FY26, what can we anticipate in terms of operational trends?
See, operationally, company, as you would know, that EaseMyTrip is a bootstrap company. I mean, only about last year ago, we raised some capital in the company. Otherwise, the company has grown completely bootstrap, never raised any external capital. So we have been extremely cautious about growing while growing profitably. So in the last couple of years, I believe that we have taken a conservative step of, not putting growth over profitability. The company has continued the profitability streak, and we would like to continue doing so. However, markets right now are well poised for us to continue our growth momentum again. A couple of private players who basically recently forayed into this space again with the newer enthusiasm. They basically burnt a lot of money, and now they are going a little bit quieter. So I believe that for us, the FY26 could look much, much better.
Got that. One final question, since you're making this acquisition via a share swap. Now, the acquired company's revenues were 120 crore. Last year, you ended with 480 crore. So it's about 1/4 in terms of your size. Give us some indication of the valuation of the acquired company, because that will, it's directly going to impact your shareholders who've bought into EaseMyTrip. Your value, your market cap, as we can see right now, is 4,700 crore rupees.
It would be substantially lower than our market cap. Substantially lower than our market cap. Let me put it this way.
Like 1/10? Revenues are 1/4. Would the market cap be commensurate 1/4 of yours, or would it be even lower?
Much, much lower than that. I mean, we are expecting it to be in the ballpark of 1/10 of whatever market cap is. But again, I would not like to be held on to this. This is the number which we are negotiating with. And we believe that this is going to be a very, great deal for the company. Another reason is that the Flybig people, the current promoters, they also understand the value which EaseMyTrip can bring into the company. by bringing lots and lots of new customers which they have not acquired in the past.
Thank you so much, Prashant, for joining us. So an acquisition of a little less than 500 crore is what we are looking at. Well, time now for a short break. We'll get you more on the markets on the other side.
The shakeout has been good. It has tested you. It has, proven that you have a conviction in what you buy. And there's no something called easy money on the Lal Street, as everyone thinks that I buy today, make tomorrow, which had gone on for a few years. But all the veterans have told you that, wait, when the correction comes, people will panic. But I think if they hold true to the flag and, I think it's great. I think the domestic money prospering or domestic India is great. We welcome foreign money, we welcome foreign capital. But they have a right to sell, and I don't begrudge that.
Okay.
Market is a self-correcting mechanism. If you take stocks to unbelievable heights, the short seller will step in, or the promoters will sell in, or the insiders will sell in, and want to encash it. So that will act as a natural check on the market, which it has done. As long as there's not any undue amount of leverage in the system. There was, I think, 50-70,000 crores of margin funding, which is the size of a small mid-cap company in India today. So there's no leverage. The banking system has no leverage. The government had fiscal restraint. So, in fact, money was tight. So there was no reason to believe that this would be a long-lasting bear market.
Sure.
And market will correct itself. Anytime the valuations of something become excessive, people step in and sell. Insiders sell, someone sells, and that creates a buying opportunity. First correction in 4 or 5 years, so it was particularly severe. And market correction is always severe. It always kind of panics you and tests your conviction, tests your patience, which is all the things that it did. But they are short, sharp, and swift. As you saw, the index fell very sharply and very swiftly, almost without respite, 800,000 points a day after that. But my feeling is that that is just a correction in a bull market, not the topping of a bull market. The reason I say that is even when the fall started, individual stocks were making new highs, new all-time highs. Bajaj Finance, United Phosphorus, Shree Cement, so many companies, good high-quality businesses were making new high. That would typically not happen in a bearish phase of the market.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Welcome back to Trading Hour. Well, the volatility as far as the markets continues. The Nifty that briefly slipped into the negative territory is now once again just above the flat line, up 18 points. The Bank Nifty to a very similar story, just slightly trading and holding above the flat line. But the broader end of the market is where the selling pressure has intensified. The advance decline ratio has actually worsened. One particular stock that we'd like to highlight is IndusInd Bank. That particular stock is now down almost 5%. Remember, the low that the stock saw after the disclosure that it made in terms of derivatives trading was close to 600. The stock after that saw a significant bounce. But today, the stock, remember, it's also in the F&O band, is now down over 6%, closer to the 640 mark. But with that, it's all the time we have on this edition of Trading Hour. Stay tuned. Halftime Report is up next.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
If you're booking an Ola, Uber or Rapido in Hyderabad, it could be a sweltering ride. Cab drivers have launched a no AC campaign, refusing to turn on air conditioning to highlight their financial struggles. For many drivers at ride-hailing platforms, driving a cab is no longer financially viable. After operational costs and platform commissions, they're often left with earnings that barely cover their daily expenses, forcing them to make tough choices like turning off the
After 6 days of non-stop one-way rally, the market is a little more mixed today. While the Nifty is trading above the mark of 23,700 and it crossed 23,800 intraday, the mid-caps and the small caps are now trading in the red.
Trump threatens a 25% tariff on any trade with countries that buy Venezuelan oil and gas. This would impact China and probably India as well. Analysts at ICICI Securities, though, do not see a major impact for India or Indian companies as the quantum of imports from Venezuela is low.
The SEBI has eased disclosure norms for smaller foreign portfolio investors, also announces the formation of a high-level committee to review corporate governance norms at SEBI. Tuhin Kanta Pandey, the new SEBI chair, in response to a question, says they will examine the NSE IPO matter but did not commit to a specific timeline.
The management of Electronic Mart of India and the heads of Retailers Association tell CNBC-TV18 that consumer spending in the fourth quarter has remained muted. While EMIL points out to some same-store sales growth of 5 to 6%, RAI says the industry has seen near zero growth in apparels and very low growth in electronics as well. Whereas food delivery, or rather food and grocery, remain at mid-single digits as well. The recent stock market decline has a sobering influence on sentiment. You're watching us here on Halftime Report on CNBC TV18. We come to you live from the CNBC TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Horma Svatakia. Doing okay-ish for the frontline index. After a big rally, it's paused for breath, maybe some sort of consolidation at higher levels and maybe some bit of profit booking that we are seeing for the mid-cap end of things as well. Where is it that the most amount of underperformance apart from mid-caps is? We have it on Nifty Bank, which is actually, very close to its, previous all-time high, sub 5% away now. It's above all the important moving averages and dips are being bought into. That's a positive. And the second part is that we have some weakness coming in from, erstwhile outperformers, which are now seeing some bit of profit booking once again. The Nifty Bank has been buoyed lower by IndusInd Bank, which continues to move lower. What's done well, however, is IT, which after earlier underperformance is now seeing some bit of an outperformance as well. So Hormaz seems like it's par for course.
Par for the course, actually, absolutely. And it after a move like this, where you have gained almost 2,000 points, right, in a very short span of time, some bit of consolidation is warranted. But the Nifty still holding on to gains of around 50 points. At one point was up 200, of course, but still around about levels of 23,700. A lot of the movers in the broader markets, though, are the ones that are grabbing the headlines. Mangalam just mentioned IndusInd Bank, the only one that is still in the F&O ban today, but still continues to trade with losses of around 4.5-5% in today's trading session. Among the top losers on the index, Swan Energy is another one, 5.5% lower there as well. And these quick commerce names as well, Zomato is down around about 4.5% as well. We'll talk to Mangalam more about this during the course of the show. But the sector that's doing well today, as Mangalam just mentioned, is IT, and that's bucking the trend, if you could call it that. UBS is bullish on the sector. It's come out with a note saying that it is seeing more upsides than downsides for the sector in FY26. Rima has details on that. Over to you, Rima.
Indeed, UBS says there's more upside in store for Indian IT compared to downside because stocks have corrected so much. Indian IT stocks are down 15 to 20%. The valuation multiples of these stocks are down anywhere between 12 to 20%. So yes, uncertainty has increased. The macro has gotten tougher, but their conversation with the IT companies suggests that the impact on tech spending has been marginal. So on the whole, FY26, they acknowledge will be tough. They're lowering their revenue growth forecast by 5 to 7%, but they're still saying that FY26, even after, the expected cuts, will be better than FY25, and therefore there is a case for the valuation multiples, which got compressed over the last 2 months, to retrace a tad bit, at least go back to levels of FY25. So they're expecting a rebound of 5 to 10% for the IT sector in the near term. Also, while, there is uncertainty because of the US economic slowdown, etc., there are certain counterbalances in the form of, Fed rate cuts and corporate tax rates. So therefore, they believe FY26 will be better than FY25 for most of the Indian IT companies. And the table will come up for you where, they show the revenue growth forecast for the coming year, except TCS. All the others will see a better growth. Also on the valuation front, they're saying that, the valuations, because of the correction that we've seen, are trading below than their 5-year averages. So TCS, for instance, is trading more than 1 time standard deviation below its 5-year average. So therefore, UBS likes TCS, Infosys, Wipro, HCL Tech, all buy calls on these large cap IT names. It's only at Tech Mahindra where they've got a sell call.
All right, Rima, thanks a lot for that. With that, let's shift to a space which is doing a lot better today, which is the cement space. Ultratech is the top Nifty gainer. In fact, a bunch of cement stocks are doing well, and that's on account of a UBS note that has come in where there has been an upgrade. Nigel joins in with all the details out here. Nigel.
Well, that's right. UBS has gone ahead and they have upgraded the cement sector. They believe that the rough patch is coming to an end, and so they've upgraded Ultratech, Ambuja, Dalmia to buy. Remember, UBS has a negative view on the sector itself all the way since July 2023. The key reasons they cited at that point of time was rising competition, the demand slowdown because of the general elections, and also price competition because Adani had entered the cement space. But now, UBS, they have turned positive and they anticipate the earnings upcycle to emerge from this fiscal, that's FY26, strong EBITDA growth over the next 2 fiscals. Their positive stance is backed by demand revival, which will be driven by housing upcycle and the revival in government capex. They're also pointing out that the structural cost savings is going to help drive margins of the sector higher. And they believe that pricing could bottom out after the sharp fall that we've seen in the first 9 months of FY25. The sector consolidation has been led by 2 big players, that is Ultratech as well as Ambuja. The reasons for upgrading various stocks, and the chart should come up for you on the screen. For Ultratech, they believe that the company has shown strong execution in tough times, have led industry both in growth as well as on margins. Their top pick, however, is Ambuja. That's because of the higher growth and the lower valuations. On Dalmia, they've done a complete U-turn. They had a sell rating, now they've upgraded it to a buy, while they maintain their positive stance and the buy rating that they have on ACC because of supportive valuations and industry tailwinds. Put all of this together, UBS, after close to 2 years, they have turned positive and constructive on the cement space. Back to you guys.
Strong day indeed, and a strong report as well from UBS. Nigel, thanks a lot for that. We take a short break, but just before we do that, here's a small programming note for our viewers. CNBC-TV18 India and HSBC India are back with Season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. You can scan the QR code now and submit your entry for the SME Champion Awards Season 2.
The Telangana Gig and Platform Workers Union has launched this No AC campaign. What are their concerns? Fuel prices are high and running AC means burning more fuel, making trips less profitable. Second is low earnings. Drivers say Ola and Uber take 30 to 40% of the fare, leaving them with just 10 to 12 rupees per kilometer. But operating costs with the AC turned on rise to 16 to 18 rupees per kilometer. Essentially, the driver is left with very little in hand. And so drivers are demanding higher base fares to cover rising costs, lower platform commissions and government regulations to ensure fair pay. The union is also pushing for a Telangana gig workers' rights bill, and if their concerns aren't addressed, they plan to escalate the protests nationwide. While Hyderabad's campaign is making headlines, this isn't new. It has been happening in Hyderabad and even Bengaluru. Drivers in Bengaluru have unofficially stopped using ACs for more than a year. In 2024, drivers even demanded 5 rupees per kilometer extra for AC rides, but this wasn't officially implemented by ride-hailing apps. Most drivers just simply refuse to switch on the AC unless riders insist, and even then, some decline. Now, as the mercury rises, so have passenger complaints. This begs the bigger debate, which is who pays for the AC. Passengers expect an AC cab, especially in the scorching summer heat. Drivers say they can't afford it unless fares increase. Ola, Uber, Rapido haven't provided a clear solution. No pricing model for AC usage, no opt-in feature either. So should drivers absorb the cost or should riders pay extra? Let us know what you think in the comments below. There doesn't seem to be an easy resolution to this tug-of-war. Perhaps us riders should consider investing in one of those handheld fans for now.
Welcome back. Now, market regulator SEBI has eased its disclosure rules for foreign portfolio investors after Chairman Tuhin Kanta Pandey chaired his first board meeting yesterday. We are now being joined by Sunil Badala, the national head of KPMG, and we are also being joined by Tejas Desai, the partner and leader of wealth and asset management of tax at EY, and Surbhi is joining in on the conversation as well. Surbhi, good afternoon.
Hi, Hormuz. Good afternoon. I mean, just a bit of a background. This obviously, it sounds like a, good enough relief. Because what we have is that, you had to make additional disclosures if you were an FPI in India. If your total AUM was 25,000 crores or
if the total exposure of your AUM, more than 50%, was in one single corporate entity. Now, this just goes back in time, just to revise our viewers' memory, back to August of 2023. And these new disclosure norms came in at the height of the entire Adani saga, when the stock prices were literally crashing. So from then, we've traveled a very long way. There have been several changes as well, several extension of the deadlines as well. And more importantly, there's been a carve-out that SEBI also allowed, that, while you hit these thresholds, if you fulfill a certain set of conditions, then you still not have to make those additional disclosure requirements. So what has happened today is that one of those conditions, the definition has been changed. The threshold has been hiked, which is the first part of that definition, which was, the total assets under management that an FPI has in India. So instead of 25,000, now that limit has been hiked to 50,000. So let's try and find out to what extent does it help? Does it allay all the FPI concerns or not? Sunil, let me open the floor with you. That's really the question. Does it put to rest completely the ghosts of the August 2023 circular?
No, Surabhi, so as you correctly mentioned, this just addresses one element of the overall situation that we have. So obviously this 25,000 crore limit has been raised to 50,000, which anyway should have happened, because SEBI itself has noted in the circular that the trading volumes actually have become more than double. So what was 25,000 crore way back in 22-23 obviously is much more than 50,000 crores now. So, but still that's a good move. So yes, until your AUM in India is 50,000 crore, you don't have to worry about disclosure requirement. Having said that, of course, there are various other triggers where these disclosure requirements will get kicked in, and therefore the fear of FPIs identifying the natural person as beneficial owner of the investing entities actually remains in many cases. But yes, as far as this relief is concerned, I think it's a welcome relief.
And how big a Sunil relief is this? I know it's hard to get numbers on it. I remember when the original circular came, I think SEBI itself had made the contention that almost 90% plus sort of FPIs will be exempt from the purview. Only a very few handful of FPIs will be impacted by the requirement of additional disclosures. Now with the threshold going up to 50,000, is almost everybody exempt?
I don't think so. I think the percentage will probably not undergo significant change. So whilst on the one hand what SEBI said was correct, that more than 90% FPIs were anyway outside of this. But as I said, because of the trading volumes going up, I think whatever 5-6% of the FPIs which were getting impacted because of the volume being higher than 25,000 crores, I think my sense is that many FPIs will still remain under the radar. Although I don't have the concrete data, but I don't expect any change in that.
Okay, fair enough. Tejas, let me get your perspective on this as well. So one condition has been relaxed. The other condition stands, which is that if you own more than 50% of your AUM is in one single corporate group, then you still have to make disclosures. And let's not forget that there is also that exemption list, right? Which over the course of the last 15 to 18 months, they also had a carve out that if you're a pooled vehicle in a jurisdiction which SEBI recognizes, then perhaps you can be exempt from these higher disclosure norms. So we come down to the same question. Are there still outstanding issues? Are FPIs still being impacted despite this relaxation?
Yeah, so Surabhi, two things. One is that the August 24, 2023 circular basically laid down two criteria for FPIs to provide granular ownership details. One was what we call the size criteria, which is what you alluded to, the 25,000 crore becoming 50,000 crores now. And the second was the concentration criteria, which basically means that if an FPI holds a concentrated position in a single investee company, then he has to provide the granular details. Now, that criteria, as you rightly said, has not been relaxed. And SEBI's intention is that that is potentially perceived to be a violation of what we call the minimum public shareholding norms, or the takeover regulation. So SEBI is not relaxing that criteria, and I think rightly so. It is relaxing only the size criteria. So any FPI still has a concentrated investment in a single portfolio company is bound to provide the granular details. But having said that, I think it's a welcome relief, to increase the threshold from 25 to 50,000 crores. Again, like Sunil said, we don't know the exact numbers, but it does provide some relief for the FPIs. And to your point on the exemptions, yes, there have been significant exemptions that SEBI has provided already in its August 24 circulars, which is, applicable to government entities, government-related entities, ETFs, listed funds, university funds. So there are a host of exemptions which were already provided. Those continue to stay, and I think those will provide meaningful relief. And I think that brings us to the point that, look, I think this will, rightfully exempt, almost 90% or more of the FPI population. There will be that 10% who will continue to have to comply with the granular ownership details.
So, Tejas, with this additional relaxation, and plus, like you said, they've already, announced a whole host of exemptions. I mean, funds which will be exempt even if they hit the threshold. So, all put together, should we expect greater inflows? This is not a question for today, but generally, because the framework is being made a little more liberal, should we be expecting this overhang to end and then therefore more inflows?
No, look, I think the increasing limit is a good thing. It will certainly be welcome. But I think FPIs have to recognize that India is an ID market. India will demand more data from them as compared to other geographies. I think that is not going away. That is something that is here to stay. But any incremental relief is a welcome step, and should go some way in increasing ease of doing business or ease of investing into India.
Sunil, your thoughts on this?
No, so I think I agree with what Tejas mentioned. See, look, Surabhi, to actually expect a greater inflow obviously will depend on a lot of other market dynamics, but certainly this is a deterrent which I think FPIs had. So to that extent, I think this is a welcome move. So I mean, let's just simply take an example of let's say an FPI with its investor group. Their ability to invest from 25,000 crore has suddenly gone up to 50,000 crore. So obviously, we have provided them an enabling framework to actually double their investments on an immediate basis. Now, whether they will take advantage of this framework or not is obviously going to depend upon a lot of other dynamics. But certainly there is a framework, and therefore to that extent, I think this is a great thing.
Okay. Final question, gentlemen. When we talk to several foreign investors, and I always remember Chris Wood because he's repeatedly made that point, talking about how it's difficult to register in India. It's still difficult to do business in India as an FPI. Some people argue on taxation. I'm leaving tax completely out of this, but purely from a disclosure and regulatory perspective, are we there yet? Or what are the other aspects which are still trouble spots where you would perhaps want to see more focus from the regulator? Quick, last word on this, Tejas.
Yes, since you brought up the tax issue, Surabhi, I do want to call out that I think March 24 has been a good day for FPIs investing into India. There has been a relaxation on the tax front in Section 9A, where they have relaxed one of the conditions. Section 9A was essentially introduced to give a boost to asset managers to relocate to India, to come back to India. This was Make in India for the asset management industry. And I think they have relaxed one important condition by omitting the word indirectly, which basically required asset managers to trace granular ownership. So the two issues are interconnected. This is all about granular ownership, whether it comes from the SEBI regulations, whether it comes from the tax law. And I think if you look at the two together, then I think yesterday was a good chapter in the history of Indian FPI investments. I think I would leave it at that.
Sunil, you concur? Just quick 30 seconds. Any major outlier issue that still needs to be addressed?
So as far as this limit of 50,000 crores and the concentration limit of 50%, when we talk about granular details, means Surabhi, I have to provide details of each and every investor who's a natural person, regardless of a threshold. So, for example, let's say there's an individual who holds even one share in the investing FPI entity. I need to provide details of that. So maybe some kind of a percentage threshold, which is there, like in the other disclosure requirement, where it is like 10% or 15%, depending upon whether it is a corporate entity or a partnership. I think that kind of a threshold we can consider.
Okay. All right. Some more suggestions, but I guess both of you welcoming the fact that at least there's some ease that's definitely coming. The threshold limit being straight away doubled from 25,000 crores. Gentlemen, thank you very much for weighing in on what is seen as a positive development, largely for FPIs looking at India. Back to you guys.
All right, a step in the right direction, though some distance to cover as per these guys as well. But nevertheless, we will take that with both hands. Take a short break on the other side. Keep an eye on the markets, though. It's fallen off the highs. Nothing really worrisome. Just one of those dips after a big rally that we've seen. On the other side, Sachidanand Uttekar of Trade Bulls joins in with some trading strategies. Welcome back. Like we pointed out, key indices have fallen off the highs, though a couple of stocks doing extremely well. Trent, as you can see at the bottom of your screen, has picked some pace. Remember, it's been an underperformer. It's down about 40% from its high, so at lower levels, maybe some bit of purchase is what it's seeing. But good time to get in an F&O perspective, just 2 days ahead of expiry. The Nifty Bank and the mid-cap index. The mid-cap index is the one which is seeing a fair amount of profit booking. The Nifty Bank as well, after having crossed important levels, all important levels, and going within 5% distance of a 52-week high, seeing some bit of profit taking. Interestingly, the advanced decline ratio as well has, after a very long time, moved into the favor of declines. Is there a cause for worry? Perhaps not. It's just the last 2 trading sessions. We had pointed this out yesterday as well, that maybe the up move from here on may not be as smooth as what we had seen earlier itself, and that was visible in the fact that the India VIX moved higher despite the market surging in yesterday's trading session. Today is no different either. The India VIX is up around 2% odd. Where does the Nifty go from here? Not much lower. Why do I say that? Because on the way up, while there is some writing at the 23,800 call telling you that 23,850, 23,900 could be some bit of resistance, at the lower level, 23,700 put writers haven't budged. In fact, 23,700 put writers still active for a premium of 120 rupees, telling you around 23,580 to 23,600 could be the supply, could be the demand zone for the market. And every time the market moves towards those levels, it would make prudent sense to invest or buy in that dip itself. On the way up, if the Nifty does cross that 23,850 mark, there are punts which are being made at the 24,000 level itself, which is closer to the 200-day moving average on the index. The other heartening fact, despite the correction that we've seen from the top today, is that yesterday's decline was also, or rather yesterday's surge also meant that the put-call ratio overheated to 1.21, and now today's decline has cooled that off as well, leaving further headroom for growth for our markets from here on itself. Just keep an eye out on Hind Copper, though, from the individual stocks. It's one of those stocks which may give Indus company tomorrow by entering the F&O ban. It is the one that actually exited F&O ban yesterday, may re-enter that.
In ban one day, out the other. It'll be interesting to see once IndusInd Bank too comes out of the ban sooner or later, as we are heading towards the monthly expiry as well. But Sachitanand Uttekar of Trade Bulls is joining in on the show now. Sachitanand, good afternoon. Thank you for joining in. What are the stocks that you are recommending this afternoon in this volatile market?
Good afternoon, almost. Good afternoon, Mangalam. I think this correction that we have seen so far is very healthy. In fact, even after 7 days of a rally, Nifty was indicating some headroom towards 24,000, and I think that headroom still remains intact. On the lower side, I think today's build-up is again indicating that 23,600 looks like a decent support, which has been elevated. So I think closer to that is again a good opportunity to create some long positions. We are expecting that eventually we may see this particular move getting exhausted towards 24,000. So I think the reward to this opportunity is again bright. Any declines towards 23,650, 600 would be a good level wherein some long positions can be committed. The stop loss for the trade should be placed at 23,520. And we may see a final swing towards 24,000. Now, if you look at the entire rotation, banks are something wherein there is some profit booking, but IT stocks have started performing. So from this particular space, Coforge has registered a fresh breakout from this consolidation. Now, if you look at the 60 minutes chart, it's a classic rounding bottom formation. It has also, crossed its 50 DEMA convincingly. It's an open interest hurdle which has been crossed at 8,000. So we are expecting this momentum to continue towards 80 to 50. And that's why we are recommending building fresh long positions here. One can keep a stop loss at 78.80 on a closing basis for a pattern target of around 8250. The other stock which Mangalam has already highlighted is Trent. Now, after a good underperformance and consolidation, the stock has started, trending above its 5200 hurdle. Now, if you look at the trend indicators, there is a positive crossover on its RSI, and plus there's a good strong convergence on its 5 and 20 exponential moving averages, which is again a sign of momentum. So we are expecting this particular rally to continue towards 5450, where its 50-day exponential moving average is placed. The reward to risk is again healthy. One can keep a stop loss at 5120 on a closing basis, and some aggressive long positions can be considered for a final target of 5450.
All right, Sachi, thank you so much for joining in and giving us your call on the index and individual stocks. With that, we'll take a short break. On the other side, we have the management of Symphony joining in to discuss demand trends and the outlook going ahead of what promises to be a very hot summer.
The shakeout has been good. It has tested you. It has, proven that you have a conviction in what you buy. And there's no something called easy money on the Lal Street, as everyone thinks that I buy today, make tomorrow, which had gone on for a few years. But all the veterans have told you that, wait, when the correction comes, people will panic. But I think if they hold true to the flag and, I think it's great. I think the domestic money prospering or domestic India is great. We welcome foreign money, we welcome foreign capital, but they have a right to sell, and I don't begrudge that.
Okay.
Market is a self-correcting mechanism. If you take stocks to unbelievable heights, the short seller will step in, or the promoters will sell in, or the insiders will sell in and want to encash it. So that will act as a natural check on the market, which it has done. As long as there's not any undue amount of leverage in the system. There was, I think, 50-70,000 crores of margin funding, which is the size of a small mid-cap company in India today. So there's no leverage. The banking system has no leverage. The government had fiscal restraint. So, in fact, money was tight. So there was no reason to believe that this would be a long investing.
Welcome back. We're just about to step into the month of April, but just before that, we've already witnessed some extreme heat already here, at least in the city of Mumbai. But how is the demand trend shaping up for cooling products as a result of this? We're being joined by Rupesh Shah, the Managing Director of Corporate Affairs at Symphony. Mr. Shah, good afternoon. Thank you for joining in. How has the demand trends shaped up in the month of March in specific because of the rise in temperatures across the country? I'm referring to this brokerage note, which is saying that there has been a strong surge in demand for residential air coolers from mid-March. What are the trends that you are observing on the ground? Mr. Shah, I think you're on mute. You'll have to unmute yourself.
There are very strong trends, very buoyant demand, and on top of it, the 17 new models which we have launched have also received overwhelming response, and even adjacent category also is receiving good response. So as of now, in current quarter, we are heading towards very strong growth and performance.
On mute, Mr. Shah, your tie, which is a bright summery tie with flowers, was telling us the story that this is going to be a good summer. I just wanted to know, when you say that there is buoyant demand and strong performance that is expected in the current quarter, if you could put some numbers to it versus last summer to this summer with the 17 new models that you've launched in India, what kind of growth can we see in the cooler business? And at the same time, I presume with these new models, you would make better margins as well. So what can we expect in this summer versus last year?
So right now I'm talking about March quarter, and of course, good summer is expected. So we are hopeful that June quarter should also be good. However, in March 25, already on a high base of March 24, we expect to deliver as per the going so far, strong top line, strong profitability, and better margin.
Could you define strong in some numbers? Is it plus 20%, plus 30%, mid-20s, mid-teens, low double-digit? If you could just, I'm not asking you for a specific number, but just a range which, the street understands.
It's difficult to quantify because of our IR policy. But I'm giving you adequate guidance that we are heading to on a standalone basis as well as on a consolidated basis for the quarter and year as a whole. This should be a very strong performance, and including better profitability on new models.
Mr. Shah, at the end of the third quarter, you had mentioned that a large part of your unbilled advances, which were at the end of the third quarter, were for newer models. Has there been any recovery on that front? And as a result of which, do you see better margins as well this time around compared to last year, as well as compared to the previous quarter as well?
Yes. So as it was guided post-December quarter, there was large unbilled advances towards new models. So as scheduled, as decided and as guided, new models production have commenced well in time. They have been billed and they have been delivered. So of course, that sale will be recorded in the current quarter. Secondly, as guided, new models do command better pricing and better margin. So overall, mix of new models and old models should improve the profitability.
What about the overall business for the next year? You've given us a sense into March, and understandably, because of your IR policy, you can't, give us any more details. For FY26, given the early trends that you're seeing for summer, what is the kind of growth that one can expect? If you could give us a sense in the first half of this year versus the second half of this year at least, because you have visibility, I'm sure, for the next few months.
Sure. So as per all the signals, there seems to be very strong summer. Overall market sentiments, trade channel sentiments, and of course our team sentiments are very buoyant. And if so, we do expect 25-26 should register strong top line and profitability growth on 24-25, keeping in mind 24-25 itself will be a high base, considering likely very strong quarter performance as well as earlier performance bearing December quarter.
Would you grow faster than the industry? Because then that would imply that you are gaining market share.
We are growing and we should grow faster than industry.
Okay, and what rate is the industry expected to grow at?
So on a CAGR basis rather than YOY basis, industry is growing in the range of 10 to 12% in last 3-4 years. Our CAGR growth is certainly higher than that.
One final question.
Will continue because the kind of the variety of the models, price points, and we are addressing every segment, and more importantly on account of several strategic initiatives which we have taken to penetrate in semi-urban and rural market in last 3-4 years. Apart from that, digitization, e-commerce, D2C, that's really bearing the fruit, and that's quite evident as it was witnessed last year, and I think we are gaining further traction even in that respect.
All right, we take that point. Thanks a lot, Mr. Shah, for joining in and giving us all those details, though we would have liked some more conversation around your international subsidiaries as well. I remember climate tech is something that you said that you will see some improvement in the next financial year, but we'll leave that for another conversation. As of now, it looks like this summer will be fairly hot for us and very bright for your cooler business as well. Thank you. Wish you all the best for March quarter as well as June quarter. With that, we'll take a short break. And as we do that, let's give all our viewers some good news. The India Business News Leader is now just a click away, which is the CNBC-TV18's all-new app, which gives you access to instant, breaking news, in-depth analysis and financial world updates, all of them at your fingertips itself. What you can do is you can download the app from either the Apple Store or the Google Play Store, or just scan this QR code which is up for you on the screen on your phones, and that will redirect you to the link that takes you to this app.
Sure.
And market will correct itself. Anytime the valuations of something become excessive, people step in and sell, insider sells, someone sells, and that creates a buying opportunity. First correction in 4 or 5 years, so it was particularly severe. And market correction is always severe. It always kind of panics you and tests your conviction, tests your patience, which is all the things that it did. But they are short, sharp and swift. As you saw, the index fell very sharply and very swiftly, almost without respite, 800,000 points a day after that. But my feeling is that that is just a correction in a bull market, not the topping of a bull market. The reason I say that is even when the fall started, individual stocks were making new highs, new all-time highs. Bajaj Finance, United Phosphorus, Shree Cement, so many companies, good high-quality businesses were making new high. That would typically not happen in a bearish phase of the market.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC TV18.
Welcome back. Let's get you some value plus on what's taking place in the internet commerce sector, the e-commerce sector. And this is a note which is coming from Jefferies, who hosted Redseer, who are basically strategy consultants for the internet commerce companies. And this is their key takeaways from their business, which one can look for in the e-commerce space as well. They expect the sector's growth to moderate. In the last 4 years, it's actually grown at a CAGR of 30+%, which could moderate between 20 to 25% over the next 5 to 7 years. Quick commerce, value commerce, and beauty and personal care, however, have performed fairly well. Remember, almost 85% of the quick commerce gross merchandise value is concentrated in the top 8 metros. So the belief that it's, only a metro phenomenon stands validated out here. So how it expands beyond that is something we have to look at, because even of this 85%, 75% is concentrated just on 3 metros, which is Delhi, Mumbai, and Bengaluru. Value commerce, however, is growing over 20% last year, expanding beyond fashion, entering into home and beauty products as well. Why is this important? Because in beauty and personal care, e-commerce is seeing good traction across both premium and value segments. We've seen premium outperform anyway, but now maybe is there a case for Zudioization of beauty and personal care in the value segment, specifically in the e-commerce space or not, is something we'll most definitely keep an eye out on, because value players are looking to mimic the local market in terms of assortment, value offering, and they are seeing some strong traction as well. Add to that, players are also looking to unlock further growth in new opportunities such as fast and value fashion online, because this is a proof of concept that has worked offline already. So can they replicate that online or not is the big question. So key takeaway, while overall e-commerce is likely to moderate in terms of the growth path as against what it had done in the last 5 years, you have a couple of sectors which are doing well: quick commerce, value commerce, and BPC, beauty and personal care. In quick commerce, though, it's still a metro phenomenon. Let's see how it expands beyond that itself. With that, we'll take a short break. On the other side, Manisha Gupta joins in with Peter Maguire of trading.com.
CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
If you're booking an Ola, Uber or Rapido in Hyderabad, it could be a sweltering ride. Cab drivers have launched a no AC campaign, refusing to turn on air conditioning to highlight their financial struggles. For many drivers at ride-hailing platforms, driving a cab is no longer financially viable. After operational costs and platform commissions, they're often left with earnings that barely cover their daily expenses, forcing them to make tough choices like turning off the AC. And so the Telangana Gig and Platform Workers Union has launched this no AC campaign. What are their concerns? Fuel prices are high and running AC means burning more fuel, making trips less profitable. Second is low earnings. Drivers say Ola and Uber take 30 to 40% of the fare, leaving them with just 10 to 12 rupees per kilometer. But operating costs with the AC turned on rise to 16 to 18 rupees per kilometer. Essentially, the driver is left with very little in hand. And so drivers are demanding higher base fares to cover rising costs, lower platform commissions and government regulations to ensure fair pay. The union is also pushing for a Telangana gig workers' rights bill, and if their concerns aren't addressed, they plan to escalate the protests nationwide. While Hyderabad's campaign is making headlines, this isn't new. It has been happening in Hyderabad and even Bengaluru. Drivers in Bengaluru have unofficially stopped using ACs for more than a year. In 2024, drivers even demanded 5 rupees per kilometer extra for AC rides, but this wasn't officially implemented by ride-hailing apps. Most drivers just simply refuse to switch on the AC unless riders insist, and even then, some decline. Now, as the mercury rises, so have passenger complaints. This begs the bigger debate, which is who pays for the AC. Passengers expect an AC cab, especially in the scorching summer heat. Drivers say they can't afford it unless fares increase. Ola, Uber, Rapido haven't provided a clear solution. No pricing model for AC usage, no opt-in feature either. So should drivers absorb the cost or should riders pay extra? Let us know what you think in the comments below. There doesn't seem to be an easy resolution to this tug of war. Perhaps us riders should consider investing in one of those handheld fans for now.
Joining us on the show now is Peter McGuire. He's CEO Trading.com. Peter, hi, thank you for joining in. And I want to start with the crude oil prices because we've seen a percentage point of gain overnight. We're trading at a 3-week highs. I mean, as is being said, you can't teach a lesson to countries and then also hope that the crude oil prices will remain stable or lower. I mean, that seems a bit contradicting, won't you say?
Absolutely, Manisha. Good to see you. I think, so many different components still working through. Naturally, we're a week away from President Trump's introduction as far as the tariffs on the 2nd. And also now, which is the wild card, these secondary tariffs have been introduced. And this invents a new trade weapon. And that's the issue. Now, Venezuela, as we know, exports greater than 40% of its crude to China for oil and gas. And this is going to be a really heavy hit on China. That's who it's directed at. There's no doubting that. So Venezuela, naturally, that's the other side of it. But this is very dynamic. And these geopolitical, I suppose, strategies are going to be fascinating how they play out over the next week or two.
And Peter, apart from that, we are on to a countdown on 2nd of April as well. The reciprocal tariffs is something that everybody seems to be talking about. And then, of course, retaliatory tariffs and etc. Would you say that the next 1 week is going to be very, very volatile or important in that sense?
I would think so, Manisha. I feel as though that you'll see an interesting what's going to be, I think, how it plays. First off, naturally, the impact as far as US dollar. Secondly, stock markets and the likes of gold as a safe haven. And it's bounced heavily today. It's up back at 3,050. So all of those components and then volatility across, naturally, the energy sector. And I think how stocks play and bond yields, they're going to be the next part of it. So, yeah, there's no doubt about it. We said it'd happen. There's plenty of action under President Trump.
There is. So since you talked about gold, what's your sense on that? We've done an all-time high of 3,057. We are holding around 3,015 right now. There is some profit taking. And that also is because we've seen the US dollar index gain to a 2-week highs right now. For the near term, there is a bit of a profit taking. But going forward, would you say that the gold still has it in itself to make further all-time highs going forward for the rest of this year?
Absolutely, Manisha. I mean, we've got 9 months to run, so I don't think that's going to be too hard to achieve. And the way it's going, I wouldn't be surprised that it probably does it this week. I think because volatility working through the market, yes, it's profit taking. Yes, it's going to be volatile, but these big breakouts on either side, there'll no doubt be resistance. I think probably around about that 29.50 sort of number if it was to hit it, as support, I should say, but the resistance to the upside. Let's see where it rolls. And yeah, I truly do think that we're in for some very interesting times over the next week.
Peter, any targets that you would want to put on in gold on the higher side?
It's got to be 31.50 to look at, Manisha. I want to go there first off. 32.50 is really the line in the sand, but I'm probably a little bullish there at the moment. I've got many investment banks and the biggest banks in the world are saying between 3 and 3.5. So we're in that, but I think it's going to be there a lot quicker than everyone's thinking because the ramp up that we've seen since January 1 has been monumental. And that, I think that that strength and the overall support is not going to wane anytime soon.
Peter, what's also your sense on the metal prices? Because copper clearly has been an outperformer. And then, of course, we've seen supports come in for aluminum. Cobalt is up by 38% in this year. The metal is clearly taking it firm.
Yeah, I noticed that some of those, the other metals, cobalt was just a scream. but it's only just nudging 10,000. Copper at 99.56 on the LME. It's going to take, I think, again, it'll take it out this week, that psychological barrier of 10,000, Manisha. It's been very, very bullish. And aluminium, I think that'll probably have a little bit of a run as well, and zinc. So tin's been a strong market. And all of those metals, I think we've got probably, second quarter could be a very dynamic quarter for industrial metals.
Anything as an outperformer that you see continuing for second quarter as well?
I think everything is going to be volatile, and I think that's going to be. I listened to the likes of Treasury Secretary Scott Bessent. I listened to Howard Lutnick, Commerce Secretary. These guys have got their finger on the pulse, and you've got to appreciate what their viewpoints are. And I'm really thinking that we're going to see, one, volatility, and secondly, opportunity leading into Q2 up till start of Q3.
All right. So clearly, Hormuz, as I say, stay invested when it comes to metals, not just base metals, but definitely precious metals.
Oh, absolutely. And that's why they are precious, right? This is gold, the way the kind of moves that gold prices have seen. Peter, thank you so much for sparing time and joining in. Manisha, thank you for joining in as well. With that, we call time on this edition of Halftime Report. Thank you so much for watching Business Lunch for the next 30 minutes.
After 6 days of a non-stop one-way rally, the market is a little mixed today. While Nifty crossed over about that 23,800 level, intraday mids and small caps are lower in trade. Trump threatens a 25% tariff on any trade with countries that buy Venezuela oil and gas. This would impact China and probably India. Analysts at ICICI Securities, though, do not see a major impact for India or Indian companies as the quantum of imports from Venezuela is low.
SEBI eases disclosure norms for smaller foreign portfolio investors, also announces the formation of a high-level committee to review corporate governance norms at the SEBI. Tuhin Kanta Pandey, the new SEBI chair, is in response to a question says that they will examine the NSE IPO matter, but did not commit to a specific timeline. And the management of Electronics Mart of India and the head of Retail Association tells CNBC-TV18 that the consumer spending in Q4 has remained muted, while EMIL points to the same-store sales growth of 5 to 6%. RAI says that industry has seen a near zero growth in apparels and very low growth in electronics. Both pointed to the recent stock market decline as a sobering influence on sentiment. Hello, good afternoon. You've tuned into Business Lunch, coming live from CNBC-TV18 Motilal Oswal Studios. I'm Vinny Motiwala, and thank you so much, as always, for tuning into CNBC-TV18. A quick look at what the market is doing. A mixed opening is what we're seeing coming in, few in the red, few in the green as well. Now, Nifty is off the day's highest point, right now managing to hold on to some bit of a green, but it did go in the red territory at some point of time as well. Look at the contributors coming in. HDFC Bank, Infosys, Ultratech Cement, TCS among the support coming in for the Nifty 50, while the drags is ICICI Bank, Reliance, L&T, IndusInd Bank. So some bit of a pressure is coming in on that front as well. Mid and small cap, let's look at that because that's an underperformance coming in on that front from the broadwood end of the market. And this is after 6 consecutive days of gains with the Nifty mid and small cap. We've seen a decline for both these indices. Nifty Bank, let's pull that up as well. Nifty Bank, after 8 days of gain, consecutive trading sessions of gain, we've seen a decline coming in today for the Nifty Bank. It did open up in the green, but as of now is trading in the red, almost near the day's lowest point is what the Nifty Bank is trading at, down 0.2%. The only sector that's trading in the green is Nifty IT. We did see those names coming in for the Nifty 50 as well, right? TCS, Infosys. So that is why what we're keeping an eye out on. Nifty IT is the only one trading on the green side. But let's move on, and RBI has modified priority sector loan rules. Now, how will this impact banks? Lata is joining in with us to give us more details on this one.
Well, first things first, priority sector is that 40% of all the loans banks have to give some favored sectors like, farming, affordable housing, renewables, etc. Now, regularly the Reserve Bank does modify these rules because they have to at least adjust for inflation, sometimes even for new products like renewable products. So what is the revision now? Houses, the limit has been raised as to what will qualify as priority. For big cities, over 50 lakh population, they used to give only up to 35 lakh loan as priority. Now it can go to 50 lakh. For smaller, for smaller towns, mid towns, the level goes from 35 to 45. And for, very small towns, the limit used to be 25 lakh to qualify as priority. It goes to 35. Then there are other limits that have been raised. You give even for damaged housing repair. Even there, similarly, for various categories, the limits are raised. Education loans, only 20 lakh was considered priority. Now it's become 25 lakh. So loans for, drinking water in schools, sanitation, that has been up from 5 to 8 crore. Healthcare in tier 2 and lower cities, smaller cities, has been up from 10 to 12 crore. And the number of people who qualify as weaker section, it has been increased a little, artisans, cottage industries and women, and also the amount that you can give them to qualify has gone up from 1 lakh to 2 lakh. So basically, they're adjusting to inflation and they're adjusting to a few new products. Then there are smaller, ease of doing business for banks, if you please. There used to be an interest cap if banks sold off the loans in the form of securitization. Those caps are gone. For urban cooperative banks, there is a genuine big relief. They had to give 75% of their loans as priority loans. Now they have to give 60%. And then for renewable energy, more projects under renewable energy are included as priority. These are also technological advancements which bring new products into the market. Now, who benefits? Well, all banks benefit in a way because it's easier to find a priority sector borrower. If it is a very small amount, it becomes more difficult for them. And HDFC Bank benefits because, they had this huge HDFC loan coming in and they had to do priority sector for that entire lot of some 7 lakh crore. Now more of the erstwhile HDFC loans will qualify as priority sector because the limits have been raised. And likewise, other banks, this is an IIFL note, which says banks like RBL, SBI, IIB, Federal, used to now and then fall short. In 2024, they fall short of that 40%. Then there are ways you buy priority sector certificates from other banks, or you have to invest in what you call RIDF, Rural Infrastructure Development Fund, done by the NABARD. That will be less. You know, that gives very little money, these other avenues. Now that the limits are raised, these banks can perhaps lend more profitably in the priority sector category.
Thank you so much for that, Lata. Now let's move on to the new SEBI chief, Tuhin Kanta Pandey, chaired his first meeting after taking the helm of the market regulator body. SEBI has decided on a host of changes, and here are the key highlights. SEBI has raised the threshold limit for FPI to make additional disclosure to 50,000 crores in equity AUM in India versus the earlier 25,000 crores. SEBI will no longer prescribe a cooling off period for public interest directors transitioning from one market infrastructure institution to another, but existing process for the appointment of PIDs will remain unchanged. The other important change is that the registered investment advisors can collect up to 1 year's fee in advance and reversing the previous 3-month limit that they had. The market regulator has also decided now to form a high-level committee to look at the rules governing to conflict of interest, which is there, and related matters pertaining to SEBI board members. And lastly, the SEBI chief signals a review of the NSE IPO proposal, and here is what he had to say. Listen in.
But surely, I think we'll look into it. You know, I've just, you know, sort of we'll apply our mind on how is it and how we can take it forward and what's the issues.
And moving on, the post of the 4th Deputy Governor at the Reserve Bank of India remains vacant nearly 70 days after Michael Patra's retirement. Now, the RBI traditionally maintains 4 Deputy Governors, 2 promoted from within its rank and one from a commercial banking background. And one is an economist. Ritu is joining in with us to give us more details on this one. Ritu?
Well, it's a crucial role, and therefore prolonged vacancy does have critical consequences, because it's been over 2 months since Michael Patra's retirement in mid-January, and the RBI is still missing a key decision maker on monetary policy. And this delay has not gone unnoticed by the financial markets, economists and policy watchers. The role is also vital because the Deputy Governor in charge of monetary policy is an ex officio member of the MPC that sets interest rates to maintain price stability. So while in the interim, RBI has reassigned this responsibility to Deputy Governor Rajeshwar Rao, who handles this portfolio along with his banking regulation duties, economists we've been speaking to warn that the absence of a dedicated Deputy Governor for monetary policy could weaken the depth of policy deliberations within the MPC. Keep in mind, Patra is a well-known, celebrated macroeconomist and was the only member to have served continuously on the MPC since its inception in 2016, steering it through many tough economic periods. Secondly, in the absence of the 4th Deputy Governor, RBI has had to reshuffle the 33 departments among the 3 remaining DGs rather than 4, leading to a greater concentration of responsibilities. And financial markets also closely monitor such appointments, and it tends to have a sentimental impact, and the delay in finding Patra's replacement is also being noted. Remember, the government had invited applications for this position back in November, which was a good month and a half before Patra was to retire. And we understand it has since held interviews with several candidates, including Poonam Gupta, Prachi Mishra, Chetan Ghate and others. Yet, nearly 70 days later, this critical seat remains unfilled.
Okay, Ritu, thank you so much for that. But, do keep an eye out on IndusInd Bank and Star Health as well. We had a couple of news flows coming in, and the ticker team of CNBC was surely flashing about that. Star Health, some bit of a negative news there, so keep an eye out on that one. But on that note, we're going to slip into a very short break. And after the break, we'll bring you with some details coming in as US President Donald Trump is threatening additional tariffs on countries importing Venezuelan oil. More on the story after the short break. Welcome back and thanks for staying tuned into Business Lunch on CNBC-TV18. Now, the US President Donald Trump has indicated that not all of his threatened levies would be imposed on April 2nd, and some countries may get breaks as well. However, he also opened another front in a global trade war by announcing 25% secondary tariff on any country that buys oil or gas from Venezuela. Take a look at this report.
Donald Trump could be more flexible than expected over new tariffs on automobiles and other goods. Speaking at a cabinet meeting Monday, the US president said his threatened levies would be imposed in the coming days.
And we'll be announcing cars very shortly, and we already announced steel, as you know, and aluminum. We'll be announcing pharmaceuticals at some point in the not too distant, because we have to have pharmaceuticals. We don't make pharmaceuticals anymore in our country.
But he said a lot of countries could get breaks without giving any more details. Earlier reports of the possible partial reprieve were hailed by Wall Street, sending US stocks sharply higher. But a White House official warned against expecting too much, saying Trump was still determined to impose strong reciprocal tariffs. The new president has regularly claimed that his trade policy will raise revenue and create jobs. On Monday, he announced a $21 billion investment in the US by South Korean giant Hyundai.
Hyundai will be producing steel in America and making its cars in America, and as a result, they'll not have to pay any tariffs. You know, there are no tariffs if you make your product in America.
The same day also saw Trump open a new front in his trade offensive. He said any country buying oil or gas from Venezuela would face a 25% tariff on exports to the US. Trump said the country was guilty of sending tens of thousands of very violent people to America. Venezuela's government said it firmly and categorically rejected what it called the new aggression. The latest move sent oil prices higher in Monday trade, with US benchmark crude gaining around 1%.
Now, following President Trump's tariff threat on countries that import Venezuelan oil, we spoke to Probal Sen, senior research analyst at ICICI Securities, to understand how the imposition of additional tariff could affect India. Let's listen in to what he had to say.
My understanding is that India imports close to about 0.2 to 0.25 million barrels a day of oil from Venezuela. When you consider that India's total imports are in the range of around 4.5 million barrels of oil per day, obviously it is a relatively small percentage compared to the percentage from, let's say, Middle East or, even Russia for that matter. But the fact is that if, the condition for avoiding this additional 25% tariff is that this oil will have to be replaced, then that's an additional sourcing that you will have to find from somewhere. From a supply security perspective, I guess because it's less than 5% or less than 4% of our overall crude slate, it's something that I think India can figure out how to basically, manage this hit from what we can tell.
And moving on, a team of US officials will be in India later this week for discussions focused on a bilateral trade agreement, with India looking for relief from tariff. Abhimanyu is joining in with us to give us more details on this one. Abhimanyu?
An American delegation is visiting New Delhi for trade talks between both the countries. This is not the first round of negotiations. What government sources have indicated so far is that India and the US are going to finalize the contours, the negotiation schedule and the terms of reference of the proposed bilateral trade agreement between both the countries, which is likely to be finalized in 2 tranches. The first phase of the BTA is expected to focus on issues pertaining to goods trade. What we have learned from sources so far is that the US has sought greater market access in certain industrial goods, automobiles, wines and agriculture, and India may seek duty cuts in labor-intensive sectors like textiles. Now, both the sides are trying to find a common ground based on each other's strengths, weaknesses and sensitivities to create synergy for two-way trade and investments, as well as for predictability in tariffs, regulations and economic integration. More clarity is expected by the end of this week. It remains to be seen how the talks are going to pan out, based on which the negotiation schedule is going to be made.
Thanks so much for that. Meanwhile, the Trump administration is in a soup after it apparently added the Atlantic editor-in-chief Jeffrey Goldman to a Signal app, a group which was discussing strikes on Houthis. Sanjay Suri is joining in with us with more details on this one.
Talk of a journalist having a story drop in the lap or into a chat group he's on. The editor-in-chief of The Atlantic magazine, Jeffrey Goldberg, got invited, inadvertently it seems, to a group chat on the Signal app where top secret plans to attack the Houthis in Yemen were being discussed. Goldberg says he was invited to join that chat on March the 11th, 4 days before the US launched what it called decisive and powerful strikes against the Houthis. He says he was invited by a user, Mike Walls, believed to be the National Security Advisor. He was then added to the group called Houthi PC Small Group. Goldberg says that on that chat were accounts that matched the names of Vice President Vance, Defense Secretary Pete Hegseth, Director of National Intelligence Tulsi Gabbard, CIA Director John Ratcliffe. Goldberg has now published some of that chain of correspondence, and the White House acknowledged that it appears to be authentic. Though President Trump has denied any knowledge of it, he says only that he's no fan of the Atlantic. National Security Council spokesperson Brian Hughes has said they are now investigating how an inadvertent member was added to that chain. This has come as a shock here in Washington to see that top US defense team was discussing plans against Houthis on a social media communications app, and without checking who all had been invited to it, who were on it unknown to them, and of all people, a journalist. Goldberg now reveals that in the hours before the strikes began, an account attributed to Defense Secretary Pete Hegseth posted detailed information on the group's imminent attack, on targets or the ammunition to be used, the sequence of the attacks. The discovery has now set off a furor within the Congress, particularly both Republican and Democrat lawmakers have been livid over this. Members from both sides have demanded a full inquiry, and Senate Minority Leader Chuck Schumer says he has demanded a full investigation.
Okay, on that note, we're going to slip into a very short break. Viewers, don't go anywhere. We'll be back with more news and updates after this break.
The shakeout has been good. It has tested you. It has, proven that you have a conviction in what you buy. And there's no something called easy money on the Lal Street, as everyone thinks that I buy today, make tomorrow, which had gone on for a few years. But all the veterans have told you that, wait, when the correction comes, people will panic. But I think if they hold true to the flag and, I think it's great. I think the domestic money prospering or domestic India is great. We welcome foreign money, we welcome foreign capital, but they have a right to sell, and I don't begrudge that.
Okay.
Market is a self-correcting mechanism. If you take stocks to unbelievable heights, the short seller will step in, or the promoters will sell in, or the insiders will sell in and want to encash it. So that will act as a natural check on the market, which it has done. As long as there's not any undue amount of leverage in the system. There was, I think, 70,000 crores of margin funding, which is the size of a small mid-cap company in India today. So there's no leverage. The banking system has no leverage. The government had fiscal restraint. So, in fact, money was tight. So there was no reason to believe that this would be a long-lasting bear market.
Sure.
And market will correct itself. Anytime the valuations of something become excessive, people step in and sell. Insiders sell, someone sells, and that creates a buying opportunity. First correction in 4 or 5 years, so it was particularly severe. And market correction is always severe. It always kind of panics you and tests your conviction, tests your patience, which is all the things that it did. But they are short, sharp, and swift. As you saw, the index fell very sharply and very swiftly, almost without respite, 800,000 points a day after that. But my feeling is that that is just a correction in a bull market, not the topping of a bull market. The reason I say that is even when the fall started, individual stocks were making new highs, new all-time highs. Bajaj Finance, United Phosphorus.
Welcome back to Business Lunch on CNBC TV18. Now moving on to some national news update coming in from the national capital. Delhi CM Rekha Gupta has tabled the first budget of the BJP government, and the BJP formed a government for the first time in 27 years last month after defeating the incumbent Aam Aadmi Party. Gupta, who also holds a finance portfolio, presented a 1 lakh crore budget, and which is over 31% higher compared to last year. The government has increased the capex from 15,000 crore rupees to 28,000 crore rupees, and the Chief Minister has allocated 5,100 crore rupees for Mahila Samriddhi Yojana, under which the poor will receive 2,500 rupees per month for this. Now, the government, Delhi government, has also granted 696 crore rupees for deploying slum clusters in the city. And with that, we're absolutely out of time on this edition of Business Lunch on CNBC TV18. Thank you so much for tuning in. Up next, your Mid-Cap Reader.
So many companies, good high quality businesses were making new high. That would typically not happen in a bearish phase of the market.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
My understanding is that India imports close to about 0.2 to 0.25 million barrels a day of oil from Venezuela. When you consider that India's total imports are in the range of around 4.5 million barrels of oil per day, obviously it is a relatively small percentage compared to the percentage from, let's say, Middle East or
Good afternoon. You're watching your Midcap Radar live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always is Vivek Iyer. Vivek, good afternoon. We started off the session well, but it seems like there's been a slight cool off from the highs of the day, but then it's par for the course, right? We've been moving non-stop for 6 straight days. Some bit of consolidation now.
Absolutely right. Good afternoon, Hormaz. Like you mentioned, on par for the course, given the fact that we saw 6 straight sessions of gains that ended yesterday. Today we saw a very strong open, a little surprising, managed to outperform in the morning. But post that, what's actually transpired is that the mid-cap and the small-cap index have seen significant profit booking. Small-cap index now down almost 1.7%. So that's a bit of a significant sell-off. But still, we've seen almost an 8 to 9% rally in just the last 6 trading sessions.
Absolutely, and there's a lot lined up on the show as well. So we'll take you through the top headlines then that are lined up at 1:30 this afternoon. There's some bit of profit booking coming in for the broader markets after healthy gains in the early session. The Nifty Bank is in the red while the mid-cap index is underperforming with gains cuts of anywhere between 1 to 2%. The Nifty IT is bucking the trend.
Cement stocks climb on the back of sectoral upgrade by UBS. The brokerage believes that the rough patch for the cement sector is coming to an end and upgrades Ultratech, Ambuja and Dalmia to a buy rating.
Donald Trump has threatened a 25% tariff on any trade with countries that buy Venezuelan oil and gas. This would impact China and probably India as well. Analysts at ICICI Securities, though, do not see a major impact for India or Indian companies as the quantum of imports from Venezuela is low.
QIPs galore on Dalal Street as Restaurants Brand Asia launches a 500 crore QIP. Central Bank of India launches a QIP to raise close to 2,000 crore and Punjab and Sindh Bank launches a QIP to raise close to 1,600 crore rupees.
And Kotak Institutional Equities says that the Indian CRDMO market is expected to quadruple over the next decade. It issues a buy recommendation on Piramal Pharma, Syngene and Sai Life Sciences.
Welcome to Midcap Radar. Like we just highlighted, today is a day where you're seeing quite a bit of consolidation emerging as far as the broader end of the markets are concerned. Whole host of stocks are seeing significant profit booking. One sector, once again, that's in focus on the back of worries of tariff is actually the entire pharma pack. So today, the pharma pack, barring a few select stocks, the entire pharma pack is actually seeing quite a bit of a sell-off. Names like Sun Pharma, Aurobindo, Dr. Reddy, all of these stocks trending and trading near the day's lowest point. But Hormaz has stepped to the wall. Hormaz has been looking at the broader end of the markets. And Hormaz, please highlight, which are the top movers over there.
It's a shade of red across the broader markets, and that comes after a swath of green that we have seen over the last few trading sessions. But we'll start off with the losers today for a change in the broader markets, and there are a lot of them. And Dixon Technologies is one as well. It's correcting significantly from the highs now at the lowest point of the day, 5.5% lower there. Zomato too seeing some bit of profit booking in today's trading session, actually continues to grind lower, but it's still not managed to break below that 200 marks. Another 5.5% gone there as well. MQR Pharma, Himadri Chemicals, all of them at the lowest point of the day. There is some selling pressure that is also being seen in a lot of PSU banks in today's trade, and most of these are the ones where there are QIPs that are open. Central Bank and UCO Bank in particular, these two, and also all of them are down to the lows and down between 3.5% to 5% in today's trading session. A couple of companies that have been in focus because of the order wins in today's session. NBCC won a 658 crore order, still trading with some bit of pressure today today at the low, still 2.5% down. And Kalpataru Projects also won significant orders, taking the total order inflow close to 25,000 crores for FY25, still holding on to gains of around 2%. And lastly, some stocks that are bucking the trend in today's session on the back of strong volumes, of course. HEG and Graphite India, both of them continuing to surge 11 and 15% higher now on HEG. Blue Dart and Fine Organics too seeing a good session so far in an otherwise market, in a broader market that is correcting in today's session.
Absolutely right. Thank you so much, Harmaz, for taking us through the list of movers as far as the broader end of the markets are concerned. But moving on, it's a very good time to get a technical check on the market. Let's now welcome Srikanth Chauhan from Kotak Securities. Good afternoon, Srikanth. Thank you so much for joining us. Would you call this as a slight correction, a bit of a consolidation before the next move higher, or are you worried that markets could fall from here on, Srikanth?
Good afternoon, Vivek. Good afternoon, Harmaz. Yes, for Nifty, I can say that it's a short-term correction that we are going to witness maybe for next 1 or 2 days of time. But the base part and the most, we can say the crucial part that the market did in the current run-up is that it has broken almost all its important levels except 200-day simple moving average, which is around 24,000 levels. But in this up move, the market has broken the level of 100 days as well as 200 days exponential moving average, which is positive. So now that particular level, 23,400 is going to act as major support for the market. And on monthly basis, the market has broken its previous highest level. I'm going to say the highest of the previous month. So which gives more comfort to traders. And it clearly then suggests that in case if there is any correction in the market, which is like going to come because the market is now very close to its overbought levels. Also, and most of the stocks are turning after hitting their important resistance levels. So broadly, I am of the view that for next few days, we may see the market between the range of maybe 23,500 and 24,000 on the higher side. But the strategy should be to buy on dips, and we should look for adding some mid-cap stocks at these levels to take or to create some long positions.
So which are those mid-cap stocks on your radar, Srikanth?
Afternoon, Harmaz. See, in that space, I would like to go with few pharma companies because most of these stocks are showing some extraordinary strength. They have broken their important levels, specifically stocks from the CDMO baskets. They are showing a lot of strength. And in that space, we like Piramal Pharma, which is currently around 227, 230 levels. There I'm expecting stock to move towards the levels of minimum 260, 265 in the near term. And if there is a short-term view, then one can create long positions with a stop loss close to 210. The other stock which we like is Chambal Fertilizer. And if we consider its technical formation, then it has broken the important resistance level at 570, 580, and it's a perfect bookish pattern. Based on that, I'm expecting stock is moving towards the levels of 700. Currently, it is around 610, but it is advisable to buy between 620 and 590 levels with a target of 700 on the higher side.
Thank you so much, Srikanth, for joining us. Piramal Pharma, doing very well in the session today. Also, Kotak Institutional Equities, that particular arm also initiated coverage on the stock with a buy rating. On the back of that, Piramal Pharma up almost 5%. But it's now time to slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
For that matter. But the fact is that if, the condition for avoiding this additional 25% tariff is that this oil will have to be replaced, then that's an additional sourcing that you will have to find from somewhere. From a supply security perspective, I guess because it's less than 5% or less than 4% of our overall crude slate, it's something that I think India can figure out how to basically, manage this hit from what we can tell.
If you're booking an Ola, Uber or Rapido in Hyderabad, it could be a sweltering ride. Cab drivers have launched a no AC campaign, refusing to turn on air conditioning to highlight their financial struggles. For many drivers at ride-hailing platforms, driving a cab is no longer financially viable. After operational costs and platform commissions, they're often left with earnings that barely cover their daily expenses, forcing them to make tough choices like turning off the AC. And so the Telangana Gig and Platform Workers Union has launched this No AC campaign. What are their concerns? Fuel prices are high and running AC means burning more fuel, making trips less profitable. Second is low earnings. Drivers say Ola and Uber take 30 to 40% of the fare, leaving them with just 10 to 12 rupees per kilometer. But operating costs with the AC turned on rise to 16 to 18 rupees per kilometer. Essentially, the driver is left with very little in hand. And so drivers are demanding higher base fares to cover rising costs, lower platform commissions and government regulations to ensure fair pay. The union is also pushing for a Telangana gig workers' rights bill, and if their concerns aren't addressed, they plan to escalate the protests nationwide. While Hyderabad's campaign is making headlines, this isn't new. It has been happening in Hyderabad and even Bengaluru. Drivers in Bengaluru have unofficially stopped using ACs for more than a year. In 2024, drivers even demanded 5 rupees per kilometer extra for AC rides, but this wasn't officially implemented by ride-hailing apps. Most drivers just simply refuse to switch on the AC unless riders insist, and even then, some decline. Now, as the mercury rises, so have passenger complaints. This begs the bigger debate, which is who pays for the AC. Passengers expect an AC cab, especially in the scorching summer heat. Drivers say they can't afford it unless fares increase. Ola, Uber, Rapido haven't provided a clear solution. No pricing model for AC usage, no opt-in feature either. So should drivers absorb the cost or should riders pay extra? Let us know what you think in the comments below. There doesn't seem to be an easy resolution to this tug of war. Perhaps us riders should consider investing in one of those handheld fans for now.
Welcome back to Midcap Radar. Well, it's now time for a CNBC TV18 exclusive. Yash joins in with more details on Star Health.
Well, that's correct, Vivek. So what we've been able to pick up from our sources is that the insurance regulator very recently conducted certain, inspection when it comes to about 8 to 10 general as well as health insurance companies. The matter of the inspection was to see how these companies have been handling their claim settlement processes. Star Health was one of those companies where inspection was done. As I said, it concluded about a month ago. Now, what we've been given to understand from our sources is that as a part of its initial investigation, after the inspection was conducted, there have been certain serious lapses which the regulator, that is IRDAI, has found when it comes to the claim settlement practices at Star Health Insurance. When I tried to understand more in terms of what are the areas which have been inspected and are being investigated where these lapses have occurred, essentially what I've been given to understand is that this includes areas like the claims repudiated, which means not settled by Star Health Insurance and rejected. It also pertains to areas like the average time taken to settle claims, also the deductions which Star Health has been making when it comes to the entire amount which needs to be settled as part of these claims. All these areas is where the regulator has found certain lapses when it comes to Star Health Insurance. What we've been given to understand otherwise is that once the investigation ends from the regulator's end, there is a possibility that the regulator might look to take some serious action against Star Health Insurance for all these lapses.
Yash, thanks a lot for that. At the lowest point of the day now is Star Health Insurance, 3% lower on the stock at 348, well below its IPO price as well. Moving on then, the other pocket that was in focus over the morning, and that was courtesy Donald Trump's threats on Venezuela, has not seen a very significant impact. Are these companies, ONGC and the oil marketing companies, HPCL, BPCL, but stocks like MRPL are taking it a bit on their chin. Sudarshan is joining in with more details on this. Sudarshan.
So as you said, overall the impact is very minor, but nevertheless there is an impact, and it's because of that US President Donald Trump has announced that he'll be imposing 25% tariffs on all the countries which are looking to import oil from Venezuela, and that would be effective April 2. Now, which all companies, Indian companies, can be impacted? So first on that list is ONGC. Why? Because ONGC has a subsidiary with the name of ONGC Videsh, which has 2 plants in Venezuela, and through that they used to produce crude oil. Second point for ONGC is ONGC was looking to recover dues, and the dues are of more than $500 million. So ONGC was planning that they can recover that dues by getting more crude from Venezuela. That is unlikely to happen. That's the reason ONGC is impacted. Now coming to oil marketing companies. If you remember, last month, Oil Minister Hardeep Singh Puri had said that he is looking to increase the crude oil imports from Venezuela because Russian crude discount that these companies used to get, now that has been narrowed after the US sanction. So he was looking at an option, and that option was Venezuela. So that is also unlikely to happen. But also, if you look at the overall imports, in 2024, there was hardly any crude oil imports by these oil marketing companies from Venezuela. The last time they had seen the imports was in January 2024. So overall, it's a minor impact, but nevertheless, it's an impact.
Thank you so much, Sudarshan, for joining us and giving us a sense of what exactly is transpiring as far as the oil and gas space is concerned. In fact, earlier today, we spoke to Probal Sen, Senior Research Analyst at ICICI Securities, to understand how the imposition of additional tariffs could affect India. Let's listen in to what he had to say.
My understanding is that India imports close to about 0.2 to 0.25 million barrels a day of oil from Venezuela. When you consider that India's total imports are in the range of around 4.5 million barrels of oil per day, obviously it is a relatively small percentage compared to the percentage from, let's say, Middle East or even Russia, for that matter. But the fact is that if the condition for avoiding this additional 25% tariff is that this oil will have to be replaced, then that's an additional sourcing that you will have to find from somewhere. From a supply security perspective, I guess because it's less than 5% or less than 4% of our overall crude slate, it's something that I think India can figure out how to basically manage this hit, from what we can tell.
That was Probal Sen of ICICI Securities there. And let's also focus on the CRDMO sector, where Kotak has issued a note on the sector and has initiated coverage on some of those stocks from that space. Vinny is here to tell us more on that. Vinny.
Yes, Kotak has issued and initiated coverage on some of the CRDMO space. CRDMO is Contract Research Development Manufacturing Organization. So they are third-party manufacturers somewhat of that sort to make it easy for pharma companies. Now they've initiated coverage on PPL Pharma, buy rating, target price of 300 rupees per share. Syngene is another one, buy rating, target price of 700 rupees per share. And Sai Lives, they've initiated coverage, reduced rating as of now, and target price of 875 rupees per share. What they say and what factors they believe will work out well for these companies: one, the rising focus in terms of the research and development outsourcing, that may continue to inch up going forward as well. In 2005, it was somewhere around 18%, and now it's become 42% across the globe. So that is an increase coming in. Plus, we have seen that shift coming in where everyone wants to reduce their focus on China and come to other countries. And that is what is something that could work out well for Indian CRDMO companies as well. So that rising shift from China will augur well for these Indian companies. Other than that, they expect the CRDMO market to even quadruple over the next decade. So that is important to watch out for in terms of the growth opportunity that they see coming in for these companies. And that is why they have come out with a note on this. Most of them are a positive rating that they've given here.
Thank you so much, Vinny, for joining in and giving us a sense of what exactly institutional equities had to say on the CRDMO space of Indian pharma companies. Let's now slip into a short break. We'll get him on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. Now the race to acquire Jayaprakash Associates is under the IBC is heating up. Now Ritu is joining in with all the exclusive details. Ritu, what are you picking up?
Well, Hormaz, over 24 suitors led by some of the largest conglomerates in the country are lining up to acquire Jayaprakash Associates under the bankruptcy law. We've been given to understand, the names of Adani Group, JSW Group, Oberoi Realty, Vedanta Group, Welspun. These are just some among the 25 plus suitors that have come forward to submit expressions of interest for the company. We've been reporting the deadline for the submission of EOIs will end later today, and bankers are expecting a few more players to come forward before the close of the deadline, which has now been extended 2 times before. But given that NCLT had disallowed bids for individual business clusters of JP, suitors are now allowed to only submit bids for the company as a whole, and that includes its interests across real estate, cement, hospitality, engineering, constructions. It's a fairly large conglomerate, so you can see the kind of interest that is coming in from various companies for various assets that are looking to acquire the company under the bankruptcy law. Now, Jayaprakash Associates is facing claims of more than 57,000 crores under IBC, and we had reported sometime earlier that the SBI-led consortium of lenders have already sold their stress loan exposure to JP, to the National Asset Reconstruction Company, and received about 1,800 crores in cash. The rest they'll recover from security receipts through the sale of the company via this IBC process. Now, keep in mind, though, this is just the EOI or expression of interest stage. After this, the final bids are going to be invited, and we'll then have to see how many of these 20 plus suitors actually bring serious offers to the table.
Thank you so much, Ritu, for joining us and giving us an update on this very, very important story. Remember, earlier 2 bits and pieces of that particular group were looking to be sold. Hormaz, if you recall, some cement assets, etc., were going to be sold to Dalmia Bharat, but that particular deal didn't go through. So it's going to be very, very important to see, what are the number of expressions of interest that do come in, and finally, via the NCLT route, who finally bags these assets. And also, there's a significant debt over there. So, the entire banking pack will be looking at that particular development in quite detail. But what's actually worked for the market is that in the last half hour, we've actually seen quite a bit of recovery come about as far as the market is concerned. The Nifty, that was trading in the red is now once again back in the green. And a whole host of large cap names, especially look at some of the OMC stocks, they recovered quite sharply. Names like BPCL, SPCL, ISCL, BPCL, in fact, now trading near the day's highest point. JSW Steel, that particular stock too, is now trading near the day's highest point. So it's been a sharp recovery, especially in the last half hour, Hormaz.
Oh yes, and Nigel has a very special nugget on JSW Steel, which he will be presenting in during closing bell. So do stay tuned for that one. At the highest point of the day, as Vivek was mentioning, is JSW Steel. What is not doing very well though is Zomato. 5.5% lower now on the stock. The second worst performer on the Nifty 500, and that too, interestingly though, despite the fall that the stock has seen, its record high is around about 304, 305, and the stock fell to around levels of 200. And despite the correction that it has seen, it has held on to that level of 200 on the downside. So it'll be interesting to see whether it still holds on to those 200 levels even after this kind of correction. But shifting focus now to the cement space, UBS has upgraded cement stocks like Ultratech, Ambuja and Dalmia Bharat now to a buy recommendation. The brokerage is saying that the rough patch is ending for this sector. Nigel is here with more details on that.
Well, that's right. UBS has gone ahead and they have upgraded the cement sector. They believe that the rough patch is coming to an end, and so they've upgraded Ultratech, Ambuja, Dalmia to buy. Remember, UBS has a negative view on the sector itself all the way since July 2023. The key reasons they cited at that point of time was rising competition, the demand slowdown because of the general elections, and also price competition because Adani had entered the cement space. But now, UBS, they have turned positive and they anticipate the earnings upcycle to emerge from this fiscal, that's FY26, strong EBITDA growth over the next 2 fiscals. Their positive stance is backed by demand revival, which will be driven by housing upcycle and the revival in government capex. They're also pointing out that the structural cost savings is going to help drive margins of the sector higher. And they believe that pricing could bottom out after the sharp fall that we've seen in the first 9 months of FY25. The sector consolidation has been led by 2 big players, that is Ultratech as well as Ambuja. The reasons for upgrading various stocks and the chart should come up for you on the screen. For Ultratech, they believe that the company has shown strong execution in tough times, have led industry both in growth as well as on margins. Their top pick, however, is Ambuja. That's because of the higher growth and the lower valuations. On Dalmia, they've done a complete U-turn. They had a sell rating, now they've upgraded it to a buy, while they maintain their positive stance and the buy rating that they have on ACC because of supportive valuations and industry tailwinds. Put all of this together, UBS, after close to 2 years, they have turned positive and constructive on the cement space.
Thank you so much, Nigel, for joining us and telling us about what exactly is transpiring as far as the cement stocks are concerned. Quite a few of the stocks doing very well in the session. But with that, it's all the time we have on this edition of Midcap Radar Mutual Fund Corner. When we return.
Hello, good afternoon. Welcome to Mutual Fund Corner on CNBC-TV18. I'm Vinny Motiwala, and thank you so much for tuning in as always. Now, it's that time of the year when you rush to make most of the best in terms of the investment avenue that you have to reduce your tax burden or to get in some benefits from the tax side as well, but also to look at your investment strategies. Now, in this episode of Mutual Fund Corner, we put the spotlight on various steps within the mutual fund industry that can help you as an investor to ease the tax burden, or maybe steps that you've taken during the year. What is the tax implication of that as well? And a lot more on that front. Now, to discuss all of this today, we're going to be joined by Varun Fatehpuria, the founder and CEO at Daulat Finvest, to talk to us about what, as a mutual fund investor, that you should be keeping an eye out on before the 31st of March. What can you do? What is the checklist that we should be watching out for? Varun, thank you so much for joining with us on the show. It's a pleasure having you here. 31st of March, financial year end is just approaching, just around the corner. Just a basic checklist as an investor. What do they have to do if they still haven't utilized maybe that 1,50,000 limit that they have? What options do they have maybe on the last few days, what can they be doing right now?
Absolutely, Winnie. Firstly, thank you for having me back on the show. As you correctly mentioned, that ATC 1.5 lakh rupees limit is something that every investor today will rush to take use of. And just to caveat that by saying that this is only applicable in the old tax regime, where you have a bunch of exemptions that is made available to you as a taxpayer. But specifically coming to the ATC itself, this is a 1.5 lakh rupees deduction that you can make from your taxable income if you make contributions to certain products. So these products could be your PPF investments, this could be your EPF, this could be your premium towards your life insurance, or even a contribution towards repayment of your principal home loan. So these are the major avenues under ATC that an investor today could utilize to effectively reduce their taxable income on the investors with the still old tax regime. So that's something that investors definitely should be mindful of. They could also further reduce the taxable income by further 50,000 rupees under Section 80 CCD that effectively allows you to invest into NPS, and then another about 25,000-30,000 rupees with respect to your ATD towards health insurance premiums. So really, all in all, about 2.5 lakh rupees of total taxable income could be reduced from an investor's taxable income by making contributions to all of the avenues that I just mentioned.
Absolutely. You know, out of that now, the important one that comes in is in terms of ELSS funds for a mutual fund investor. If they've done that, you know, normally there's that lock-in period of 3 years that you have. Now, those who have actually invested it, you know, 3 years ago maybe, should they redeem it? You know, if they're now moving out of that old regime, does it make sense then to look at an ELSS fund and, you know, maybe reinvest in an ELSS fund then?
So naturally, someone who is shifting towards the new tax regime where you do not have any of the exemptions that I just mentioned, then it does not particularly make sense to invest in an ELSS from a purely tax saving perspective, because you do not have any sort of an exemption over there. But where typically we have seen ELSS actually when he stands out is that because of the 3-year lock-in, it actually forces investors to stay invested into an equity scheme for a sufficiently longer period of time compared to, let's say, an investor who would maybe want to shift in and out of schemes in the next 6 months, 12 months. At least this 3-year period is forcing you to stay invested in that scheme. And that typically has a better investor outcome, since there is no frequent switching in and switching out of funds during that interim period. But just purely from a tax saving, if someone is getting into the new tax regime, then perhaps ELSS would not be the best choice for you. So that's number one. And number two, people also need to keep in mind that unlike, let's say, more traditional instruments like PPF, where the redemption proceeds are also tax-free, if you're redeeming ELSS funds, the capital gains that you accrue over that period of time is taxed at the capital gains tax slab. So that is also, you need to keep in mind that the entire proceed is not tax-free. Only the investment amount at that particular year becomes tax-free, but the redemption proceeds are fully taxable.
So the redemption proceeds, so someone is maybe, you know, redeeming it right now, that would be taxed in this financial year then, right? And they would be paying a long-term capital gain tax on this one.
That's right.
Okay. And then if someone is already invested maybe in a PPF, EPF, right? We were mentioning these options. Then does it make sense now maybe just to move out of it and maybe continue with the PPF, EPF, or, you know, ELS still makes sense as just in terms of equity exposure that they want?
I think it's important that investors today understand what their overall asset allocation is. If I look at my PPF allocation or an EPF allocation from purely a debt perspective, so the post-tax returns comes to at about 7%. If I'm looking at a comparable instrument from a pre-tax perspective for my fixed income allocation, that needs to be anywhere between 9 to 10%. So PPF is where that stands out, that tax exemption that you get not only on your investment but also on the redemption proceeds comes in very, very handy over a 10-year, 15-year period. So for people looking at PPF as a debt allocation, as a fixed income allocation of their overall investment portfolio, definitely we would suggest that maybe you could continue doing that PPF. But someone, let's say, if you already have a debt allocation outside of PPF in the form of fixed deposits or something, then it is better than you probably go with an instrument like an ELSS, which comes with a significantly lower lock-in period of 3 years compared to a 15-year lock-in period in PPF.
Right.
And the returns are also definitely higher given you have equity exposure as opposed to a fixed income exposure.
We'll take a slight detour from MF Corner, cutting across to the Finance Minister, who's replying to the discussion on the finance bill in the Lok Sabha.
Major steps through this finance bill. It's actually a bill which aims to provide tax certainty. It rationalizes a lot of provisions which are towards ease of doing business and also provides unprecedented tax relief in honor of the taxpayers of this country. So I'll straight go to talking about the direct taxation, in which the income tax is something which I'll spend a minute on, and then talk about the other direct tax reforms that we've undertaken. We've recognized the strength, spirit, and the contribution of the Indian middle class, and as a result, this budget has, under the new tax regime, come with a proposal that there will be now zero income tax payable for income up to 12 lakh rupees. So that is an average of 1 lakh rupee per month salary, which is going to be tax-free, completely tax-free. So for the salaried taxpayers, this limit technically will be even higher. At 12.75 lakhs, which is inclusive of the 75,000 rupees standard deduction, and the marginal relief that is going to be applied for the taxpayers reduces the tax burden on the marginal rise in the income beyond the limit. So I will elaborate this point in response to some of the members who have asked specific question about what happens for those who are crossing 12 lakhs per annum income. I'm also glad to say that through this finance bill, we have brought in the new income tax bill, meaning I have not presented it as part of the finance bill. The introduction of the new finance bill during the budget session this time, which of course is rightly gone into a select committee's review, post which we will take it up in hopefully in the monsoon session, aims to... Yes, I thought I said that. I said it is not brought through the finance bill, it is a new income tax bill. Thank you. So, brought during this budget session, but hopefully we'll have it taken up for discussion in this House during the monsoon session. So during this budget session, sir, not only the provisions and also certain reformatory steps taken during the through the finance bill, the rationalization of customs also is a major thing that I'll come to talk about in a minute. So the steps taken for the customs duty reduction are also post elaborate discussion with the stakeholders. So there has been an element of Jan Bhagidari both in the preparation of the new income tax bill and in the larger finance bill itself. The other direct tax reforms, sir, are worth mentioning. We have brought down certain TDS and TCS provisions. We've increased the thresholds so that the deduction of tax starts at a higher threshold rather than a lower. In respect of sale of goods, the requirement of TCS, particularly under section 206C, 1H, is proposed to be done away with. We are completely removing it. Further, considering the difficulties which is faced by the taxpayer, we now propose to allow the benefit of 2 such self-occupied properties without any condition. And that is a major step which will benefit the middle class, because in order to prove that the second house is also under their occupation, they do quite a few of paperwork and diligence has to be kept up. We are now saying you don't even need to do the paperwork. We take it as you stated for the second such occupied property. In order to streamline the process of transfer pricing, sir, and to provide an alternative to yearly examination, we have proposed that a scheme of determining arm's length price in international transaction for a block period of 3 years at a time. So this will be in line with the global best practices. So annually, people do not have to rush to prove what the transfer pricing commitments will be. Further, we've also, with a view to reducing the litigation and provide certainty in international taxation, the scope of safe harbor rules have been expanded. Instead of having it narrow and expecting people to continuously come and prove that it is required for their business, we've widened it, and the safe harbor rules are therefore broader in favor of the assessee. Further, the presumptive taxation regime for non-residents is also now a lot more relaxed, particularly in the case of those businesses or resident companies which are operating in electronics manufacturing facilities, because electronics manufacturing demands supply of components in time, and those specific components will have to be brought in. If time lapses in their supply from the original equipment manufacturer, the production itself will suffer. So we've given them this particular presumptive tax regime, so that the non-residents who participate in these services, particularly given to a resident company, can benefit. So also for the startups, again, which is primarily for the middle class, government has proposed to extend the period of incorporation of startups by 5 years to allow the benefit available to the startups which are incorporated before 1/4/2030. So that's been an extension given so that there's greater participation of the newer registering startups as well. Again, to promote IFSC, the International Financial Services Center, government has proposed specific benefits to ship leasing units, to insurance offices, treasury centers of global companies which set up business in the IFSC. In order that they can claim benefits, the cutoff date of commencement for the commencement in IFSC has also been extended for 5 years, that is up to 31/3/2030. So these are, in brief, the steps through this finance bill taken up for direct taxation. Now, if I were to briefly look at the indirect tax, sir, as I said earlier, the customs rationalization, tariff rationalization, which was an exercise that we began 2 years ago. Every year, some or the other rationalization-related steps have been announced in the budget. Now, this budget, this finance bill in 2025, relating to the customs, aims to rationalize tariff structure and to address duty inversion. These will also support manufacturing units, domestic value addition, promote exports, facilitate trade, and also provide relief to the common people. So that has to be highlighted, because it's not just the new income tax bill which is coming, but this finance bill itself is talking about rationalization of customs, which is a very big step forward so that importers can benefit from it. Exporting industry which import parts can also become cost competitive. So, budget 2025, sir, we aim to boost domestic production and enhance export competitiveness by reducing duties on raw materials and inputs, making domestic products more cost effective, as I said a minute ago. So taking forward the comprehensive review of customs, about which I would like to elaborate, the rate structure announced in July 2024 budget, we are taking that forward. So as I said, the exercise began 2 years ago. We made a major announcement in July 2024 budget. We are taking it further in this budget also. So this finance bill actually proposes to remove 7 customs tariff rates for industrial goods. The 2 tranches of rationalization of customs tariff carried out so far have reduced the number of tariff rates from 21 to 8, including the zero-rated goods. Many Indian exporters have become cost competitive, and one matter which will interest honourable members is when you're looking at cess and surcharge, we made sure that on no one item on the customs duty where it is being imposed, both cess and surcharge would be imposed. We are looking at that, and therefore in this budget, in the finance bill, we have proposed that only one can be applied, and therefore only one cess or surcharge will be applied on any one item. So, for instance, social welfare surcharge will be now exempted from 82 tariff lines which are subject to a cess. So the double burden of both cess and surcharge on any particular item is being removed. In addition, sir, we also propose to add 35 additional capital goods for EV battery manufacturing and 28 additional capital goods for mobile phone battery manufacturing to the list of exempted capital goods to boost domestic manufacturing. So this will actually have a bearing. So EV battery manufacturing will be a lot more cost competitive because 13 additional capital goods are being exempted. So 28 additional capital goods for the mobile phone battery manufacturing are also being exempted. Sir, we also propose in this finance bill to fully exempt basic customs duty on cobalt powder, waste, the scrap of lithium-ion battery, lead, zinc, and 12 more critical minerals. So this is in addition to the 25 critical minerals which were fully exempted from the basic custom duty in the July 2024 budget. So we have not wasted time. After that, we've rapidly also brought in more goods, particularly critical minerals, into this exemption due. So the Customs Act as 1962 does not provide, as it prevails now, does not provide any time limit to finalize provisional assessments leading to uncertainty and cost to trade. So as a measure of promoting ease of doing business, in this finance bill, government has proposed to fix a time limit of 2 years, extendable by a year, for finalizing the provisional assessment. That will itself bring in a lot of certainty for those importers and exporters. Sir, we also propose to extend the time limit for end use of imported inputs in the relevant rules from 6 months to 1 year. What this actually means is some exporters, in order that they produce goods for export, import some components. The customs duty is not paid because they're bringing it for the production of goods which have to be exported, because we don't export taxes. But for that use of that component which is imported, we normally give 6 months, saying you brought it in June 2025, by December 2025, you should have sent that product out, that product which you manufactured with this particular item imported. Many exporters found it difficult. The 6 months period is not sufficient. So for them, we have extended that time period to 1 year. So this is more an export-friendly measure that we have taken. So we have actually allowed the industry to better plan their imports, and also we are providing operational flexibility. So these are as about the finance bill as it was presented to the House. We are of course coming up with some government amendments. The amendments which are being brought, 4 of them I'd like to highlight. The simplified safe harbor regime in Section 9A for investment funds managed by fund managers in India. Normally, these fund managers are expected to verify that no one exceeds the 5% limit in terms of direct investment or indirect investments. So it is proposed to be made further simpler by removing this 5% condition for monitoring indirect investment, because it becomes too cumbersome for them to search for who the investor is indirectly, and that itself hampers investment, so we are removing that. Clarificatory amendments in the provisions for IFSC's provisions and presumptive taxation for service providers for electronic manufacturing units is also being brought in as government amendment. And the third one, for clarity and consistency, a government amendment is coming in for small changes in the block assessment provisions, and then the 6% equalization levy, which was being proposed, which was in effect for advertisement and other things, is being proposed to be removed, so that we can address the uncertainty in the international economic conditions. So largely, these are the major... yes, I'll answer. These are my opening statements. I'll come to answering each one of the members' points. I will come to answer. So these are the finance bill related...
writer for...
So then I now come to addressing individual members who have raised issues or sought clarification. So I'll go one by one. By the issue, 2 or 3 members could have spoken on each of the issues. I'll go by the issues. So on the income tax, as I said, members have shown concern for incremental increase over 12 lakhs. What if, I think this was a member, Sri Neeraj Maurya, who had raised this question about if income is 12.10 or 12.20 lakhs, tax will have to be paid. So ensure taxes are graded from 12 lakh rupees is what the suggestion came from Sri Neeraj Maurya. So I want to say that even while I read the budget speech, we made it very clear that marginal relief is being granted. Under the provision of Section 87A, it has been ensured that the tax payable by a person having income marginally above 12 lakhs is required to pay only the marginal amount of tax equal to the amount of income above 12 lakh, so that his carry home is also 12 lakh of rupees. So he may earn incrementally more, but he'll still take back to his home 12 lakhs, and that increment on the incremental amount, the calculation is also very well explained. For instance, with an income of 12.10 lakh, rupees 10,000 is what he earns over the 12 lakh that he already earns. So for that 10,000 rupees, it will be paid as income tax only. Tax without marginal relief on that person earning 12.10 lakh would have been 61,500. So we have given the marginal relief where he, for the 10,000 rupees he earns more than the 12 lakh, the 12 lakh is exempt from tax, but the 10,000 will have to be paid as tax. He would have ended up paying 61,500, whereas because of the marginal scheme that we've added into this scheme of income tax, he ends up paying only 10,000 rupees. So, and when income of rupees 12.20, only 20,000 will be paid, and he will still take the 12 lakh. Otherwise, the marginal relief, if not given, he would end up paying 63,500 rupees. So the marginal relief has been brought in for the incremental increase in pay. Sir, personal income tax has been reduced by way of rebate. This can be altered in the coming years. It may be done away with in the future years if income tax collection is lower.
The shakeout has been good. It has tested you. It has, proven that you have a conviction in what you buy. And there's no something called easy money on the Lal Street, as everyone thinks that I buy today, make tomorrow, which had gone on for a few years. But all the veterans have told you that, wait, when the correction comes, people will panic. But I think if they hold true to the flag and, I think it's great. I think the domestic money prospering or domestic India is great. We welcome foreign money, we welcome foreign capital, but they have a right to sell, and I don't begrudge that.
Okay.
Market has a self-correcting mechanism. If you take stocks to unbelievable heights, the short seller will step in, or the promoters will sell in, or the insiders will sell in and want to encash it. So that will act as a natural check on the market, which it has done. As long as there's not any undue amount of leverage in the system. There was, I think, 70,000 crores of margin funding, which is the size of a small mid-cap company in India today. So there's no leverage. The banking system has no leverage. The government had fiscal restraint. So, in fact, money was tight. So there was no reason to believe that this would be a long-lasting bear market.
Sure.
And market will correct itself. Anytime the valuations of something become excessive, people step in and sell. Insiders sell, someone sells, and that creates a buying opportunity. First correction in 4 or 5 years, so it was particularly severe. And market correction is always severe. It always kind of panics you and tests your conviction, tests your patience, which is all the things that it did. But they are short, sharp, and swift. As you saw, the index fell very sharply and very swiftly, almost without respite, 800,000 points a day after that. But my feeling is that that is just a correction in a bull market, not the topping of a bull market. The reason I say that is even when the fall started, individual stocks were making new highs, new all-time highs. Bajaj Finance, United Phosphorus, Shree Cement, so many companies, good high-quality businesses were making new high. That would typically not happen in a bearish phase of the market.
Go beyond market headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Asian markets this morning, they're mirroring what the US market has done. Asian markets have opened up on a positive side.
Was willing to dismiss the tariff effects on inflation as transitory.
WSJ and the Bloomberg stories, which said that tariffs could be more targeted and less drastic.
Maybe post the recent run, taking some money off the table if you're a trader may not be such a bad idea.
There's limits on housing loans. The price limits have been increased.
Volume growth has continued to surprise on the upside, specifically for MGL.
There you go. I mean, we're at about 23,753.
Some of our schemes will be overweight more in capital marketplace, somebody more into NBFCs or financials. So I think combination is what possibly makes sense to be overweight for now.
Restaurants Brand Asia, Central Bank of India, as well as Punjab and Sind Bank, all three of them actually see divergent trends.
March 24 has been a good day for FPIs investing into India. There has been a relaxation on the tax front.
Today is a day where you're seeing quite a bit of consolidation emerging as far as the broader end of the markets are concerned.
Okay, today is a more normal kind of a day, which means that we're not moving up rapidly. It's more mixed, it's more two-way, it's not one-sided. But 6 days we've had a non-stop one-way move, and it's good perhaps to see a little bit of consolidation. I'm Prashant, this is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios with me, my colleagues Nigel and Reema. Guys, hi, good afternoon.
Hi, good afternoon. And it's good to see that at least the large caps haven't given up ground. They're consolidating, but they're flat right now.
Well, that's right. And, though the breadth of the market is negative, there are plenty of stocks actually that are moving around, and we'll tell our viewers about a few of them, like the graphite electrode players. They're up 10-15% or thereabouts. There are pockets that are still, giving you a good amount of gains.
Absolutely. And, the graphite twins, so as to speak, when they move ferociously. Double-digit gains, and they move together. And Nigel will tell us in a bit from now in terms of what's happening. But just a quick 2 words on the market and what we are seeing. So we had 6 days of a one-sided non-stop rally. And today, I mean, can you call this a pause? Because we are still up 0.25% or so. But in the context of the 150, 200-point days we've had, this is a pause. Small cap index, more broadly, it's a pause for the mid and small cap space. 1% lower in the small cap index. The last I checked, mid cap index is down about 0.5. On the Nifty, we crossed. And, you know, we've been galloping higher. So, you know, from the 20-day to the 50-day to the 100-day to the first retracement to the February high, it's all happened in 6 days. So 23,807 was the February high. Intraday, we crossed that. We're under it now by about 100 points. That's naturally the first resistance. And I think it's possible that for 2-3 days, you are actually going to see some consolidation. We said in the morning as well. You got an event on the 2nd of April. Coming into it, you've got massive gains. It could be a bounce. It has been a bounce from sold-off levels, but it's gains nevertheless. Very fast-paced ones at that. So, you know, it's possible you get a couple of days of consolidation, not a bad thing at all, and then maybe the uptrend resumes. Nifty Bank, the Nifty support is at 23,400, which is roughly the 20 hourly simple moving average, and the Nifty Bank 20 hourly moving average is to 50,700. So these are 23,400 and 5,700. These are near-term supports that you need to watch out for on the way lower. But otherwise, I mean, just a bit of a pause after fantastic gains. Nothing otherwise. It's more stock specific, which I think we'll spend time on. Prima.
IT is catching up after the drubbing that it got in the month of February and early March. So the Nifty IT index is leading from the front, 1.7% up today, adding to the 1.5% gain that it had yesterday. So in 2 days, the Nifty IT index is up more than 3%. And the gainers there include Infosys, where Jeffrey says the 20% correction seen in Infosys perhaps is a bit excessive. HCL Tech, TCS, Wipro, all on the gainers list with gains of more than 1%. Banks have cooled off. It's come off more than about 400 points from the day's high. That's the Nifty Banking Index. PSU banks are weak. The Nifty PSU Banking Index is down close to about 1.5% now on the Nifty PSU banks. Individual stocks in the frontline space which catch your attention. Ultratech Cement right on top, 3.5% up. Trend has been flip-flopping both sides with big moves. Today it's up nearly 3.5%. Bajaj Finance, Finserv, these stocks continue to gain ground.
Well, that's right, Rima. Well, let's welcome Mitesh Thakkar onto the show. Hi, Mitesh. Good afternoon and good to see you. Well, you know, some kind of profit taken from the broader markets, though the headline index, well, that continues to hold up in the green. What are you doing? You know, I think earlier this morning we were discussing closer around 23,600 could be a good entry opportunity. Buy on dips continues?
Good afternoon, Nigel. I think exactly that's the point which I was trying to make, that you will get a decline or pullback at some point in time. And to my mind, I think, you know, it started, we got a low of 23,627 or thereabouts. So that's the area which, you know, you would want to buy 23,600 levels, give and take 25, 30 points. Similarly, on the back Nifty also, I think the first support or the first pivot is still about 51,500. I think let it come down to those levels and then we'll take it from there. So the timing remain long, identify.
Oopsie. Okay, all right. I think the message was to remain long, but we'll try to get Mitesh back with us in just a bit to complete that point. Let's focus on a couple of stocks that are buzzing in trade. And graphite electrode companies, HEG and Graphite India, both of them are on fire today. And that could be probably two reasons. They're moving on rather large volumes. Point number one, Japan has imposed tariffs on China's graphite electrode imports from the coming Saturday itself. Now, the Japanese market is to close to around 60,000 tons, of which close to 25% or 15,000 tons is imported from China. So the street believes that the Indian graphite electrode companies could fill in from these Chinese imports. So that could be one reason there's an opportunity in the Japanese market. Point number two is there could be a price hike in the offing from April 1st itself, because Chinese producers, they went ahead and they increased prices of HP grade. That's the high power grade. And so the domestic prices, they as well will follow suit. And effective, April 1st, it's likely graphite electrode prices for HP grade could go up by around 7 to around 8%. And this will positively impact roughly around 25% of the sales mix. So both the factors at play. One is they're looking to fill in the gap that will be created in the Japanese market via those Chinese imports. And the second factor is price increase after a while could be accepted by the street. So two probable reasons why the graphite electrode companies are buzzing in trade. Deepak Shenoy joins us on the show. Hi, Deepak. I'm not sure whether you track these names. A few years ago, they rocketed up. Then the stocks saw a sharp correction, and their margins have seen a sharp correction from the peak. But now you have a couple of triggers. Probably that the steel cycle is on the revival. There could be some export opportunities and a price hike as well. All of them could bode well. Any view on these names?
Nigel, I don't have too many views on them, though, they're a set of spiky stocks. So when sometimes there are issues with, like for instance, the last time it was because China suddenly decided to shut down a lot of operations around because of a move by even Europe to do this. There was a revival in electric arc furnaces all over, and they provide the raw material or one of the consumables in electric arc welding, electric arc furnaces. So therefore, you get a sudden bump in margins, and these margins will collapse once things get better. There are two big companies, Tokai Carbon in I think in Japan, and Graftech in the US. Much bigger producers of the same materials, but in India, because these are two very large compared to the Indian size of the market, they tend to get impacted by international prices. Japan's just done, I think, a 95% duty on anti-dumping duty. So we can assume that prices are actually lower than what otherwise China wants. In general, or China is otherwise selling, but in general, the problem is this: America has put import tariffs on steel worldwide. Japan and Korea are large manufacturers of steel. I think the world is going to be flooded with steel from these manufacturers compared to the Indian manufacturers. And production dynamics might actually come down in the future. So you want to be careful about sudden spikes. So you want to play stocks like this, you want to play them on price momentum, but not really on fundamentals, because the fundamentals are just really fast. And I don't think the current triggers are actually strong enough for you to even see a sustained 1 or 2 quarter increase in margins. You might see something that's very short term, not more than that.
Okay, Deepak, stay with us. Mitesh is back with us. We lost the line there earlier. Mitesh, sorry, complete that point on the indices and then your trades as well, Mitesh.
So, Prashant, I was on the indices, my view was to use any declines to buy. I think that's the remains. And on the stock side, I think Axis Bank is something, which is showing extraordinary strength and is outperforming in a negative kind of market. So buy here with the stop at 1098. 1155, 1165 is my first target area. Eventually, I'm looking at slightly higher levels as well. And the other one which I like is Reliance, which has given a pullback towards support area. The first support pivot of gap around 1280, and the stock is now at about 1290, had a low of 1284. So buy here with a stop at 1277 for a target of 1315.
Got that. Let's talk about IT. The Nifty IT index is up nearly 1.5%. UBS today says there is more upside in IT names compared to downside. The key reason is stocks have corrected sharply, 15 to 20% lower on stocks. Valuation multiples have derated by 12 to 20%. Now coming to the fundamentals. UBS spoke to many of the IT managements, and they said that yes, the uncertainty has increased, but there has been a very marginal impact on tech spending. And plus, there are counterbalances to US slowdown. For instance, Fed rate cuts could take place, corporate tax cut. So that could help, the overall fundamentals. So according to the earnings downgrades, but on the whole, FY26 will still be better than FY25. And therefore, valuation multiples should get back to the levels that it was in FY25. And therefore, they're expecting about a 5 to 10% bump up in IT names. Also, getting back to the point about valuation after the recent correction, they're saying the Nifty IT index is trading at a 5% discount to the 5-year average. TCS is trading more than 1 time below its trading 1 standard deviation below its 5-year PE multiple. So therefore, valuations are fine. They like UBS likes Infosys, TCS, Wipro, HCL Tech, all of them are buy calls for them. The only one which is a sell is Tech Mahindra. So more upside compared to downside for them. Deepak, UBS is talking about a rebound of 5 to 10% for the sector in the near term. Would you play for this tactical bounce, like from oversold regions? Would you play for it? Or do you think there is an investing case now in IT names, large cap IT?
Rima, I think the case is slowly starting to come because of valuations, but not necessarily in all of the companies mentioned. I think one of the problems right now is we don't know how these tariff issues are going to impact some of the companies' spending patterns in the US, especially if there are tariff impacts. There is going to be a change in spending, IT-related spending in a large number of organizations in the US, whether they're manufacturing organizations or retail, in terms of how they'll plan their road ahead. If you add 20-25% tariffs to China and Chinese products, especially in the small packages front, some of the way the retail expenditure happens will change. And I think in some cases it's positive, in some cases it's negative. BFSI might still continue to be okay for the time being, but again, a lot of it depends on the US not going into a recession. So I would say at this point, let's wait for the tariffs. It's just a week and a half away. We'll be able to figure out if this requires a large number of changes. And if it does, you might actually see more IT spends than less once you get to know the extent of the impact of the tariffs, because things may change from regulatory technology perspective, or in terms of what they might need to be able to enforce these tariffs at a company level itself, and produce more need for outsourcing rather than less. Because of that, I think the future might still be bright, but we'll have to see the contours based on the traffic. So this 5-10% short term, I mean, I don't think I'd play for it. There are too many events in the short term that can derail any short term prediction like this. But at a 5 to 10 year basis, I think some of these companies might actually succeed quite well, because they may be able to use this AI pieces to make themselves more productive and offer their customers a better price and value kind of equation. So we have some names, but I don't think the next 3 months are going to be very great.
Deepak, coming back to you, interesting thoughts there. Star Health is the next one we're going to focus on. That's the health insurer, private health insurance company. IRDAI, the insurance regulator, has found some lapses in the claim settlement practices. Yash is here with details. Yash.
Well, Prashant, at the start of it itself, let me make it very clear that the insurance regulator, IRDAI, recently, just about a month ago, had conducted inspection on about 8 to 10 general as well as health insurance companies. Star Health Insurance was one of them. Now, what we've been able to pick up from our sources is that as far as that inspection is concerned, that concluded about a month ago, after which investigation into the content which was received from the inspection had begun. And what we've been given to understand is that the regulator has found some serious lapses when it comes to the way claim settlement process was handled at Star Health Insurance. When I tried to understand more in terms of what are the areas where these lapses are found, what I was given to understand there is that various areas, including the claims which have been repudiated, the claims which have been rejected, the claims, the time taken for claim settlement, even the deductions which were put as far as these claims are concerned. These are certain areas where the regulator has found some serious lapses when it comes to the process and how it was handled at Star Health Insurance. What I've been given to understand is that that investigation is still ongoing, and once the investigation against these various companies as well as Star Health Insurance ends, the regulator might look to take some action against Star Health Insurance for these lapses which it has found, and of course it finds if there are more going ahead in its investigation. We had also written to Star Health Insurance on this particular query, and we are yet to receive a response from the company.
Okay. By the way, Yash, thank you very much for that. That is with regards to this particular story. But last week, of course, was pretty big with insurance. That big Bajaj deal and entry of more players. And by the way, health as a segment is seeing a lot of activity as well. LIC, for example, is on record to say that they're in advanced conversation to buy a health insurance company. So a fair bit happening. I think Deepak generally, broadly, from what I remember, has a positive view there on life insurance companies. Deepak, but my question, I wanted to ask you about defense as a space. Stocks have bounced nicely. I don't know if you own any names, 30, 35, 40% actually across the board.
Yes, I think, some of them I think still continue to be a little overvalued, but the scope for growth is going to be even more now, given how Trump is behaving. We are going to see a lot more demand locally for locally produced equipment. And I think the private sectors needs to play a much larger role also in this place because to a certain extent, the belief that only public sector can serve the defense services and all that stuff is a little bit old school. You can have 51% plus domestic ownership and still do quite a good job going forward. I think we'll need it. We're seeing this in railways in some cases where India is not able to meet a lot of demand, and I think in defense also we will reach that point. But a lot of the expenditure planned for last year wasn't actually fully done when a lot of orders have kind of been held back. But I believe that in the next year, we might see a significantly higher chunk of orders. It might happen, whether it is drones or ships or submarines and things like that. I think a lot of these companies will benefit. There's still a long way to go. And I know the scope of these companies have probably gone up 5x in the last 2 or 3 years. But I think there's another 5x that's still remaining in the next decade. So we should be seeing a lot more domestic defense companies do really well, and even arms of companies like M&M and all that. We own this by the way. So there is a scope for those defense units also to kind of tremendously increase their sales from where they are right now. Still early days, but I think overall the space I'm very positive on. It's part of a couple of portfolios that we own. And I think I can't comment on the recent 20-30% fall. They fell 50-60% also. So I don't think most of them have recovered back to the highs of where they were last year, middle of last year. But I would say think of these as a 5 to 10 year play rather than what's happening right now. It may be useful to look at the overall market growing 5x rather than look at whether they've grown up 30% from the lows. That might not be so meaningful.
Deepak, thank you very much for joining in. We'll get into a break on that note. We'll come back and chat with Pashupati Advani, founder and chairman at Global, Foray on the other side.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBC-TV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube.
Welcome back. So you got the market, which is, broader market under a little bit of pressure, and of course the Nifty still trading with the small gains. 20 odd points is all that is left now. We started at 230 with about a 0.25% gain. Pashupati Advani is founder and chairman Global Foray. Pashupati, good afternoon. Good to have you here. We've had a fantastic and ferocious bounce. Have you been a buyer over the course of the last 10 days or so, or you've sat pat?
I nibbled, but not enough. So it has been a bit of a damn squib for me. But a little bit of money is still better than no money. And also it brought back some of the positions that had gone down quite a lot. It's been nice, but I think we're going to float again. And I think we may even float down a little bit because except for certain sectors, I think that, we're in a range. And, I would say 22,000 on the bottom, 22,000, 22,200 on the bottom, and maybe another 200-300 points from here in Nifty on the other side. So we're floating in a range. Bad news comes from the US. We're coming closer and closer to April 2nd when the tariffs are actually going to bite. And then we're going to see, because everyone in our part of the world doesn't know how to react to the tariffs, because they haven't yet enunciated what the tariffs on Indian companies are going to be. So let's see what happens.
Although, Pashupati, those who we've spoken with, economists, etc., they're of the uniform view generally, that actually our trade with the US is not that large. As a percentage of our trade, of course, as a percentage of US outside trade is very small. Our trade also is very small. So we're not big trading partners. So actual impact, if tariffs go up, it's indirect. So if tariffs go up for the rest of the world and global growth takes a bit of a hit, so that we are a lot more exposed to.
No, for sure. Global growth is obviously going to take a hit. There's no doubt about it because of the volatility and the changing sort of whims of President Trump. I think that he announces one thing and cancels it the next day. So I think that that's going to actually make some difference. But the reality is there's a lot that they can do against us in the sense that our service industry still pumps money into the US and pumps people. The people side is very easy because Elon Musk seems to have dodged the immigration department in the US. So who knows what's going to happen, if it's going to take a lot of money, a lot of time to get visas and a lot of time to get permissions for people to move over there. That's going to cause problems for our IT companies. But the reality of the fact is, I think that we are going to have to sort of make some changes, and those changes are going to be painful for us. And I expect some kind of, inflation all over the world.
Pashupati, you said you nibbled. You sound a little regretful that you didn't buy enough or buy more, but you did buy a little bit. So what is it? I am
super conservative, and I bought a little bit of Paytm, and I bought a little bit of Zomato, and then I kept quiet and I left it. And I think that there were obviously opportunities in Reliance, HDFC Bank. The big parts of the index have actually moved up quite nicely, and they were also sitting targets looking for us to be able to buy into them. So I think that was a mistake. But hey, life happens.
So why not buy now? HDFC, Reliance, yes, they're not at the lows that they were about a week back, but you're not comfortable, after a 5% up move in these stocks?
No, so I'll tell you what does look interesting are sectors. Reliance is also part of that sector, but I think that we should be looking at Reliance because it's always an interesting stock, and I think that it's moved up nicely and will probably continue to move up. I think personally that we're going to be in a little bit of a sort of hum and haw till April 2nd, And then after that, we shall see what kind of tariffs actually hit us and what's hitting the world, and then take a decision. Because I think it's time to keep the powder dry and be ready to buy if the opportunities come. And I definitely think that those opportunities are going to be there. A sitting duck has been the defense industry, because everyone is saying that, we may stop buying armaments from the US and we'll have to make our own. So our own industry has to step up, and therefore that provides a great opportunity. And it's the government as well as the private sector that's going to get into all the defense stuff and start doing, new capex in that industry. So that's kind of a no-brainer.
All right. Hi, Mr. Advani. Good afternoon. Good to see you. Nibble a little is better than not nibbling at all, right? So at least you got in some money, and you're sitting on some gains out there.
At least I didn't sell off stuff at the lows. That's the other thing that people have done.
Indeed.
Yeah, anyway, yeah.
All right. Mr. Advani, but the call on IT, I think the last time around we were chatting about this. You said you're not very optimistic on the tech pack. There is that threat of AI. There's a lot of uncertainties as well. And that call has worked out well, right? Because the tech index has actually underperformed. Year to date, it's still down close to around 13-14%, while the Nifty is more or less flattish. But various sell-side notes, yesterday we had CLSA, today we have a UBS note as well. They believe that maybe the time has come for IT. You're still staying away, or will you nibble?
See, the reality of IT is that it's a large part of our index. So unless IT stocks either become a lesser part of our index or, start to move. They've got some earnings, but I think those earnings are going to be under some pressure. And, I think the real issue is going to be this whole issue of H-1Bs and getting visas to get people into the US, which has been our major market. And I think that that's going to cause a slowdown and probably lesser results from the IT companies. So yes, I am still not bullish about that sector. But hey, who knows? I have been proven wrong, and I guess I can be proved wrong again.
No, absolutely. Now you are saying, Pashupati, near term, those who are watching you, although your time horizon is longer, but since you began by saying you're expecting a bit of potentially a move lower from here, back to about 22,200. Is that what you said?
No, that I think is the bottom. I think we may float down to 400-500 points super niche and just float, because I don't think there's no strong trigger. The good thing is the IPOs have stopped. So I think that's a good positive. So I think that net as money comes into the market, money has come into the market because some people have made a quick flip in China and have flipped money and come back to India and come back into the same things, having made money in China, because the Chinese market was up very, very strong over the last 30 days. So I think that, that opportunity has been taken. This is a market everyone needs to be in. They can't be out of this market, but which sectors they choose to be in, I don't know. Obviously a new player is going to put some money in IT because it's 20% plus of our index. But, I wouldn't jump in with, both feet, because, that sector does have issues.
IPOs will start again. I think today in the newspapers there's that Manipal IPO, which perhaps is coming, could be a large one, as and when that happens. NSE, yesterday we heard from the SEBI chairman, WIP, right, work in progress. He didn't say work in progress, I'm paraphrasing. He said, well, we'll look at it. But of course, no timelines or anything of that sort. There's a lot more in the pipeline. Rima would know with the IPO KYC. Sorry.
They've stopped for this week 10 days. Now they're coming again. I guess they'll come in first week of April.
Well, the QIPs are back.
QIPs are back.
QIPs are back.
And a lot of the lock-in shares, etc., right? Which is a very large amount over the next 2 months or so. These are pre-IPO lock-ins, etc., which are opening up, and so on and so forth. Any other single stocks? You mentioned Zomato, Paytm. Anything else of interest to you? Right
Actually, I have been. One of my favorites has been Indus Towers, which is kind of working out in its own slow way. But
You're
I think
enjoying the dividends, but no price gain.
Well, it's okay. That's not a bad place to be. But I think that I think Vodafone may look interesting at these levels because they've got some relief on the tariff. Somebody thinks I'm crazy, but I think below par. I think it may provide a good speculative value. And we'll see. I'm looking at it. I haven't done anything yet, but I may just decide to jump in. So, it's one of those mad things, because I think that, telecom is here to stay. It has to be in there. The government owns 30% of the company at $10. So, what's wrong with that? So, we're partners with the government in a lot of things. What's wrong with the telecom company? And they have got some benefit in this CUG. So I think that's going to be helpful going forward.
So you're studying both Vodafone Idea as well as Indus Towers, both of them?
No, Indus Towers I've got. So I'm just sitting
You've
on
got
it.
that.
I think
Okay.
that,
And Vodafone Idea, you're flirting with the option of whether or not to get in or not, right?
Yes, but it's a totally speculative option, and it's an option that it's one of these. It's going to be 7 for 0 or 7 for 14. It's one of those. It's not really a stock that you pay for a 5% or 10% margin. So
what about IndusInd Bank? That's another one out there, right? The verdict is split out there. 600 to what?
Yeah.
Which way?
Yeah. So again, that's another one that one can play. See, I'm a great event-driven person, so I like these things. So in IndusInd Bank, I think there is some upside, but it keeps going up, and then bad news and keeps going down, and now they're sacking. They're not giving any renewals, and they're trying to get a new CEO. So there's a lot of flux there. But in flux, there's always a chance to make money. So yes, I am looking at IndusInd Bank also.
Okay, all right. Thank you very much, Pashupati. A good conversation.
Thank you.
I look forward to speaking with you after the second.
Happy 25-26. Happy 25-26 for all of us, and let's hope 25-26 is a good year also.
Let's hope so. Absolutely. Thanks again, Pashupati.
Thanks.
I thought for an instant he's wishing like happy, the next few days before Trump, 2nd April comes, and then we're hit with so many headlines. I thought he's just like, wishing.
So I was told he has decided April 2nd because he didn't want to do it on April 1st because everyone might think it's April Fool's and nobody will believe it. So that's why the tariffs are coming on 2nd. That's what I was told, but I'm sure that's hearsay.
By the way, Pashupati, Reuters is reporting that the government here is open to cutting tariffs on some 55% on US imports. So, things are in motion. This is a completely Reuters story. They say government estimates hit to exports worth $66 billion from Trump tariffs. And they're seeing a hike of 6 to 10% for key US exports out of India to the US. So this is some stuff. So, preemptive measures in that sense is what the Reuters story is indicating. We'll take a quick commercial break. Pashupati, thank you again. We'll come back. We'll get a quick check on what's happening in dealing rooms. Nimesh joins in for that.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
My understanding is that India imports close to about 0.2 to 0.25 million barrels a day of oil from Venezuela. When you consider that India's total imports are in the range of around 4.5 million barrels of oil per day, obviously it is a relatively small percentage compared to the percentage from, let's say, Middle East or even Russia, for that matter. But the fact is that if the condition for avoiding this additional 25% tariff is that this oil will have to be replaced, then that's an additional sourcing that you will have to find from somewhere. From a supply security perspective, I guess because it's less than 5% or less than 4% of our overall crude slate, it's something that I think India can figure out how to basically manage this hit from what we can tell.
If you're booking an Ola, Uber or Rapido in Hyderabad, it could be a sweltering ride. Cab drivers have launched a no AC campaign, refusing to turn on air conditioning to highlight their financial struggles. For many drivers at ride-hailing platforms, driving a cab is no longer financially viable. After operational costs and platform commissions, they're often left with earnings that barely cover their daily expenses, forcing them to make tough choices like turning off the AC. And so the Telangana Gig and Platform Workers Union has launched this no AC campaign. What are their concerns? Fuel prices are high and running AC means burning more fuel, making trips less profitable. Second is low earnings. Drivers say Ola and Uber take 30 to 40% of the fare, leaving them with just 10 to 12 rupees per kilometer. But operating costs with the AC turned on rise to 16 to 18 rupees per kilometer. Essentially, the driver is left with very little in hand. and so drivers are demanding higher base fares to cover rising costs, lower platform commissions and government regulations to ensure fair pay. The union is also pushing for a Telangana gig workers' rights bill, and if their concerns aren't addressed, they plan to escalate the protests nationwide. While Hyderabad's campaign is making headlines, this isn't new. It has been happening in Hyderabad and even Bengaluru. Drivers in Bengaluru have unofficially stopped using ACs for more than a year. In 2024, drivers even demanded 5 rupees per kilometer extra for AC rides, but this wasn't officially implemented by ride-hailing apps. Most drivers just simply refuse to switch on the AC unless riders insist, and even then, some decline. Now, as the mercury rises, so have passenger complaints. This begs the bigger debate, which is who pays for the AC. Passengers expect an AC cab, especially in the scorching summer heat. Drivers say they can't afford it.
Welcome back. Well, a few stocks actually have moved to the low point of the day, and that explains why after moving up close to 60-70 points in the last hour or so, we're back down to just a 10-point gain. But it's that time of the day when we tell you what's going on D-Street Chatter. Nimesh joins us to fill us in with what he's picking up. Nimesh, after a while, some bit of a cool off, but who's complaining? Some consolidation is par for the course.
Oh, by far actually it's been a day of consolidation, but clearly, from a flow perspective, Nigel, I guess today's a day of much better buying. So that's the overall feedback from the FID. In fact, there's going to be a small MOC basket buying as well in some select stocks in the last 30 minutes. So that's something from a flow perspective. Even the mid-cap index, while the index is down 1%, even in the broader markets, the feedback is there is buying interest. In fact, for a change now, today there is reportedly buying in select small caps and micro cap stocks as well. I'll cover some of those names in D-Street Chatter, but broadly, that's the sense from a flow perspective. Again, the sector of late has clearly been the PSUs. While some of the PSU stocks have seen some bit of profit booking, there is still buying interest at large from large institutions in the PSU basket as well. So clearly, Nigel, it looks like a day of consolidation. While we've given up most of the gains from the early morning trade, but there is buying flow or buying interest from larger institutions in today's market. Technically, we're heading into the big resistance of 23,900, so that's the level to watch out for. But because of the expiry and the big concern on reciprocal tariffs, for the next few days, you might see a bit of consolidation on the Nifty. But there is clearly buying interest in individual names, and that outperformance is likely to continue. That's the sense I'm picking up as far as flows are concerned.
What about stocks, Nimesh? What chatter have you picked up?
Well, Rima, so the first on my list is Carbon Universal. While the stock has gave up most of the gains from the opening trade, but there is buying interest from larger FIs in today's market. So expect very high delivery volumes in Carbon and Universal. That's the first stock. Couple of stocks there is selling pressure. Zomato as well as LIC Housing Finance. Zomato is clearly clearly down 5%, largely on back of very strong selling. So looks like some FIs have turned net sellers again in stocks like Zomato. The third stock is Suzlon. While there was a Motilal Oswal initiating report, I understand there is going to be a small MOC buy as well in Suzlon in today's market. So watch out for delivery volumes there. And the last is a couple of stocks where I mentioned, within the broader market stocks, there is buying interest. JB Chemicals, Hudson Agro, and Grindwell Norton. All three stands out. In a weakish market, these three are buzzing into it. The volumes on the higher side, and there is buying interest from larger FIs in the broader market stocks, and these three names stands out in terms of delivery-based buying.
All right, Nimesh, thank you very much for that. So that's the chatter as Nimesh is picking up at this point in time. Mitesh is back with us with what he'd want you to do as far as trades go. So 23,675 now. Mitesh, what do you have?
So, despite the fact that the markets have come off, Prashant, my view remains positively biased, so we'll keep trading on the long side. And I have more of, I've rather BTSC call than SCBT side call. So, BTSC on TCS here, keep a stop just below levels of 36.47 and a target of 36.90, 36.95 can be looked at. And the other one which I like is BHPL, still in good pullback. So by here, BTSC here at the start at about 212.7 and a target of 216.5, 217 can be looked at.
Okay, all right. Well, thanks a lot for that, Mitesh. Let's focus on the fairest names then. And post an 18% run in 2025 so far, JSW Steel has become the most valuable steel company in the world by market capitalization. This as it's overtaken ArcelorMittal as well as Nippon Steel. Now, even if you compare, JSW Steel with the other Indian companies' market capitalization, well, JSW Steel is by far much larger than the others by market capitalization. In fact, in comparison to Tata Steel, it's more than 20% higher at current reckoning. Brokerage firm Investec, they have a buy rating on the stock with the target price at around 1,100 rupees. They say the company is their preferred fairest play on the growth pipeline, return ratio profile, execution, and leverage management as well. They highlight that the company has delivered attractive shareholder returns in the past few years. That's based on the steady capacity addition as well as EBITDA growth that we've seen in the last 4-5 years or so. Now, here are a few takeaways from Investec's meeting with JSW Steel's top management. They say that the company is targeting 51 million tons of capacity by 2030, which they've already laid out a plan for around 43 million tons by 2027. Additionally, they want to ensure that the value-added products as a percentage of their total mix will be around 50 to 60%, which is good, right? They're also focusing on operational efficiencies by securing raw material in both the key inputs, that is iron ore as well as on coking coal. And they've also ensured that limited capex will be taken on board outside India. The street wants them to focus more on India, and that's precisely what they're doing. Investec mentions that on inorganic growth, they said that that's optional in nature and will be subject to various synergies as well as the balance sheet health as well. The management as well has remained committed on the leverage ratios, and they say that they're targeting net debt to EBITDA that will remain sub that 2.5 times in the medium term. On the regulatory front, they say that they have recently announced that 12% safeguard duty on flats that could aid pricing by around 3,000 rupees per ton. And the management remains very, very hopeful on the incremental policy aiding mining economics. And unlike peers, JSW Steel lacks legacy leases, which minimizes the impact of lease expiring as well. Finally, on ESG, the management says that they maintain that they're going to be net neutral in carbon emissions by 2050. The company is focusing on renewables as well as zero liquid discharge. That's the big headline today. JSW Steel is by far the largest company by market capitalization across the globe. So thumbs up to that name.
Absolutely, and it's quite an achievement coming through. Well, let's talk about another asset which has been up in the air for the last 10-15 years now, 10 years at least. This is Jaiprakash Associates I'm talking about now. The race to acquire Jaiprakash Associates under the IBC process is heating up. Remember, for more than a few years, the question was whether it will be taken through the IBC process or there could be an outside IBC process which perhaps could be found. Well, we know it's going through the IBC and now potential suitors are lining up. Ritu is here with details. Ritu.
That's right, Prashant. Nearly 8 years in the making, and now we understand more than 24 suitors, including some of the country's largest conglomerates, one of which Nigel was just talking about, are lining up to acquire Jaiprakash Associates under the bankruptcy law. Names like Adani Group, JSW Group, Oberoi Realty, Vedanta Group, Wells Fund. These are just some among the 25 potential bidders that are expected to submit their expressions of interest today. We've been reporting that the deadline for submission of EOIs, which has already been extended twice, closes later today, and banks do anticipate a few last-minute entries as well. Keep in mind, given that NCLT has ruled out bids for individual business clusters, suitors will now have to bid for the entire company, and that will include interest in real estate, cement, hospitality, engineering, and construction, where the company does have some prized assets, which is really luring the suitors. There's also huge debt at stake, almost 57,000 crores of claims under the IBC. But keep in mind, we had reported that the SBI-led consortium of banks has already transferred their stress loan exposure to the NARCL, already received about 15% of the amount, which is 1,800 crores in cash, which will reflect as recovery in the current quarter. But that said, this is still the EOI stage, more than 24 suitors, yes, but the real test will come when final bids are invited, and we'll see how many of them actually put real offers on the table.
All right, absolutely. And, assets are lots of assets, lots of good assets, lots of, remember there was that cement plant which went to Dalmia, and then, of course, that transaction never went through. Some high quality assets, some not so high. but suitors are lining up, as Ritu is pointing out. Thanks very much for that. Now let's focus on the CDMO space. Kotak has come out with an initiating coverage on the space. Vinny is now going to tell us what they're saying, what their thesis is, and what are their top ideas in this space. Vinny, over to you.
So yes, in terms of the note that has come in from Kotak, they've initiated coverage on 3 specific stocks in the CRDMO space. That is Piramal Pharma, then we have Syngene as well as Sai Life Sciences. Now for Piramal as well as Syngene, they've initiated coverage buy rating. For Piramal Pharma, target price 300 rupees, Syngene target price is 700 rupees. For Sai Life, it's a reduced rating, but a target price is 875 rupees per share. Key factors that they think will pay out for this segment and sector, especially the CDMO side, is one, the rising R&D outsourcing business from innovators from across the globe. That may continue. They expect that to see a further rise. And do not forget, India surely will be benefiting from this because of the shift that is coming in terms of the supply chain from China towards India side. So that is one benefit there. They expect the CRDMO segment actually and the market to quadruple in the next decade. An important one there. Supply chain rejig, like I was mentioning, a gradual improvement in terms of funding that we've seen, as well as niche tech is something that is driving the growth and will drive the growth for the company over the next few years. Other than that, in terms of the base case also, the shift that we're seeing in terms of China, what Kotak is saying is that at least India will be able to capture that 30% of the demand shift that they may see from China will come to India. So that is still going to be a very huge amount in terms of the opportunity that comes in for Indian players. Now, in terms of Piramal Pharma, they're expecting a revenue growth of around 13% over the next 4 years. Syngene around growth is around 14% is what they're seeing, while Sai Life is a 17% growth over the next 4 years is what they're watching out for. In terms of valuation, they still believe that Piramal Pharma is much better valued versus a Syngene or Sai Life, and Piramal Pharma is still much lower valued even when you compare it to global peers. So that is why it's a much more of an interesting bet coming in for Kotak in terms of Piramal Pharma, then Syngene and Sai Life.
Okay, all right. Thanks a lot for that, Vinny. Well, let's get in Jay Bala of cashsecures.com who joins us on the show. Hi, Jay. Before we get to the levels, how are you feeling? Bullish or bearish?
I'm changeably bullish, Nigel.
Yeah, bullish now.
Fickly bullish.
Let's get to the levels then, Jay, because the last many weeks you have got it right and kudos on that. But suddenly the markets has found momentum. Is this the real deal? Are you not looking at levels now sub that 21,000, 20,000? I mean, sometimes I worry when I hear those levels. But what are the levels now? We're at around 23,700 or thereabouts. Where are we headed?
Actually, the markets have done a few good things, but that have not eliminated some bad things. So I'm looking for. I was looking for some things to get eliminated so that we get clarity. We don't have 100% clarity. The good things for the market first is that last week when Prashant was talking to me, he was about to come back to me about the USD INR after Lata finished, but unfortunately we ran out of time and we couldn't have got it. USD INR was breaking out of a head and shoulder stop on the day we were speaking last Tuesday. And it is that the reason why it's come here at 85.5 is because of that. That's bullish for the equity markets. But if what we missed out last week, what we can still continue to be a valuable input is that if the Reserve Bank allows it to appreciate, it can get to somewhere close to 83, even 82.5. But I don't know if that's going to be possible if the Reserve Bank is now allowing the rupee to appreciate freely. Number two, we had spoken about small caps 3-4 weeks ago, and I said that small caps is likely to rally from 14,100 to earlier level at what projected 70,000, slightly short of that to about 16,500. Small caps have done 16,500 now, and they seem like they might still have one more higher highs to come through. It's a similar situation for mid caps and micro caps. But the bad things are that there has been considerable amount of damage done to the FMCG sector, auto sector, consumption, and even the Nifty IT sector. And Reliance is definitely not helping bulls so far. So given these heavyweights that are doing these things, I don't know what the good things that we spoke about will counterbalance that. So the levels we're talking about right now, we are looking at 24,230 as the resistance. I'm anticipating the market to first pull back somewhere closer to 23,275, and then possibly push back about today's high. So a pullback due, and as I said earlier, I'm fickle about my bullishness, but as the tapes is telling me right now, is asking me to be bullish, but the structure hasn't eliminated some of the bearish things for the markets as such.
It's been a long, long while, Jay, since I've heard you say that. Normally you say a visit down and then later on a visit even lower after that. But now you're saying maybe a 400-point pullback and then brace for a 1,000-point rally, which would mean that we move to, above that 200 DMA mark on the Nifty. Jay, just stay with us. For the time being, we'll slip into a short break. You come back and we'll get more picks out of Jay. Stay with us.
Increase. Ola, Uber, Rapido haven't provided a clear solution. No pricing model for AC usage, no opt-in feature either. So should drivers absorb the cost or should riders pay extra? Let us know what you think in the comments below. There doesn't seem to be an easy resolution to this tug of war. Perhaps us riders should consider investing in one of those handheld fans for now.
Welcome back. Nifty is ending flat around 23,650, about 200 points off from the session highs. The mid and the small cap index down over 1%. Jay, what about individual stock trading ideas? What would you have for us?
Yeah, I have a couple of names today, Rima. The first one is Blue Dart, and Blue Dart is thrusting past a downtrend line from the 2024 highs, and it's well above it. And it's an economy-facing stock. Probably there is some message here. A stop loss at about 5,700, and as long as 5,700 holds, the stock is bullish for and good for more. The next one is Persistent. I've been bullish on this since October 2022, and it looks like the high that it registered in December 2024 by outperforming the market is probably an incomplete high. And the recent low of about 5,000 is just slightly above maintaining the bullishness for the structure to clock one more record highs. So as long as 5,000 holds, the stock is bullish. Maybe it doesn't get as high as the all-time high, but possibly pushing somewhere close to it.
Jay, just to I have your view on Nifty Bank as well. And are you turning bullish here, or are you kind of saying overall in the market very briefly? I know what your view on the Nifty. You're saying pull back to 23,200, then one more swing high.
I still haven't dropped my bearish anticipation, Prashant, but I know I'm a slave to the tape. What the market is saying right now is, there are both options. The markets are finely balanced between the bullish and the bearish case. And as long as some of these bearish things that I spoke about, as they are not eliminated, there is still a risk for the market to the downside. And the main risk actually comes from the dollar index. The dollar index possibly bottomed on the 18th of March. And also, there's a possible signal that's coming from gold. Gold has possibly got one more higher highs to come through, fresh all-time high. And post that, if what I'm seeing is correct, it's if gold has a potential to drop something bigger than what we saw in 2011 and 2015. Basically, if that were to materialize, gold is saying we are entering a deflationary situation. So, in a deflationary environment, it doesn't spare any asset class. It will be only the dollar that succeeds. So watch out for it. It's just latent at the moment. We want gold to do what I'm anticipating to do. Only then the realization will happen.
Okay. If you were a fundamental analyst, it's simpler. You'll say I'm neutral. I'm not bullish, I'm bearish. But as you said, you're a slave to the tape. Fair enough. Let's quickly run through Nifty Bank and Nifty IT as well, because you've got calls there, right? You've got a view.
Yeah. See, ICICI Bank still got one more higher high to come through. And I think once that's complete, probably the banking index will also start to slide lower. And I'm anticipating that resistance to come about 52,600 to 52,900 on the banking index. When it comes to the IT index, it's got a weak bounce pending in the very short term, possibly somewhere close to 38,900. If we see a strong rejection from 38,900, which I think it might be the case, because I'm anticipating the NASDAQ futures to get rejected somewhere close to about 20,655, currently at 20,300. So I think that will be in sync with the IT index. IT index, as I said earlier, it shouldn't have closed below 37,000 last week, and it did. That's not a positive. But if it needs to do reparation to recover the bullishness, it needs to do a lot of work. Let's see what it does around the 38,900 mark.
Okay, all right. Jay, stay with us. Before we wind down the show, I want to pull up an intraday chart on the Nifty, actually, because that's moved to the low point of the day. The last tick is absolutely at the lows of the day, and it seems, there is some selling that's crept in. Wipro has come off. Tata Motors is one stock. Pull up the intraday chart on a few of these, auto names. I think pull up the auto index, actually. Tata Motors, Maruti, both of them have moved to the low point of the day. So sharp downtick is what we're seeing on both those two. TCS, the tech index as well, it's done a relative outperformance, but towards the end of trade, that is one has slipped from the high point of the day. So quite a bit of selling is what we observed in the last few minutes. So let's wind down the markets. Then we go with the cut-off close around 50 points. The broader markets, well, the Nifty paused a little bit. The broader markets came in for some profit taking. On the Nifty itself, Indices Bank was the big loser, down close around 5%. Dr. Reddy's down 3%. Adani Enterprises down 2%. On the flip side, your Ultratech Cement that did well. Trent as well bounced back. Bajaj Finserv, well, that was another stock that was up close to around 2%. And Grasim as well, up close to around 2% in trade.
Well, let's get to some of the losers then. Indices Bank down 5%. So stock continues to crumble, still not at the lows that it was, which is closer to 600, when the bad news first came out. But Indices Bank under severe pressure. Dr. Reddy's, Adani Enterprises, Coal India, Adani Ports, auto names like Bajaj Auto, M&M, weak in trade with a cut of nearly 1.5%. Reliance Industries crumbled. State Bank of India weak.
Absolutely, and lots of movers on the upside and downside in the broader space. Actually, Zomato, Dixon, PG Electroplast are some of the broader market losses that we had. And there were also losses in names like Dam Capital, HCC, Kaveri Seeds, Jyoti Structures, Iron Exchange. Just to name a few. Nifty 50 just, I think, because it's the adjusted close, it's I think the adjusted close is slightly in the green, 10 points higher, 23,668 is where we are closing at. Well, I think it's a wrap on this edition of Closing Bell from all of us here. Goodbye, but more coming up on Markets Forward in just a bit from now.
Just trying to do the right thing for the American taxpayer, for the American people. Just a thank you to the Doge team. We're literally getting death threats and being accosted. And here.
You know, these are a lot of them are just kids. You know, they're just trying to help out, and they're very talented. They could get jobs for millions of dollars a year. Instead, they come here, earn peanuts, and get death threats. So thanks to the Doge team.
The Nifty and the Sensex end mildly higher, gaining for the 7th straight day. The Nifty holds on to 23,650. Mid-caps taking on the chin. The index cracks closer under %.
UBS turns bullish on cement and IT, expects both sectors to see a better FY26. Ambuja, ACC, Ultratech gain nearly 1%. The IT index up 1.5%.
QIPs galore on the Lal Street as restaurants brand Asia launches a 500 crore rupee QIP. Central Bank of India launches its QIP to raise 2,000 crore rupees, while Punjab and Sindh Bank will raise close to around 1,600 crore rupees. Hello and welcome to a fresh new edition of Markets Forward, your go-to show. We'll apprise you on what went on in today's trading session and gear you up for tomorrow's trade as well. I'm Nigel and with me is Rima. Well, Rima, some kind of consolidation today, par for the course.
Indeed, we've had 6 good days on the trot. Today, we, at least on the frontline indices, flat, which is not bad.
Yeah.
Mid-cap, small caps, though, corrected a tad bit.
Well, that's right. Just run you through the basic highlights with regard to today's trade. Well, the Nifty, it paused for breath, but the mid-cap index, that came in for profit-taking. Remember, it's had a heady run in the last few trading sessions. The Nifty, though, by the time we wound up, though the final tick was at the lows of the day, it managed to maintain its winning streak. And that's why the Nifty, because it averages the last half hour odd, it ended with a gain of closer around 10 points odd. The mid-cap screen, though, comes up for you. And the index itself was down closer around 1%. What did well in trade today? The IT index. Year to date, that index is still down closer around 13 to 14%. But now you have various brokerages that are getting positive. So you had yesterday CLSA that was talking about maybe IT doing decently well from year on. UBS as well did speak about that, and that's why that index did well. And with today's move, what it did was that it ended above the 20 DMA, which is the near-term technical level. The cement stocks as well, they did pretty well because it was fired up by another UBS note coming in. They were negative on the cement stocks for the last 2 years or so, but they've turned around their stance, and that's why a couple of those stocks did well.
Indeed, and so many others, individual stocks were in focus today. We'll discuss them. Here's what we've lined up for you on our show today. The top movers and shakers of the day with Vivek. Cement and IT stock surge following UBS's bullish note. And about over 24 suitors have joined the race to acquire JP Associates. Meanwhile, Star Health was under pressure. We'll also talk about the key market events to watch tomorrow in the trading session. But first up, it's over to Vivek. He's at the big wall with the top stock movers of the day. Vivek.
Well, thank you so much for that. So after 6 straight sessions of gains, a bit of cooling off seen, especially as far as the broader end of the market was concerned, breadth over there quite muted. But the whole host of stocks made the moves. First, like you've been mentioning since the start of the show, the cement pack did very well. Ultratech Cement is the name that we're talking about. The top gainer, as far as the Nifty was concerned, over 3% higher for Ultratech Cement. The other stock on the radar was HEG. HEG and Graphite, both of these stocks did very well in the session. HEG ended over 11% higher, top gainer as far as the NSE 500 index was concerned. IT stocks, the entire pack did very well today. Most of the IT stocks ended with a gain. In fact, names, some of the mid-cap IT names ended over 2% higher, persistent among the top gainers over 2.5% higher. Piramal Pharma, that was the other stock, from the broader end of the market, and one of the select pharma stocks that actually did quite well. Kotak Institutional Equities initiated coverage on the stock. They had a buy rating over 3.5% higher up move for Piramal Pharma. And Kalpatarupa, to round off the list of gainers, that particular stock saw order wins of over 2,300 crores. The stock ended higher by over 4%. But quite a few laggards as well. IndusInd Bank, after a brief respite rally that the stock saw today, ended lower by over 5%. Key to watch out for will be Friday, where external auditor PwC will be going ahead and submitting a report or tabling a report as far as IndusInd Bank is concerned. Star Health, we did an exclusive news break. There are some concerns regarding IRDAI, where they're going to go ahead and they've noticed a few lapses as far as the company's processes are concerned, over 3% lower. Pharma stock, apart from the few CDMO stocks that did well, the entire pharma pack today was weak in trade. Tariff overhang over there, so Dr. Reddy's Lupin, all of the generic stocks under significant pressure. And lastly, Dixon Technologies, that particular stock, top laggard as far as NSE 500 was concerned, over 6.5% lower for Dixon Tech today.
Thank you very much for that. Let's go across now to our guests, Jay Bala of CashTheChaos.com and Sudeep Bandopadhyay, Group Chairman in Trade Capital. They're with us on the show. Jay, first up, would you have any individual stock trading ideas for tomorrow's trading session?
Yeah, I have two stocks today, Rima. One is Blue Dart. Blue Dart is pushing past, or rather punching past a trend line strongly with volumes. And it's bullish as long as the stock stays above 5,700. I expect further up move for the stock from here on. And the second stock is Persistent. It has been an outperformer even during this recent decline. It topped out only in December, whereas the rest of the markets topped out in September. And the recent low of 5,000 is slightly above a structure which points to a possibility of further record highs. So as long as the stock can hold about 5,000, I think there is possibility of somewhere between a push towards fresh all-time high, or maybe just past the all-time highs.
Okay, all right. Well, got that, Jay. Stay with us. And Sudeep, I wanted your view on the cement companies because they were in focus today. UBS has upgraded the cement sector. They believe that the rough patch is now coming to an end, and so they've gone ahead and upgraded select counters. Remember, UBS had a negative view on the sector all the way since July 2023 due to rising competition, demand slowdown because of the general elections, and also rising price competition that, that was hampered because a new player came in. That is a big boy, Adani, entered the cement space. But now UBS, they have turned around. They are positive. They anticipate that earnings recovery will emerge from FY26 onwards. They are working with strong EBITDA growth for the next 2 fiscals. Their positive stance is backed by a few factors. On demand, they expect revival to be driven by housing upcycle and the revival in government capex. On margins, they are looking at the structural cost savings, which will drive margins higher. And they're also saying on pricing, there's likely to be a bottom in place on prices after the sharp fall that we've seen in the first 9 months of this fiscal. The reasons for upgraded various stocks should come up for you on the screen, and the chart will tell you the picture. On Ultratech, they say that the company has shown strong execution in tough times, which has been led by industry-leading growth, both in volumes as well as on margins. Their top pick, though, is Ambuja because of the higher growth and the relatively lower valuations. While on Dalmia, they have done a U-turn. From a sell, now they have a buy call. While on ACC, they maintain their buy call. They say that the valuations are supportive and there are industry tailwinds as well. Put all this together, well, UBS quite impressed with the cement names. Sudeep, your view on these stocks?
Well, Nigel, I've been positive on cement for last 1.5 months. I think, when the Q3 numbers came, Ultratech was a pleasant surprise. In spite of the demand challenges, I think the performance and the margin improvement was commendable. They did a lot of cost engineering, which helped them improve the margins. And I think that was showing the trend of the way forward. Of course, demand was expected to pick up, and I believe demand is picking up. Also, with the amount of government capex and private capex coming on stream, the demand for cement is going to remain strong. So when the demand was weak, even then Ultratech outperformed the market. And I think a lot of other cement companies also had a lot of cost cutting done and efficiencies built in. So now with demand coming back, I think good time is back for the cement industry, and it's going to last for some time because the new capacity which is going to come up is going to take some time. So the demand supply position is going to remain favorable for the cement industry for the foreseeable future. Under the circumstances, with the strong demand, they will have pricing power as well. So yes, cement, but I like Ultratech more than any other company, being the leader, and the way they have gone about consolidating and increasing the capacity as well, both through brownfield as well as greenfield expansion.
Okay, betting on Ultratech Cement. IT had a good day. The Nifty IT index ending with a gain of about 1.3%, and in the last 2 trading sessions, it's added close to about 2.8%. Today, UBS said there is more upside than downside because stocks have corrected. IT stocks are down 15 to 20% so far this year. The valuation multiples have contracted by 12 to 20%, and while there will be earnings downgrades, their view is that stocks have corrected more than the potential earnings downgrade. So they're saying the discussions with IT management teams suggest that while the uncertainty has increased, there is only a marginal impact on client spending. On the whole, FY26 will still be better than FY25, and therefore there is a case for valuation multiples to rebound. According to UBS, we could see a 5 to 10% rebound for the sector in the near term. And again, reiterating that FY26 for the sector is likely to be better than FY25, even though expectations have now moderated. Valuations on the whole are lower than the 5-year trading multiple, 5-year averages, whether it's for TCS, whether it's for Infi, and therefore UBS likes the large cap IT names, all except Tech Mahindra. So they've got a buy on Infi, TCS, HCL Tech and Wipro. Tech Mahindra, on the other hand, is a sell. Jay, today the Nifty IT index closed above its 20-day moving average, but it's still about 13% down on a year-to-date basis. What's the Nifty IT index telling you and individual stocks? Is there a trade?
Yeah, I had mentioned this last time too. Nifty IT index has gone below a trend line that you draw from the 1996 low, the pre-dot-com boom times, and that passes through the COVID lows and the post-election low of June 4th. So that is not a good sign for an IT index. If the IT index were to recover, it needs to do a lot of reparation, and that's quite a bit of sizable work to be done. And I've been bullish on Persistent since October 2022, and I thought it had topped out in December 2024. But the market is saying that it's possibly got one more higher highs to come through. So, and being the outperformer, I'm positive on Persistent at the moment. I'll see how this starts to unravel. If that were to be the case, we can see incrementally turn bullish. But I think it's Persistent is likely to be an outlier rather than call it start of a trend.
Okay, got it. All right, Jaya. Well, Sudeep, coming across to you for some of the mining, the ferrous news that we got today. Let's focus on JSW Steel first. It became the most valued steel company in the world with the market capitalization of a whopping 2.5 lakh crore rupees. So that was the big news that came in today. And also in comparison to its peer group as well, JSW Steel is much higher in comparison to Tata Steel and the likes. Well, separately, graphite companies, HEG and Graphite India, they were on fire today. And there could be two probable reasons for both the stocks doing well. First up, Japan has imposed tariffs on China's graphite electrode imports effective from this Saturday itself. Now, the Japanese market is approximately 60,000 tons, of which 25% or 15,000 tons comes in from China. So the street believes that the Indian graphite electrode companies, they could fill in this gap. That's with regard to that 15,000 tons that currently comes in from China. Secondly, there's a price hike expected from April 1st. As Chinese producers, they have gone ahead and they've increased prices on HP grade or high power grade. And this means that domestic players can also go ahead and increase prices by approximately 7% or thereabouts. This will impact close to around 25% of their mix, because 25% of their mix is towards HP grade. That's the high power grade. Sudeep, your view on the steel companies, they wanted to get some kind of safeguard duty. That's happened. And these graphite electrode players can be very, very tricky. They go up in one direction, but when they come down as well, sometimes they come down via the elevator. Your view on them?
Oh, you're absolutely right. They do come down by the elevator. But I think, a lot of good things are happening. You are absolutely right. The Japanese market opportunity is opening up for the Indian graphite companies. Also, I think, you have to remember that domestic demand also is increasing with incremental steel production and the demand for steel going up in domestic markets. I think the domestic producers also will require more support from graphite electrode companies. And of course, the price increasing opportunity will also help them. So I think on the balance at this stage, I think they do look good. Of course, if at a later stage the valuation reaches a level which is unsustainable, one has to become careful. But at this stage, I think it's absolutely fine. Overall, on the cement, steel also, we are positive. Domestic demand is strong. And I think export demand at some point of time may become strong because Europe is getting into rearmament and steel demand in Europe is going to significantly go up. Now, whether Indian manufacturers will be able to benefit out of that or not is to be seen. But of course, Tata Steel, it's a big opportunity because Tata Steel Europe was a loss-making unit. Now, definitely they will break even and start making money.
Let's get to the other story. Over 24 suitors, including the likes of Adani Group, JSW Group and Vedanta, have joined the race to acquire JP Associates. Ritu's here with the details. Ritu, what have you learned from your sources?
Well, yes, Reema, more than 24 suitors, including some of the biggest conglomerates in the country, they are lining up to acquire Jayaprakash Associates under the bankruptcy law. Names that you said, Adani Group, JSW, Oberoi Realty, Vedanta Group, Welspun, these are just some among the 25 potential bidders that are expected to submit expressions of interest today. As we've been reporting, the deadline for EOI submission, which has already now been extended twice, closes today, and bankers are expecting a few last-minute entries as well. Keep in mind, the NCLT has ruled out bids for individual business clusters, meaning suitors will now have to bid for the entire company, including its real estate interests, cement, hospitality, engineering, and so on. And there's plenty there for suitors to really be lured into. There's also huge debt at stake, about 57,000 crores of debt under IBC. We had reported, though, that banks have already transferred their stress loan to the National Asset Reconstruction Company and received about 15% of the consideration, which is 1,800 crores in cash, which will reflect in the current quarter. Now, that said, keep in mind, this is still the EOI stage. The real test will come when final bids are invited, and then we'll see how many of these 24 odd suitors put serious offers on the table.
Okay, all right. Thanks a lot for that, Ritu. Well, let's focus on another stock. We have Star Health Insurance that hit an all-time low after the insurance regulator found serious lapses in claim settlement practices. Yash is on top of that. He joins us with exclusive details. Yash, take it away.
Well, Nigel, what we've been given to understand from our sources is that very recently, just about a month ago, the insurance regulator concluded its inspection on a few general as well as health insurance companies with respect to the claim settlement practices. Star Health happens to be one of those few companies where the inspection was conducted by the insurance regulator. Now, what is, further to that we've been given to understand from our sources is that the regulator, in its preliminary investigation after that inspection, has found some serious lapses when it comes to the claim settlement practices at Star Health Insurance. When I asked them more in terms of what are the areas of these, specific lapses, what I was given to understand is that this starts from, claims being repudiated or rejected by Star Health Insurance, or, what is the total amount which has been given in terms of claims against what was asked for, to the deductions that Star Health has put, to the time taken by Star Health. When it comes to settling these claims, all these issues have come together where lapses have been found by the insurance regulator in its preliminary investigation. Now, what we've been given to understand is that once the investigation against the company and in these matters, and there could be an action by the insurance regulator against Star Health Insurance, keeping in mind all these lapses. We've also written to Star Health Insurance on this particular query, and a response from the company is still awaited in terms of what their stand is.
Okay, all right. Thanks a lot for that. Well, Jay, quick word from you. How's it looking on the charts? Star Health, the stock has absolutely collapsed. Where's it headed?
Yeah, I think it's trying to bottom out here, Nigel, but it's too early, very extreme, and it'll be catching a falling knife. But there are mild positive developments, but we are better off looking at SBI Life or ICICI Lombard. But it's for a stock to stop, and turn around, it must first stop falling, and then it should register a reversal. It has potential. It's high, and we don't know completely in the dark whether the stock is likely to reverse or not. But there are some very, very mild positives, but it's too early to put any money into the stock.
Right, Sudeep, you quick view on it. Time to buy or don't touch it?
Not really. I think it's better to avoid at this stage. No point trying to catch a falling knife. We need to understand the seriousness of the allegations and what really happens going forward. There are better insurance plays to buy at this stage, so this is avoidable.
All right, don't catch a falling knife. That's the consensus view. Thanks a lot, gentlemen, for joining in and filling us in with your views on the market and a whole host of stocks. For the time being, we slip into a short break. You come back, we'll get you all the top corporate voices along with key events you need to track. Stay with us. Welcome back. You're tuned into Markets Forward. Well, as promised, let's get you all the key corporate voices that joined us during the course of the day. The Greenply management said that there have been some liquidity concerns across the building product space. However, they added that the plywood margins were expected to move into double digits as timber prices have cooled off. Meanwhile, they expect the advertising spends to remain high as the company targets double-digit growth in the next fiscal year.
Next up, Electronics Mart India is targeting a mid to single-digit same-store sales growth for the next year. The management said growth in Q4 was subdued, with the apparel industry experiencing nearly zero growth. It added that the electronics industry also saw muted growth, but food and grocery remained steady, posting mid to mid-single-digit kind of a revenue growth.
Finally, Titagarh Rail Systems, the top boss said that the company's wagon execution improved in Q4 compared to the previous quarter. The company expects production targets to be in the vicinity of around 11 to 12,000 range for FY26. The management also highlighted that in FY26, the firm would focus on execution of the passenger coach business. Okay, before we wrap up, then, as always, let's get you all the key market events you need to track for tomorrow's session. Upasana standing by to tell us exactly that. Upasana, take it away.
Well, let's just look at the key important events that we'll be closely tracking for tomorrow. First up, let me start with the global economic cues. UK will be reporting its CPI data for the month of Feb and also will release its spring forecast statement. Europe, ECB non-monetary policy meeting is scheduled to be held tomorrow, and US will be reporting its crude oil inventory data. Now let us look at the key stocks that will be in focus tomorrow on the back of corporate action. Stocks like TVS Motors and REC Limited will go ex-dividend tomorrow, hence they will be in focus. And mind you, board meeting for REC is scheduled tomorrow to consider a proposal for approval of market borrowing program for FY25, FY26. Now, stocks like Ashok Leyland and PI Industries will also be in focus as these companies will be holding investor and analyst meet tomorrow. And lastly, it is important to note that Punjab budget is to be tabled tomorrow on 26th of March. Hence, we'll keep an eye out on that one as well.
Well, thank you very much for that. And that brings us to a close in this edition of Markets Forward. Thank you for watching. We'll be back with more news and updates.
Doing it to help our country, and our country was riddled with fat, like no country probably anywhere in the world, and we're getting rid of the fat. And at the same time, we're going to be bringing in millions of very good, high-paying jobs, and we're going to be taking in a lot of money. Our country's going to be very strong. We've been ripped off by every country in the world, friend and foe, and we'll be announcing cars very shortly. And we already announced steel, as you know, and aluminum. We'll be announcing pharmaceuticals at some point in the not too distant, because we have to have pharmaceuticals. We don't make pharmaceuticals anymore in our country. And if we have problems like wars or anything else, we need steel, we need pharmaceuticals, we need aluminum, we need a lot of these things that we sort of don't make anymore, and yet we're equipped to do it all. So we'll be announcing some of these things in the very near future, not the long future, the very near future. And
so exciting is April 2nd is just around the corner, and that's American Liberation Day. That's the day when the rest of the world starts to treat America with respect. And your leadership, understanding how the rest of the world treats us and what balance and what fair trade finally is going to be, is going to take care of America. It's going to launch the External Revenue Service to start to build the power and prestige of America back.
So we're going to take in a lot of money from the outside, and that's going to keep our taxes low, and I think getting a lot lower. It's going to be a lot of money, and the external will take care of the internal to a large extent. So I think it's going to be a beautiful transformation.
Hello and welcome to Business 360. I'm Shireen Bhan, and the top stories that we're tracking for you this evening. The Nifty ends in the green for the 7th straight session, but the gains are limited as the markets give up their high points of the day. US President Donald Trump threatens more tariffs, and this time puts the spotlight on Venezuela, but Trump extends the timeline till the end of May. A US trade delegation is in Delhi just a week before Trump's proposed reciprocal tariffs on countries like India. Washington wants greater market access for certain industrial goods, autos, wine and agriculture. Reuters reports that India is open to cutting tariffs on 55% of US imports. Lok Sabha passes the finance bill. Finance Minister Nirmala Sitharaman highlights measures taken to rationalize the tariff regime, also defends the changes to the income tax law, which allows tax officers access to email and social media data. Donald Trump's White House mistakenly shares its war plans in Yemen with a journalist from The Atlantic magazine. The plans were disclosed in a messaging group where the journalist was added accidentally in what is a serious security breach. The death toll in Gaza crosses 50,000 as Israel continues to bomb for the 8th day. Over 20 people killed in overnight air raids. Israel issues fresh evacuation orders for northern Gaza. It's the last day to bid for bankrupt JP Associates. Sources say over 24 suitors, including Adani, JSW, Oberoi Realty, Welspun, are likely to fight for assets spanning across real estate, cement, hospitality, and others. Consumer spending remains muted in Q4. Retailers Association says apparel and electronics are seeing very low sales growth. Electronics Mart of India says same-store sales growth is around 5%. JSW Steel overtakes ArcelorMittal as the most valuable steel company in the world. Market cap touches 2.5 lakh crore rupees as the stock gains 18% so far in 2025. Chief Minister Rekha Gupta presents a Delhi budget with an outlay of 1 lakh crore rupees, allocates 5,100 crore rupees for monthly cash allowance to women and 50,000 CCTV cameras across Delhi for women's safety. Also promises free laptops to around 1,200 10 standard pass outs. The Allahabad High Court Bar Association begins an indefinite strike after the proposed transfer of Justice Yashwant Verma from the Delhi High Court. This after the police allegedly discovered a large stash of cash at his official residence after a fire. Justice Verma strongly denounced the allegations, hinting at a conspiracy. Mumbai police summons comedian Kunal Kamra for taking a jibe at Maharashtra's Deputy Chief Minister Eknath Shinde. Kamra stands by his comments as he does not fear the mob. Shinde calls for limits to freedom of speech. Well, we'll come to all of that in just a bit, but first up to the market action of the day. And the markets continued to gain ground today for the 7th straight session, but they did give up some of those gains coming off their intraday highs. The gains were limited at close. The Nifty held on to levels of above 23,650 and the Sensex above 78,000. Mid-cap saw a sell-off with the index losing over 550 points. The big story this evening, a fresh tariff concern for India with just 1 week to go for US President Donald Trump's deadline to impose reciprocal tariffs. President Trump has signed a new executive order to impose 25% tariffs on countries who buy oil from Venezuela from the 2nd of April. Trump has described the move as a secondary tariff aimed at punishing the country for allegedly sending thousands of high-level criminals into the US on purpose. The additional tariff will come into effect from the 2nd of April. China and India amongst the largest importers of oil from Venezuela. India was the top buyer of Venezuelan crude oil in January of 2024, importing nearly half of the country's total exports. Sudarshan is standing by with more. Sud, how could this impact India?
Oil and gas stocks were low in today's trade on the back of the announcement made by US President Donald Trump, who announced that there would be a tariff of 25% on the countries that decide to import crude oil from Venezuela, and that would be effective April 2. Now, which all Indian companies be impacted from this? First up is ONGC. ONGC has one subsidiary with the name of ONGC Videsh, which has 2 production units in Venezuela that produces crude oil. Second is ONGC was expecting to get its dues of $500 million from Venezuela in the form of additional crude, and that is also likely to be impacted. Second, the companies which are going to be impacted are oil marketing companies IOC, BPCL and HPCL. In 2024, OMCs, or say India, imported 22 million barrels of crude oil from Venezuela, which formed 1.5% of total purchases that the country has made in 2024. So it's very minor if you consider the total purchase of crude oil that India has done, but nevertheless, it's an impact. Now the important part is last month, that is in February 2025, Oil Minister had commented that India is looking to increase the crude oil imports from Venezuela, considering that Russian discount had narrowed after US sanctions, and that is unlikely to happen in near future with the US sanctions or say US tariff coming in. So companies which are going to be impacted are ONGC, IOC, BPCL and HPCL.
So many thanks for joining us. US officials, including the Assistant US Trade Representative in India, to take forward negotiations and talks around the trade deal between India and the US. This is, of course, a 4-day visit, and the ongoing tariff battle will be one of the key issues on the agenda. Abhimanyu standing by. Abhimanyu, reports suggest that India has agreed to tariff cuts across almost 55% of what the trade is with the US. Take us through the details, if any.
An American delegation is visiting New Delhi for trade talks between both the countries. This is not the first round of negotiations. What government sources have indicated so far is that India and the US are going to finalize the contours, the negotiation schedule and the terms of reference of the proposed bilateral trade agreement between both the countries, which is likely to be finalized in 2 tranches. The first phase of the BTA is expected to focus on issues pertaining to goods trade. What we have learned from sources so far is that the US has sought greater market access in certain industrial goods, automobiles, wines and agriculture, and India may seek duty cuts in labor-intensive sectors like textiles. Now, both the sides are trying to find a common ground based on each other's strengths, weaknesses and sensitivities to create synergy for two-way trade and investments, as well as for predictability in tariffs, regulations and economic integration. More clarity is expected by the end of this week. It remains to be seen how the talks are going to pan out, based on which the negotiation schedule is going to be made.
Abhimanyu, many thanks for joining us. The Lok Sabha has passed the finance bill. Speaking in Parliament, Finance Minister Nirmala Sitharaman highlighted measures taken to rationalize the tariffs regime. She also defended the changes to the income tax law, which allow tax officers access to email and social media data, essentially saying that this is a clarification and nothing new.
The WhatsApp group of key persons include many professionals also, unfortunately. So we had to contemplate on how to be lawfully on the side of law to say that these are evidences which are incriminating in themselves. Therefore, it has been brought in. I can also give one more, which is evidences have been found with the help of Google Map History. So in the case of Google Map History, sir, found on the phone was used to determine the frequented locations of individuals who enabled location history. This enabled detection of hideouts where cash and unaccounted transactions are kept, and that also came of help. So there is a need for us to change or add the digital elements into the Act itself.
Well, the race to acquire JP Associates heating up, so they've told CNBC-TV18 that over 20 suitors led by the Adani Group, JSW, Vedanta are likely to join the bidding process. We've also learned that more suitors are likely to come forward and submit their expression of interest by the end of the day. Ritu joins us now with more. Ritu, long line of potential suitors there.
That's right, over 24 suitors, including some of the country's biggest conglomerates, are lining up to acquire Jayaprakash Associates under the bankruptcy law. We understand names like Adani Group, JSW Group, Vedanta Group, Oberoi Realty and Wellspun are just some of the nearly 25 potential bidders that are expected to submit expressions of interest today. Now, we've been reporting the deadline for EOI submission, which has already been extended twice, closes finally later today, and banks do anticipate a few last-minute entries as well. Keep in mind, however, that NCLT has ruled out bids for individual business clusters, meaning suitors must now bid for the entire company, including its interests in real estate, cement, hospitality, engineering, construction, and so on. And the company does have some prized real estate and cement holdings that is sure to attract the suitors. There is also huge debt at stake. Jayaprakash Associates is facing claims of more than 57,000 crores under the IBC. Now, we had earlier reported that the SBI-led consortium of lenders had sold their stressed exposure to the National Asset Reconstruction Company and already received about 1,800 crores in cash recovery, which will reflect in the current quarter. Now, that said, this is just the EOI stage. The real test comes next when final bids are invited, and we'll see how many of these 20 or 24 plus suitors put serious offers on the table.
Ritu, many thanks for joining us. The government is likely to go slow on selling minority stakes in public sector undertakings. Sapna Das is standing by with more details. Sapna, what are you hearing?
Well, we have been clearly given to understand that probably government will like to go slow as far its offer for sales program is concerned in terms of the minority stake sales in CPSEs. We are given to understand that probably a month or 2 months deferment is on the cards or has already been worked out, given the state of the markets, the market volatility. So this is a time period that probably the government would like to play safe and avoid, bringing out OFSs, no matter even if they are small in size, like 2% or 3 odd %. It's something that the government will like to strike a cautious note on that. So that's one. Second, of course, this entire financial year, the focus has been on CPSE dividends. It was the case last year also, but more or less, or rather heightened interest in the current financial year. So given to understand that by March 31, around 1.40 lakh crore worth of dividends by CPSEs is likely to be given to all the investors across the board. Of course, the government share as of now from the CPSE dividend stands around close to 70,000 crores. So that's a healthy number that we're looking at. So any kind of a divestment shortfall, of course, will be made up through this. But as far as the OFS program is concerned of the government, most likely April, May, next financial year, we'll have some clarity. But a month or 2 months deferment probably has already been worked out.
Sapna, many thanks. Now, demand for consumer spending has been muted in the fourth quarter. Retailers Association says that whether it's electronics or apparel, they've seen very low growth. In fact, Electronic Mart of India has said pretty much the same thing. Let's listen in.
See, after witnessing a little bit of disappointing third quarter, so this fourth quarter is quite promising, and we did see decent demand for the consumer durables in the fourth quarter of this year. See, for the next year, at the company level, we are expecting mid-single digit SSG.
Well, I think overall, when I take into account all the categories, what we have seen is a very subdued growth in Q4. Some categories, obviously, like food and grocery, has remained steady, mid-single digits in terms of growth. The apparel industry is close to zero in terms of growth.
Well, concerns there over consumer demand. Rekha Gupta, Delhi's Chief Minister, presents her maiden budget with an outlay of 1 lakh crore rupees. That and more coming up on Business 360.
Today, we're delighted to report that Hyundai is announcing a major $5.8 billion investment in American manufacturing. In particular, Hyundai will be building a brand new steel plant in Louisiana, which will produce more than 2.7 million metric tons of steel a year, creating more than 1,400 jobs.
My understanding is that India imports close to about 0.2 to 0.25 million barrels a day of oil from Venezuela. When you consider that India's total imports are in the range of around 4.5 million barrels of oil per day, obviously it is a relatively small percentage compared to the percentage from, let's say, Middle East or even Russia, for that matter. But the fact is that if the condition for avoiding this additional 25% tariff is that this oil will have to be replaced, then that's an additional sourcing that you will have to find from somewhere. From a supply security perspective, I guess because it's less than 5% or less than 4% of our overall crude slate, it's something that I think India can figure out how to basically manage this hit, from what we can tell.
If you're booking an Ola, Uber or Rapido in Hyderabad, it could be a sweltering ride. Cab drivers have launched a no AC campaign, refusing to turn on air conditioning to highlight their financial struggles. For many drivers at ride-hailing platforms, driving a cab is no longer financially viable. After operational costs and platform commissions, they're often left with earnings that barely cover their daily expenses, forcing
Delhi's Chief Minister Rekha Gupta has presented the Delhi budget with an outlay of 1 lakh crore rupees, 5,100 crores. Of course, the state government has allotted 5,100 crore rupees for monthly cash allowance to women and 50,000 CCTV cameras across Delhi for women's safety. Timsi Jaipuria is standing by with the details.
Delhi Chief Minister Rekha Gupta, who also holds the finance portfolio, proposed an outlay of 1 lakh crore rupees, which is a 31% higher allocation compared to Aam Aadmi Party government's full-term budget, which was presented in March last year. Now, here's a quick look at the top 10 highlights of the Delhi's budget. The government has allocated 2,144 crore rupees under the Ayushman Bharat Pradhan Mantri Jan Arogya Yojana. The scheme provides a 5 lakh rupee top-up from the Delhi government in addition to the centre's 5 lakh rupee health insurance coverage. 5,100 crore rupees has been allocated for the Mahila Samriddhi scheme, which would provide a monthly allowance of 2,500 rupees to eligible women. The budget has also set aside 300 crore rupees for measures towards curbing air pollution, but there is no concrete plan or details in the budget. The Delhi government has also allocated 6,897 crore rupees for MCD. Chief Minister Rekha Gupta said that the majority of these funds will be used towards redeveloping roads and sewage system across the capital. Over 3,800 crore rupees has been allocated for flyovers and infrastructure. Chief Minister Rekha Gupta has also announced a common free bus pass to commute across the national capital for women. The pink passes, which were introduced by the erstwhile Aam Aadmi Party government, will now be discontinued. When it comes to Yamuna cleaning, the BJP government has allocated 500 crore rupees, proposing that only treated water enters the river Yamuna through the decentralization of 40 sewage treatment plants. An additional 500 crore rupees has also been earmarked for the repair and upgradation of the sewage treatment plants. Apart from this, the government has allocated 9,000 crore rupees for schemes related to clean drinking water and sanitation. The Chief Minister has also allocated 750 crore rupees for providing free laptops to select group of students who pass the 10th standard exams. The initial beneficiary list may cover around 1,200 students. So that's all to encapsulate the top highlights.
Timsy, many thanks for joining us. Artificial intelligence and quantum computing are the buzzwords driving conversations and global innovation today. But India has a long distance to go when it comes to research. Shivani Bajaj tells you why.
AI is already reshaping our polity, our economy, our security, and even our society. AI is writing the code for humanity.
India has big ambitions for its role in the global artificial intelligence race and in building applications to accelerate the use cases for AI. When it comes to AI research, the numbers tell the story. Budget 2025-26 allocated 500 crore rupees for the Center of Excellence in AI for Education, aiming to enhance skills, personalize learning, and transform the educational landscape. Additionally, the government proposed a deep tech fund of funds of 20,000 crore rupees, approximately $2.3 billion, to spearhead the next generation of startups and translate ideas into tangible outcomes. But there is still a gaping gap in this area. Data shows that as of 2022, China accounted for 61.3% of all AI patents awarded globally. USA accounted for 20.9% and India a mere 0.23%. Ashoka University is looking to address this gap in AI research.
Ashoka is that students come in the first year not committing to any particular subject. They learn a very large range of subjects in the first year, which go from literature, history, economics, psychology, and the sciences, and then commit to an education in computer science and data sciences. The school will ensure that the students, after having learnt the general context of the various different areas in which computer science and data sciences can be applied, then learn the basics of the subject to find out how AI and related data, related activities can be applied to all these diverse areas.
Its new School of Advanced Computing aims to fill a crucial gap in India's AI research by integrating computing with social sciences, healthcare, and ethics. Over the next 5 years, Ashoka University plans to raise 250 crore rupees to support the expansion of the school, pioneering research and attracting top-tier faculty, students, and researchers from across the world. Experts say that while such initiatives are needed, there is a greater need for sustained and substantial funding to help India compete on a global stage.
I think we certainly need financial resources. You mentioned the 250 crore number, but it's really a drop in the ocean. Yeah. You can't do much with that kind of money, with the kind of work that is going on around the world. Yeah. Individual companies, small companies are spending a lot more money. I think the challenge for us is really as a country, even as a university and as entities in India, is how do you do more with less? How do you pick your battles? Where do we focus on so that even with our meager resources we can have disproportionate impact? And I think that's true for Ashoka. I think that's true for our country. The other challenge is that if we don't do it, we'll be saddled with solutions that come from other parts of the world. So our diseases are going to be diagnosed by AI that has learned on the Western patients. And so it will by definition be flawed.
They say that the road ahead requires stronger public-private partnerships and a sharper focus on India-specific AI applications, from local language processing to healthcare models tailored for Indian conditions. India's efforts in building AI infrastructure, AI chip procurement, and computing capacity will not be enough unless it works on bolstering three crucial elements: large volumes of proprietary data, homegrown and properly upskilled talent, and R&D across the facets of the AI stack. In New Delhi, Shivani Bajaj.
Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned.
Like turning off the AC. And so the Telangana Gig and Platform Workers Union has launched this No AC campaign. What are their concerns? Fuel prices are high and running AC means burning more fuel, making trips less profitable. Second is low earnings. Drivers say Ola and Uber take 30 to 40% of the fare, leaving them with just 10 to 12 rupees per kilometer. But operating costs with the AC turned on rise to 16 to 18 rupees per kilometer. Essentially, the driver is left with very little in hand. And so drivers are demanding higher base fares to cover rising costs, lower platform commissions and government regulations to ensure fair pay. The union is also pushing for a Telangana gig workers' rights bill, and if their concerns aren't addressed, they plan to escalate the protests nationwide. While Hyderabad's campaign is making headlines, this isn't new. It has been happening in Hyderabad and even Bengaluru. Drivers in Bengaluru have unofficially stopped using ACs for more than a year. In 2024, drivers even demanded 5 rupees per kilometer extra for AC rides, but this wasn't officially implemented by ride-hailing apps. Most drivers just simply refuse to switch on the AC unless riders insist, and even then, some decline. Now, as the mercury rises, so have passenger complaints. This begs the bigger debate, which is who pays for the AC. Passengers expect an AC cab, especially in the scorching summer heat. Drivers say they can't afford it unless fares increase. Ola, Uber, Rapido haven't provided a clear solution. No pricing model for AC usage, no opt-in feature either. So should drivers absorb the cost or should riders pay extra? Let us know what you think in the comments below. There doesn't seem to be an easy resolution to this tug-of-war. Perhaps us riders should consider investing in one of those handheld fans for now.
Hello and welcome. You're watching Commodity Champions and I'm Anisha Gupta. Well, the Trump trade and tariffs. These are three words that have made commodity prices highly volatile in the recent months. Gold prices have hit all-time highs 6 times this year so far as concerns over the tariffs boosted its safe haven appeal. Copper prices are near record highs at a time when Trump is weighing tariffs on the metal's imports. Crude prices are trading at a 3-week highs after Trump threatened 25% tariffs on countries buying oil from Venezuela. Come April 2nd, Trump is set to announce sweeping reciprocal tariffs on all trading partners of U.S. Remember, the U.S. already has imposed 25% tariffs on aluminum and steel imports from 12th of March. And this has led to countermeasures from Canada, Europe Union and China. While next week would be an eventful one, let's discuss what's in store for commodities during the rest of this year. Joining me now is Max Layton. He's Global Head of Commodities at Citi. Max, hi, thank you so much for being with us. I want to start with gold, and we've seen a string of all-time highs followed by some profit-taking right now. Where are the prices headed for the rest of this year, according to you?
Thanks, Manisha. Manisha, thanks for having me on the show. We think gold price is going to keep going up. Bottom line is we're in the underlying drivers, the physical and we would say fundamental drivers of this gold bull market remain in place and will continue to drive gold all the way up in our base case to $3,200 an ounce over the next couple of months, and then potentially up as high as $3,500 an ounce if we're in in more of a concerning U.S. growth environment than what we have in our base case.
Max, also, where do you see all of this buying coming in from? I mean, we do understand that the central banks are buying and ETF buying has also been quite strong. The kind of gold that we've seen being shipped from UK to US is yet another story. But to take the prices from where they are to 3,200 and 3,500, where is this new buying going to come from?
Yeah, I think you've named all the core recent drivers. We think a lot of them remain in play. In particular, President Trump and his team, they've mentioned some pretty high headline tariff figures on April 2, on Liberation Day, as President Trump's calling it. And these kinds of tariffs, if delivered, even if half of them are delivered, are going to be concerning from a global growth perspective, but also from a US growth perspective over the next 3 to 6 months. So that would kind of cement, in our view, a continuation of what we've seen over the last couple of years, which is a very gradual slowing in US economic growth. Around that, in the past, we've tended to see savings rates rise, ETF demand rise alongside that, with the driver of both being precautionary savings from households. And we think this is kind of going to take you that next leg higher over the next quarter or two.
Max, also, what is your sense on the silver prices? Because the prices have had strong fundamentals, the industrial demand deficit, but we haven't seen $34 an ounce break on the higher side. How are you looking at fundamentals and the price move from here?
Yeah, I think stepping back, this silver price is fantastically high versus mining costs relative to, even if you take a 50-year silver chart, this is a pretty high price by historical standards. So, silver's done well. It's doing well. It's up. It was trading in the low 20s a bit over a year ago. So, the price is doing extremely well. It perhaps has, disappointed some of the kind of, stronger bulls. It hasn't exactly significantly outperformed gold. So it hasn't been the leveraged kind of play to gold that a lot of people were looking for. And really that all comes down to the soft global growth environment. So, we think silver, it's got a lot of exposure to a bigger than expected China easing, for example, or and it continues to kind of probably give you roughly the same, maybe less return than gold over the next couple of months. I think the thing that's stopping us getting super excited about silver, and we are modestly bullish from these price levels over the next 3 to 6 months, getting up to $34, $35. The thing that's stopping us is this tariff threat from President Trump. So less tariffs than expected, together with some China easing, and silver can come in more in line with our bull case scenario towards the $40 mark.
How are you also looking at the US dollar index? Because it's come down from 110 plus kind of levels when we started this year to almost 103. Would you look at the currency in the light of fundamentals that you talked about in the US, and what would that mean for the dollar index?
Yeah, I mean, currency's, notoriously difficult. There's a lot of different moving parts, especially with the dollar, and I kind of defer to our currency team on that one. I don't think they have a particularly kind of, super bullish or super bearish stance from these levels. it's very difficult to have a high amount of conviction considering the range of tariff outcomes. I would say that's going to come down upon the global economy, potentially as soon as in less than 2 weeks. Overall, I would say that it's extremely rare historically that you have a very even though the dollar's come down, it's still relatively strong. It's extremely rare you have a strong dollar, a relatively strong dollar. It's extremely rare you also have high interest rates at the same time as gold is printing all-time highs. This combination is highly unusual, and it's resulting in an extremely large contango across the gold curve. So we're highlighting to our clients, for example, that in 5 years forward, gold is already trading at 3,600 plus per ounce, which is essentially a gift for the gold producers. And it's a gift that is not given in other commodity markets to other commodity producers. When prices are at all-time highs, they're typically in backwardation or at best a flat curve. Gold is printing a 4% per annum contango, rising to 20% in 5 years' time, which is, in our view, a remarkable kind of gift and a potential opportunity over the next 6 to 12 months for miners to take some insurance that gold isn't 3,600 in 4 or 5 years' time.
All right. Let's talk about the copper prices now and the kind of run-up that we've seen here. 12% up on LME, 25% up on COMEX. I mean, Max, when was the last time we saw something like that, this huge disparity in prices?
Yeah, what a run. I mean, it's kind of reminding us of the copper price action we saw a bit over 12 months ago, which was the strongest in years and years, certainly since 2020, 2021 out of the COVID recovery. And yeah, what I find amazing is you've had 3, 4, 5,000 years of gold building above ground in the gold market, and the gold market has been tightened by the shift of metal from ex-US to the US. So the gold market ex-US has been tightened. Gold market has a 50-to-1 stock to flow ratio, whereas copper it has a very low stock to consumption ratio. It's like not the inverse exactly, but essentially the opposite of gold. So if gold can get tightened by the shift of metal due to the threat of tariffs, and it has this massive above ground stock, just imagine what can happen in copper over the next couple of months. So I think this kind of tightening that we're seeing in physical markets across precious metals and copper, any commodity that's trading CME and has a liquid ex-US kind of contract, you are seeing this big shift of metal to the US, and it's tightening things up, and that's most likely to continue for the next couple of months, and is kind of why we upgraded our copper forecast to 10,000. We're already there, and obviously there's potential for that to go higher. Reason why we haven't gone with a higher number is just because we're expecting pretty sizable tariffs on April 2. So you've got this kind of medium-term demand potential shock to the downside at the same time as you've got a really tight and tightening physical market. And so, it's not like both are going in the same direction. So, we didn't put in higher than 10K.
All right, Max, not yet, as you said. But when it comes to aluminum and steel, where we already have seen tariffs and the premium that the U.S. metal seems to be commanding, what is the best case scenario for these prices by the end of this year? And also, how would you look at zinc or iron ore, where we already have seen some profit taking, kind of underperformance, by the way?
Yeah, so I would kind of distinguish copper and aluminium from zinc, for example. So copper and aluminium really don't have much supply growth. Copper on the mine supply side, aluminium on the smelter supply. They're I wouldn't say X supply growth, but China's been driving the supply growth in aluminium for almost 20 years or 20 years, and that's pretty much drying up. On the copper side, it's tough to mine copper, and it's become more and more expensive and more difficult. And we're seeing that with both disruptions remaining elevated, despite analysts seeing disruptions every single year. We still over forecast copper supply every year for pretty much the past 20 years. And this year, is kind of no exception. The supply is coming in lower than expected again on the copper side. So I think copper and alloy, although we have them coming down temporarily for the second half and then having a strong 2026, they're supported. Their prices aren't going to be as low as historical lows in growth slowdowns. So obviously 10 years ago we saw a big growth slowdown, a deflationary shock, and copper got down to $4,000. This is not going to happen again. I could be eating my words here, but I think that's highly, highly unlikely. Similarly, in aluminium, it got down to $1,400 in the previous down cycle. This time, we just don't have the supply growth. And secondly, we've got very strong energy transition demand-related growth coming from China, which is absorbing whatever supply growth there is, which is not much. So we didn't build much inventory in the last couple of years of weak cyclical demand growth. So for all these reasons, I think they're going to go down, but not that much over the next six months or so associated with the pretty strong tariffs that we think are coming. And then on the zinc side, we think that will go down and underperform. That it's the big underperformer, and the reason is the next 12 months there's a lot of zinc supply, mine supply coming on.
I also want to shift focus to the energy space, and the International Energy Agency's recent report talks about how global energy demand grew by 2.2% in 2024. While we have seen growth across energy, whether it's oil, natural gas, coal, or even nuclear, but the highest investment and demand came in from renewables at 35 to 38%. How would you look at the energy and the crude prices going forward?
Yeah, I think from a longer-term perspective, we've obviously seen a slowdown in oil demand growth, both outright and certainly relative to GDP. That's something we very gradually expect is going to continue over the next 5 years or so. Having said that, we are on the supply side seeing some signs that sustained high levels of capex in the US is not resulting in kind of constant growth in supply. We're seeing a slowing in US supply growth, particularly for crude oil. And so there does look like over the medium term that there is some increasing room for OPEC Plus to return barrels to the market. Now, we think this dynamic, certainly for the next year or two, as the barrels are returned, means that we're going to be in a $60 to $75 Brent range over that period. But certainly kind of medium to longer term, there is room for those OPEC barrels to come back, in our opinion. And it's created by shale, essentially, growth slowing down. Now, we don't see flat or negative demand growth in crude oil over the medium term, and we don't see negative shale oil supply growth either. Overall, this market looks kind of like the right price is in that $65, $70 bracket.
A final question then, and since we've spoken so much about tariffs, Max, going forward now, what is the worst case scenario or the best case scenario when it comes to tariffs going forward?
I would say one of the worst case scenarios is that the reciprocal tariffs that U.S. Commerce Secretary Lutnick said that their finding was that would raise $700 billion, that those are enacted fairly immediately, and that those are not redistributed. On top of that you have a higher headline number than the $700 billion because because the administration might want to negotiate down from an even higher number. So kind of worst case scenario for me on April 2 is a 15 to 30% tariffs across the vast bulk of the imports implemented immediately and not redistributed to people either through no tax on tips or to kind of middle income and lower income people on incomes less than $150,000 US. I mean, if that happens, that's the worst case scenario, I think. The best case is for me is, something like 5 to 10% tariffs. which would still be a pretty big headwind for global growth, in my opinion. And for metals and commodity markets more broadly, and that they are kind of either phased in, or industries with complex supply chains are given time to phase in, and that the revenues raised are near immediately redistributed. That would kind of minimize the impact of the shock. On top of that, China and Europe stimulate to kind of offset the impact on their economies. And in that scenario, I think, you can be looking at what U.S. Commerce Secretary Lutnick mentioned about, President Trump and their team owning the economy from the fourth quarter of this year, which would be essentially that the fourth quarter growth outlook is better and even better into 2026. So that's probably the best case. And even then, we've got some pretty serious adjustment to global trade coming over the next 3 months.
All right, that's interesting, Max. As you said, 5 to 10% perhaps in the current scenario would be a best performance, and 15 to 30% would be a worst scenario when it comes to tariffs. Reciprocal tariffs is what we're talking about on 2nd of April. So a week to go to that, and that is what could really change the international markets there. Max, thank you so much for joining us. And with that, it's time for a break. But don't go anywhere. We will throw the spotlight on several Indian jewelers and their outlook on the year on the other side. Welcome back. You're watching Commodity Champions. And record high gold prices may have dampened demand in the first quarter, but Indian jewelers expect 2025 to be a good year. I caught up with industry experts on the sidelines of IGJ-ME Tritiya, a jewelry exhibition held in Bengaluru. Listen into what they had to say.
Quarter one was a little bit slow because of the steep rise in the gold prices. We're anticipating a good Akshaya Tritiya because as soon as the second quarter starts, people will start digesting the new gold rates and we'll be happy to cater to them then. The sentiments in India are always very festive. So quarter two is always something we look forward to every year. The design trends that we're observing in IGJ Tritiya and what we have come up with this new quarter is more related to traditional designs. We see Gudi Padwa in Maharashtra, we see Akshaya Tritiya in all other states. It's a festive season and people are looking at more yellow goods and more traditional goods where they can wear occasionally and for wedding wear.
There is small correction has happened in last 2-3 days, but still then we see the prices are very strong and positive, and there are a lot of scenarios like geopolitical issues and trade wars which is happening between different European and American countries. So while we feel that there may be a small correction, but we still feel that gold prices to be strong for coming 2-3 months. So we at Joe Lucas now runs around 60 stores all over South, in Kerala, Karnataka, Tamil Nadu, Andhra and Telangana. Coming year we are focusing to open more showrooms in South, into Tier 3, Tier cities where we are looking to open 7 to 8 stores.
Currently the gold prices are very high. There is little resilience in domestic market, but it is temporary. Once the price is stable, I can tell you the market will stable, domestic also. We have seen very good growth in last financial year, about 20%. And I'm hoping that domestic market will continuously grow. I have spoken to some exhibitors who have taken part in Hong Kong show. There is a demands from China started again, and I can see that if China recover, the export will match again.
Everybody knows like 24 was little slow. The market was little slow due to the gold rate and all these things. But we have a good hope in 25. But the things what I thinking about the new jewelry culture, talking about this new generation, and the jewelry culture is going to change. So the selection has to be taken very carefully.
The gold price hitting new highs, I think there is a lot of demand and confidence with people to invest in gems and jewelry. There is a short-term volatility that comes whenever gold spikes very fast or in any direction. But once it stabilizes, the demand still continues. So I don't see any challenges in the Indian segment with regards to the demand for gems and jewelry. A lot of new stores are opening up, new business houses are looking into this industry, and we are going to see a robust demand going forward. So barring this 10-15 days, March end, I think these are the small factors, but long-term growth is very robust.
All right, that's the baseline coming in from the jewelers as an industry, that the long-term trends are still intact. The growth will come in. And the second quarter, because it brings in Akshaya Tritiya and a wedding season, there are jewelers putting out new offerings and designs and themes in the industry there. Well, with that, it's a wrap on Commodity Champions. Thank you for watching.
The shakeout has been good. It has tested you. It has, proven that you have a conviction in what you buy. And there's no something called easy money on the Lal Street, as everyone thinks that I buy today, make tomorrow, which had gone on for a few years. But all the veterans have told you that, wait, when the correction comes, people will panic. But I think if they hold true to the flag and, I think it's great. I think the domestic money prospering or domestic India is great. We welcome foreign money, we welcome foreign capital, but they have a right to sell and I don't begrudge that.
Okay.
Market has a self-correcting mechanism. If you take stocks to unbelievable heights, the short seller will step in, or the promoters will sell in, or the insiders will sell in and want to encash it. So that will act as a natural check on the market, which it has done. As long as there's not any undue amount of leverage in the system. There was, I think, 70,000 crores of margin funding, which is the size of a small mid-cap company in India today. So there's no leverage. The banking system has no leverage. The government had fiscal restraints. So, in fact, money was tight. So there was no reason to believe that this would be a long-lasting bear market.
Sure.
And market will correct itself. Anytime the valuations of something become excessive, people step in and sell, insiders sell, someone sells, and that creates a buying opportunity. First correction in 4 or 5 years, so it was particularly severe. And market correction is always severe. It always kind of panics you and tests your conviction, tests your patience, which is all the things that it did. But they are short, sharp, and swift. As you saw, the index fell very sharply and very swiftly, almost without respite, 800,000 points a day after that. But my feeling is that that is just a correction in a bull market, not the topping of a bull market. The reason I say that is even when the fall started, individual stocks were making new highs, new all-time highs. Bajaj Finance, United Phosphorus, Shree Cement, so many companies, good high-quality businesses were making new high. That would typically not happen in a bearish phase of the market.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating.
US and India are holding crucial trade negotiations this week with Assistant USTR Brendan Lynch in New Delhi for talks on the bilateral trade agreement. The visit comes just days ahead of the 2nd April deadline for reciprocal tariffs. According to news agency Reuters, India is open to cutting tariffs on 55% of US imports. The reports also say that reciprocal tariffs would hit 87% of India's total exports to the US, worth $66 billion. In a reply to Parliament, the Ministry of Commerce has said that US reciprocal tariffs are yet to come into effect. The government said that India continues to engage with the US to achieve a mutually beneficial and fair trade deal, and the focus is on increasing market access, reducing tariff and non-tariff barriers, and increasing supply chain integration. President Trump has further escalated trade tensions by saying that US would levy a 25% tariff on any nation that imports oil from Venezuela. Just for context, in 2024, India imported 22 million barrels of oil from Venezuela, making up 1.5% of India's total crude oil purchase. Joining us right now on the tariff threats to India is Anup Vidhaban, India's former Commerce Secretary. Sir, thank you very much for joining us. How do you see this Reuters report which says India is open to cutting tariffs on 55% of US imports? We understand that in trade negotiations, several permutations and combinations are made. But what is your sense on the kind of concessions India can comfortably make?
I think this report, of course, it is partly conjectural, I suppose, but there must be some basis to it, I'm presuming. And 55% of the tariff lines traded with the US is not overly ambitious, and I think we can easily do it. If you look at many of our FTAs with, far more formidable manufacturing nations, whether it is Japan, Korea, the ASEAN countries, we've done agreements with much higher ambition, with over 80% of all the tariff lines going to zero. So 55% of the traded lines with the US is not an unmanageable number. I'm sure we can manage that, subject to getting, our ambitions met by the US side. So I'm not overly alarmed by it. In fact, I think it should be quite comfortable. I think there's an element of conjecture in this. I don't know how true it is and how well validated this news is.
Right.
But taking it on face value, I think it's manageable.
Okay. Now, let me ask you about a Wall Street Journal report, sir. They said that the US is now going to act in a more targeted fashion against countries, or at least 15% of the countries with whom the US has the highest grade trade deficit. Now, India is number 11 on list. China, the trade deficit is the highest at $270 billion. India is around $45 billion. So India could be among the countries which would be hit the hardest. But frankly speaking, sir, if we don't act, or if we're not able to have some sort of a carve-out or deal by the 2nd of April, how bad can things be, even if those reciprocal tariffs against India come into effect?
Yeah, so certainly, you see, this is the same thing as the reciprocal tariffs. So basically, what the report is saying is that when dealing with the countries with which US has the highest trade deficit, there'll be a particular focus, and there'll be some element of, deliberateness, if I can use the word, in dealing with these countries. So it's simply the mechanism for applying the reciprocal duties which has been amplified. So I don't think this by itself, again, is very alarming. Ultimately, that principle of reciprocal duties, whichever way it'll ultimately be exactly interpreted and implemented, it relates to the same thing. So certainly, there'll be some impact on our exports, but I don't see a catastrophic impact. There's some estimates that, in our exports of around $80 billion, there might be an impact of, say $6 million, maybe something plus minus on that. So what happens with the tariff is that, depending on the attachment American customers have with those particular Indian goods that are exported, the tariff is shared between the buyer in America and the exporter from India. So to the extent American consumers are attached to that product, prices will go up with the tariff for the American consumer, and to some extent, the price received by the Indian exporter will come down. So the tariff is always shared between the consumer and the exporter, and that is what will happen. So from good to good, the situation will vary, and partly the exporter will absorb the tariff, partly the buyer will pay a higher price. So there will not be a catastrophic impact that, some lines, the exports will stop completely. Profitability will come down. Some volumes might come down at the margin, but I don't see a catastrophic impact.
Right.
And
Mr. Vidhaban, Ajay Srivastav of GTRI, somebody who's also been a trade negotiator, he has mentioned on record that India should withstand the US pressure right now. We should not concede everything that the US is asking in terms of major concessions on India's subsidy policies, MSP policies, intellectual property rights in the pharma sector, access for companies like Starlink on very easy terms. Do you feel that the threat of reciprocal tariffs is something that India can deal with? and it's probably not worth giving all those concessions to US as it may be demanding?
No, I think that is perfectly correct. We should not unilaterally give any concessions at all. Everything should be negotiated as part of the BTA, bilateral trade agreement, which is going to be negotiated. So, but anything you give outside the agreement gets pocketed and swallowed and put aside. And then you start from that point in the negotiation. So certainly I agree with him fully. We should not make any concessions outside the agreement. It is not going to help us at all. The reciprocal duties will still kick in, and we have to deal with them separately. And further in trade sort of parlance and trade practices, there are strict protocols which countries have always followed. In President Trump's first term, when he put those security-related duties on steel, aluminium, we immediately put our countervailing duties. So that if they put the reciprocal duties, we must take whatever action we need to take by way of countervailing those duties. And to the extent, we can convince the Americans that this reciprocal duty route is not in good faith, then we are going to discuss a bilateral trade agreement. Either you can have a trade war and implement reciprocal duties, and then India has no option but to respond to them, based on standard trade practices. Or otherwise, you can have a more congenial environment in which to negotiate the BTA. So both can't go together. I'm quite puzzled at the way, the US side is taking this forward. And I think we should, urge the Americans that have a good faith negotiation in a quick time frame where you can have a mutually beneficial outcome, for both sides.
All right. Thank you very much, Mr. Vadhavan, for joining us with your perspective on the ongoing trade negotiations and also the kind of pressure that is building up from the United States. On that note, we take a short break, but don't go anywhere. When we return, we're going to get you an exclusive interview with the co-chairman of global direct selling firm, which is into wellness, health and nutrition. That is Amway. And the co-chairman of Amway, Doug DeVos, will be joining us.
And influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m.
Just trying to do the right thing for the American taxpayer, for the American people. Just a thank you to the Doge team who are literally getting death threats and being accosted. And
You know, these are a lot of them are just kids. You know, they're just trying to help out, and they're very talented. They could get jobs for millions of dollars a year. Instead, they come here, earn peanuts, and get death threats. So thanks to the Doge team.
US headquartered Amway is one of the world's leading direct selling companies in the nutrition, health, beauty and wellness space. The company reported $7.4 billion in sale in 2024. Based in Ida, Michigan, USA, the company was founded in 1959 and has been present in India since 1998. Amway began manufacturing operations in the country in 2015. Today, the company is actively looking at expanding operations and sales in India, including in the Ayurveda space. Joining us right now to speak about Amway's global plans and India strategy is Doug DeVos, co-chairman of the board of directors for Amway. Doug was previously the president of Amway for 16 years and joined the company in 1986. Doug, thank you so much for joining us here during your India visit. Tell us about the importance of India in your global vision for Amway going forward.
Well, absolutely. So, India is going to be is already and will continue to grow and be a dynamic marketplace. And you can easily see that it's going to be one of the top 3 economies in the world, right? With, India, the United States, China, you can see where that's going to happen. And so India has a huge role in the Amway business for us going forward. We see that potential and we see that we believe we can bring to the marketplace products and services and operational excellence that allows us to compete in the marketplace here and be very successful. We saw that years and years ago. We continue to see that now. And our opportunity and our job is to make sure we continue to stay close to the dynamic nature of this marketplace and that we continue to meet the needs of the consumer, that we continue to meet the needs that the market is demanding and find a strong pathway forward for success. So India plays a huge role in the future of Amway globally.
Could you give us a sense of the kind of growth that you're expecting from the India market, and overall, how do you expect the India market to contribute to your overall revenues in the next 5 to 10 years?
Yeah, absolutely. So we see the growth here being very solid and strong. And we don't want to try to make assumptions or guess. Our job is to go to work every day and do the right things every day. We believe if we work hard and make sure we're a better company tomorrow than we were today and even better the next day, that the growth will follow. Once we are better, we believe bigger follows. And we see that the potential of this market, if you look at other markets in similar situations, you can see repeated double-digit growth in the near-term horizon. Those would be sorts of the ideas that we look at. But what we want to do is make sure that growth continues year after year after year, that we build a solid foundation around that growth to support that growth. We don't want to just pursue growth for growth's sake. We have a long-term vision here, and we know that India has a huge role in the Amway business, not just with its size, but with the way it can help us learn how to be a better business, how to be a better company, how we have to adapt to changing marketplaces like we've learned in other parts of the world. But we know India is going to teach us a number of very important lessons in the next 5 to 10 years. And we're excited to be part of it and really looking forward to the times ahead. We have a great team that is dedicated at doing this work and doing it well.
You know, Doug, we are in a volatile geopolitical environment, and the U.S. president has already said that reciprocal tariffs are going to come into effect from the 2nd of April. How do you think this is going to impact American companies? And are American companies largely in favor of these reciprocal tariffs?
You know, every industry or every company is going to be looking at some of the moves that the U.S. government is making from their own perspective. They're going to try to figure it out and deal with it. The main thing that comes through in my mind is perspective. You know, U.S. policy has changed many times. I'm old enough to have seen different changes in U.S. policy and, and the way we approach trade in different markets. And so I try to take a more moderate view of the latest thing that's being discussed. So tariffs are the big thing being discussed today. I try to say, okay, I understand that, but but they're going to be part of the bigger picture, the longer term picture. And my impression is that there's a strong desire to engage in global trade, but on a little different terms maybe than the U.S. has done it in the past. And so I think there will be a lot of discussion, but how things settle out and how trade relationships get built, going forward, I think we'll still have many of the similar characteristics. We really are pursuing free and fair trade and a rule-based sort of system. And so while there's a lot of different talk about how to get there today, and there's a lot of reaction to it, I think over the long term, a lot of those questions will get answered, and it will lead us to a stronger and more sustainable trade strategy or trade policy going forward.
Right. How does this impact, this trade uncertainty, tariff uncertainty, impact companies like yours and their plans? How do you think 2025 or even the next 2 years are going to be for the company? Would you like to invest more, explore more, or would you like to hold on till the time you see some clarity on what's going to happen on the tariff front and where the dust eventually settles over the next 8 to 9 months?
Yeah, that's such a great question, and such a challenging question because business craves for certainty. You want to know exactly what you're investing in and what's going to happen, but we don't live in a world of certainty. We live in a world where things change all the time. So our mindset is that now is the only time we have. We're going to have to make the best of the current situation, so we continue to look at what's happening. We have to make our best estimates at where the future is going to shake out and still make decisions to move forward today. We don't believe we can just wait for things to get calm or for everything to get settled, because we don't think that's ever going to happen. It's always going to be a changing and dynamic marketplace. So as we look at our investments, again, we invested in our manufacturing here in India. We invest in our R&D. We invest in our product development. We invest in our operational excellence. We invest in our technology. And we're going to have to keep doing all those sorts of things in the midst of maybe an uncertain environment. But that's we do not see some of the volatility around the world holding us back. We just see that as something that's always going to exist, but we have to be clear about who we are, how we serve the marketplace, how we serve our customers, how we serve all of our Amway business owners and our employees. And when, like I said earlier, when we're better, then the bigger part tends to take care of itself, and we'll make adjustments for the newer situations that come along, as things develop in the future. But we don't wait. We continue to move right now.
India and US are negotiating a broad trade agreement. In fact, the consensus is to have a bilateral trade agreement by the end of the year. How do you think such a bilateral trade agreement will be for both US and India?
I think it'll be fantastic. I think anytime you can find an agreement, especially between two dynamic countries and dynamic economies like the U.S. and India, I think you will find a lot of synergy that will build on itself, and you will find that starts to create some of the certainty that we were talking about earlier, and maybe some of the other businesses that look at things a little different or are waiting for that certainty, maybe that's when they see the opportunity to act. And I believe that with that sort of a foundation, if that were to happen, and I do have a sense that it will happen in a good way, that that it will grow on itself. It will become even more than what could be expected at the onset, because these are very dynamic economies, and there's a lot of people in both the United States and India that would be very interested in how we can learn from each other, how we can grow together, and how we can approach the market in even better ways going forward. So I'm encouraged. I'm really happy to hear as you speak of these talks and to see those things develop, and trust that it will turn into agreement at some point, hopefully soon.
When it comes to the ease of doing business ecosystem, Amway has now been around in India for close to 3 decades. What do you think can be easier for companies to do business? There is also a regulatory overhang that Amway has been facing in India in the form of a probe that has been going on. If you were to make some recommendations on ease of doing business for companies like yours to really prosper, create jobs, create more manufacturing, what would that road and recommendation be?
What a great question. What a great opening. There's always things that we would hope for from a regulatory or an operational environment here in India that would make it easier to operate. You mentioned the technology investments that we've made, that a number of companies in India have made as India's pursued digital India. And I think sometimes it takes a while for a lot of the regulations to catch up with where the industry really is or where the marketplace really is. So my hope would be, without trying to dive into specifics, my hope would be that the respective government agencies would really be working closely hand in hand with what industries are doing and watching them, learning from them, applying the appropriate regulatory oversight. That's what they need to do. We understand that. But there's a number of things that just are not productive, either for the government or for protecting consumers or for industry. And those would be the ones that you would like to think that there could be very quick action to say, these are outdated regulations, they don't really apply to the marketplace today, they don't apply to the technology that's being used, and therefore we're going to take those off the books, because if they're still on the books, we as a company and industries and others like us have to comply. And so those are the things that can become a drag on the economy if the regulators aren't working or aren't looking to the future like the marketplace is or like the businesses are. And so it would be my hope that in this dynamic tension of moving forward and how technology is changing things for so many people so quickly, that the government and our regulators would continue to be part of that journey with us and find ways to streamline, because when that happens, as you mentioned, there can be more investment, there's more jobs created, there's more opportunity created, there's better products and services that are brought to the marketplace, and it increases prosperity for everybody in the process.
All right, so that's all we had time for on this special broadcast. Amway clearly bullish on the India market, and they are expecting a lot from the India-US trade deal as well. Thanks for watching, and goodbye.
and welcome to the Global Dialogue. I'm Shireen Bhan. US conglomerate Honeywell has taken a decision to split its businesses across 3 separate listed entities, and aerospace is going to be one of them. It will be the largest publicly traded pure-play aerospace company, but that, of course, happens in September of 2026, or at least towards the second half of 2026. Joining us now to talk about the road ahead and the flight path is Jim Courier. Jim, many thanks for joining us here on the Global Dialogue. It's a pleasure to have you join us.
No.
Let me start by talking to you about that decision of splitting up these businesses into 3 separate listed entities.
Correct.
And I guess we've gone through that conglomerate boom of the 1960s, and now everyone's decided that perhaps moving into separate entities and individual businesses makes sense. The conglomerate discount perhaps has weighed on this decision as well.
There's a prevailing sentiment that that's the case. I will tell you, for us within Honeywell, there were some very strategic reasons why there was a decision to ultimately separate the business into 3 businesses. We announced, advanced materials in October of last year, and just recently announced the fact that we'll be spinning aerospace from Honeywell as well back in February of this year. And really what was kind of driving some of those decisions ultimately was that the strategic direction of some of the businesses were very different.
Right.
The demand drivers for the businesses were very different as well. And so it was truly looking at the business holistically in the portfolio. What is in the best interest of shareholders? What is in the best interest of our customers? And it made sense to ultimately split the business into those 3 independent publicly traded companies, which is what we'll have going forward.
Well, the work has just begun because, as you pointed out, the decision was taken in February, and eventually we will see this culminate into a listing of a separate entity in 2026. So what can we expect between now and then?
So it's definitely in the early stages of planning, without a doubt. And I think if I were to focus on, for me in aerospace, what are some of our short-term goals and what are some of our long-term goals relative to what this decision means? Short-term, it's business as usual in terms of we're still one Honeywell. We still have commitments that we need to make to the organization that we will deliver on those commitments, both financially and from a delivery standpoint. It's supporting our customers going forward as well, all of the customers that we have around the world. And then if you think about on a longer term trajectory, what does this really mean for Honeywell Aerospace? By separating out Honeywell, now we become very, very strategically focused on the aerospace business itself. And it provides a lot of flexibility in terms of capital allocation. How we deploy capital for organic investments, how do we want to deploy capital for inorganic investments, capital deployment within the factories and our facilities to drive growth and enable growth and investments that we need to make. That flexibility that's afforded to us on a longer term horizon provides a foundation to be able to support our customers better and to be able to supply the needs of the industry and the demand needs that are out there in the industry in a much more efficient and productive manner.
I'll get to capital deployment in just a second and also talk to you about possible M&A, but let's talk about demand. And the Honeywell forecast has a very strong demand outlook, not just for the year ahead, but over the next decade. And India, of course, continues to be one of the hotspots as far as demand for commercial aviation is concerned. Give me more color on what you're seeing as far as the demand situation is concerned, and back that up with what we're seeing on the supply side challenges and whether those have started to ease at all.
It is starting to ease some. What I would say on the demand side, I mean, Honeywell is in a very fortuitous position in the fact that we have a breadth of technology that we provide to the aerospace industry, nose to tail on the aircraft. Anything you can think of in terms of integrated avionics, flight management systems, weather radar systems, jet engines, APUs. It's a broad breadth of technology and innovation that we're creating. You combine that with the fact that we support multiple end market segments. So we're not just a commercial business, but we're also a defense business. Right. So our portfolio is about 60% commercial, about 40% defense. And of that defense business, about a quarter of it is in the international defense market. And in terms of demand, in my 20-plus years in this industry, I have never seen an opportunity whereby all end markets simultaneously are growing at the levels that they're growing. So it does create a very bright future for the aerospace industry overall. And when you look at backlogs for the major OEMs, multiple years of backlog in terms of thousands. It's unbelievable, right, what is occurring. And so now you pivot that to the supply side of the equation. with all of the aerospace industry growing in the manner that it's growing, it does create strain within the supply base. So you have to look for alternatives, like how do you support this industry on a go-forward basis to support the demand that is out there commercially and defense as well. And you start looking at where do those opportunities represent. Here in India is a great example. It's an industry in the aerospace industry that is growing substantially. I mean, unprecedented amount of orders from the major airline carriers here in India as a result of that. That creates opportunity for localization. There's tremendous talent here, technologically speaking, tremendous talent from an innovation perspective, tremendous talent from a manufacturing capability as well. So we in Honeywell Aerospace are looking at that very earnestly and looking at opportunities to build out that industrial supply base here in India to support the demand that's required for the Indian aerospace market.
So let's build on that. You know, when we talk about using India as a supply base at this point in time, the exposure that Honeywell currently has is relatively small in comparison to some of the other players. What's the aspiration and where do you believe you could be over the next few years in India?
Yeah, so I think I look at our footprint in India from two perspectives. One of them is the technology and engineering presence that we have in India.
Where you have 3 centers of excellence.
Correct. Right, and we have over 3,000 engineers that only support the aerospace business. And this isn't something that happened overnight. This is something that we started over 20 years ago and invested hundreds of millions of dollars into the laboratories, the R&D centers to really build out that capability. And that innovation that comes out of India is absolutely amazing for our products. It's a cornerstone of the successes that we have had thus far, and it will still remain to be a cornerstone of our successes going forward. And they're developing some of the most innovative technologies for our industry. Now, the second element of that is the supply side. Right. And so, yes, we have been sourcing material and sourcing supply here out of India. But
could you give me a number for that?
It's not an exact number. I mean, it's relatively small in the grand scheme, but we're looking at quadrupling that within the next few years. Okay. And that will drive a lot of growth opportunity here as well in terms of that industrial supply base. But it's also not just about the material and the engineering technology. As the Indian market is growing in the way that it is going to grow in the future, there's going to have to be an ability to maintain, repair, and overhaul those aircraft. And so we're also looking at investing in factories to be able to develop an indigenous capability here in India that is allow us to build on the maintenance, repair, and overhaul that's necessary to support the aircraft here.
And I think this has been a long-standing demand from industry, and many changes have been brought about at the policy level to incentivize setting up MROs in India.
Correct.
Has the regulatory environment become much more facilitative for that to happen?
There's a lot of early conversations around that, and I would say yes, but I think there's a longer journey that still needs to happen to be able to open that up in the speed at which it needs to open up to be able to support the industry here.
So what could it mean then in terms of your own plans as far as MROs are concerned?
Well, if you think about the number of aircraft that are going to be entering into the Indian aerospace industry here, we're talking over 1,000 aircraft from the major OEMs, for which we have substantial content on those aircraft. Some of it is standard equipment, some of it is selectables equipment. So whether we're talking APUs, environmental control systems, avionics, weather radar, radio communications, all of that equipment on those aircraft will be coming into this industry over the years during that growth. There has to be an ability to maintain, repair, and overhaul that going forward. And so looking at regulatory aspects, looking at opportunities to build that infrastructure here is what's of primary importance for us and something that we're committed to do.
And do you expect a decision, what, in the next year, next 2 years, 3 years? What's the broad timeline that we're looking at?
Oh, I think we're within a year of making the decision. I mean, we're already making the decision to actually source more material here to support the industry, but in terms of establishing partnerships and relationships to put an actual footprint for maintenance, repair, and overhaul, we're within a year of making those decisions.
Within a year of making that decision. That's as far as the commercial side is concerned, but you also talked about the defense opportunity. And again, this is an area where the government has decided to prioritize localization. In fact, there's been 3 or 4 lists of indigenized products that the government has put out. How do you see Honeywell playing a role in the indigenization process?
I think it creates a tremendous opportunity. So I think we build upon that that from two fronts. I mentioned earlier about our engineering footprint that we have here and the innovation and the technology that's being generated out of that. Most of our products that we develop can be applied to either commercial aircraft and or military aircraft and to support the defense industry. So a lot of what we're doing here indigenously in terms of the technology and the innovation that we are creating, we can apply that into the defense market as well. Now, India, historically speaking, has been more of a net importer of defense, right? Yes. So as that indigenous capability builds, as the needs of the Indian government and defense needs are fulfilled, I anticipate a true opportunity to become a net exporter of some of this defense equipment.
That is the aspiration.
I believe, and I think it's actually achievable ultimately. I mean, there's a lot of technology and innovation happening here within India that I think becomes then an element where in the future you can be a net exporter of some of this defense technology.
You know, when we talk about defense and what we're seeing happen on account of the decisions that the Trump administration has decided to take is weaponization and defense budgets in Europe now being revived, or at least on the cusp of seeing some revival. What do you make of what is going on with the decisions coming in from the US and the likely impact of that across the world?
Well, the geopolitical landscape is changing, right? It's a very, very stressed environment today. There's conflict occurring around the world. And I think a lot of countries are recognizing a need to have self-sufficiency in terms of their own defense capabilities. And the reliance on other countries for their defense needs, they want to maintain some of that internally themselves. So that creates indigenous opportunities to create new platforms for defense, localization of developing technology and innovation as well. And I think the recognition of the geopolitical landscape changing in the manner that it has caused countries to realize they have underinvested in their own indigenous defense capabilities, and hence why you're seeing a lot of rhetoric coming out of the EU in particular about increasing defense spending, becoming more self-reliant on their defense needs on a go-forward basis. That will create a lot of opportunity ultimately. And for us, we think about our international defense footprint and what we're trying to grow in that regard. We made an acquisition last year of an Italian company called Civitanavi.
Yes.
Purposeful in the EU, it's an Italian company, and purposeful to be able to develop non-ITAR controlled technology in region, in the EU, with a manufacturing footprint in Italy as well to be able to support that growth that is happening. That becomes another anchor for us to be able to build upon supporting the EU and some of the defense needs there. Similarly, we're thinking about doing the same thing here in the Indian defense market as well, and being able to apply that. So there's a clear recognition that a substantial amount of growth is occurring in the international defense markets, and we're going to position ourselves to be able to capitalize on that growth with our products and our technology and our innovation.
You know, you talked about how you're coping with the changing geopolitical landscape, but let's also talk about the changing geoeconomic landscape and the threat of tariffs at this point in time. We're counting down to the 2nd of April when we will see the Trump administration finally take forward what it intends to do as far as tariffs are concerned. How does that impact your plans? How does it impact the supply chain generally for the industry, which has already been fairly stressed and fragile?
Yes, it does create a little bit of anxiety within the supply base, without a doubt. I think the lack of clarity in some regards in terms of how tariffs will apply and when and how much will create a little bit of anxiety. Anxiety creates uncertainty, and uncertainty creates a little bit of trepidation in terms of how do you manage your supply base. What I will tell you is that we're a global company. And as a global aerospace company, I have manufacturing facilities all over the world that are supporting the industry at large around the world, whether it's civilian or whether it's defense related. And so we closely monitor what is occurring. I look at the current tariff situation, and albeit it's very dynamic, it can change, you know, from one day to the next.
Or one tweet to the next.
Or one tweet to the next. But under the current set of circumstances that are in play for us in Honeywell Aerospace, it's a negligible amount of impact that we would see on our business, and it wouldn't change our desire and our continued efforts to focus on investments back into the supply base and continuing to grow.
So how do you then look at building out the supply chain resilience? Because we saw this happen post the pandemic, where most people were talking about diversifying risks, diversifying supply chains.
Correct.
In this current context, where there seems to be an effort to move manufacturing back to the US, what does it really do to supply chain expansion and diversification plans for a company like yours?
Well, first and foremost, thinking about the demand that is out there requires a completely different set of circumstances and decision making to be able to supply to that demand. The geopolitical landscape is a player in that. So we looked at our supply base from start to finish, and we started evaluating where we were single sourced, where we weren't dual sourced, multi-sourced, where do we have some specialized capability internally as well to be able to move some products back inside. So we are revamping our internal supply base within Honeywell Aerospace to look at dual sourcing, multi-sourcing, moving around supply base for geopolitical concerns may exist. Where is the demand, i.e. what we talked about earlier, here in India, establishing an ecosystem of a supply base here to support our products here in India as well. So you kind of have to see where the demand is moving and where it's occurring, and then just position yourselves accordingly for that.
So what will that then mean in terms of capital deployment? You talked about how the restructuring will give you a little bit more flexibility on how you choose to use your capital. So in this current scenario, where you see demand, where you see opportunity, what could it potentially mean for a market like India?
Well, I mean, for us, when I think about the demand cycle that is happening here, we talked about maintenance, repair, and overhaul facilities. We're seriously considering, and we'll make that decision here in the not too distant future, about ingesting a substantial amount of capital to enable that capability here in region to support the demand growth that is happening here as well. And so we'll look at where do we want to deploy that capital, where do we want to put in certain factories, other capabilities that may exist, but that flexibility allows us to be very agile. It allows us to be very responsive to the industry needs going forward, and I think it sets us up to be a little bit more supportive of our customers.
So a ballpark number to sort of set up MRO capabilities, what does it take in terms of the kind of capital requirement?
It depends on the amount of investment that you want to make for certain capability, mechanical and or avionics, but you can be anywhere between $100 to a few hundreds of millions of dollars to put that capability in place.
Are you looking at both?
We're looking at both.
Okay.
And we're looking at establishing a footprint from the start, and then how do you build upon that for the future as the industry grows along with it. And a big part of that also is determining, are there partners in region that you would want to partner with to enable that capability that exists here as well. And that's part of the equation that we make those decisions from.
So partnerships could entail joint ventures, or partnerships could entail M&A. What are we talking about?
All of the above. All of the above are
Anything
in play.
on the radar at this point in time?
Nothing I could speak about, of course, right? But I will tell you from an M&A standpoint, just across the board for Honeywell Aerospace, we're still very active in the M&A front. We did acquire 2 companies last year. Civitanavi, I mentioned, was one. Case is the other one that we acquired for just over about $2 billion. Great technology, great capability, great platforms that are growing in the defense industry. If you notice, those 2 are specifically around defense and defense capability, because we recognize that that is a growth that is happening for the future. But there's also many other assets that we're taking a look at, and how do they fit into overall Honeywell Aerospace for our future.
So defense clearly a priority area as far as M&A is concerned. What would be some of the other gaps that you intend to use the M&A route to plug?
Yeah, so we look at where there's technology gaps. We look at where there are capabilities whereby I just don't want to bolt on something that is just something where we look at an asset, we look at the capability, we look at the platforms. Are they serving the same customers that we're serving today? Are there synergies between the technologies whereby we can incorporate some of their technology, some of our technology, bring it together and create more value for our customers as a result? So that M&A outlook for us is very, very robust on a go-forward basis, but we'll have to see which ones ultimately make it.
How large is the war chest for M&A?
It's as large as we can make it, right?
Since we're talking about technology, let me ask you about AI and the role that AI and generative AI specifically is likely to play when we talk about both safety as well as sustainability, and what that means for your plans going forward?
So AI and the incorporation of AI within the Honeywell Aerospace business is very strong, and we're moving very diligently in that regard. I'll give you a couple of examples of where we're incorporating AI. If you think about avionics for a moment, you think about pilot state monitoring. So incorporating AI algorithms that can look at physiological and physical attributes of a pilot, determine is there stress, is there fatigue, are they being overworked as well. That's one example. Another example would be navigational systems. So an issue that is occurring in our industry today is operating aircraft in a GPS-denied environment. It's becoming more prevalent, as we can see. So how do you develop AI algorithms to look at alternate means of navigation, whether it's visual, celestial, magnetic? So there's technology that we're developing in that realm to produce alternate navigational capability and operating in a GPS-denied environment. And then just engineering in general across Honeywell Aerospace, right? We look at using AI as a tool for productivity, for efficiency, quality, improving quality of software loads. So whether we're doing test and validation, training AI algorithms to look at software requirements, code structure, and then ultimately be able to create code, for your platforms and for your products, again, with an underlying principle around productivity, efficiency, safety, and quality.
Yeah, so those are some of the trends that you're using technology to solve for. Sustainability and sustainable aviation fuel has again been something that Honeywell has been backing for a while now. Are you seeing a greater degree of enthusiasm to move forward in terms of adoption at this point in time, or is it low on the list of priorities?
It's high on the list of priority, particularly in the aviation industry. I think collectively as an industry, we've all made commitments about being net zero carbon emissions by 2050. A big path to be able to achieve that is the incorporation of sustainable aviation fuel. And so there's going to have to be the incorporation of that fuel into the aerospace ecosystem to get to that net zero carbon emissions.
So where are we from pilot to actual adoption? I mean, even India's done its first sort of SAF flight, but where are we in terms of large-scale adoption?
So it's starting. Right? I think I would characterize it as being in the early stages of adoption going forward. Part of the problem is the lack of feedstocks to be able to create sustainable aviation fuel. And that's where Honeywell actually has come in and come up with some very innovative solutions for that. So some of the processes, refining capabilities, and the like that we've developed allow you to produce sustainable aviation fuel off of multiple varied feedstocks. So now you've got a feedstock that goes across multiple elements to be able to feed into sustainable aviation fuel refining and capability. That's a major advancement that needs to happen for further adoption. And then specifically in Honeywell Aerospace, we have to ensure that our equipment, our turbo machinery, our jet engines, our APUs are capable of operating on sustainable aviation fuel without sacrificing efficiency, quality, or reliability of the equipment. So we bring that in together in a holistic approach to continue to drive the industry towards more adoption.
SAF is one thing, but in terms of fuel efficiency, and I think that's the big one across the aviation sector, because that's the one big thing that's not in your control, and it depends on where the commodity markets are. What can technology do, specifically the technology that you're working on, to be able to drive efficiencies there?
So ultimately, it's going to be SAF incorporation, but then it's going to be operating an aircraft more efficiently, ultimately. And so that can take on many different aspects. Two examples that I would give you is in the incorporation of our auxiliary power units. We've incorporated some technology and some software whereby you can operate in what we call a high efficiency mode. So the APU will operate depending upon the environment and the characteristics. It will alter, and therefore saving fuel as well. So adding a little bit more efficiency to the aircraft. But another particular area is electrification. Right, and so minimizing the consumption of amount of Jet A and/or sustainable aviation fuel by incorporating electrification across the aircraft platforms, allowing engines to operate more efficiently and be more productive in terms of operability on the aircraft, are other areas of technology that we're developing.
We talked about all of the tailwinds at this point in time for the sector, specifically for your business. What could be the potential headwinds as well? What could cause some turbulence down the road?
Yeah, again, a lot of demand and inability to supply to that demand that we have today. So that's a headwind, right? We've got to be able to continue to build out the aerospace, industrial supply base, the complete ecosystem to be able to support the demand that we have today. The other thing that I would say is that growth that we're seeing, right? We're seeing like almost doubling the amount of passenger traffic in the next, 15 or so years means more aircraft are flying. It means more congested airspace, and typically around airports, right? Air traffic control corridors that become much more congested. So where we're developing a lot of technology is around safety. It's around situational awareness in the cockpit to ensure that we're driving the most advanced safety critical features and functions to the pilot to be able to address any concerns that may exist there. And we've seen incidents that are happening, around the world today. That's an area that needs to be addressed. That could be a headwind for our industry going forward. And then the little sub-element behind that is pilot demand. Right? If that growth is going to happen and that many more aircraft need to fly, you need to be able to have the pilots to be able to support that on a go-forward basis. So that could be another element that could be a headwind to be able to introduce enough pilots to be able to support the growth.
So $15 billion in 2024. What's the outlook as far as the next 4 or 5 years are concerned?
In terms of Honeywell Aerospace?
Yes.
Yeah, so we're projecting this year at about mid-single digit to high single digit growth on a go-forward basis. I anticipate that to continue for us, for the next few years as we continue to capitalize on this run that we're having in our industry. And at the same time, using this opportunity to invest back into our products. So we're doing a tremendous amount of organic investment back into developing new technologies, new features, new functions. I mentioned earlier about the breadth of our portfolio across Honeywell Aerospace. I can tell you there isn't a single part of that portfolio that we are not investing money to develop new technologies for the future.
India, for the conglomerate, has been a high-growth market. For aerospace in particular, the role and relevance of India over the next few years?
Substantially relevant, right? I mean, you think about the backlog, the number of aircraft that have been bought, the growth that'll be happening here in terms of demand. There's some underpinnings within the Indian market that's driving that growth. You think about the economy growth that is occurring in India, tourism growth that is occurring, more disposable income here within India. All of those are underpinnings that drive growth in terms of travel and demand on aircraft. The existing infrastructure, aviation infrastructure here in India is becoming much better, connecting points much better. So that is a real growth potential that we're very excited about here in India, and just making sure we're positioned for that on going forward.
Well, Jim, thanks very much for your time, and we look forward to you telling us more about the MRO plans as and when they get finalized. But appreciate you joining us here to talk about Honeywell's aerospace plans, specifically here for India, as well as what the flight path ahead looks like. Appreciate your time.
No, thank you so much for the time and the opportunity to speak with you.
Well, with that, it is time for us to wrap up this edition of the Global Dialogue. From all of us here on the team, for now, goodbye. Thanks for watching. Do stay tuned to CNBC-TV18. The news will continue right after this.
We're doing it to help our country, and our country was riddled with fat, like no country probably anywhere in the world, and we're getting rid of the fat. And at the same time, we're going to be bringing in millions of very good, high-paying jobs, and we're going to be taking in a lot of money. Our country's going to be very strong. We've been ripped off by every country in the world, friend and foe, and we'll be announcing cars very shortly, and we already announced steel, as you know, and aluminum. We'll be announcing pharmaceuticals at some point in the not-too-distant, because we have to have pharmaceuticals. We don't make pharmaceuticals anymore in our country. And if we have problems like wars or anything else, we need steel, we need pharmaceuticals, we need aluminum, we need a lot of these things that we sort of don't make anymore, and yet we're equipped to do it all. So we'll be announcing some of these things in the very near future, not the long future, the very near future. And
so exciting is April 2nd is just around the corner, and that's American Liberation Day. That's the day when the rest of the world starts to treat America with respect, and your leadership understanding how the rest of the world treats us and what balance and what fair trade finally is going to be, is going to take care of America. It's going to launch the External Revenue Service to start to build the power and prestige of America back.
So we're going to take in a lot of money from the outside, and that's going to keep our taxes low, and I think getting a lot lower. It's going to be a lot of money, and that will, the external will take care of the internal to a large extent. So I think it's going to be a beautiful transformation.
Hello and welcome to Business 360. I'm Shireen Bhan. The top stories that we're tracking for you this evening. The markets close in the green for the 7th straight session, but the gains are limited. Mid-cap see a sell-off with the index losing over 550 points. U.S. President Donald Trump threatens 25% tariffs on countries buying oil from Venezuela. China and India among the largest oil importers. U.S. is the second largest buyer of oil from Venezuela, but Trump extends the deadline for Chevron to shut down operations in the country till the end of May. A U.S. trade delegation in Delhi just a week before Trump's proposed reciprocal tariffs on countries like India kick in. Washington wants greater market access for goods, automobiles, wine and agriculture. Reuters reports that India is open to cutting tariffs on 55% of U.S. imports. Lok Sabha passes the finance bill. Finance Minister Nirmala Sitharaman highlights measures taken to rationalize the tariff regime, also defends the changes to the income tax law, which allows tax officers access to email and social media data. Donald Trump's White House mistakenly shares its war plans in Yemen with a journalist from The Atlantic magazine. The plans were disclosed in a messaging group where the journalist was added accidentally in what is a serious security breach. The death toll in Gaza crosses 50,000 as Israel continues to bomb for the 8th day. Over 20 people killed in overnight air raids. Israel issues fresh evacuation orders for northern Gaza. It's the last day to bid for bankrupt JP Associates. Sources say over 24 suitors, including Adani, JSW, Oberoi Realty, Welspun, are likely to fight for assets spanning across real estate, cement, hospitality, and others. Consumer spending remains muted in Q4. Retailers Association says apparel and electronics are seeing very low sales growth. Electronics Mart of India says same-store sales growth is around 5%. JSW Steel overtakes ArcelorMittal as the most valuable steel company in lakh crore rupees as the stock gains 18% so far in 2025. Chief Minister Rekha Gupta presents a Delhi budget with an outlay of 1 lakh crore rupees, allocates 5,100 crore rupees for monthly cash allowance to women and 50,000 CCTV cameras across Delhi for women's safety. Also promises free laptops to around 1,200 10 standard pass-outs. The Allahabad High Court Bar Association begins an indefinite strike after the proposed transfer of Justice Yashwant Verma from the Delhi High Court. This after the police allegedly discovered a large stash of cash at his official residence after a fire. Justice Verma strongly denounced the allegations, hinting at a conspiracy. Mumbai police summons comedian Kunal Kamra for taking a jibe at Maharashtra's Deputy Chief Minister Eknath Shinde. Kamra stands by his comments as he does not fear the mob. Shinde calls for limits to freedom of speech. Well, we'll come to all of that in just a bit, but first up to the market action of the day. And the markets continued to gain ground today for the 7th straight session, but they did give up some of those gains coming off their intraday highs. The gains were limited at close. The Nifty held on to levels of above 23,650 and the Sensex above 78,000. Mid-cap saw a sell-off with the index losing over 550 points. The big story this evening, a fresh tariff concern for India with just 1 week to go for US President Donald Trump's deadline to impose reciprocal tariffs. President Trump has signed a new executive order to impose 25% tariffs on countries who buy oil from Venezuela from the 2nd of April. Trump has described the move as a secondary tariff aimed at punishing the country for allegedly sending thousands of high-level criminals into the US on purpose. The additional tariff will come into effect from the 2nd of April. China and India amongst the largest importers of oil from Venezuela. India was the top buyer of Venezuelan crude oil in January of 2024, importing nearly half of the country's total exports. Sudarshan is standing by with more. Sud, how could this impact India?
Oil and gas stocks were low in today's trade on the back of the announcement made by US President Donald Trump, who announced that there would be a tariff of 25% on the countries that decide to import crude oil from Venezuela, and that would be effective April 2. Now, which all Indian companies be impacted from this? First up is ONGC. ONGC has one subsidiary with the name of ONGC Videsh, which has 2 production units in Venezuela that produces crude oil. Second is ONGC was expecting to get its dues of $500 million from Venezuela in the form of additional crude, and that is also likely to be impacted. Second, the companies which are going to be impacted are oil marketing companies IOC, BPCL and HPCL. In 2024, OMCs, or say India, imported 22 million barrels of crude oil from Venezuela, which formed 1.5% of total purchases that the country has made in 2024. So it's very minor if you consider the total purchase of crude oil that India has done, but nevertheless, it's an impact. Now, the important part is last month, that is in February 2025, Oil Minister had commented that India is looking to increase the crude oil imports from Venezuela, considering that Russian discount had narrowed after US sanctions, and that is unlikely to happen in near future with the US sanctions or say US tariff coming in. So companies which are going to be impacted are ONGC, IOC, BPCL and HPCL.
So many thanks for joining us. US officials, including the Assistant US Trade Representative in India, to take forward negotiations and talks around the trade deal between India and the US. This is, of course, a 4-day visit, and the ongoing tariff battle will be one of the key issues on the agenda. Abhimanyu standing by. Abhimanyu, reports suggest that India has agreed to tariff cuts across almost 55% of what the trade is with the US. Take us through the details, if any.
An American delegation is visiting New Delhi for trade talks between both the countries. This is not the first round of negotiations. What government sources have indicated so far is that India and the US are going to finalize the contours, the negotiation schedule and the terms of reference of the proposed bilateral trade agreement between both the countries, which is likely to be finalized in 2 tranches. The first phase of the BTA is expected to focus on issues pertaining to goods trade. What we have learned from sources so far is that the US has sought greater market access in certain industrial goods, automobiles, wines and agriculture, and India may seek duty cuts in labor-intensive sectors like textiles. Now, both the sides are trying to find a common ground based on each other's strengths, weaknesses and sensitivities to create synergy for two-way trade and investments, as well as for predictability in tariffs, regulations and economic integration. More clarity is expected by the end of this week. It remains to be seen how the talks are going to pan out, based on which the negotiation schedule is going to be made.
Abhimanyu, many thanks for joining us. The Lok Sabha has passed the finance bill. Speaking in Parliament, Finance Minister Nirmala Sitharaman highlighted measures taken to rationalize the tariffs regime. She also defended the changes to the income tax law, which allow tax officers access to email and social media data, essentially saying that this is a clarification and nothing new.
The WhatsApp group of key persons include many professionals also, unfortunately. So we had to contemplate on how to be lawfully on the side of law to say that these evidences which are incriminating in themselves, therefore it has been brought in. I can also give one more, which is evidences have been found with the help of Google Map History. So in the case of Google Map History, sir, found on the phone was used to determine the frequented locations of individuals who enabled location history. This enabled detection of hideouts where cash and unaccounted transactions are kept, and that also came of help. So there is a need for us to change or add the digital elements into the Act itself.
Well, the race to acquire JP Associates heating up, so they told CNBC-TV18 that over 20 suitors led by the Adani Group, JSW, Vedanta are likely to join the bidding process. We've also learned that more suitors are likely to come forward and submit their expression of interest by the end of the day. Ritu joins us now with more. Ritu, long line of potential suitors there.
That's right, over 24 suitors, including some of the country's biggest conglomerates, are lining up to acquire Jayaprakash Associates under the bankruptcy law. We understand names like Adani Group, JSW Group, Vedanta Group, Oberoi Realty and Wellspun are just some of the nearly 25 potential bidders that are expected to submit expressions of interest today. Now, we've been reporting the deadline for EOI submission, which has already been extended twice, closes finally later today, and banks do anticipate a few last-minute entries as well. Keep in mind, however, that NCLT has ruled out bids for individual business clusters, meaning suitors must now bid for the entire company, including its interests in real estate, cement, hospitality, engineering, construction, and so on. And the company does have some prized real estate and cement holdings that is sure to attract the suitors. There is also huge debt at stake. Jayaprakash Associates is facing claims of more than 57,000 crores under the IBC. Now, we had earlier reported that the SBI-led consortium of lenders had sold their stressed exposure to the National Asset Reconstruction Company and already received about 1,800 crores in cash recovery, which will reflect in the current quarter. Now, that said, this is just the EOI stage. The real test comes next when final bids are invited, and we'll see how many of these 20 or 24 plus suitors put serious offers on the table.
Ritu, many thanks for joining us. The government is likely to go slow on selling minority stakes in public sector undertakings. Sapna Das is standing by with more details. Sapna, what are you hearing?
Well, we have been clearly given to understand that probably government will like to go slow as far its offer for sales program is concerned in terms of the minority stake sales in CPSEs. We are given to understand that probably a month or 2 months deferment is on the cards or has already been worked out given the state of the markets, the market volatility. So this is a time period that probably the government would like to play safe and avoid bringing out OFSs, no matter even if they are small in size like 2% or 3 odd %. It's something that the government will like to strike a cautious note on that. So that's one. Second, of course, this entire financial year, the focus has been on CPSE dividends. It was the case last year also, but more or less, of rather heightened interest in the current financial year. So given to understand that by March 31, around 1.40 lakh crore worth of dividends by CPSEs is likely to be given to all the investors across the board. Of course, the government share as of now from the CPSE dividend stands around close to 70,000 crores. So that's a healthy number that we're looking at. So any kind of a divestment shortfall, of course, will be made up through this. But as far as the OFS program is concerned of the government, most likely April, May, next financial year, we'll have some clarity. But a month or 2 months deferment probably has already been worked out.
Sapna, many thanks. Now, demand for consumer spending has been muted in the fourth quarter. Retailers Association says that whether it's electronics or apparel, they've seen very low growth. In fact, Electronic Mart of India has said pretty much the same thing. Let's listen in.
See, after witnessing a little bit of disappointing third quarter, so this fourth quarter is quite promising, and we did see decent demand for the consumer durables in the fourth quarter of this year. See, for the next year, at the company level, we are expecting mid-single digit SSG.
Well, I think overall, when I take into account all the categories, what we have seen is a very subdued growth in Q4. Some categories, obviously, like food and grocery, has remained steady, mid-single digits in terms of growth. The apparel industry is close to zero in terms of growth.
Well, concerns there over consumer demand. Rekha Gupta, Delhi's Chief Minister, presents her maiden budget with an outlay of 1 lakh crore rupees. That and more coming up on Business 360.
Today, we're delighted to report that Hyundai is announcing a major $5.8 billion investment in American manufacturing. In particular, Hyundai will be building a brand new steel plant in Louisiana, which will produce more than 2.7 million metric tons of steel a year, creating more than 1,400 jobs.
My understanding is that India imports close to about 0.2 to 0.25 million barrels a day of oil from Venezuela. When you consider that India's total imports are in the range of around 4.5 million barrels of oil per day, obviously it is a relatively small percentage compared to the percentage from, let's say, Middle East or even Russia, for that matter. But the fact is that if the condition for avoiding this additional 25% tariff is that this oil will have to be replaced, then that's an additional sourcing that you will have to find from somewhere. From a supply security perspective, I guess because it's less than 5% or less than 4% of our overall crude slate, it's something that I think India can figure out how to basically manage this hit, from what we can tell.
If you're booking an Ola, Uber or Rapido in Hyderabad, it could be a sweltering ride. Cab drivers have launched a no AC campaign, refusing to turn on air conditioning to highlight their financial struggles. For many drivers at ride-hailing platforms, driving a cab is no longer financially viable. After operational costs and platform commissions, they're often left with earnings that barely cover their daily expenses, forcing them to make tough choices like turning off the AC. And so the Telangana Gig and Platform Workers Union has launched this no AC campaign. What are their concerns? Fuel prices are high and running AC means burning more fuel, making trips less profitable. Second is low earnings. Drivers say Ola and Uber take 30 to 40% of the fare, leaving them with just 10 to 12 rupees per kilometer. But operating costs with the AC turned on rise to 16 to 18 rupees per kilometer. Essentially, the driver is left with very little in hand. And so drivers are demanding higher base fares to cover rising costs, lower platform commissions and government regulations to ensure fair pay. The union is also pushing for a Telangana gig workers' rights bill, and if their concerns aren't addressed, they plan to escalate the protests nationwide. While Hyderabad's campaign is making headlines, this isn't new. It has been happening in Hyderabad and even Bengaluru. Drivers in Bengaluru
Delhi's Chief Minister Rekha Gupta has presented the Delhi budget with an outlay of 1 lakh crore rupees, 5,100 crores. Of course, the state government has allotted 5,100 crore rupees for monthly cash allowance to women and 50,000 CCTV cameras across Delhi for women's safety. Timsi Jaipuria standing by with the details.
Delhi Chief Minister Rekha Gupta, who also holds the finance portfolio, proposed an outlay of 1 lakh crore rupees, which is a 31% higher allocation compared to Aam Aadmi Party government's full-term budget, which was presented in March last year. Now, here's a quick look at the top 10 highlights of the Delhi's budget. The government has allocated 2,144 crore rupees under the Ayushman Bharat Pradhan Mantri Jan Arogya Yojana. The scheme provides a 5 lakh rupee top-up from the Delhi government in addition to the centre's 5 lakh rupee health insurance coverage. 5,100 crore rupees has been allocated for the Mahila Samriddhi scheme, which would provide a monthly allowance of 2,500 rupees to eligible women. The budget has also set aside 300 crore rupees for measures towards curbing air pollution, but there is no concrete plan or details in the budget. The Delhi government has also allocated 6,897 crore rupees for MCD. Chief Minister Rekha Gupta said that the majority of these funds will be used towards redeveloping roads and sewage system across the capital. Over 3,800 crore rupees has been allocated for flyovers and infrastructure. Chief Minister Rekha Gupta has also announced a common free bus pass to commute across the national capital for women. The pink passes, which were introduced by the erstwhile Aam Aadmi Party government, will now be discontinued. When it comes to Yamuna cleaning, the BJP government has allocated 500 crore rupees, proposing that only treated water enters the river Yamuna through the decentralization of 40 sewage treatment plants. An additional 500 crore rupees has also been earmarked for the repair and upgradation of the sewage treatment plants. Apart from this, the government has allocated 9,000 crore rupees for schemes related to clean drinking water and sanitation. The Chief Minister has also allocated 750 crore rupees for providing free laptops to select group of students who pass the 10th standard exams. The initial beneficiary list may cover around 1,200 students. So that's all to encapsulate the top highlights.
Timsi, many thanks for joining us. Artificial intelligence and quantum computing are the buzzwords driving conversations and global innovation today. But India has a long distance to go when it comes to research. Shivani Bajaj tells you why.
AI is already reshaping our polity, our economy, our security, and even our society. AI is writing the code for humanity.
India has big ambitions for its role in the global artificial intelligence race and in building applications to accelerate the use cases for AI. When it comes to AI research, the numbers tell the story. Budget 2025-26 allocated 500 crore rupees for the Center of Excellence in AI for Education, aiming to enhance skills, personalize learning, and transform the educational landscape. Additionally, the government proposed a deep tech fund of funds of 20,000 crore rupees, approximately $2.3 billion, to spearhead the next generation of startups and translate ideas into tangible outcomes. But there is still a gaping gap in this area. Data shows that as of 2022, China accounted for 61.3% of all AI patents awarded globally. USA accounted for 20.9% and India a mere 0.23%. Ashoka University is looking to address this gap in AI research.
Ashoka is that students come in the first year not committing to any particular subject. They learn a very large range of subjects in the first year, which go from literature, history, economics, psychology, and the sciences, and then commit to an education in computer science and data sciences. The school will ensure that the students, after having learnt the general context of the various different areas in which computer science and data sciences can be applied, then learn the basics of the subject to find out how AI and related data, related activities can be applied to all these diverse areas.
Its new School of Advanced Computing aims to fill a crucial gap in India's AI research by integrating computing with social sciences, healthcare and ethics. Over the next 5 years, Ashoka University plans to raise 250 crore rupees to support the expansion of the school, pioneering research and attracting top-tier faculty, students and researchers from across the world. Experts say that while such initiatives are needed, there is a greater need for sustained and substantial funding to help India compete on a global stage.
I think we certainly need financial resources. You mentioned the 250 crore number, but it's really a drop in the ocean. You can't do much with that kind of money, with the kind of work that is going on around the world. Individual companies, small companies are spending a lot more money. I think the challenge for us is really as a country, even as a university and as entities in India, is how do you do more with less? How do you pick your battles? Where do we focus on so that even with our meager resources we can have disproportionate impact? And I think that's true for Ashoka. I think that's true for our country. The other challenge is that if we don't do it, we'll be saddled with solutions that come from other parts of the world. So our diseases are going to be diagnosed by AI that has learned on the Western patients. And so it will by definition be flawed.
They say that the road ahead requires stronger public-private partnerships and a sharper focus on India-specific AI applications, from local language processing to healthcare models tailored for Indian conditions. India's efforts in building AI infrastructure, AI chip procurement and computing capacity will not be enough unless it works on bolstering three crucial elements: large volumes of proprietary data, homegrown and properly upskilled talent and R&D across the facets of the AI stack. In New Delhi, Shivani Bajaj.
Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned.
Stopped using ACs for more than a year. In 2024, drivers even demanded 5 rupees per kilometer extra for AC rides, but this wasn't officially implemented by ride-hailing apps. Most drivers just simply refuse to switch on the AC unless riders insist, and even then, some decline. Now, as the mercury rises, so have passenger complaints. This begs the bigger debate, which is who pays for the AC. Passengers expect an AC cab, especially in the scorching summer heat. Drivers say they can't afford it unless fares increase. Ola, Uber, Rapido haven't provided a clear solution. No pricing model for AC usage, no opt-in feature either. So should drivers absorb the cost or should riders pay extra? Let us know what you think in the comments below. There doesn't seem to be an easy resolution to this tug-of-war. Perhaps us riders should consider investing in one of those handheld fans for now.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. Zepto plans a $250 million secondary share sale to boost Indian investor ownership ahead of its IPO in 2026. Sources tell CNBC-TV18 the private equity arms of Motilal Oswal and Edelweiss Financial Services are in discussions to buy shares in the secondary sale.
Grow Indigo, an agri-tech startup, has raised $10 million from British International Investment to accelerate the expansion of its sustainability programs across India, with 4 carbon farming projects at different stages of development and the first carbon credits expected to be issued soon. Grow Indigo aims to enroll millions of farmers and acres within the next 2 years.
Irame.ai, an AI-powered enterprise productivity and audit intelligence platform, has secured $1 million in seed funding from Sense AI Ventures. The investment will be used to scale its AI-driven audit intelligence across enterprises, expand its capabilities, and set new benchmarks for governance and compliance automation.
Chinese artificial intelligence startup DeepSeek released a major upgrade to its V3 large language model, intensifying competition with US tech leaders like OpenAI and Anthropic. The new model, DeepSeek V3-0324, was made available through AI development platform Hugging Face.
Xiaomi has raised $5.5 billion in an upsized share sale as the company pushes forward with its ambitious electric vehicle manufacturing plans. The company sold 800 million shares at 53.25 Hong Kong dollars each. There were more than 200 investors who placed orders during the book building process, and the book was multiple times oversubscribed, Reuters reported.
Those were the headlines that we're tracking for you from the startup world. But on what's brewing today, quick commerce startup Zepto is in talks for current stockholders to sell as much as $250 million of their equity. The move comes ahead of the company's plan for an IPO later this year. Aishwarya Anand joins us now with the details. Aishwarya, what are you picking up?
Quick commerce unicorn Zepto is in talks with current stakeholders, including private equity arms of Motilal Oswal Financial Services and Edelweiss Financial Services, to sell as much as $250 million of their equity in the secondary sale, sources have confirmed to CNBC-TV18. Now, this move is aimed at increasing shareholding by Indian investors ahead of Zepto's IPO in 2026. The company is aiming to execute transactions at a valuation of just over $5 billion, sources added, saying Indian shareholders currently account for about 33% of Zepto's cap table, with founders Adit Palicha and Cavalier Vora owning about a fifth of the firm. The goal is to lift that overall proportion to about 50%. Zepto had completed its reverse flip from Singapore to India in January, having received formal approvals from Singaporean courts and NCLT. In November 2024, Zepto raised $350 million in its third funding round, which added to its impressive 2024 trajectory, which has seen the company raise over $1 billion. Back to you.
Thank you, Aishwarya, for those details. Appreciate you joining us. Also on What's Brewing, Narayana Health, one of India's leading hospital systems, W Health Ventures, a healthcare venture capital firm, and 2070 Health, a healthcare-focused venture studio, have come together and launched Everhope Oncology, a chain of medical and surgical oncology facilities. Everhope has secured $10 million in seed funding to establish medical and surgical cancer care facilities in Delhi and Mumbai, and plans to expand to 10 cities over the next 3 years. To elaborate more, joining me now are Viren Shetty, the Vice Chairman at Narayana Health, and Dr. Pankaj Jetwani, Managing Partner and at W Health Ventures. Gentlemen, welcome to Startup Street. Viren, let me start with you. What inspired Narayana Health to partner with W Health Ventures and 2070 Health to launch Everhope Oncology? Also, if you could take us through your model and the venture's offerings.
Sure. The genesis of this came with a conversation that I had with Pankaj when I told him that we're facing a major problem in that we are building such large hospitals, we're investing in all the highest and latest end technology, getting very expensive doctors who've trained at some of the top medical colleges all over the world and buying surgical robots. And yet people don't want to come to the hospital. They don't want to come and they don't want to get treated in a hospital-like environment. And then we realized that people want to be treated much closer to their home. They want to be treated in a retail setting. So I said, what can we do? As a hospital group, we have to not think about building things in hospitals? How do we go about it? And that was the genesis of the idea behind setting up this venture.
All right. Moving on to Dr. Pankaj now. Cancer care in India faces major challenges, like Viren also pointed out, from late detection to overburdening oncologists. How does Everhope Oncology plan to address these pressing issues? What are the offerings?
Yeah, look, I think the reality we're living today is that 150 million Indians who are alive today will have cancer at some point in their lives. And as a health system or as a society, we are not prepared. Patients with cancer not only go through their journeys of the clinical complex journeys that they also have to face a lot of uncertainty, anxiety, chaos, lack of clarity, and it doesn't have to be this way. With Everhope, we're trying to redesign what we know of cancer care today. We want to bring high quality cancer care, but bring it in an extremely patient-centric format, closer to the patient's homes. And as a platform, we will continue to work on early diagnosis, daycare, chemotherapy that is closer to patients' homes, as well as other modalities, including surgical care. You mentioned doctor shortage. There's a huge supply constraint in this equation. We don't have enough oncologists. And our desire at Everhope, right from the get-go, is we're actively looking, literally trying to hunt down highly entrepreneurial, like-minded oncologists who are interested in redesigning cancer care along with us and are interested in becoming business owners, right? So that's the mandate and thesis.
All right. Going back to Viren. Viren, affordability remains a huge barrier to cancer treatment in India. And, while you're starting with facilities in Delhi and Mumbai, plans are to expand to 10 cities in the next 3 years. How does Everhope Oncology plan to make advanced treatments more affordable to a wider population?
See, the largest components of cancer treatment are in the medicine cost. And the government has done a good job in trying to bring a lot more local sourcing in enabling companies to get the APIs done in India. So medicine costs are quite affordable. And with new medicines being added to DPCO, a lot of patients won't bear the burden of very high costs. And as it is in India, for the quality of care you get one of the lowest prices in the world. What we're trying to solve for is healthcare access. Not so much about whether I can afford oncology or not, but the biggest barrier most people face is taking their aunt, their nephew, their grandmother, their cousin, their neighbor to a hospital to get checked up. So we're hoping that by building much smaller facilities in much more convenient locations, closer to where people work or where they live, that stigma gets removed from accessing the first level of cancer care.
Okay. Dr. Pankaj, coming to you now, you've previously mentioned that global innovations like CAR-T therapy and daycare chemotherapy infusion centers. How do you see these advancements shaping the future of cancer care in India particularly?
Look, let me have you in on a secret that Viren made me aware of. If you're interested in a time machine to know the future of healthcare in India, all you have to do is get on a plane, right? Travel east or west, and you'll probably know what the future of healthcare might look like.
Okay.
I think there are 3 or 4 things that I think will happen. I think first we need to diagnose our patients early to improve their chances of recovering and living a healthy life, also reducing the cost of care. So I think there are interesting, low cost, more accurate, more convenient, broad-based screening technologies that are becoming more and more possible that I think will continue to scale in India. I think the second is daycare chemo will become the standard of care for chemotherapy delivery.
Okay.
It honestly very, very limited sense, no sense for most patients to get their chemotherapies in large hospitals. And I think this format, almost like a spa-like, comfortable, patient-centric setting, will become more and more common in India in the decades to come. And the third thing, could be wrong here, but I think we're seeing this massive demand in oncology will continue for the next decade, even more. At the same time, there's very limited supply of specialists. So this format I think will lead to the rise of single specialty oncology businesses like Everhope that will use technology to standardize care delivery, protocols that will use technology to enhance the patient experience So I think that will continue to happen. We'll see the rise of more single specialty oncology businesses that will continue to leverage to provide.
And one final question, Dr. Pankaj, before I let you go. How do you see Everhope Oncology scaling beyond India in the future? And if you could share with us your long-term vision and any targets.
Look, I think we're in a privileged position to work on an extremely large and hard societal problem. I think our eyes are set on India as a market. There's so much to do to meet the needs of 150 million Indians who are alive today who will get cancer at some point in their life. Long-term vision is very simple: to bring best-in-class, patient-centered, empathetic care closer to the patient's home.
All right. With that, I'll have to wrap up our conversation. Gentlemen, thank you for your time today and for joining us on Startup Street.
Thanks a lot. Thank you. Thanks, Vern.
Well, in other interesting data coming in, data intelligence platform Traction's latest geo-quarterly India Tech report shows India's tech startups have raised $2.5 billion in the first quarter of this calendar year, ranking third globally behind the US and the UK. Auto tech, enterprise applications and retail were the top performing sectors, with Delhi leading in total funding. Late-stage investments also surged, while seed and early-stage funding declined. The quarter saw about 6 IPOs and 38 acquisitions. But for more on the highlights from this report, I have with me Neha Singh, the co-founder of Traction. Neha, thanks very much for being with us here on CNBC-TV18. Begin by telling us about the key factors that contributed to India securing this kind of funding, surpassing the likes of Germany and others, despite the volatility that we're seeing in global funding.
Yeah, thanks a lot for having me. So yes, India did see, so India has today become one of the largest ecosystems, I would say, in terms of the startup activity, as well as in terms of, followed by the funding activity that has happened. So if you see Q1, that saw a total of $2.5 billion invested across over 250 rounds and multiple companies. So I think India has become, like, even if you look at the number of unicorn companies or the number of late-stage companies, private companies valued at over $1 billion, India today stacks at the third largest ecosystem that it has become. And similar is the following up in the terms of the funding round as well. So Q1, India saw a rank being third, behind only US and UK.
Neha, this very interesting trend that your report points out, late-stage funding surging, seed-stage funding dropping significantly in the quarter and year-on-year. Does this indicate any kind of a shift in investor risk appetite towards the more mature startups? And what does it mean for early-stage innovation and the startup pipeline sustainability in India?
Yeah. So the early-stage startup funding declined marginally. That's primarily because of the low volume that we saw, and that is likely to improve. The late-stage activity has saw, sort of uptick. And one of the reasons of that is funding that you saw in IPO-ready companies as well. So if you look at the last calendar year, 2024 was a very buoyant market for the Indian IPO market, right? And you saw a lot of companies which are venture and PE-backed, getting listed. So that provided, a good sort of success, a lot of examples. And that is why you also have a pipeline of companies which are mature enough and are looking to sort of hit the IPO market. So you saw some companies in rounds in some of the late stage companies, which also contributed to the uptick that you saw in the late stage funding overall.
Yeah. What was extraordinary was auto tech. The increasing funding sequentially, specifically in that, of course, some deals drove that. But are there specific innovations or market trends that are fueling this particular sector's growth? And do you expect this to continue?
Right. Yeah. So in terms of sectors, auto tech stood out, and primarily because on the back of, I would say electric vehicles. So that saw a few of the deals which have happened. Which is also supported by the government, but also in general, you saw this is a large theme that is happening globally. So auto tech was one of the sectors, followed by enterprise applications, and then B2B e-commerce. Interestingly, there are about 1 or 2 sectors that were also saw a lot of investor interest. So one of them being AI. So obviously AI is being talked about, across all. So globally, you saw a lot of funding happening in the AI space, in the infrastructure layer. In India, you saw funding happening in the applications layer. So, that was one of the sectors that saw a lot of investor interest. And the second was actually quick commerce. So, given that you've had obviously success of some of the large quick commerce players like a Blinkit or a Zepto or a Swiggy's Instamart, you also saw some of the companies emerge in various verticals. taking over, stab at quick commerce. So these were the two, large sectors that also saw a lot of investor interest.
Typically, even in terms of cities, Bengaluru keeps coming up on top when you talk about startups and funding. But your report says Delhi accounted for the major chunk of funding, nearly double that of Bangalore's. Is this just a short-term shift or part of a larger trend that you're seeing?
So that's an interesting point that you actually make. So if you look at across the last 4 quarters, if you look at like 2024, Bangalore was probably one of the most funded. This year, obviously, it started with Delhi and NCR being at the top of the charts in terms of total dollar raised. If you actually see the total number of deals, again, Bangalore kind of inched up over that ranking. So, but I would say, there's a fairly healthy mix that you also saw. So Delhi obviously has had a lot of good exits, right, in terms of the IPOs. And I think Bangalore is probably just starting on that way. But in terms of deal activity, I think, you'll continue to see a lot of deal activity continue to happen in Bangalore.
Oh, well, speaking of deal activity, Neha, the number of acquisitions also increased by about 41% over the previous year, 38 deals, including some large ones. Does this uptick in acquisition sort of indicate increased market consolidation? Do you expect that to also play out in the rest of the year?
Yeah, so that was an interesting trend that Q1 saw, which is the uptake in terms of the number of acquisition rounds. And also it was not just in terms of the number of acquisition, but it was also in terms of some of the sizable acquisitions that happened. So for instance, Minimalistic getting acquired by HUL or Wingify getting acquired. So you also saw some large acquisition happening. So I think that is good overall in terms of the startup ecosystem, because last year, for instance, was very buoyant in terms of the IPO as an exit market. And, now with a few successful M&As also happening, I think this actually provides a liquidity back into the investment ecosystem, right? So hopefully this will also, provide some exits to the LPs, and that dollar will get reinvested in the VC ecosystem.
All right, Neha, we'll leave it at that. Thank you very much for joining us here and sharing all of these insights. It was a pleasure speaking with you.
And with that, it is time for us to head into a short break. But coming up next, we dive into 11 Labs, the AI voice-over company that made waves after doing Prime Minister Modi's voice-over for a podcast with Lex Friedman. The company has also entered the Unicorn Club. Stay tuned for that discussion. Welcome back. You're still with us on Startup Street. Prime Minister Narendra Modi's recent interview with Lex Friedman made global headlines, not just for the depth of the conversation, but for what many are calling the best dubbing to date. 11 Labs was behind the hyper-realistic AI translation. And to talk to us about the future roadmap of the newly turned unicorn, I have Siddharth Srinivasan, the GTM of India 11 Labs. Siddharth, thank you so much for taking time out and being here with us on Startup Street. You know, this isn't the first leader you've used your AI translation tool for, right? You've also done it for Volodymyr Zelensky in the past as well. If you could sort of talk to us about how these projects came to be and the kind of demand that you're witnessing for your voice dubbing.
Hey, thank you so much for having me here. It's lovely to be on your show. You're right. You know, our partnership with Lex Friedman has actually been a few of these content pieces old. You know, we've done Volodymyr Zelensky, we have done Javier Milei, and now we had the privilege to do Mr. Modi for, I think, a really interesting and long-form piece of content. We're a 2-year-old company, and what we pride ourselves on is having really the best voice technology on the planet. We have millions of users all around the world, and I think as a natural consequence of that, over a period of time as the category leader, we found ourselves able to be on these kind of transformative and impactful projects. And so, you know, hopefully the audience, our mission is to really make sure that the content is available in every language and every voice. And so hopefully by participating in projects like these, we're able to take that piece of content and bring it to the audience in a more authentic experience, preserving the original voice.
Absolutely. And, you know, in just 2 years, you've become a unicorn, raising your last round of $180 million just a month back, right? If you could take us through how you've used these funds since you've raised them and, you know, what's new ahead for you? What's exciting for you going forward?
So, you know, in this category, you sort of hang your hat on the quality of your research, and that's what we primarily are. We are a research company. We're an AI audio lab, and we have some fantastic researchers, right from our founder, Piotr, who's on Time 100's top AI, personalities. And, you know, we start with that, and I think a lot of the funds that we have will really go into core research and infra. On top of that, you know, we are building enterprise-ready products today. So if you look at our workflows being used by, you know, Fortune 500 companies, we are investing a lot to sort of make sure that our technology is productized and reaches the hands of the users well. And the third part is really go-to-market. You know, I think maybe about 18 months back, we had 5 employees. Now we've got 150 employees. We are almost 10 people in India, in fact. And so a lot of these go into localization and investments, which make sure that our technology finds its hands in terms of the users for all of the fantastic use cases that we think we can power.
Absolutely. And, you know, before I delve deeper into the India market, right, if you could sort of just tell us how big is this AI voice market? If you could sort of, you know, take us through all the other offerings that you have as well. And how do you keep innovating to stay ahead of the big guys like Google, OpenAI, you know, and the likes of them? And how many languages are you available in?
Sounds good. That's many questions in one. Let me take them. So first of all, you know, I think what's really interesting is India has actually become our highest user market globally. From around November to around January, we actually saw 50% growth in usage. And, you know, that trend sort of continues, right? So it's a really voracious market when you sort of think of language solutions. And that's no surprise. We are a multicultural, multilingual, multi-dialect market. And so when you look at the technology that, you know, our founders sort of built out and our research team is building, which is essentially multi-language and multicultural at the heart of it, I think we had great product market fit right from the beginning. Today, when you look at the Indian story, you know, you sort of see us in really big media context. So, for example, you know, we're partnered, you know, with the fantastic folks at Star Cricket, where they're taking international cricketers and unlocking experiences in native Indian languages, making it really accessible. So that's an example. We work, for example, with partners like Cube Cinema, who actually drive accessibility and audio narration through the use of our technology on mainline film releases. So that's on one side. And on the other side, we're powering extremely large volumes of customer support across languages. So I think, you know, this is really a technology that was always had a market ready for it. And now the state of technology and product is able to sort of reach the final consumer. You know, if you sort of look at NASSCOM reports, you know, the estimates that this is maybe a $1.82 billion market by 2030. And I think, you know, it has the opportunity to be extremely large, and we're surely seeing that in our user base today. And so, yeah, I think what we are looking to do as we round up this year is to continue to innovate on really world-class research, you know, apart from having what we think are the best voice models in the world, the most expressive, the fastest voice models for real-time conversation, one of the simplest AI agent building platforms. We also just recently launched Scribe, which is actually available in 11 Indian languages. And in all of them, we think it has the highest accuracy compared to any other model that sort of takes your speech and maps it to text in the world, right? So that's something we launched. We've got sound effects models, and down this year, we're going to be innovating more on the model side. So I think you will see that happen. The second thing you will see on top of this world-class research is just great product, which allows for various dialects, languages in the India use case to reach the final consumer.
Right. And in 10 seconds, if you could tell us, what's the revenue target for this year and what about profitability?
These are things that we're not disclosing, but what we can say is we've got a great business model, we're well capitalized, and we're investing deep in India.
All right, Siddharth, thank you so much for joining us on the show. It was a pleasure talking to you, and we wish you all the best on your journey going forward.
Thank you for your time.
And with that, it is a wrap on this.
Curtains down on this edition of Startup Street. Well, more news and updates will continue on the other side. It's a goodbye from all of us. Thank you.
The shakeout has been good. It has tested you. It has, proven that you have a conviction in what you buy. And there's no something called easy money on the Lal Street, as everyone thinks that I buy today, make tomorrow, which had gone on for a few years. But all the veterans have told you that, wait, when the correction comes, people will panic. But I think if they hold true to the flag and, I think it's great. I think the domestic money prospering or domestic India is great. We welcome foreign money, we welcome foreign capital, but they have a right to sell, and I don't begrudge that. Okay. Market has a self-correcting mechanism. If you take stocks to unbelievable heights, the short seller will step in, or the promoters will sell in, or the insiders will sell in, and want to encash it. So that will act as a natural check on the market, which it has done. As long as there's not any undue amount of leverage in the system. There was, I think, 70,000 crores of margin funding, which is the size of a small mid-cap company in India today. So there's no leverage. The banking system has no leverage. The government had fiscal restraint. So, in fact, money was tight. So there was no reason to believe that this would be a long-lasting bear market. And market will correct itself. Anytime the valuations of something become excessive, people step in and sell, insiders sell, someone sells, and that creates a buying opportunity. First correction in 4 or 5 years, so it was particularly severe. And market correction is always severe. It always kind of panics you and tests your conviction, tests your patience, which is all the things that it did. But they are short, sharp, and swift. As you saw, the index fell very sharply and very swiftly, almost without respite, 800,000 points a day after that. But my feeling is that that is just a correction in a bull market, not the topping of a bull market. The reason I say that is even when the fall started, individual stocks were making new highs, new all-time highs. Bajaj Finance, United.
Single goes away. I know. I'm just.
Is fixated with the AI race and where India finds itself in the race at this point in time, what's happening globally. You know, it really depends on what tweet you're looking at and how quickly the world is changing depends on the news feed that you're broadcasting. But I've got a very astute set of panelists here with me, and we have 40 minutes. So without further ado, we're going to get cracking and get right to it. Vinod Dham, first of all, congratulations on your Padma Bhushan. So a big round of applause for Mr. Dham here. But if I could get started by talking to you about this AI race that we seem to be talking about at this point in time. One, where does India find itself in the race? Are we in the race? Are we outside of the race? Are we at the middle of the race? Number two, you know, what should we prioritize at this point in time from an Indian perspective as we talk about the AI landscape?
This is not the India I knew 15, 20 years ago. This is India where they are one step ahead of even the ideas the advisors are bringing from abroad, which is really a remarkable thing to be knowing. So anyway, I think what I would like to talk about is there are 4 things needed to really succeed. First, of course, is skills. Now, skills for AI, if you already have IT or software skills, are not that hard to transform to. The reason is, fundamentally, people who are in software and IT services have a computer science degree. And if you have learned linear algebra, you have learned statistics, you have learned calculus, you can very quickly learn how to build neural networks, learn about deep learning, do the backpropagation, and learn about transformers, which was a single seminary event that really created ChatGPT and this whole OpenAI phenomenon in November of 2022. So I think it's not that hard for our kids to learn this technology, and we have deep talent and very wide talent, and that's the biggest strength India has when it comes to AI today. Now, when it comes to models, of course, there are companies like OpenAI and now a host of other companies who are also creating models, Google being one of them. And then there are open source models like Llama and Mistral and Falcon. So
you didn't mention DeepSeek.
I'm sorry?
You didn't mention DeepSeek.
I will mention DeepSeek, and I'll take a second to, let me first deal with DeepSeek because it seems like it's a thing waiting to be talked about. I will let actually Ronnie talk about DeepSeek. He's an expert. But my view of DeepSeek that I deeply studied and all the paper they published and everything that went on, and me personally losing 18% of my value of NVIDIA stock for a stupid reason, is really DeepSeek was built on top of OpenAI's training. So it's not like DeepSeek existed in vacuum and they just came up with $6 million investment and showed us how to do inference. And by the way, it was an inference step where they did some reasoning and they paused, and they, of course, it required a lot of calculations and compute at that time as well. But really, DeepSeek is built upon OpenAI technology. It's built upon US technology. So I don't think they should, anyone should be misled to believe that by themselves, only with $6 million and 4 engineers, they came up with a thing like that.
Okay.
At least that's my view. I'll let Ronnie tell me whether I'm right or wrong.
Yeah, I'll get to Ronnie in just a second, but you want to finish your...
I want to. So I think India should approach models with a hybrid approach. That is, they should use open models. And since it's very expensive to build, by the way, models, LLMs, so we don't need to spend billions of dollars that Ronnie has spent already. We can just leverage that and then build models in our multilingual languages in a hybrid approach. So that's one thing. And we need those models for government, medical, military, defense, and they should be proprietary. We should not use Western models to do very confidential things that we need in this country. Okay. And the last 2 points are, you need lots of compute, and to run the compute, you need lots of energy. And lots of compute being, we need lots of GPUs. And one of my recommendations would be, beyond the government of India really doing some private-public partnerships, do an ISM-type funding. You know, the government of India, mighty, came up with $30 billion funding for semiconductor program. I think AI will need a similar kind of funding for next 3 years, $50, $100 billion type of investment to really run this marathon and stay competitive in this marathon. And energy is an important thing because these chips need a lot of power to run, and we will need to multiply our energy sources.
Well, thank you very much for setting the context for the conversation that we're about to have. So the big advantage really lies on the skills side. The big ask at this point in time is on infrastructure. Ronnie, I'll come to you in a second, but let me get Minister Vaishnav to respond to what we've just heard there from Vinod Dham. Minister Vaishnav, 1 year of the India AI mission, 14,000 GPUs on the table. You got a round of applause on that, but the ask now from Vinod Dham is we need the government to back this up with at least $20 to $30 billion of investment on the infrastructure side, do a semiconductor mission as far as the AI mission is concerned. Can you draw parallels with the experience that you've had on the semicon side? Can we expect you to replicate that on the AI side?
Absolutely, yes. And I thank Vinod for such a nice way of structuring the entire context. One, making GPUs available as a common compute facility. That's done. 14,000 GPUs already inaugurated. Two, the most important part of the entire AI journey is getting the data sets. So we have set up a common compute kind of structure called AI Kosh. That is also done. And today morning we signed an MOU, the India AI Mission and the Indian Parliament. We signed an MOU. So because Parliament has a very large data set in multiple languages over a period of time. So that will be a very good training resource for training our models. That's done. And many more other, like Doordarshan, All India Radio. There are many other sources of data which is available. Third, getting our own GPU chip. That's very, very important. And we have already started working on it, working with the industry, evaluating different options that we have. And we got really good, bright professors, bright startups who are willing to contribute to that journey. So that is also in place now. Hopefully, we should be able to finalize the best option very soon. Fourth, having our own LLM, because whatever the world says, if it's open source today, it may not remain open source tomorrow, which we have seen in the case of OpenAI. I think we should also change the name. Better to have our own LLM. I don't think we should be shying away from that. So I think we are taking the problem in a very methodical, very systematic way. The part on talent is very important, and that's where we have a major advantage. And we have a template in front of us. In case of 5G, we set up 100 labs in universities so that the students can actually learn it on the real 5G environment, real tools. In case of semiconductors, 240 universities and institutes combined, 240 institutes we gave the latest EDA tools so that the students can actually learn what is a chip, how to design it, and really get their hands, get the real experience. Similar approach we are following on AI also. So I think we'll be in a good shape, I would say.
On the GPU, Mr. Vaishnav, a broad timeline by when you expect to finalize who you choose to partner with, just give some color on what we should expect on that front.
In short, 3 to 5 years, 3 to 4 years, I would say, to get your good, reasonably good capability GPU up and running. The approaches, basically there are two approaches which we are evaluating seriously, two different types of instruction sets. Which one we will finalize, or will we take both the instruction sets and move forward? that is something which the expert.
Ronnie, let me come to you now. Number one, are we likely to see a name change anytime soon? But more importantly, I want you to put on your OpenAI hat, but I also want you to put on your former White House CHIPS Act coordinator hat and tell us what you believe the future holds as far as public-private partnership is concerned, and how do you believe it's likely to play out for an emerging economy like India? How important will that be?
Well, Shireen, first, thanks for having me, and it's an honor to be on a panel with Vinod, who's the father of the Pentium chip, one of the greatest innovators and investors, and the Honorable Minister, who's really leading the way around technology transformation in India. We've been here basically to listen, to understand what's going on in this market, and it's incredibly impressive. So when you think about the meetings we've had over the last couple of days, one, the Honorable Minister mentioned data sets, huge ingredient to building large language models. And India, and the government in particular, has done a fantastic job in terms of making those data sets, public data sets, more available, which is going to be really important to the future of AI. Two, people. I mean, I heard a statistic today that India graduates about 1 million or more STEM graduates every year, depending on how you identify STEM. And when you think about the talent base and their ability to adjust to what's hot in the market, that's an amazing advantage. Even when we talk about the transitions that are going to have to happen around the world because of AI, if you have 1 million people coming out every year with a new set of skills and a population of 30 years old or younger for the next 30 years, it's a huge opportunity for India to stay on the cutting edge. So you have that ingredient too. And now these investments in AI infrastructure, which is such an important piece of it, the data centers, the GPUs, the energy hookup. I mean, even on the stage, we've now launched a new AI infrastructure initiative. So we're making good progress. Here's the things I think are really interesting in India. One is, what are those killer applications going to be? When you think about the impact of AI on the economy, us economists, I'm very sorry, we're all over the place. We predict it'll be 1% of GDP, 30% of GDP. People have tons of different estimates. Why is that? Because we're still figuring out how this is being used in organizations. We're still seeing frictions to adoption in government, in business, into SMEs. But over time, you'll see a convergence on a huge economic impact. The question is, what are those applications and key verticals going to be? In India, it could be in education. It could be in defense or healthcare. It's going to be up to the people in the Racina Dialogue audience and around the country to figure that out. As someone who led the implementation of the CHIPS Act in the last administration in the United States, I can tell you I see a focus around the world, not just the United States and India, around investments in critical technologies, supply chains, infrastructure. And I think it's reflective of a world where national security and the subject of this conference, geoeconomics, is becoming predominant. When I did my PhD, we lived in a world that was very globalized, where everything was about sort of knocking down barriers, trading, right, and assuming the best intents of countries around the world. Now we're entering into an era of more contention, nationalism, populism, and you're seeing countries around the world adjust accordingly. It doesn't mean to me, though, that the US and India can't have a very strong relationship and that OpenAI can't be a good part of it. I don't expect any name change for OpenAI, but ChatGPT might be called Chatterjee GPT. But that is what I will promise the Honorable Minister, okay? That's my own.
Well, we look forward to that. But Mr. Vaishnav, that's a very important point that Ronnie mentioned there. You know, in the world that we live in today, when we're talking about the escalation of tariff wars, we're talking about export controls, and which is why Mr. Dham is suggesting that you need to focus on proprietary technology, proprietary models. I want to understand from you, you know, the partnership between India and the US, how do we build on that? We've had a partnership which is, of course, but in an AI era, in an AI age, what can India and the US do together? What do you foresee on that front?
I think we have very complementary strengths between India and US. If you look at it, today Stanford University ranks India as the biggest talent concentration in terms of AI. Every country needs the talent. Second, the diversity that we have, the kind of rich data we have, that would be one of the greatest resource for any country which wants to be in the race of AI too. Third, the way we have developed our relationship with the US, where the foundation of the relationship is trust. The foundation of the relationship is respect for IP rights. The foundation of relationship is to co-create and co-develop technologies. That thing is something which has happened over a period of last 10 years, and that is a very big strength for both the countries. I think the two of us will do a lot of things together. I think that will be a good win-win for the entire world.
But you don't believe that Make America Great Again could overshadow this partnership that you speak of?
See, I think today's world is quite different from the past when it was win-lose kind of situation. In the world of technology, I think it's more of win-win, and the pragmatism with which we are approaching our foreign policy, our Prime Minister is very clear in his mind, and our External Affairs Minister has a very practical approach. So with those two major ingredients, where we are looking at what can, how both the countries can really win and create things which are good for the humanity, good for the two countries, and they are following some of the most basic principles which in the world of technology are very important.
Let's talk about the capital that's going in. And I think, Ronnie, the question that's being asked today, and it's being asked by corporations, it's being asked by governments, is what is the return on investment? Stargate, $500 billion. What is going to be the timeline before we start to see a return on investments? How do you respond to the in-between phase of where you've got to put the capital in the hope of being able to see returns at the end of it?
So, I mean, the first thing I did when I took the job as the chief economist, I'm the first chief economist at OpenAI, so there wasn't really a predecessor. I spent time talking to the technologists and the people who are building these large language models. And those folks, they live in the future. You have to do that work, you have to live in the future and see the future in some ways. And when you understand the revolution that's happened over the last 2 or 3 years, where the capabilities of our models have grown so fast, things that people thought were impossible in the models are now possible. You start to understand that, the laws of scaling, as they're referred to, are going to require more compute. And that's why, as a company, right, we believe that infrastructure is destiny, and the investments in Stargate, properly calibrated with milestones in the right places at the right time, will make good sense. Now, there's been lots of challenges to these scaling laws over time, and you mentioned before, of course, the DeepSeek example. But even with our new models, our reasoning models, and you're seeing this rise of test time compute and the power of inference, which is also going to use a lot of compute. To me, just as Vinod said, I'm actually not too worried about these challenges to compute, because I think, as an economist, the cost of intelligence going down, the cost of compute going down is a good thing. And in fact, we're going to have so many applications to use it. Think about the applications that were already mentioned. I'll give you one more. In villages in India, when a child is born, we heard about this earlier today, there's often a question about low birth weight. But nobody knows exactly what the cutoff is and how to properly weigh the child. And you all know, if you're from India, some of the superstitions around handling children in that stage or having strangers handle a child. Well, now you can take a picture of that child, right, in a privacy-controlled way, and estimate the weight very precisely, which allows a healthcare worker, without visiting that village, to figure out whether the child is underweight and needs further medical attention. It's those kinds of innovations that can make the impact you're talking about. They don't require massive infrastructure investments yet, but they can be really useful. So this is kind of where I see a lot of opportunity here. If India decides also that this AI infrastructure bet is one they want to make, that's fantastic as well. But in the US, as we saw it, based on where the models are going, we think the return on investment is going to be very positive in the next 5 years.
I'd just like to add, I mean, the talk in the media on the ROI is that if you just imagine the next move in AI is agentic models. Yeah. And that's, agent is like a human. Just think of it like that. And if you have 10 agents working together, there are 10 humans working together. If they can create an output which can save, let's say at the minimum, one head count. One head count is like, in American terms, they talk about $10,000 a year, which is a reasonable number. Right? If you save $10,000 a year for a company, and you charge them $2,000 instead, which is a 5x saving for them, which is Microsoft charging its Copilot $250 a month. Suddenly their revenues and profitability will skyrocket. So this is the kind of thinking. I'm not saying it's going to come to fruition,
yeah,
but at least there is a
that's the bet.
thinking going on ROI as to how you're going to get there.
That's the assumption. Mr. Vaishnav, let me come to you, sir, to really get a summation, so to speak, of what you've heard from these two gentlemen here, but more importantly also your vision as far as the next year of the AI mission is concerned. What should we expect as the short-term milestones? What should we expect as the medium-term milestones? What should we expect as the long-term milestones?
For summary, go to OpenAI, ChatGPT.
We need a proprietary vision, sir.
Immediate term, we must get our startups and academia and researchers and students the right tools, the right skill sets, making sure that our IT industry is geared up for taking it up as an opportunity rather than thinking of it as a big challenge. That is the immediate term goal. Mid-term focuses on getting the LLM in place, making sure that our GPU strategy is progressing well, making sure that our universities have changed their course curriculums so that they are able to generate a continuous stream of well-trained, great talent. That is the midterm. Long-term, of course, we need to keep our eyes focused on our goal of 2047. We definitely want to take lead in some of the most important technologies.
You know, and again, I want to just go back to that 2047 goal as well and link that to what we heard there from Ronnie in terms of economic impact. There are assumptions that, economists are working with. What's the assumption that you're working with on how much AI and the transformative impact of AI you can harness to be able to get to the 2047 goals, sir?
See, when new technologies come, getting the ROI equation solved for it, I don't think that's the absolutely the right approach. I think when new technology comes, we must invest in it. We may not know what exactly the returns would be, but for a country or for a company or for an organization to be able to compete ahead, that investment in technology must be continuous, for sure. How AI will play out in the next 20, 30 years, I think it will be something that we'll have to kind of modulate our approach. We'll have to see how it plays out. As I said, this is just the chapter 1. And as AI evolves, and there's going to be a lot of mathematical innovation which will go into this. I remember my IIT days where I built the first text-to-sound transformer, that T in GPT, right? So that transformer which I built, from those days things have changed a lot. But some of the fundamental math behind neural networks, some of the fundamental math behind AI, that remains constant. So that math, when it gets applied into the newer AI models, that's going to bring about changes which we, at this point of time, we can't even imagine. What I would say is embrace technology, use it properly, make sure that it is good for society, and make sure that the harms which can come from it are also controlled.
I'm going to end by asking you, because I know the minister has a hard stop at 6:40. Are we in the race? Are we at the starting point? Where are we today?
We are very much in the race. We are in the first inning of the race, not at the starting point. And like Ashwini said, it's a multi-inning race. This will go on for a long time. And we need to just stay there and continue to invest appropriately and make sure we don't fall too far behind.
I'm glad that you've moved from race to cricket, which is probably appropriate of an analogy to close the conversation when we talk about where India finds itself, the role and relevance of AI. Ronnie, I'll give you the final word.
Well, first, just thank you. And I think going back to the IIT Energy, the students and young people in India are really the future in a big way. And I think leveraging the universities to produce cutting-edge innovation, to improve on this is something that's worked in other parts of the world. And I think that's another opportunity here with India, given how many people are going to university and the kind of research happening at institutions all around the country. So I'm just excited to watch and support however I can.
All right, gentlemen, thank you very, very much for joining us here.
Hello and welcome to On the Record with me, Shireen Bhan. Vedanta is gearing up for a demerger that will create 4 independent entities with a focus on aluminum, oil and gas, power, iron and steel and base metals. Vedanta's shareholders as well as creditors have already approved the plan, and the demerger process could be completed by the first quarter of the next fiscal. Chairman Anil Agarwal, in a letter to investors, said that each of the new companies has the potential to grow into a $100 billion company. He also compared Vedanta to a banyan tree while advocating for the demerger. He said, and I quote, "I've always found the trees that grow under the shade of a giant banyan tree often find it difficult to grow, but once you take them out and allow them to grow under the sun, they show remarkable growth and progress." End of quote. Chairman Anil Agarwal joins me now on the record. Mr. Agarwal, always a pleasure. Many thanks for joining us here on the program. So let me start by using your analogy of the banyan tree. As you go about this demerger process, Mr. Agarwal, do you believe that each of these businesses has strong enough roots to exist outside of the shade of the big banyan tree?
Absolutely, because if you see all our business, whether you talk oil and gas, tremendous potential in India, and we have a best anchorage. If you look at the aluminum, we completing 30 lakhs ton production, adding 30 lakhs ton more, huge potential. Zinc, if you look at zinc, which will be part of our main company, we are producing 1.2 million ton, going to produce 3 million ton. Copper is such an important metal. We are going to produce almost 500,000 ton copper. The growth on this, any country which developing to developed country goes, it all goes fundamental. We have seen is all about below the ground. Below the ground, we have a tremendous geology. I always say that. And today, the way the government is working on below the ground, because we need it, this is a transition material. To create the world better, you need this metal. Without this, world can't work, especially India. India is a developing country. So we are very excited about this growth and making these 4 companies separate, making a very professional management. They will take this company forward at a different level.
Well, speaking about taking these companies forward, sir, let me break up each of these businesses, and let's start by talking about the aluminum business, because that is a lion's share as far as your EBITDA is concerned. You talked about adding 30 lakh tons. By when do we expect this capacity expansion to take place? What's the time period? If you can share that with us. And also, in terms of growing the EBITDA, Q3 EBITDA was at 4,540 crores out of the total Q3 EBITDA of 11,280 crores. That was the contribution of the aluminum division. What can this be potentially post the kind of expansion you spoke to us about?
Yeah, I think each of our business will have the same level of EBITDA. We work on around 35% margin. All our product is about 35% margin. As far as the aluminum is concerned,
EY Entrepreneur of the Year is the world's most prestigious business award for entrepreneurs. As the first and only truly global business award of its kind, EY Entrepreneur of the Year encourages entrepreneurial activity among those with potential and recognizes the contribution of people who inspire others with their vision, leadership, and achievement. The 26th edition of EY Entrepreneur of the Year 2024 India Awards celebrated the shapers of India's future. Selected from over 300 nominations, these trailblazing finalists are fueling India's economic growth and prosperity through transformative ideas and purposeful leadership. And the India winner will compete at the EY World Entrepreneur of the Year Awards in Monte Carlo in June 2025.
Good evening and welcome to the 26th edition of the EY Entrepreneur of the Year Awards 2024. To kick off this glittering evening, I would like to now invite on stage the Chairman and CEO of EY India, Mr. Rajiv Memani.
Ladies and gentlemen, a very, very warm welcome to all of you. The EY Awards are a celebration of entrepreneurship. 3 decades back, we started these awards globally with the belief that entrepreneurs are the bedrock of society and a fast-growing economy. Yet their contributions are often not adequately recognized or celebrated. With the same purpose, we started the awards in India 26 years ago as a humble tribute to all of you who are in the room today. You're India's biggest competitive advantage and economic force multipliers. And finally, big congratulations to all the award finalists. You exemplify the qualities of what entrepreneurship stands for. All of you have taken the offbeat journeys, unleashed change in your industry or business, and created scale and an unbeatable moat through that transformation. May I request everyone to give a big round of applause to all our finalists today. And with that, I would like to thank you all once again for joining us and wishing you a great evening ahead. We shall now play the video message from Shri Piyush Goyal.
A big, big congratulations to all the award winners. This award is more than just an accolade. It's a global beacon of innovation, celebrating those who redefine the power of possibilities. I commend Ernst & Young on this event's 26th edition, a testament to its excellence. Congratulations to our India's risk takers and record makers who turn ideas into industry, dreams into disruptions, and challenges into opportunities.
And with that now, it is my pleasure to introduce to you our chief guest of the evening. Please welcome with a huge round of applause the Honorable Minister for Environment, Forest and Climate Change, Shri Bhupender Yadav.
जिन एंटरप्रेन्योर्स को प्राइज मिले हैं, उनमें जो सफल होने की बात मैं देख रहा था, वो सबसे बड़ी बात है कि हर एक की सफलता के पीछे भारत का पिछले 10 साल में जो डिजिटल एम्पावरमेंट हुआ है, उसके कारण में सबकी सफलता की कहानी भी छिपी हुई नज़र आ रही है। चाहे मेक माई ट्रिप हो, चाहे रियल एस्टेट का विषय हो, चाहे हेल्थ केयर के विषय हो, जितनी भी सक्सेस स्टोरी है, हमारा जो डिजिटल प्रोग्रेस जो हमने एक बहुत साउंड तरीके से किया है, और ये आज आप लोग यहाँ पर बैठे हैं, EY के जो देश के प्रमुख चुनिंदा लोग हैं, आप बैठे हैं, लेकिन मैं आपको हिंदुस्तान के बहुत दूर गांव की कहानी में भी मैं बताऊंगा कि वहाँ के भी नौजवानों में इतना ही बड़ा इंस्पिरेशन है, और इसमें कोई शक नहीं है कि आने वाले 5 सालों में वो लोग भी इसी तरह के पुरस्कार पाएंगे, क्योंकि देश अब तरक्की के रास्ते पे बढ़ गया है।
Let's move on with the show now. Ladies and gentlemen, we have a real treat in store for you all. A special panel discussion featuring as panelists the past winners of the EY Entrepreneur of the Year India Awards. So please welcome this glorious stage with icons of Indian industry.
Rumi said that we choose our joys and sorrows before we actually experience them. Let me extend that to entrepreneurship and say We choose our success and failures before we actually experience them as well. And these three gentlemen here on the stage with me have had their fair share of successes, but have also had some learning to do with many tough decisions that they've had to encounter and take during the course of their careers. So without further ado, let me start. And Sajjan Jindal, I'm going to start by asking you, as you look at what's happening around us in the world today, Mr. Jindal, do you see this as an opportunity or as a threat to India?
So we have two opportunities in front of us. One is to build this nation, India, which by itself is a huge marketplace, and we don't have to fear anything. We have to build it. We have to really put our best foot to build this nation and build it well. And we are very fortunate that we are at this time, we are here to build this country, and we are really doing it. Second is that we can really be a part of the global supply chain. Indian companies are very good at it. We have an extremely good cost structure. We have a very good skilled manpower, and we are already we are a very good supply chain partner of the world industry. And we need to really expedite that, and we have to expand that. So I'm very clear and very confident that we can really do that.
Reliance Subbiah, let me come to you as the winner of the World EOY Award. When you look at the India trajectory today, and I've heard you speak previously about looking at what's happened in China, and you believe China is going through its third phase of growth, where it's now focused much more on high value added as well as innovation. If you look at what's happening in India today, and we're talking about shaping India of the future, what's the role? Where do you believe we're in the cycle at this point in time?
Yeah, absolutely, Shreem. So I think that, if we look at our evolution, a lot of the growth in the first phase, came from either building things that we were used to. Even if we see industrial GDP formation, a majority of it came from the auto sector, sectors that have been in India for quite a while. But the new evolving sectors then also that have come about have been in the service economy, for example, with software development, with GCCs, all of that. But that still doesn't allow for product innovation. If we're actually going to become part of global supply chains, we need to be innovating products here, building products and components here. And that is a set of IP that needs to get developed in this country, which has to get done, I would say, over the next decade.
Mr. Mariwala, that's what you've spent your entire career on, sir. Your entire career at building Marico has been about innovation. It's been about focus. How do we create a culture of innovation? How do we go from being a services economy to, as Reliance Subbiah said, a product nation?
At an organizational level, it's very important that you create the right culture of innovation. And for that to happen, the biggest deterrent to innovation is the fear of failure. People are afraid to take risks because they fear that if I take a risk, and all innovations are not going to succeed. Many of them are going to fail, as you rightly put it, and failure is the only way to move forward. You learn from the failures and launch something else, which will be a bigger success. So remove the fear of failure, encourage experimentation, encourage risk-taking. It's the responsibility of top management, and have diverse talent. Diversity adds a lot of value to innovation within an organization. So you need to create a culture of innovation which is diverse, empowered, open, trusting. Remove the fear of failure and encourage your talent to take risks and experiment. Because only out of experiments you'll decide whether you'll succeed or not.
Well, to enjoying more success, and gentlemen, we